is indicating for our own Indian market, but all eyes will be on the Reliance AGM that is scheduled later today. But that's all the global market action. But how will all of these overnight cues impact our own Indian market? We now have our research team joining in with how the trade setup looks like and the F&O space. First up, Hormaz joins us to get us all the market cues we need to watch out for today. Hormaz, good morning.
Good morning, Vamakshi, and it's looking like a cautious start to the September series and has been the case all through this week as well, right? And if you see the benchmark indices as well over the last 4 days, there's nothing to write home about. The Nifty is down almost 600 points. The Nifty Bank continues to be the pain point, down almost 2,000 points in the last 4 sessions. Similar story playing out for the broader markets as well. The small cap index too facing a loss of around 700 points in the last 4 sessions. Now, it's the Nifty ended the series lower as well. All sectoral indices closed lower on Thursday. Now, and if you take a look at the contributors as well, it was IT that was giving some support to the index through this week, but it was IT that was the pain point yesterday. The banks were the pain points yesterday as well. And even for the week now, as a result of this truncated week, the Nifty is down almost 1.5%. The Nifty Bank is down 2.5%. The small cap index is down 3.5%. So it shows the kind of selling pressure that you have seen in the broader markets as well. Now, what has happened for the Nifty is that it closed at the lowest point of the day yesterday, somehow managed to defend 24,500, but that 78.6% retracement that you get from the lows of August of 8th to the highs of the 21st of August comes up to 24,512, and we are almost at those levels. So that becomes the first one to watch out for. On the downside, yesterday's low 24,482 becomes the first one for the Nifty to defend on the downside. And for the Nifty Bank, now it closed below the 54,000 mark yesterday, so getting above that and sustaining above that becomes the first challenge for the index. And the low of the 9th of May, which is 53,483, that opens up on the downside. Now that becomes another important level to watch out for the banking index. Today, of course, is the start of the September series. We now enter a new expiry cycle, NSE moving to Tuesday, BSE moving to Thursday, so that will be in focus as well. GDP data reporting later this evening, but all eyes, of course, as you mentioned, will be on the Reliance Industries AGM, and it was that intraday recovery seen in Reliance Industries that ensured that the Nifty somehow managed to defend that 24,500 mark in yesterday's trading session as well. So for now, the GIFT Nifty is indicating a cautious start to the September series. It will be interesting to see whether 24,500 holds today, but all eyes starting 2 p.m. on the Reliance AGM.
Well, absolutely, Hormaz. Of course, all eyes will be on the Reliance AGM. The GIFT Nifty for now is indicating a 14-point uptick. So a start minor in the green is what the GIFT Nifty is indicating so far. But, let's focus in on the F&O space then. Mangalam is here with cues from that. Good morning, Mangalam.
Good morning. So we kickstart a new series, after what was a very volatile August series, we start a September series. If you look at the last few series, we saw 4 series of gains, and thereafter in July and August, the Nifty has given up almost 1,050 points. So that's something we'll have to watch out for. And we're entering the September series. The September series is usually known for big moves on either side. September 2021, we had a near 1,000-point move. Last September itself, we had a 1,000-point up move. But amidst all of this, there was one September where we saw a decline of nearly 4% on the frontline index as well. So big moves on either side is what the September series is known for. And in that big moves, we have the FII positioning, which is at 8% on the long side, which is the lowest that we've seen at the start of this series. If you look at the rollovers, they've been higher than average. The open interest at the start of the series has been higher than the last few series average as well, at 1.6 crore shares versus an average of 1.44 crore shares. And the FII long exposure, that comes up for you on the screen at 8%. It's the lowest ever since the data has been revealed by the NSE. And this usually is not a big negative because every time the FII exposure has been low, as the table comes up for you, you would see over the next few series, you've seen a big up move on the Nifty. And the counter positioning to the FIIs are the clients, which are the HNIs. They are 72% long on the index futures. So April 2023, FII started the series with 9% long exposure. Next few series, we saw a 2,500-point move. November, we had an 11% exposure. The next few series, the Nifty saw a 2,900-point move. And then we had February 2025 as well. The FII started the series with 11% long exposure. The next 5 series saw a 2,300-point move on the Nifty. So what could be the triggers that could take the market higher? Starting today, we have the Reliance AGM. Any word on value unlocking with sheer weight on the stock and the underperformance that the stock has seen perhaps could lead the market higher. We have the GST rate rationalization that come in. any positive move on India-US trade talks could be a big upside trigger for the market. And then you have the US FOMC meet as well, where there is a rate cut which is expected. Impact of heavy rains in the north on demand and pre-festive buying is something that we'll be tracking, which may impact the EPS going forward too.
Well, thank you so much for that, Mangalam. Absolutely, we'll be watching on for the all-important September series then. But, let's, focus back on Reliance because the 48th annual general meeting is set to take place later today. My colleague Reema joins us with a brief overview of what to expect from this time's meeting and what the street will watch out for. Over to you, Reema.
So the AGM is always important because it sets the tone for the company's growth for the next year. And very often we've had big bang announcements. So what is it that the street expects? One, timeline on the Jio and the retail IPO. This was first mentioned by Mukesh Ambani in 2019. He said an IPO will happen in 5 years, but that was pushed back as the company is more focused on strengthening the business. Secondly, in the last AGM, Mr. Mukesh Ambani laid out an ambitious roadmap, doubling Reliance Industries, by FY30. It also included doubling retail and Jio in the next 3 to 4 years. So how does the company get there? Then thirdly, on the new energy, because new energy is seen as the next big growth driver. So clarity on timelines, how much can it contribute to overall Reliance's financials, the earnings potential? Fourthly, expansion plans. The company is always big on expansion. So whether it's in retail in terms of fast fashion, quick commerce, in terms of the digital side of the business, whether it's on the space side, more than 40% of the subscribers are already on 5G. They have an ambitious plan of hitting 100 million broadband subscribers. And even on the pure O2C, the traditional business, the company has lined up massive capacity expansion. And finally, in terms of the stock price, it's up 14% in 2025, but it's still 11% below its 52-week high of 1551.
Well, thank you so much for that, Reema. And you can catch the comprehensive coverage of Reliance Industries AGM starting this afternoon at 1:30 p.m. But on that note, let's slip into a very short break. Up next, we get you exclusive details on some likely GST rate reforms that are expected in next week's meeting. So don't go anywhere. Welcome back. You're watching Power Breakfast on CNBC-TV18. Now, the latest on the GST front. Sources say the group of ministers on rate rationalization are likely to table Centre's proposal do away with 12% and 28% slabs. My colleague Timsy brings us all the details. Timsy?
Well, that's right. What sources are indicating to us that the upcoming GST Council meet, which is scheduled to meet on 3rd and 4th of September, the Centre's proposal on rate rationalization is up on the agenda, and the group of ministers on rate rationalization has put forward the Centre's proposal, which includes reducing GST on hotel accommodation of less than or equal to 7,500 rupees per night from current 12% with ITC to 5% without ITC. Beauty and physical well-being services proposed to be reduced from 18% with ITC to 5% with ITC. Admission to cinematography films where prices are less than 100 rupees are likely to be proposed to be reduced from 12% with ITC to 5% with ITC. The proposal is also to hike rates on services from 28% with ITC to 40% with ITC on admissions to casinos, race clubs, sporting events like IPL, race club services, betting, casinos, gambling, horse racing, lottery. On the other hand, when it comes to the business class air travel, over there we are likely to see a hike from current 12% with ITC to 18% with ITC. The Centre's proposal is also to reduce certain items from 28% to 18%, which includes cement, which is a key item there. Also, there's a proposal on transportation sector, which includes cars, automobiles. Over there, something that we need to know. Petrol, LPG and CNG driven motor vehicles of engine capacity not more than 1200 cc and less than 4000 millimeter length proposed to be reduced from 28% to 18%. Diesel driven motor vehicles up to 1500 cc and up to 4000 millimeter length proposed to be reduced from 28% to 18%. Three-wheeled vehicles proposed to be reduced from 28% to 18%. Motorcycle of engine capacity not exceeding 350 cc proposed to be reduced from 28% to 18%. The parts, automobile parts, accessories for motor vehicles proposed to be reduced from 28% to 18%. Where there's a hike on this particular sector, station wagons, racing cars, motor vehicles of more than 1200 cc and 4000 millimeter of length to see a hike from 28 to 40. Aircrafts, helicopters, aeroplanes for personal use, yacht, other vessels, motorcycles with more than 350 cc, again a hike from 28% to 40%. Let's see what all happens when the council meets.
Well, thank you so much for that, Timsy. We indeed will be watching out for the GST meeting, which is scheduled on 3rd and 4th of September. But let's take a look at what happened in the US market. The S&P 500 scored another record close on Thursday as traders pored over Nvidia's earnings results and forecast. The Nasdaq ended the day up by 0.5%, while the Dow Jones also closed at a record high. CNBC's Angelica Peoples gets us a wrap of all the action on Wall Street.
U.S. markets were up across major indexes in Thursday trading, thanks in part to strong GDP gains in the second quarter. The Dow closed at a record high, gaining 72. The S&P 500, which also closed at a new high and hit 6,500 for the first time ever, gained 20. And the tech-heavy Nasdaq added 115. The U.S. economy grew faster than expected in the second quarter as consumers continued to spend despite tariff volatility. The Commerce Department on Thursday announced GDP rose at a 3.3% annualized pace. It's the second estimate produced for the most wide-ranging measure of economic activity. The initial estimate pinned GDP growth at 3%. And Nike announced Thursday that it's laying off about 1% of its corporate workforce in CEO Elliott Hill's latest move to realign how teams are structured across the company. Since taking over, Hill says that he's been trying to reverse ongoing declining sales, reignite innovation, and win back partners. Shares of Nike are down about 14% so far this year. That's what's happening here in the U.S. Back to you in Mumbai.
Angelica, thank you so much for that. University of Pennsylvania's Loretta Mester also talked about the importance of Fed's independence. Let's listen in.
Right now, the markets are focused on the short run and not the long run, which is precisely why you want to have an independent monetary policy making central bank. The central bank focuses on the longer run and setting interest rates, or the short-term interest rate, to help the economy meet price stability and maximum employment goals. It doesn't focus only on the short run. And that's because monetary policy affects the economy in the long run. So the fact that the markets haven't reacted strongly actually underscores the need to make sure that we maintain an independent Fed and in terms of their monetary policy making.
Morgan Stanley's Andrew Sliman, meanwhile, believes the future for stocks is looking bright as earnings estimates are on the rise. Let's listen in.
The future for stocks is looking pretty bright right now because earnings estimates in general are going up. And I think, and certainly the AI sentiment and the very large companies in the S&P that are very much focused on this, that's where the best earnings revisions are coming. So I think the stock market is acting very rational here in terms of rewarding the best fundamentals, and the best fundamentals seem to be in these very, very large companies.
And JP Morgan's Gabriela Santos adds that the magnitude of earnings beat this quarter has decelerated, which has led to a rotation within the AI theme. Let's listen in.
I think what's been interesting from the summer has really been the rotation within the market. So clearly these mega cap tech companies are doing very, very well. Incredible earnings. It's just the magnitude of the earnings beats have been decelerating. And so you're seeing a nice rotation within the AI theme to also include software infrastructure and, of course, to include physical infrastructure, including utilities, industrials. So it's already moved on to that new phase of the theme, which is really encouraging.
Well, on that note, let's slip into a very short break. Up next, we get you cues from the commodities market, so don't go anywhere. Welcome back. You're watching Power Breakfast on CNBC TV18. We now have our colleague Manisha Gupta joining us with all the updates from the world of commodities. Good morning, Manisha. What are you watching out for?
Well, thank you for that. I'm looking for silver prices because while we are trading at a near 1 month highs in the international markets, but for the Indian silver prices, we are trading at an all-time highs. Well, MCX has made an all-time high above 117,000 rupees a kg, while for the spot markets, we've already seen 120,000 rupees a kg come into the market. Well, there is strong China industrial demand. There is very strong Indian investment and industrial demand as well. And remember, we are looking at a fifth year of deficit in the global markets when it comes to silver. The strong retail buying and very strong investment demand is something that really seems to be supporting silver. So while the physical buying has been strong, we've seen the silver ETF demand also on the stronger side, and that clearly has been supportive. The other thing that has continued to gain up has been the crude oil prices, up nearly 1% overnight. Remember, the U.S. inventories have seen a decline. The tariffs on India at 50% with 25% of a penalty also seems to be keeping international markets jittery. And then it also is about Russia, Ukraine stepping up attacks on each other's energy sector, infrastructure, etc. And that seems to be supporting not just crude, but gasoline, heating oil, distillate prices. All of that is trading at a multi-week highs at this point.
Well, thank you so much for that, Manisha. But moving on, heavy rainfall and flash floods have wreaked havoc in several parts of North India, causing significant damage to infrastructure. The Jammu-Srinagar National Highway remains closed for the fourth day after heavy rainfall triggered landslides in the region. Over 600 vehicles remain stranded. The death toll in the Union Territory has already crossed 40, with the Vaishno Devi landslide accounting for most of the fatalities. Several places in Himachal have been battered by the rain as well. The NDRF is carrying out rescue operations in Kangra and Chamba districts. A portion of the Chandigarh-Manali highway was washed away. More than a dozen villages in Punjab continue to remain inundated due to the overflowing Peace River. Schools in Fazilka, Jalandhar and other districts remain shut. The Indian Army deployed its advanced amphibian mobility vehicle for its rescue operations in Amritsar. More than 8 people have been killed in rain-related incidents in Chandigarh. Well, moving on then, Prime Minister Narendra Modi is on a 2-day visit to Japan to participate in the 15th India-Japan Annual Summit. This is the Prime Minister's 8th visit to Japan and first annual summit with his Japanese counterpart, Shigeru Ishiba. The External Affairs Ministry has said that the two Prime Ministers will review the special strategic and global partnership between India and Japan. In the second leg of his visit, PM Modi will also travel to China from August 31st to September 1st to attend the Shanghai Cooperation Organization Summit. He is expected to hold bilateral meetings with several leaders attending the summit. He will also meet Russian President Vladimir Putin on September 1st. Well, with that, that's all the action that we have on this edition of Power Breakfast. Don't go anywhere. Pasar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Friday morning, last day of what has been basically a very, very hectic week. It's a holiday-shortened week. But guys, did you feel like there was a holiday in between?
They did not feel like a holiday. In fact, the way the markets moved, it looked like there were 3 more days added to this week this time around. But you know, the good part is that not only is it the last day of the week, but it's also the first day of a new series. And a lot is riding on the September series in terms of news, cues, and a lot of the developments that may so happen. So we'll discuss all of that, I think.
Absolutely. And I mean, festivities galore. They continue as the Ganesh festival revelries are all over. Plus, of course, the big bonanza, and we'll spend a lot of time today on the show talking about it. Tim C's story, all the possible GST cuts that have been moved in that bill. Of course, what comes through the council, we'll see. But I think it just adds to the festive fervor if indeed some of those cuts come through.
Lastly, all mostly on expected lines.
Yes.
This is what we are what I saw: auto, cement,
yes.
consumer durables, etc.
Daily consumption items coming down to 5%.
You also just have to look at the couple of details that may come by, in the sense that how much of that is without input tax credit, with input tax credit. So I think a lot of the chartered accountants this
9:30 a.m.
after
going to ask the question.
We'll have put a lot of pen to paper, I guess.
We'll have the details coming up. Let's just quickly get to what you need to know as we begin the session. So first up, right, US equities, I'll start there, jumped to a record high. Basically from the session lows, markets recovered quite a bit. And solid economic data, which we will refer to. So S&P was up 1/3%, NASDAQ was up about 0.5%. The 10-year macro market's quiet. 10-year yield down about 3 basis points. Oil was up about 0.5%, so nothing very much. So the data, second quarter GDP was revised up from 3% to 3.3%. The expectation was that it'll be revised up to 3.1%. So it was a beat. And the jobless claims number, which the market got in the US, was also pretty benign. You'd wonder with this kind of data and this kind of macro market reaction, etc., why was the dollar, why did the dollar go the other way? The dollar index was down 0.5%. So we are now under 98, 97.9. The 50-day moving average is around that 98 level for the dollar index. So actually, the weak dollar is one of the strongest opinions out there on Wall Street. The dollar will weaken. On pretty much else, there is a fair bit of debate, etc. But I think there is using a political term, bipartisan kind of consensus that the dollar perhaps is headed lower. We'll see. But this is important for us as well. It's a determinant. I mean, it's not that it's mattered quite a bit. FIs have been still big sellers, and we'll get to flows, etc. in just a bit from now. But keep an eye on this one. Now, Fed Governor Lisa Cook, of course, filed a lawsuit against Trump. She pushed back earlier as well when Trump said, well, she has to go. Later today, we get core inflation, July core PCE inflation. That's essentially what the Fed's favorite inflation gauge is. Monday is a market holiday in the US. Cash markets are closed. Futures are open, but they shut early. So in that sense, I mean, you're going into a US-less sort of weekend when you come back on Monday. Market positioning, and Mangalam, of course, will look at the F&O stats more closely. But a cursory sort of glance with the expiry yesterday suggests that the positioning, etc., is largely similar. FIs continue to sell about $4.5 billion in cash. Locals continue to buy about $9.5 billion in cash. But FIs continue to add to and build index shorts. $600 million worth of index shorts added in this particular series. And of course, the retail public seems to be pretty upbeat with the index long addition, etc. As I said, more granular data with Mangalam in a bit from now. Of course, I mean, now we are running into the September 3rd, 4th GST meeting. Center is proposed, and we'll put all those rates, etc. As I said, they're largely in line with expectations. So I'm not going into details here. Timsy will address that in just a bit from now. But that's the trigger. The big overhang still remains, of course, that 50% tariff from the US. And how the market will be able to navigate that, I think, is the real question. Without a doubt, I think that remains the bugbear for markets, which I think will prevent any upsides. Will the market sell off from here is the question, and that brings me to levels here. So we basically on the Nifty closed firmly below the 20-day moving average. As of day before yesterday's close, we were kind of just under it, hovering around it, but yesterday's close broke it decisively. I put this level out yesterday as well. First stop is 24,337, which is the 8th of August low. And I think that's the first stop. Bank Nifty is close to a weekly lower band, which is 53,563. The support here is the 50%. If this goes, that is 53,563. The 50% retracement of the rise comes into view, which is 52,692, 52,700. Basically, it becomes a support target, however you want to look at. And of course, I mean, the 20 days, the trailing upward level, which is 56,370 for the Nifty Bank as well. So just, I mean, some levels to work with as we kick this last session for the week out. GIFT Nifty will give you a sense of how we are starting, about 14, 15 odd points higher. So it's quieter as compared to what we had yesterday morning. Mangalam is with us on the wall with the F&O stats. Mangalam.
Well, I'll set the September series up for you first by telling you what happened in the August series. We saw a range of nearly 1,000 odd points, and thereafter the August series, the Nifty ended about 270 points lower, taking July and August losses to a cumulative over 1,000 points. And as we enter September series, history tells you that September series is actually known for big moves on either side. So September 2021, we had a near 1,000-point move. Then there was a 700-point decline the next September. Last September itself, we saw a near 1,100-point move on the upside on the Nifty. So the series is known for big moves. And known for big moves, what are the positionings suggesting right now? You know, the rollovers have been on the higher side, telling you that the conviction on the short side has been higher, 84% versus 78%. Even the open interest on the Nifty at the start of the series at 1.6 crore shares is higher than the 3-month average of 1.44 crore shares. So higher rollovers, higher conviction. What does that imply? It implies that those who were bears have actually increased their bearish positions. Prashant just said that, you know, the FI positioning hasn't changed. Well, it has for the obverse. In fact, at the start of the August series, the FIs were just 10% long, and now they are just 8% long. And 8% FII long exposure is actually the lowest in terms of long exposure at the start of the new series. Ever since the NSE has started revealing that data, their net exposure is nearly 1.7 lakh contracts on the short side. Who are the counterparties to the FIs? We have our domestic retail clients and HNIs, 72% long exposure, 1.27 lakh net long exposure for them as well. Is FII shorting necessarily a bad thing? Perhaps not, because I was looking at data. You know, in April 2023, the FIs were long at just 9%. Over the next 4 series, we saw a 2,600-point move on the upside on the Nifty. November 2023 and Feb 2025, the FIs started the series with just 11% long exposure. The next 2 to 5 series, we saw 2,300 to 2,900 points on the way up for the Nifty. So not necessarily a bad thing, especially given the triggers that we have going forward as well. So the last 2 series, we've seen an 1,100-point decline on the Nifty. Now we start with the biggest trigger. Today we have Reliance AGM. With the sheer weight of the stock on the index, any positive news could spur a bit of a rally. Then we have the GST rate rationalization, India-US trade talks. Even as the overhang continues, any sort of resolution may trigger a bit of a rally. We'll watch out for that. And thereafter, towards the second half of the month, we have the US FOMC outcome that will come by. The first rate cut is expected out there. You'll see pre-festive buying, and also keep an eye out on impact of heavy rains on demand on the ground. So all these factors together will be ingredients for the September series. Known for big moves, the FI is just about 8% long.
Okay, well, let's take a look at what's happening across the Asian markets. And Asian markets are mixed shade, actually, as we speak. Some of the markets, China, Hong Kong, for instance, they're still flashing green. There's some profit-taking going on in Japan. There was inflation data that came out of Tokyo today. And the rise in inflation is not as much as what was anticipated. So those are some updates. By the way, on FPIs, and I'll put up that data in just a bit, the FPI cash market trends are really interesting, and they've simply mirrored the delays that have taken place in the India-US trade deal, which of course still hasn't seen the light of the day. And as we're rounding up this month of August, the selling is almost 29,000 crores in the cash market. So it's progressively increased from July. And I will put the numbers up in just a bit. Let's get started then with the equity call of the morning. Chris Wood of Jefferies says Jerome Powell's Jackson Hole speech has been interpreted as dovish by the markets. He says the message conveyed was that the Federal Reserve will prioritize the labor market over inflation. He adds if the likelihood of a 25 basis points cut on September 17 has risen, this also means that the next payroll data due to be announced on September 5 has become more important than usual. Meanwhile, he says the inflationary pressures from tariffs are only just starting to show up. On India, he says one chance or one change will be made in the India long-only equity portfolio this week. The investments in Aditya Birla Real Estate will be removed and replaced with an investment in M&M. So that's Chris Wood saying that they're giving a thumbs up to M&M in that portfolio change. Well, let's take the conversation forward. Folk Heen, senior investment strategist at Standard Chartered Bank, is with us. Folk, great to have you with us. So, I just want to focus exactly on this, on how you're looking at a market like India now, because it's been underperforming, the currency has been under pressure as well, and that trade deal is still elusive. But do you think the worst is already factored in the way prices are shaping up here in India, or could there be further downsides?
Yeah, hi. Morning. Good to be here. Thanks for having me. I mean, yeah, we do get a lot of questions about India from clients asking, is it a good time now? It's pulled back. Is it a good opportunity to add aggressively? Look, I think we are looking at it as a core holding. We think it is good for the medium term. But in the short term, the headwinds, sure, you have tariffs, but I think we all know that for the equity index, sales in the US is just about 8%. So India's the revenue and earnings is very much domestically focused. So the direct impact is not so great, actually, in terms of the sales into the US. And even then, a lot of its IT services, pharma, which is exempted from tariffs at the moment. So it could affect sentiment in terms of the headlines that we're getting. It could affect currency volatility. It affects the risk sentiment there. But fundamentally, the tariff impact, in terms of the direct impact, is not so much of a concern. But what is more of a concern we see actually is the earnings revision. And earnings revision actually has been negative. And we saw that post-earnings season, it is still negative. And for a growth market like India with a high valuation, we think that we really need to see earnings momentum pick up and earnings revision turn positive in order for flows to come back in there. So we do still like, I think, the medium-term story. And the earnings growth is still at very high levels, I think mid to low teens at the moment. So it is still good on an absolute basis. It's just that the momentum is still a bit weak in the near term. So what we are saying actually to a lot of clients, investors, is that it is good to accumulate for the long term, but in the near term, because of this, I think you don't have to be aggressive in terms of accumulating it. It is a core holding for us within Asia. And the preference at the moment we have within Asia as with China and Korea, where valuations are a bit more attractive. And so that is our preference at the moment within Asia ex-Japan.
So you prefer China and Korea to India right now, but India you believe is part of your core holdings and you would like to accumulate at current levels, and the momentum is not on the side of the bulls for India. But what about, the markers that you're watching out for that may perhaps turn the momentum and make you a little more attracted to India versus, say, something like a China or Korea?
Yeah, I think the markers, the key one really would be earnings revision. I think we see that valuation has come down and, it is off its peak, but compared to the 10-year average, for instance, it is still above the average. So valuation hasn't really come back yet. But look, I think in the past, we've seen India being at high valuation and still being able to perform well. And it's really because of the earnings story. And we think that, the tax cuts that has been trying to implemented by Modi and the government, that is supportive for consumption. But we're not seeing that flow through yet in terms of the earnings. So I think it's really back to earnings revision. And that's the key thing that we see. On a relative basis as well, of course, with China and Korea, those markets have been doing well recently and this year. And I think that a lot of it is because of the valuation. It is still cheap. And then the catalyst in terms of the AI investments and what they are doing with DeepSeek previously, that really spurred a re-rating in China. So in China, it's a re-rating of the valuation, really, from the AI developments and policy stimulus. And then in Korea, it has done very well, but we still see more to come. I think the government there with the KOSPI 5,000 target, then the improvements in corporate governance. So again, valuation is still cheap there at a big discount. So on a relative basis, we still see a bit more momentum for these two markets. relative to India. But India is something we watch very closely because the medium-term story is great, but it's just getting the short-term headwinds. Once we see earnings revision turn positive, I think that would be a good time to get in there.
Okay, all right, Fook, we'll leave it on that note. Shorter conversation today, but thank you very much for giving that important view on how you're looking at India amidst some of the other regional markets as well. Thanks for joining in. We'll take a very quick break, come back on the other side. More news and updates coming in, including our spotlight on the big story, GST cuts. What can be expected and how will the market perhaps interpret all of this? Back with that in just a moment. Welcome back. Well, let's get to that big story as promised. Our sources in the government are indicating that the group of ministers on rate rationalization is likely to table the centre's proposal to do away with the 12% as well as a 28% slab. So what we're talking about essentially is a two-tier GST structure. Timsy has a lot of details on at least what the proposals are. Which are the key items, key categories which could shift perhaps lower to 5% and where the tax incidence perhaps could go higher? Timsy, tell us more.
Well, that's right. What sources are indicating to us that the upcoming GST Council meet, which is scheduled to meet on 3rd and 4th of September, the centre's proposal on rate rationalization is up on the agenda, and the group of ministers on rate rationalization has put forward the centre's proposal, which includes reducing GST on hotel accommodation of less than or equal to 7,500 rupees per night from current 12% with ITC to 5% without ITC. Beauty and physical well-being services proposed to be reduced from 18% with ITC to 5% with ITC. Admission to cinematography films where prices are less than 100 rupees are likely to be proposed to be reduced from 12% with ITC to 5% with ITC. The proposal is also to hike rates on services from 28% with ITC to 40% with ITC on admissions to casinos, race clubs, sporting events like IPL, race club services, betting, casinos, gambling, horse racing, lottery. On the other hand, when it comes to the business class air travel, over there we are likely to see a hike from current 12% with ITC to 18% with ITC. The centre's proposal is also to reduce certain items from 28% to 18%, which includes cement, which is a key item there. Also, there's a proposal on transportation sector, which includes cars, automobiles. over there, something that we need to know. Petrol, LPG and CNG driven motor vehicles of engine capacity not more than 1200 cc and less than 4000 millimeter length proposed to be reduced from 28% to 18%. Diesel driven motor vehicles up to 1500 cc and up to 4000 millimeter length proposed to be reduced from 28% to 18%. Three-wheeled vehicles proposed to be reduced from 28% to 18%. Motorcycle of engine capacity not exceeding 350 cc proposed to be reduced from 28% to 18%. The parts, automobile parts, accessories for motor vehicles proposed to be reduced from 28% to 18%. Where there is a hike on this particular sector, station wagons, racing cars, motor vehicles of more than 1200 cc and 4000 millimeter of length to see a hike from 28 to 40. Aircrafts, helicopters, aeroplanes for personal use, yacht, other vessels, motorcycles with more than 350 cc, again a hike from 28% to 40%. Let's see what all happens when the council meets.
A comprehensive list out there, Tim C. Thanks a lot for that. Let's see indeed what actually does come by. But you've given us a fair indication of what is on the minds of those who are making the decisions out there and how that would impact, or what would the implications of this be. At 9:35 a.m. today, stay tuned to CNBC TV18. We have Najib Shah, who is the former chairman of the Central Board of Excise and Customs, joining us, along with Prateek Jain of PwC. He will join us as the group of ministers on rate rationalization is likely to table the centre's proposal on the two-rate structure. But for now, let's get the stock impact of GST developments with Gurmeet Chadda, Managing Partner, CIO, Complete Circle. We'll also connect with Jyoti Gupta, Research Analyst at Nirmal Bang Institutional Equities. Gurmeet, good morning. Always a pleasure speaking with you. What do you think have been the highlights out here? I mean, I was looking at some of the hotel business because, 7,500 rupees from 12% turns to 5%, but it's the with and without input tax credit that makes a bit of a difference. Of everything that Tim C suggested could be on everyone's mind, what are some of the standout features for you?
Yeah, hi, Mangalam, good morning. Always a pleasure. I think, some of the measures are obviously welcome. See, the private final consumption accounts for 60% of the GDP. So any boost in consumption, along with income tax cuts which have come in, as well as the welfare benefits government has done in the rural part especially, will augur well. But I just hope that there are not too many, rejig rather than final cuts. So eventually you want more money in the hands of consumer and not too much of a rejig just to compensate, moving items from, let's say, 28 to 18 and or 12 to 5, and then, so I don't want to see too many things in the 40% slab because that will then dampen the spirit, because luxury consumption is something which has also been a contributor at the margin. I think cement clearly looks to be a winner. I also think two-wheelers clearly and smaller cars seem to be a winner. I think paper, textiles, especially apparel, less than. I think there's a price threshold getting increased to 2,500. So, your retailers will gain. I think what could probably be a bit of a dampener could be more things in the 40% slab. So that's what I want to do. Hotel, I think, is travel and hotel has been one of the top themes as far as consumption is concerned. We have lemon tree in the portfolio. There's been very sharp movement in the stock in anticipation of what is going to come. So as far as 5% slab comes without ITC, I think it's fine. I think more importantly, Mangalam, from a broader consumption theme, the inverted duty structure needs a look. See, there are a lot of classification disputes also in GST. If you meet any GST tax consultants, they'll tell you. Second, because of the inverted duty structure, again, there are a lot of host issues. So you want input and output, taxes to be aligned so that broader benefits gets passed on.
Got that. Gurmeet, good morning. And Jyoti, good morning to you as well. We'll do, let's take sector by sector, right? And Jyoti, thanks for joining us. For cement, right, what we're picking up is that the centre is proposing that the GST rate be cut from 28 to 18%. What does it mean for companies? What does it mean for stocks that you cover, Jyoti?
Hi, thank you so much for having me on the show. So there are two parts to it. While currently, if you see, the demand is anyways muted, it's anyways going to pick up over the quarters. It's a seasonal impact. But when it comes to GST, there are two parts to GST. When you're reducing it from 28 to 18, it will have some impact on the operating incomes of the company, and that could be offset by increase in demand in the later part of the year, maybe next year. But if you ask me positive, yes, you could have extra money in the hands of the consumers, but that does it mean immediate, coming back into the economy in terms of cement consumption? Maybe, but with a lag. But not
Jyoti, have you done any sensitivity analysis on if, say, prices were lower by 5%, how much do volumes increase by? Prices were lower by 8%, how much do volumes increase by? And the other side, because if the GST is coming down from 28% to 18%, one would impact a price rationalization of at least 3 to 4%, right?
Actually, this kind of sensitivity is possible only if you have a consistent demand. That's where you see, if the demand goes down, if the prices goes down by 5 rupees, then possibly the demand would increase by 2%. But in India, cement is it doesn't follow that kind of trend. And if you are reducing the GST, and in a scenario where demand for a full year is expected to be around 6 to 7% and not around 9 to 10%, I think what I'm going to see is, anyways, South has already seen a rollback of almost like 15 to 20 rupees, while the rest of regions are already a reduction of 3 to 4 rupees. But that's an ongoing basis. It's part of the industry. So, in fact, the industry has already taken an increase in prices in the South region by 20 to 30, and that should eventually get, absorbed in the quarter.
So, short point is that this news by itself does not make you tweak your estimates or your model.
Absolutely not, because I've already taken in a very base case scenario. Even if that happens, it's not going to spike the demand. I don't see 7% or 6% going to 10%. Even if it happens, maybe it could happen with a lag, and possibly you may see an impact in FY27. But if you ask me in terms of the impact of GST on the operating income, yes, the companies which have just recently commissioned and plants in 1 to 2 years, last 1 or 2 years, and likely to have, they will possibly see some impact within their from the GST.
In terms of cost workings, etc. Got that. Jyoti, just coming back to you, Gurmeet, autos, because that's where the focus is, right? Has been from a market point of view as well. Stocks, by the way, have done well. If you just look at this series that just expired yesterday. Small cars, 28% to 18%, right? Then the other bit is for luxury cars, which is greater than 1200cc, there is a hike to 40, but GST is already 40. There is plus a cess. So the logical assumption is that the rate will be 40 and the cess will be subsumed. Because right now, effective rate is up north of 55%. If that is the case, if cess is subsumed and the rate is 40, and since the market has moved to these larger cars, 1200cc plus, do you think it'll be it'll give a big fillip? And by the way, for parts, seats, accessories, and these graphics will come up. The proposal is to cut from 28 to 18%. So just run us through the three segments and what you would do from a stock point of view. Small cars, luxury cars, and auto components.
Sure, Prashant. So I don't think so, the effective price. I think effectively the price would be slightly lesser or same as far as the above 1200cc is concerned. I'm not too sure on the extreme luxury end, which could be, let's say above a certain price threshold, and not just the engine, like, the Beamer and the Mercs of the world. So starting from the lower end, so for example, two-wheelers, I think are a big beneficiary. I think and that's coupled with good rural demand. We're already seeing month on month two-wheeler numbers being better than, four-wheelers. So and there is some valuation comfort. May not be as much in TVS because TVS has got re-rated over a period of time. But even in a Bajaj Auto, it's sub 9,000. Hero also, despite the run-up, you're getting it at, mid-teens in terms of valuation. So any pickup there with good festive demand coming, price reduction, something in the hand, lower rates, all of that combines well. Ancillaries will benefit. We've already seen Uno Minda made a new high yesterday. 40-45% of the product mix is towards two-wheelers. We saw Lumex made a new high at 4,300. Then there are companies like Sandhar Technologies, which have a larger two-wheeler portfolio. They make frames for the bike. They make locks. They are now coming up with the fabrication products as well. So you got to map the value chain there. I think the two-wheelers and tractors to me. Tractors, again, I think it may move down from maybe effective rate can move down. It's already, I think, at 18. It can come down to 5. I think 12, if I'm not wrong. So that's another one we want to look at, especially the farm equipments as well. Four-wheelers, I think, barring Maruti, we'll have to see. As I said, we'll have to see. It's not negative. My sense is it will be positive, and cess would be removed. Only the effective rate would be less than what the final rate is today. So M&M, I think, remains a top pick. I also think now M&M is the second largest player, Prashant. Now it's above of Hyundai, and I'm doing a lot of. One of my clients is one of the largest dealers for M&M in North. I think despite this rates announcements, one segment, one car maker where the demand is still holding up better than others is M&M. So SUVs, I think they're at 27% market share.
Yeah, and there's still more positive calls coming in. We had one from Chris Wood of Jefferies just today. They've added M&M to the portfolio, making some changes. So even at these levels, there are people showing the thumbs up on M&M. Got that point. Gurmeet, on consumer, what would the what should the approach be from a stock perspective? Because I was reading on a whole host of a lot of things, including, for instance, toothpaste, talcum powder, hair oil, shampoo, dental floss, soap. All of it is moving from 18% to 5% if these proposals go through. On the flip side, you have caffeinated beverages, carbonated beverages containing fruit juice, etc. They could be moving up to the 40%, sin level. So purely from a consumer standpoint, then of course there are durables, consumer durables, ACs, etc., where again it could be cut from 28% to 18%. Now, how much is left in terms of the stock play? If you look at the last 1 month, for instance, a stock like Blue Star is up 8%, Trent is up 4%, but a lot of others haven't moved at all. So purely from a consumer stocks perspective, what would you buy? And if there is something that you perhaps really need to avoid now, I don't know, if Varun Beverages has an overhang now, for instance, if this goes to 40%.
I think so we need to divide it between core and tactical. I think tactical, some of it could be FMCG. We've seen some run up in HUL after some decent numbers, right? And stock hasn't done anything for 3 years. Nestle, again, because the food portion is higher. You have to also see where the packaged food could benefit, right? Within FMCG, you have to also break it down. So something like a Nestle, like a Tata Consumer, which has less carbonated drinks, more beverages. Something like even a BKG, where probably the food portion would be 65-70% maybe. So that could come under a more core portfolio with enhanced demand. Similarly, something like Trent, where the price point is not more than $9.99. Stock has corrected from 8,000 odd levels to 5,000. Still expensive, but growing. You get that 25-30% growth. Market needs to see growth in this kind of environment. So that could be there in the portfolio. I think hotels, travel platforms as well. And something like an internal, Swiggy, Nykas of the world. So I think you play that in terms of core, new age, traditional, and then there's a structural demand coming. Tactical could be, some of the names which haven't done well in FMCG, where I don't see 10% volume growth coming back. You can have a Lever, you can have a Daburs of the world, and play tactically. And then, once you've made enough money, maybe move out of it.
So to sum it up, Gurmeet, the best way to play these upcoming GST cuts, you would say some auto names like M&M. I mean, leave us with your top 3-4 names.
So, I think two-wheelers, Bajaj Auto and TVS and Uno Minda in terms of ancillary. You can take M&M and in four-wheelers, maybe a bit of Maruti. Again, hasn't done much if you see last 6-7 years. Platform play, Eternal, Swiggy and Nykas of the world. And I also think Jio Finance, some of the NBFCs will come part of this as a broader consumption play. And travel. Any further price correction in Indigos of the world is again welcome.
Very useful, very, very useful, Gurmeet. Thank you for joining us early morning and appreciate you being with us. Jyoti, thank you very much with that very sharp view on cement as well. So thanks, both of you, for being here. What we'll do is we'll just run you through, just for one with the focus to commodities and what's top of mind there. Manisha is joining us for a quick sense of that. We'll go across to her. Manisha, morning.
Thank you for that, Prashant. I'll start with the crude oil prices, where we've seen almost a 1% of gain overnight. Well, crude oil prices have had a lot going for itself. To begin with, the U.S. crude inventories have seen a very sharp decline. You have gasoline trading at a 4-week highs in the U.S. market. And then the Russia-Ukraine have stepped up attacks on each other's energy sector and infrastructure as well. And the markets are now looking at a weakness in U.S. dollar index as well. That in turn also has been supportive, not just for energy, but many of these metal names as well. So you have gold prices trading at a 5-week highs. Silver in the Indian markets is trading at an all-time highs. It's a strong gain coming back for the ferrous metals, where steel and iron ore prices gained up overnight as China is looking to curb production for steel between 2025 and 26, supporting both of these metals pairs.
Right, take that point. Manisha, thanks a lot for that. Let's get to the top brokerage calls of the day. Sudarshan joins in with his list. Sud.
So, good morning. So, Kotak Institutional Equities has upgraded Clean Science and it has upgraded to buy call, and target has given of 1370. It believes that risk reward ratio for the company is now favorable and the stock has fallen 20% last 1 month after 24% stake was sold by founding family. It believes that company also has healthy pipeline of projects and believes that stock might move upward going forward. Next one is Apollo Hospitals. HSBC has a buy call and target here is 8,520 per share. It says hospital segment stands on a firm ground and volume and efficiency are sustaining the growth, and focus areas going forward are going to be progress in 24/7 cost break-even and corporate simplification of corporate structure. Jefferies has written on consumer financials. It says loan demand stays subdued. Stress has increased across sectors, including MSMEs, due to slowing macro. But it has also talked about some of the positives. GST rationalization can lift demand in select segments and aid small truck operators, and pick up in economic activity and lower rates should ease pressure in H2, and that may help in net interest margin, and it sees an expansion in NIM in H2. And top picks remain Bajaj Finance, Chola Investment and Shriram Finance, and Muthoot Finance for Jefferies remains a defensive play.
Okay, all right. So we'll keep all of those stocks on our radar. Thanks for that. More brokerage views coming in and some model portfolio changes. And there are changes both in Jefferies, as we just saw in that equity call this morning, as well as Morgan Stanley's made some changes. Let's bring in Nimesh to understand what's going in and what's going out. Nimesh.
I said, it's not more about what's going in and what's going out, but I believe autos will be in focus. Of course, we've reported about the GST rate cuts, but interestingly, both the big global strategists, Chris Wood and Jonathan Garner, have added the Indian auto names into their respective model portfolio. I'll start with Morgan Stanley first. So Jonathan Garner has today added Maruti to their GEM as well as the Asia Pacific focus list. Now they believe that Maruti is likely to benefit, is going to be the biggest beneficiary of the GST reforms, because 50% of their volumes come in the small cars, and also the earnings have started improving. And the Morgan Stanley India auto analyst believes that Maruti can deliver double-digit revenue growth in FY26. So that's a big call on which they've added Maruti to the focus list. Coming on Chris Wood. Chris Wood has written a note today, and he's added M&M to the India long-only portfolio by replacing Aditya Birla Real Estate. So two big additions in the auto names in India from two big strategists, and both are from the auto sector. So autos will benefit not only from the GST rate cut, but the push coming in from the big global strategists as well. So Maruti and M&M will be in focus in today's market.
Okay, all right. Nimesh got that. Thanks very much. So we'll keep those stocks on our radar. We need to take a quick break. On the other side, we get to our first corporate conversation of the day. Samhi Hotels is the company we're putting the spotlight on. The management will join in to talk about an agreement that they've signed to lease 260 rooms mid-scale hotel in Hyderabad's financial district. So we'll find out more with Ashish Jhakanwala in just a bit.
Welcome back. You're watching us here on Bazaar Morning Call. Let's get our first corporate conversation underway. Samhi Hotels. The company has signed an agreement to lease its 260-room mid-scale hotel in Hyderabad. Ashish Jakhanwala, who's the chairman and managing director, along the CEO of the company, joins us now. But beyond just this, we'll focus on three important points. One, the annual revenue, obviously, from the Hyderabad hotel. What's the investment, the ROI out there? But more importantly, the second quarter, can we expect some sort of improvement in occupancies and ARR? And most importantly, the impact of GST rate rationalization, as it were, as Timsy has been pointing out for the hotels itself. Ashish, thank you so much. Let's take the last talking point first, which is the GST rate rationalization impact. What we gather from our sources is that there could be, for rooms upwards or up to 7,500 rupees, which are currently 12% with input tax credit, we move to 5% without input tax credit. How does that change things for you? Because, 5% without input tax credit, a lot of people would say is similar or perhaps worse to 12% with input tax credit.
So I think GST, people are taking a very myopic view of the impact on the hotel sector by looking at what direct impact will it have on the hotels, depending on the average room rates. And you're absolutely right. I think the devil is always in the detail. So we do need to see how the text looks, whether the input tax credit is there or not there. But listen, what's more important is that the rationalization of the GST will necessarily boost domestic demand. And that will have a significant impact on, the occupancies and the demand for the hotel rooms. I am keenly watching the text of finally what comes for the hotel sector. Well, one good news is, and this I understand this whole about input tax credit, but the good news for Samhi is that a lot of our hotels are in mid-scale portfolio and will therefore benefit if the tax rate was to go down to 5%. But a bigger excitement which spans across the portfolio is that the boost it gives to domestic demand. And Samhi as a company today, over 75% of our business comes from domestic market. Just about 25% comes from international. So I think overall, we need to look at the net impact of GST on our business, not just through the room rate, but also through who the consumers are for the business.
But Ashish, take your point completely, but just to understand this, out of your total keys right now, could you give us a rough percentage to work with? How many would be where the ARR, average room rate, is just below 7,500, if indeed that becomes a threshold?
So what I think in terms of number of keys, you will actually see over 60-65% of our rooms coming from hotels which would sell less than 7,500 rupees. This would be all Holiday Inn Express, bunch of Fairfield by Marriott's. But in terms of revenue contribution, I would think about 45% of our revenue, because they tend to have lesser revenue per key. But 45%, 50% of our revenues will come from hotels which have an average rate of less than 7,500. I mean, again, let's be cautious. We need to really understand the subtext, because our business is highly variable. We do end up pricing a room thrice over in a single day. And in the same day, a room can be priced in the morning at 7,500 and in the evening at 8,500 rupees, right? So I would advise caution about when people start interpreting the impact of GST on our sector. But what does not need interpretation is that the domestic demand, if that get boosted, I think we have a lot of gains coming, post-October.
Sometimes between clicks, the room rate changes. Ashish, hi, morning. But for a moment, right, that number is useful as a framework to think broadly. I mean, and we will not hold you to exact numbers. But what could be the impact? I mean, it's not just the GST on hotel rooms, but also, I mean, it's a cumulative impact. I understand that. But as you see it now, over a 12-month period, what could this do if these are the rates that we put out?
And if it is 5% without input tax credit, that could be detrimental overall, wouldn't it? Or I mean, just spell it out for us on what it could mean if there is no ITC and a bulk of your inventory is at 5%.
Yeah, so I think, when it comes to the impact of GST and this whole component of input tax credit, right? As I mentioned, I think generally the reduction in the GST will be very helpful, irrespective of how the ITC is treated, really. Of course, it will be really helpful if this new caveat is not inserted, because then you get the real direct benefit. But I think, if we were to ignore ITC for a moment, because we exactly don't know how they're trying to interpret that, but we really think that the reduction in the GST, both for our sector and sectors that feed demand into us, could probably add another 10-15% to our total demand,
All right. 15% to a total demand. That's right. Got that.
In terms of
And,
revenue, Prashant, in terms of revenue. I meant in terms of revenue, actually,
10 15% to your revenues.
Correct.
Okay, and this is with ex-ITC as
That's
well.
right. That's right.
All right. Okay. Take that point. So that's about the GST. We'll obviously await, clarity on this once the text is out, and obviously, we'll ask you to join us then as well. We've taken that promise from you. But for now, the 260-room hotels that you've signed an agreement for in Hyderabad, you are looking to invest about 125 to 140 crores on fit-outs, etc. out there as well. What do you think would be the annual revenue of, this hotel? By when does it start getting accumulated? Because I was doing some rough math here. A 260-room property, if it does about 75% occupancy at 5,500 to 6,000 rupees a room, because it's mid-scale, you would do about 30 to 40 crores in terms of annual incremental revenue. Would that be fair?
I love how you don't need hotel consultants nowadays, But no, I think the concept that we're looking at in Hyderabad is currently at an average rate of about 7,500, 8,000 rupees. We expect this hotel to deliver a top line of about 70 to 80 crores with a net margin, property level net margin of about 42, 43%. Don't forget, this is a variable leased asset, which means a percentage of the revenue will be paid out as a rent to the owner. So adjusted for that, we would expect that we would potentially get to about 35 odd crores, 30 to 35 odd crores of net operating profit from this hotel. So it's about a 70 to 75 crore top line asset. It's a great location right next to the under construction Google campus. I think we're very excited about the prospects of this.
70 to 75 crore. And how much do you pay as rent as a proportion of sales?
We don't want to disclose exact numbers, but in the zip code of about 12 to 13, little bit around 12%.
All right, Ashish, always a pleasure speaking with you. 12 to 13% is what you perhaps would be paying as rent on this hotel. Could be a 70 to 75 crore revenue property, which may add about 35 crores to your profitability over a period of time. We will obviously await details coming in from the GST Council on the rates for hotels. With that, we'll take a short break, come back, discuss more on the markets, fundamental stock talk lined up with Devin Choksi. Stay with us.
Okay, welcome back. I think Devin Choksi is with us, Managing Director at GR Choksi FinServ. Devin, good morning. Thanks for waiting. Appreciate you joining us. Devin, the story, of course, that we broke last evening is the GST rate cut and the specifics which the centre has proposed. I just want to make it clear that everything we are putting out is, of course, everything which the centre is proposing. The GST Council has to decide on it, and they're meeting, of course, early September 3rd and 4th. Your sort of top 3-4 ideas based off what we've been discussing, what you've seen we put out, Devin, what benefits the most, and where do you think stocks have upside?
Yeah, Prashant, good morning. Well, interestingly, I think we have been putting our focus on the discretionary spending, and probably I think we are more comfortable with auto ancillaries at this point of time. Believe that I think there is an inherent proposition for growth in this particular area of activity because of two factors. One, higher amount of disposable surplus in the hands of individuals, and also I think the lower interest cost, which is basically allowing people to spend money, I think, through the borrowings, as far as I think the buying of the vehicle is concerned. And on the top of it, if one is getting the advantage of lower GST, particularly in the premium models of some of the four-wheelers, the OEMs, I believe that I think that could possibly be signaling the larger amount of profitability portion for some of these companies, because they will be assuming certain amount of pricing power due to the GST, I think, benefit available to them. So in my viewpoint, I think the business condition looks really which could possibly benefit more.
Okay. Hi, Devin. Good morning. Great to have you on the show today. So we've discussed a lot of GST, of course, but the other big event of the day, of course, is the Reliance AGM. And shareholders are, of course, going to watch out for a lot of announcements and perhaps look out for any cues or clues, if at all, in terms of more value unlocking, and maybe that Jio IPO, if at all we get any indications of that. So, Devin, let's do one thing. I think we've got Rima joining in with a quick synopsis, a quick heads up of what can be expected from a market perspective. And then we'll ask Devin about the stock. Rima.
So the AGM is always important because it sets the tone for the company's growth for the next year. And very often we've had big bang announcements. So what is it that the street expects? One, timeline on the Jio and the retail IPO. This was first mentioned by Mukesh Ambani in 2019. He said an IPO will happen in 5 years, but that was pushed back as the company is more focused on strengthening the business. Secondly, in the last AGM, Mr. Mukesh Ambani laid out an ambitious roadmap, doubling Reliance Industries, by FY30. It also included doubling retail and Jio in the next 3 to 4 years. So how does the company get there? Then thirdly, on the new energy, because new energy is seen as the next big growth driver. So clarity on timelines, how much can it contribute to overall Reliance's financials, the earnings potential? Fourthly, expansion plans. The company is always big on expansion. So whether it's in retail in terms of fast fashion, quick commerce, in terms of the digital side of the business, whether it's on the space side, more than 40% of the subscribers are already on 5G. They have an ambitious plan of hitting 100 million broadband subscribers. And even on the pure O2C, the traditional business, the company has lined up massive capacity expansion. And finally, in terms of the stock price, it's up 14% in 2025, but it's still 11% below its 52-week high of 1551.
Okay, all right, Rima, thanks very much. Just a reminder, so the AGM kicks off at 2 o'clock today, and we'll be live with the coverage 1:30 onwards right here on CNBC-TV18. So all the perspective, all the views on the direction ahead of the company and its various businesses, all of that. So we go live 1:30 onwards. Devin, now you tell us, what's your call in terms of, any major announcements that you're watching out for, and of course, a view on the stock as well.
Yes, Sophie. Well, I believe that I think the important part here would be that you already have the consumer-facing businesses with about 50% contribution to the EBITDA, and balance 50% comes from the industrial businesses, including oil to gas and oil to chemical businesses and exploration businesses. So I think from a perspective of looking at the consumer-facing businesses separately getting listed, it's a good chance that one could possibly ask for that 25,000 crore worth of EBITDA in the retail business, 65,000 crore EBITDA in the Jio platform business, put together about 90,000 crore kind of a proposition against the overall total EBITDA of around 1,75,000, 1,78,000 crore for the other businesses included together. I believe that I think this is one area where probably I think one would be very keenly looking at when they get listed. Should Jio platform get listed with even 5% dilution, assuming that about 10 lakh crore kind of a market cap they assume? I believe that I think this would be the largest listing that one could possibly go for at around 50,000 crore kind of a fundraise on 5% dilution. So in my viewpoint, I think this is going to be an interesting proposition, not only from the listing, but also from attracting some of the large investors globally into this particular space. So really keen to look at some of these things unfolding. Along with, I think the AI implementation that they have been doing, which is giving them the advantage of implementing some of the businesses faster and giving them confidence to double the size in 3 to 4 years' time from now. That is what I think one is keenly looking at as to how they're implementing the AI part in each and every business vertical. So these are the two areas where I'm keenly observing some of the developments.
All right, Devin, thank you very much for joining us. Quicker conversation, but useful as always. And we'll have you back up after the Reliance AGM. And of course, that's at about 1:30 today afternoon. We'll take a quick commercial break here. We're going to come back and we'll get you some technical trading ideas. Sudeep Shah and Vinay Rajani are going to be with us on the other side. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. Less than 15 minutes to go for market opening. We have the pre-open rates coming in right now as well. We'll wait for them to settle. It's just been about 15 odd seconds. So in the meanwhile, let's go to our technical experts. Sudeep Shah and Vinay Rajani join in now. Obviously, these are rates that you can totally ignore. A 280-point downtick, not one step in line with what the GIFT Nifty is indicating. And obviously, early days in the pre-open as well. So we'll watch out for where it settles. The GIFT Nifty was suggesting a 15-16 point uptick. Let's get in Sudeep and Vinay. Sudeep, good morning. Yesterday there was a big gash. In fact, over the last two trading sessions, the Nifty is now firmly below the 20-day moving average. Where does it go from here? And with the kind of FII positioning that there is at the start of this series, do you see any upside triggers, or do you think it's consolidation in a ground perhaps lower?
Good morning, Manglam. Manglam, absolutely. The last point which you just mentioned about the FII positioning is extremely important here because if we see, this was one series, the August series, wherein the FII positioning was somewhere around 10 to 15% on the long side, and this is the lowest that we have seen sustaining for the entire month in last several months now. Last, in fact, over 1.5 to 2 years. So this is one important point that we cannot miss, and we need rather than just trying to do any bottom fishing or trying to buy on every dip. I guess we should be now just eyeing for some important resistances on the upside and let that cross, and then one should start positioning properly on the long side. So for me, that level now would be 24,730, 24,750 on the upside, slightly positional, but yes, this is an important level which needs to get crossed for a revival of the upside. Now on the downside, 24,300, 24,350, the mid-month, the initial part of the August series where there were few lows printed over there around 24,300. Now that becomes a very important support zone. So in case we sustain below this 24,300, then further downside up to 24,000 also cannot be ruled out. So all in all, while the current pre-opening also is suggesting some kind of a minor downtick, 24,300 initially will act as a support, and below that 24,000, 24,050 also is quite likely.
Okay, all right. I think now we're settling down, but just 2 minutes into the pre-open session still, so I think we'll have to give it some more time. Gentlemen, good morning. Vinay, what about you? How are you looking at trade?
Yeah, good morning. So basically 670 points fall in last 5 trading session in the Nifty. So definitely technically market is looking weak as it is placed below the key moving averages, and derivative rollover data is not also not suggesting any encouraging data for the bulls. So Bank Nifty especially has seen a 50% higher short rollover in the Bank Nifty. So it is looking weak. But at the same time, as we have been discussing, the FI's long to short ratio, almost 92% of their position in the index future has been on the short side. So that is also can act as a contrarian indicator once any positive news or positive sentiment turns. So basically, there is a support around, as Sudeep suggests, there is a support around 24,300, which happens to be around the 200 days EMA in the previous swings low. So there is a weakness, but I think immediately we can see Nifty going towards 24,300, and after that I'm expecting a pullback rally and bounce back. And in bounce back, we need to see whether it is crossing the crucial hurdles. As of now, we are asking our traders to hold on to their short position with a stop loss of 24,700, which is yesterday's high. So yes, it is looking weak. As far as trading ideas are concerned, Musgao Dock is looking weak. So September future can be shorted around 2626. I would suggest a stop loss at 2675. On the downside, 2550 should be the target. And second pick can be taken in the HCL Tech on the short side, which is looking weak. So 1448 was the yesterday's close in September future. 1478 should be the stop loss, and 1410 should be the target on the downside.
All right. And Sudeep, your individual stock picks, what would they be?
Manglam, two stocks now, both of them have been doing well in the August series where the markets have been negative. So the first one is Titan. Stock, if we see on the weekly as well as the daily charts, is on a sustained uptrend. The weekly charts suggest that 3,300, 3,400 has acted as a support, and since then, last 3 weeks, we have seen a stable uptick in this, and the stock is almost at the highest level of the month. What we feel is that from the current levels, 3580 could act as a decent support on the downside till 3580, 3585 holds. On the upside, Titan could see levels of 3700, 3730. The second stock that is there on our radar is Polycab. Now, even this is one outperformer in the last series. While a lot of mid caps have seen battering, this stock has held on to its important support zone closer to 6,700, 6,750, and has broken out above 7,000 on the upside. So we feel now from here on, this zone of 7,000, which was the breakout zone, will act as an important support. And this stock could be bought with a stop loss at 7,100. The upside targets, the stop loss would be 7,000, and the upside targets would be 72.60 as well as 73.30.
Okay, all right. Sudeep and Vinay, thank you very much, both of you, for joining us with that with those trades, the setup, and of course, what to do. Now things are improving a little bit. We're down about, 18 points on the Nifty. The Sensex is down about 85 points. Some delivery data. Hormuz is here with the big moves yesterday, and were they backed up with delivery stats? Hormuz, morning.
Morning, Prashant. And Vardhaman Textiles, we spoke about the stock yesterday on closing bell as well. And the volumes that we saw yesterday on that 13-14% surge, almost 2.5 crore shares. Never before has the stock traded in such volumes in a single trading session. The 20-day average in comparison to the 2.7 crore shares traded is just 5.75 lakh. So it shows the heavy volumes, but the delivery volumes, only 4% of those total, that is around 12 lakh shares were marked for delivery out of that 2.7 crore that were traded, compared to a 20-day average of just 1 lakh shares. Now, Reliance India is the other one. That the reason for highlighting these two names, the next two ones, are the fact that the stocks moving higher are doing so on very strong volumes, but the stocks falling are not doing so. Now, Reliance is down 11% in the last two sessions. Yesterday's traded volumes, 10.5 lakh shares, lower than the 20-day average, and the delivery volumes of 4.2 lakh in line with the 20-day average. So not higher or not lower either. CSB Bank 2 was a stock that was declining on lower volumes. Yesterday was down 5.5%. The Tuesday's volumes were higher because of the inclusion in the MSCI, and that was the adjustments that were related to it. But yesterday we saw around 3.9 lakh shares. The 20-day average is just 7.1 lakh, and the delivery volumes as well, only 1.7 lakh were marked for delivery, compared to, which is half of the 20-day average of around 3.5 lakh. A stock bucking the trend in this regard is Vishnu Prakash Munglia. That fell yesterday on very strong volumes. 13 lakh shares were traded yesterday, 20-day average of 4 lakh, and almost 6.6 lakh shares marked for delivery, compared to a 20-day average of just 1.5 lakh. And the stock, as a result, has now slipped below its key moving averages, and it's even hurtling lower towards its IPO price of 99 rupees.
Okay, so Vishnu Prakash, not too much Prakash, at least on the upside. All right, thanks very much for that. 7% decline this week. Thanks for that, Hormaz. Let's quickly get to Ramesh now. He's here with the standout brokerage note of the morning. Ramesh, which one is it?
As Sir said, today's standout is on financials. A big report from UBS, and from a stock specific, they've upgraded Kotak Mahindra Bank to a buy. I'll come to that, but first on the overall sector, UBS believes that the financial sector profit pool is likely to double in the next 5 years. So that's a big call. And within that, they expect the non-lending businesses, which is the AMCs, the wealth managements, they are likely to outperform and outgrow by nearly 1.5 to 1.7 times compared to the traditional lending businesses. So on back of that, which is why they've upgraded Kotak Mahindra Bank to a buy. In fact, within the NBFCs, they prefer Chola as well as PFC, and within the insurance space, they like SBI Life. So that's overall in the financial sector. Now, coming specific to Kotak Mahindra Bank, as I said, UBS has upgraded the stock to a buy from neutral, and they've raised the target price in Kotak Mahindra Bank to 24.50. They believe that Kotak is the best play on the financial services space thanks to their various subsidiaries. So that's what they believe. From a margin and cost perspective, they expect the gradual ease going forward. And on the back of superior growth and superior ROA, they expect the re-rating to continue in Kotak Mahindra Bank. So a big report on financials, but within that, they've upgraded Kotak Mahindra Bank to a buy now with a target price of 24.50.
All right.
Okay, all right.
Thanks very much for that. I just want to, just pull up three stocks. We should look at what the pre-open has ended. We should put up Maruti and Mahindra & Mahindra. This is, of course, on the back of the GST, all the changes we've been discussing from 8 o'clock. Maruti is flat. Mahindra & Mahindra is down 0.4%. Maybe a Uno Minda, auto parts, right? Gurmeet was talking about where, of course, 28 goes to 18%. Nothing very much at all so far. Okay, let's look at Lemon Tree. We had Samhi Hotels with us, but Lemon Tree, under 7,500 rupees a night, 12 becomes 5% without ITC, 2% higher on Lemon Tree. I mean, this is representative of the sector. We'll look at others as well. Maybe look at PVR. But here, I mean, it's just for cinema tickets priced under $100, 12% to 5%. Nothing very much. Look at Indigo as well, where for business premium class, 12 goes to 18% with ITC. And maybe just like one or two cement names where GST is being cut from 28 to 18%. This is, there are various, you can look at sector by sector implications, etc. But broadly, this is well telegraphed, which we've been reporting for the last, of course, this has now gone through as a proposal, and that's an exclusive which we broke. But in the sense of what we reported in terms of actual changes sector by sector, these are largely in line with expectations, market expectations. So remember that as you look at these stocks opening up. Surabhi.
And also, Prashant, if you just look at the market over the last 1.5 odd weeks since the 15th of August, which is when the first announcement happened, and we had a big pop immediately after that. And then the law of marginal diminishing utility seems to be being applied, because if you see reactions across the board, even shoemakers like, whether it's Bata or Liberty, because the threshold in the proposal is that it could be increased to 2,500. You're seeing 1.5% kind of moves, 0.5% here and there. Nothing very dramatic because of GST. But let's stay with the same conversation, because we know that consumer durables could be a big beneficiary as well if indeed that proposal of reducing the GST rate from 28%, further down to 18% actually comes through. Hiten Mistry, sector lead consumer at Aquarius Capital, is with us. Then how would you look at the whole durable space? Some of the stocks like Blue Star, I was looking at it earlier, it's already rallied 8% this month, I think, in anticipation. But will this be a meaningful fillip in demand? Because anyway, at least the AC makers have had a really rough start to the year.
So hi, morning, Surabhi, and thank you for having me. I'll tell you about the sectors, 28% to 18%. Certainly, it's a positive impact, Surabhi, and it is poised to make consumer durables more affordable and thereby stimulating demand and enabling industry growth. So I'll quickly tell you, like, consumer durables divided into three things: white goods, brown goods, and consumer electronics. Brown goods, which are small appliances, microwave, cooking range. Consumer electronics consist audio and video devices. Both comes under 18%, so there is no significant momentum there. But strong momentum may come in a white good, which consists like washing machine, AC, refrigerator, etc. And certainly because average order value for that also on a higher side, right? So certainly this changes will increase and anticipated demand is high. And not only to the consumer, but I believe business and overall Indian economy will also encouraging consumer-led growth.
Right. How much will the rate cuts impact demand by? How much would the incremental revenue, according to you, be for all these products?
Yeah, so I believe that 12 to 15% additional demand should come in this particular category where it's fetching 28% GST.
So your analysis for this year, your projections for this year, for the festive season stand increased by how much, if at all the rates are announced with effect immediately on September 4th, say?
Yeah, so see, considerable optimism regarding this substantial increase in consumer durable during this festive season also, plus the rate cuts also. As I mentioned, 12 to 15% additional demand may pump up for this.
12 to 15% additional demand.
That's for the annual this thing. So festive season obviously increases by a lot more because of seasonality, right?
Seasonality, yeah, correct. But festive season may sorry.
Go ahead.
Go on.
Yeah, so you'll see that festive demand you'll see in the third quarter, because we are already at an August month, which is in quarter 2. So that demand you may see in the third quarter. But overall, you'll say at annual level, 12 to 15% additional pump up will come for sure.
And how much upside in stocks, Hiten? Looking at valuations, ultimately that's what people want. If this is meaningful demand bump up, mera stock chalega ki nahi chalega? So when you're talking about the durable space?
So as a compliant, I can't speak about stock, but for the sector specific, I'm very, very bullish on the consumer durable segment.
You know the reason why we ask you about festive season specifically and not the annual, because the first part of this year was impacted by unseasonal rains, right? So you think that this cut will make do all the losses that we saw in the previous part of this year, which is the first and the second quarter so far?
Yeah. So see, consumer durables, it's not like so as I mentioned that 12 to 15% as an annual level. But if you see the festive season,
right? I'm sorry, I have to butt in. We will continue this conversation. Apologies, we're just hitting market open. First rate starting to come through, 24,495. The bank Nifty is absolutely flat. The Sensex is flat. The small cap index is yet to open. That's not 1.5% down. It'll just start to, yeah, there you go. So now it's slightly higher. It's absolutely flat actually. So first rate starting to come through. Mid-cap index is up about 22 odd points as well. Now we'll start to do this, stock spotting, right? What's moving, how much is moving across sectors on the back of GST and otherwise in just a bit. The Nifty heat map is up on your screen. You've got, 35 odd names which are higher. The rest of them are down in the red. And Kotak Bharti on one end, and there is Mahindra and Shriram Finance on the other end. Shriram Finance, by the way, was one of the big losers yesterday as well, meaningful losers yesterday as well. 50 higher on the Nifty now, so 24,545. Surbhi.
You know, Shriram Finance, Prashant, this week has lost about 8%. So perhaps it has something to do with some inputs talking about stress building up in MSME, and if there is a second order effect of tariffs, etc. Perhaps that could explain some of it, but there's a meaningful decline on the stock this week, down another 0.5% today. The other one that's actually started lower is Mahindra & Mahindra. Despite all the positive brokerage notes and Jefferies turning optimistic on the stock, it's opening down about 2%. M&M has also lost about 5% for this week. But overall, the Nifty is not looking bad at 40 points higher. So let's see what's taking it higher. A whole bunch of consumer stocks. There's Nestle, there's ITC, there is Lever, there is Asian Paints. If you look at autos, and names like Tata Motors are doing actually pretty okay. Jio Finance is up about 0.5%. Tata Steel, by the way, there have been reports about China cutting back on its steel capacity to reduce the overcapacity and the glut in the market. That seems to be favoring names like Tata Steel as well. Reliance ahead of the AGM up about 0.5%. So all in all, fairly strong. And Kotak, of course, reacting to the positive brokerage commentary as well, up 1.5%. So overall, it's not a bad start at all for the Nifty. Mangalam.
Not a bad start at all for the Nifty. For the broader markets as well, we have nearly 3 stocks advancing for every stock which is declining. Obviously, it's early days at the open itself, but it's a secular FMCG rally that we're seeing. Colgate is up around 2.5% in the broader markets. We have Dabur, which is 1.5% higher. Godrej Consumer, another one which is about 1.5% higher as well. On the way down, we do have Nykaa, which is down about 2.5%. Paytm is also seeing some bit of profit taking, and thereafter we have SBI Card and Phoenix Mills, both of them down by about 1.5% and 2% each. PNG Health from the broader markets has been doing well all through pre-open as well. This month it's up around 12%, currently sitting with a gain of close to 5%, and we have some sort of volumes building up on that one too. Relaxo Footwears, there is expected to be some relief coming in at the lower end of the footwear segment for GST, and Relaxo Footwear obviously has the lowest average selling price in the listed footwear universe. So that stock up around 4.5%, has been a struggler when it comes to returns to shareholders. So maybe some bit of bump up is what we're seeing from the lows. Bata is another one which is up around 2.5%, even though the company is looking to premiumize their portfolio. A large part still comes in from the sub-1,000 rupee category. So that stock too is up around 2% right now. Then you have names like Force Motors. Prashant was speaking about the auto space. Cartrade Tech is the other one which is up 3%. And Kitex Garments is the one which has announced a new plant that they'll start producing from the Telangana plant. So that stock is up around 4% after seeing a big gash this week. It's down about 12% for the week despite the 4% up move that we're seeing right now. By and large, more stocks advancing than the number of stocks which are declining.
No, absolutely. And, we'll spot more as we kind of sort of go along. But it's 24,540 on the Nifty at this point in time. And we're about 30-odd points in the green. Let me welcome in Tahir Badshah, who's with us. Tahir is Chief Investment Officer at Invesco Mutual Fund. Tahir, good morning. Great to have you with us here. We've spent the last hour or so talking about what we broke yesterday in terms of the story, specific proposal from the government to the GST Council on what the centre would like to see. Of course, the GST Council has to decide. What to your mind, Tahir, from a GST perspective, which sector, I'm sure you discussed this internally, what's your thought process? Where will this show up the most meaningfully? And distill it down to sectors from a stock market point of view. Tahir.
Yeah, Prashant, so I think it's quite obvious, and there's been a lot already discussed around this, and we know that essentially the slabs which are merging, which is basically the 28% and the 12%. Those are the ones which are actually going to see the maximum amount of benefit. And by and large, I think what has been conveyed and also been supported by the council is that most of the items in these two categories will move into the other two. So I think by and large, it is more or less determined by that some of those products which are in these two categories, basically the 28% and the 12% will be the largest beneficiaries. And I think if you distill it down product-wise, the obvious gainers are basically in the two-wheeler and in the auto space in general.
particularly as far as two-wheelers and some of the four-wheelers also are concerned, especially at the entry level or the value segment of the market. Those will be obvious beneficiaries. There will be also some of the staple products which will also benefit, although many of these did happen to be in the 5% category. So there will be a relatively lesser number of products which will probably be beneficiaries. But these are the two main segments of the market which should gain as a result of this.
Got that. And as we speak, these are the segments of the market which are doing extremely well as well. The top three gainers right now, as I see, are HUL, Asian Paints and ITC. Britannia thrown in there as well. Obviously not a part of the Nifty anymore. Tata Consumers, the other one, which is higher. So the top sectoral gainer is the Nifty FMCG, which is currently at the high point of trade. Tahir, ever since the budget announcement, the street was expecting a shift from capex to consumption. Do you think that was investable then and is investable now as well? Or do you believe that money will be made only as of now in the capex plays, given the sort of problems that overall consumption, especially at the staples end, is facing right now and the valuations at which these stocks are trading?
So Mangalam, when the first benefits were announced as far as taxation were concerned in the budget, that was essentially a bit of a starting point as far as a move towards consumption is concerned. It did not really happen at the expense of industrials to a large degree. It did for a while, especially during the time when we had that bit of the slowdown shock, and that the public spending was a little weak as well. But I think since then, since let's say the start of this fiscal year at least, we've seen even the industrial segment do reasonably well, thanks to the fact that even the government spending has held up pretty well during this period. But now that we are, we have this reasonably big boost coming on account of GST. There are still a little bit of question marks as far as the funding is concerned, and to that extent, it needs to be seen as to whether the government has enough levers in the budget to be able to kind of support both the segments. I would like to think that at this stage, it should be possible for the government to support consumption as well, without actually deviating significantly from the fiscal path, especially if we were to probably avoid the tariff-related hit. I think if that were to probably also compound, as it looks like as we stand today, then probably things get a little tougher, and we'll have to see as to where the government's priorities lie, whether they have other avenues to be able to kind of make up for the shortfall and support both the segments so as to make it a twin-track economy.
Okay. Got that point. By the way, I'm just looking at the fall on Mahindra and Mahindra. Stocks down about 3%. There is no fresh news as such. And this could be a complete off-tangential shoot, but let's not forget that there are very, very big political meetings coming up over the weekend, the SCO summit and Prime Minister Modi's bilateral meeting with his Chinese counterpart as well. And a lot of thoughts have been tossed and thrown up in the air, including the possibility of opening up to more Chinese investment. Could it something like BYD be making in India as well? Again, this is all conjuncture at this point in time till we have anything definitive from those meetings. But perhaps that could be at the margin, something that is kind of in people's mind this morning. M&M down about 3%. Tahir, hi, morning. And actually, let me toss that to you. Maybe it's a question slightly ahead of time. But it's very, very clear that while our trade relationship with the US has gone into a cold storage, there is clear momentum and clear effort to revive a trade and business relationship with China. Now, do you see any implications, even at a broader level, at a surface level right now, for the listed ecosystem, whether it's our electronics companies, Amber and Dixon's of the world, whether it's automakers? How should one start thinking about this? Because the shift seems to be in the making.
Yeah, it looks like clearly, and obviously it is born out of some of the circumstances which are surrounding geopolitical environment today. And I think at one level it is perhaps a bit of a shift in our own policy as well. And I think over a longer term it should hold up well. It should probably take away some of the shadows which surround Chinese investments and ability to probably have bilateral trade at a more meaningful level. It also probably lifts a little bit of the constraints from a few of the industries, some of the manufacturing-oriented industries, in order to be able to source raw materials and so on, so components, etc., as you mentioned. So I think it will free up some of the the supply chains which otherwise could have probably impacted India even more. I think we know that there are we probably are at this stage likely to see two supply chains develop around the world. They're already developing around the world essentially. One is a US supply chain and the one which is centered around China. And I think we'll probably have to see as to how we want to align ourselves. We've been significantly aligned on one side, and maybe we want to probably, there are some of these overtures that we are making in order to make sure that we are part of both the supply chains, at least for the foreseeable future. So I think diplomatically, it is a good move, in my view.
Tahir, absolutely, completely agree. But is there a risk of Chinese products undercutting Indian products? I mean, what's worked in many sectors, and these are high P multiple sectors, right, is import substitution. And if we are going to get stuff from China, they're going to get stuff from us. And I guess the market access here is a big one. Any thoughts?
I would think that, there are much of what we actually import out of China is essentially more of the raw materials, intermediates, certain components, etc. And that I think should not necessarily hurt us in terms of it affecting some of our local manufacturers, at least some of the finished goods product manufacturers. And in certain areas, we also have reasonable safeguard duties in order to ensure that pricing is not hit in the local market. So we'll have to see how that goes. But it's at this stage, Prashant, as you know, it is very incremental. We are seeing defreezing happen at in things like ability of Chinese professionals, Chinese nationals to be able to access India, to come to India, to be able to support some of the local manufacturers and so on. So that is the level of thawing of relations. We'll have to probably see how that further develops, but I don't fear that as much at this stage.
Right, we take that point. Tahir, in as many words as you can say without spelling out individual stocks, I have to ask you about Ola Electric. That definitely has been the stock of the month, up around 38%. The reason why I say that is because, one, from a government standpoint, there is the push that is coming in on two-wheelers and two-wheeler ownership. And the second part is the push that is coming in on electric vehicles as well. Add to all of this, the underlying fundamentals of the company, at least from what we saw in the first quarter results, seem to have been improving, along with the additional benefits that they get from PLI as well. Now, this is a high-risk bet. The stock has already seen a correction. Despite the rally that we've seen of 38% this month, the stock is still half from its 52-week high. How would you approach a space like this, which is fraught with risks, but, has seen such big moves?
So I think there are a couple of players which are, investment opportunities which are there in this space. And while we may not necessarily, as a matter of disclosure, have any exposure to Ola Electric in our portfolios, but we, again, as a matter of disclosure, we do have, exposure to, let's say, something like Ether Energy in our portfolio. So I think, by and large, we just to convey the point that we are optimistic about this space, and there will be players whom we'll back depending upon where do we see the strategy to be well placed, and the growth opportunity is still there in our view. So I think there's one segment which has held up reasonably well in the market for much of the players, even over the last some time, despite the fact that there's not really a big push as far as any other incentive is concerned. Of course, the government is now once again a little more amenable towards the segment, but otherwise it is having its own momentum simply because it is now trying to gain a larger part of the market share in the two-wheeler space.
That's on the EV side, Tahir. What about overall renewables and solar? Because there's a big fierce debate out there, right? And we've got a new listing that's just happened, and then there are companies like Wari, etc. And the debate is whether this is going to be only a short-term story till there is just overcapacity in our market. Of course, the companies say that they have a long runway of growth, but what do you believe in?
So I think it will be a typical scenario where we will probably see a burst of growth for the first 4-5 years, maybe the first 5-7 years, perhaps, if not more, and then probably the growth will kind of maybe level out and trend more towards averages. So I think it's a typical scenario of businesses which are in the early stages of of the growth cycle, and those will be there will be obvious beneficiaries. But I think these are also segments which have got other complications, especially with regard to imports, and and in that regard, we also know that some of these stocks have done well recently, simply because of the fact that we have moved closer to China, and once again that dynamic is at play out here in the very short run. But I think we are taking it step by step. We think that many of these companies, especially in the renewable space, both the product manufacturers as well as the EPC companies are in for that benefit of that very short, very strong burst of growth in the next few years, and then obviously we take it from there.
Right.
Okay, all right.
Tahir, thank you very much for joining us. Good speaking to you. I just want to, I'll toss to you. Just a quick word. And this is, basically pre-positioning, or whatever you call it. The auto index is the top losing sectoral index right now. So stocks are up between 15 and 20% if you look at the August series. So in anticipation to the GST cut, stocks, auto parts, autos, everything, OEMs, so 1% lower. Guess what the index which is the up the most? It is FMCG. FMCG index is up about 1.5%. And here you've got Colgate, which is up 4%. Britannia is up about 3%. HUL is up about 1.5%. Godrej Consumer is up 2%. Dabur is up 2%. So, buy the rumor, sell the news. That kind of story playing out, at least as far as auto is concerned. Clear, a big run over the last 1 month.
It looks like you see the auto index over the last 1 month of August, it's been up 5-6%. So therefore, now the profit taking perhaps setting in. And, like I was saying earlier, the law of diminishing marginal utility. So perhaps some shift happening to FMCG.
So perhaps some shift happening to FMCG, but for FMCG, it's more not by the rumor and by the news as well. This is just, there has been an underlying shift which everyone is expecting to come by for the FMCG space. And it has to be, put in context with the kind of underperformance that the FMCG stocks have seen as well. So we've been talking about the fundamentals of the sector, seeing some signs of improvement for the last 2 quarters.
And that was this whole conversation was on even before the 15th of August, before that speech.
Yes, so which is what exactly, is playing out in the FMCG space. But a couple of stray moves, particularly on Colgate, I'd like to bring, everyone's attention. The fear of the street was, and as, reported earlier as well, that maybe there would not be any incremental cut coming by on toothpaste. So it'll stay at 18%. But now that MC has said that it's going to come down to 5%, there is an extra relief that is coming on that. But we also need to, again, put these things into context with regards to the penetration of the category. It's not that if my toothpaste becomes 2 rupees less, I will brush 4 times a day. The underlying demand situation has to be kept into context.
Buy
more paste and brush more.
Irrespective of the price, you do that.
Okay, actually on that note, let's get to the experts. GST is absolutely dominating headlines this morning. And we have 2 subject matter experts now joining in to talk about what this could really mean. We have Najib Shah, former chairman of the Central Board of Excise and Customs, as well as Prateek Jain, who is partner at Price Waterhouse. And of course, he looks at indirect taxation very, very closely. Gentlemen, thank you very much for joining in. Mr. Shah, if I could start with you. It really is a bonanza when perhaps there were not such big expectations. The slabs being moved down from 4 to 2 and having that 40% sin rate. Do you think it will do the job? There is going to be some revenue loss, and we still need to see what shape and form that arrangement is going to take between centre and states. But do you see this being revenue neutral, or will there be a significant revenue loss? And if yes, will it be worth it to stimulate the economy?
Yes, to answer you precisely, yes, it'll be worth it. This is something which everybody had been asking for, hoping for, perhaps not as dramatically as it happened. Announcement from the ramparts of the Red Fort and so swiftly thereafter. So there's something which is good. It should stimulate demand in the economy. There will be a revenue loss for the states and the centre. Estimates vary from whatever, 85,000 to 1.5 lakh crores. And that will be something which will be a matter of concern for states. I think the GST Council's meeting will have to necessarily address the concerns of the states. And I have always held perhaps that some degree of hand-holding may be required and necessary. the government also will be closely looking at ensuring that the rate cuts translate into price cuts and are passed on to the consumers, because having taken this audacious, bold step in reducing the slabs, they would necessarily expect benefit to pass on to the consumers.
All right. How much would the impact, as per your assessment, given the data that we have so far, be on revenue, sir? We just want to understand, because the government also has to make this revenue neutral, right? Or maybe have the least impact on the fisc. Prateek, if you could do, some maths on that.
So look, there is a revenue impact, as Mr. Shah said. Of course, the estimates vary. One is hearing about 1 lakh crore as an impact. But, in indirect tax, what happens is that when the rate goes down, it increases the consumption. And therefore, to some extent, the impact of revenue loss is neutralized. So that's one point. Second is, obviously, it will reduce the classification issues and disputes, etc., for the government. If you see, before GST came in, our revenue neutral rate, when it came in, revenue neutral rate was supposed to be around 15%. We have, before the rate cuts, around 11.5%. After the rate cuts, it could be around 10%. Now, at 10%, India would be placed at any other, compared to any other developed or developing economies in the world. And that's a very, very moderate rate to my mind. So there will be an impact. But in the long run, what we have seen with GST and earlier as well, that when you reduce the tax rate, the tax base increases. So hopefully, over a period of 1 or 2 years, you will see actually the tax base increasing further, and the revenue loss to a large extent will be neutralized.
Gentlemen, morning. Great to have both of you here. Prateek, if you can talk some specifics, and we'll sort of go zoom into specific sectors and zoom out as well and look at the bigger picture. But cars, for example, right? And it's been keenly awaited. Luxury cars over 1200 cc over a certain length now will attract 40%. The rate goes up from 28 to 40, but they were the rate was already 40, right? Plus cess. So how does this work? And the cess gets subsumed?
Yes, so what we're hearing is, so obviously there was a rate with GST around 28% plus cess, and depending on the length of the vehicle and so on. In the smaller car, the cess was either not there or very small, right? So 28% there for the smaller cars. For petrol, likely to move to 18%, and diesel likely to again from 31% to 18%. So that's a big one. For bigger cars, there are two possibilities. One is that government might continue with cess in some form, right? Yesterday there was some discussion about is there a national calamity contingent duty which is going to replace cess. We have requested the government that it perhaps makes sense to replace cess and increase the GST rates per se. So if GST rates increases, then it could be 40% for bigger cars, but it will be still lesser, largely, than what you have today. But if they want to impose another cess or kind of a tax in lieu of cess, then more or less the tax incidence could be same as you have today, but it will not be worse off. So what I'm saying is that smaller cars will definitely get benefited from the looks of it. The bigger cars, either the incidence should go down slightly or should continue at the same level that you have today.
So, Prateek, hi, morning. I don't even know if it's possible to model this or not. Maybe I'll ask Mr. Shah as well. But with the changes and the proposal, as we know, in its current form, including things like, for footwear, the threshold might be hiked to now for hotel rooms, it's 7,500. For footwear and apparel, 2,500. Everything below these thresholds will be at 5%. Is there any way of modeling what the demand impetus could be? Prateek, I don't even know how one can kind of come to any sort of assessment, even category by category. Would you have anything on this?
No, look, for the bigger products, I think it's easier to simulate, right? So for auto, you can simulate that, okay, this many vehicles have been sold with the price elasticity and vehicle prices going down by 1.5 lakh. This will increase by so much. Similarly, you can do for air conditioners, some of the other consumer durables and so on. I think it's more difficult in a normal FMCG products like fruit juices and stuff like that. How do you really...
Okay, so let's talk ACs. ACs are basically durables and autos, the bigger ticket items. with the current changes being proposed, which is basically a 10% reduction in indirect taxation, 28% moves to 18%, which is big. By how much would you expect overall demand to be boosted up by? ACs and autos.
I will not take a guess on that. I'll say that it should be a substantial jump, right? It'll also, for air conditioner, also depends as to how the weather behaves and so on.
Sure.
But it should be substantial, right? I mean, 10% cut on vehicles, etc., translates into maybe 1.5 lakh or thereabouts, right, on the price itself.
Take your point. I mean, take your point. It's difficult to put a number to it, but it should be substantial. Take your point.
Then there is the tertiary impact or the secondary impact of perhaps lower rates on insurance and auto parts, etc. as well. I'm not sure.
No, absolutely. On insurance, and which brings me to the larger question of this whole input tax credit business. And Mr. Shah, if you could weigh in on this, many industries are saying keep us in the higher rate bracket, but don't take away our ITC. Insurers have been sort of asking for that. So how should we wrap our heads around this business of the 5% bracket not having ITC? Or would you expect some change there? Maybe offer input tax credit to some degree, even in the 5% bracket, because that's going to be a very large slab now.
It's a classic case of too much of a good thing. Nobody expected this sort of reduction in rates. And this having come, this is going to be a natural corollary is this accumulation of credit. Because it is extremely difficult to ensure that all the inputs which go in the manufacture of a final product are taxed in such a way that they neutralize the rate in the final product. So it's going to be very challenging. There are going to be concerns. I think there are going to be teething concerns, definitely. And the government will have to tweak as we go along and look at those rates. What can be ensured procedurally is to try and ensure that wherever there's any accumulation of credit, to have ways and means of ensuring that the industry is able to access that credit in whatever manner, right? So those are procedural issues which can be looked at to alleviate the concerns of input tax credit accumulation, which is bound to happen in the current scenario.
All right. Thank you so much for joining in and giving us your views on what may the impact be. We'll obviously wait by for the actual document that comes on September 4th and thereafter assess the impact once we have more clarity. Yes.
Maybe I'll just ask Prateek. Prateek, from what we've reported, you think anything kind of stands out to you which perhaps is a problem in the council? Or you think this is all what has been reported already? I thought largely on expected lines.
Largely on expected lines. I'll just say that what happens to the compensation cess, I think that's a big issue because the cess is there in the distribution chain, right? So if I bought a vehicle as a dealer, I have paid cess. Now suddenly when tomorrow I have to bill, there is no cess. So what happens to the cess which is there with me in my books? Will that be allowed as a refund or not? That's number one. Second is anti-profiteering. What are the guidelines which will come as to how do I pass it on to the customer? And how do I manage the transition stock, right? My stock is lying with dealers, with wholesalers, with retailers. So how do I manage that? How do I do stickering and so on? So some bit of guidance from that, from GST Council is expected. But
and on ITC, and also very quickly, if you could weigh in on this whole ITC dilemma, I mean, how can it perhaps best be handled and the transition be sort of smoothened out?
So on the transition, what they could do perhaps is to say that I can make an adjustment as a OEM, so as a company, and do a credit note to the dealers to the extent of tax amount. So I adjust the tax amount, I claim as a refund, and ITC for the dealer is reduced to that extent. So let's say a dealer has purchased something at 12%, he gets a credit note of 7% from the manufacturer. Something of that sort can come in, because if not, then obviously there will be commercial negotiation then in that case, because they will want some compensation for the incremental ITC which they're going to carry in their books for some time. So then there'll be additional discounts, etc., which will have to be offered by the manufacturers to the dealers and retailers.
All right. It'll be very interesting to see where this goes. As our guest earlier said as well, the devil will obviously be in the details. But two things are clear. If there is more money in the hands of people, irrespective of what the rates are, they are going to spend it somewhere. So consumer discretionary, just look at Trent, value fashion retailer, up around 3% right now. Again, this is a stock which has been an underperformer in the past. From its peak, it has seen a bit of a decline. 20-25% growth is what the company is guided for sustainably. This month, it's done well. And the second one is Yatra Online. That's up around 5% as well. Avenue Supermarts is the other one, which is up around 1.5%. So if you have more money in the hands of people, people will spend it on travel, fashion, and perhaps some of the important groceries.
And let's not forget footwear. Relaxo is hardly relaxed this morning. A stock that Manglam had picked out. Now it's up 8%. Relaxo on the hopes that footwear below 2,500 rupees was going to be taxed at just 5% now. So there you see the GST chart busters playing out on the screen. Thank you, gentlemen, so much for joining in on that conversation. Very, very helpful and filled with perspective. We do have to take a quick break. Come back on the other side. We'll have with us Sajid Chinoy from JP Morgan to discuss the implications of this 50% Trump tariff on India and the measures from the Indian side, like GST. To what extent can they mitigate the impact?
Welcome back. We of course are trying to get an assessment of where we stand, right? There's efforts by the government to boost consumption, but that 50% tariff from the US, of course, remains a big overhang. Who better than Sajid Chinoy to take us through the thinking and how should we think about this in terms of impact to the economy? Head of Asia Economic Research at JP Morgan. Sajid, good morning. Great to have you with us here. Thank you very much for joining us, and sorry to have kept you waiting. So first cut, Sajid, how are you thinking about this 50% tariff hit? It's almost like a trade embargo for most products out of India to the US. While one hopes that this is not, obviously this is not permanent, and perhaps the 25 gets knocked off after some negotiation or something is worked out, but for now it's there. Go on, Sajid.
Morning, Prashant. Great to be here. I think where you ended was the key here. That there are two issues about permanency, whether we're at 25 or 50 for the foreseeable future. At 25%, even though we're higher than our competitors in Asia, we're in the ballpark, and there are other measures you can use to remain competitive and keep your market share alive in the US. At 50%, we're at a distinct disadvantage. And you know the math here. There's about 2.3% of GDP of India's exports to the US. A quarter of that is exempt, in terms of electronics, pharmaceuticals. So there's about 1.7% of GDP that's exposed. But what matters really is the value addition, because many of these sectors, gems and jewelry, have large import content. And the value addition here is about 1.1%. So there's 1% of GDP that's at risk facing the US. Now, I think the couple of important points to make here. One is that even though this 1% of GDP may sound like a small number in the grand scheme of things, as you know, this is concentrated largely in labor-intensive square. And so from my perspective, if you're presuming that this is a temporary shock and lasts a few weeks or a few months and not beyond that, the key is to avoid non-linearities, by which I mean the key is to ensure that economic enterprises in those labor-intensive sectors stay alive and there are no job losses there. Once you get into job losses, then you get down a spiral in terms of knock-on effects on consumption that are harder to reverse. Now, the good news is we have a playbook from COVID. This is exactly what happened in COVID, where, one fine day there was a sudden demand shutdown. And the question around the world was, how do you keep economic enterprises alive? And India has utilized a lot of those tools. And I suspect a lot of those COVID tools will come back, by which I mean, targeted support, both from monetary and fiscal. On the monetary front, it's more about liquidity, it's about regulatory forbearance. And from the fiscal perspective, it's actually more specific fiscal packages for certain sectors. The good news is technology allows you to target these sectors and firms very precisely, because these are all exporting sectors and therefore go through the banking system. So we can target them very precisely. And so I think that's the first order of business. Before we talk about a counter-cyclical response in terms of GST cuts and monetary policy, the first order of business is, over the next few weeks and months, presuming this is a temporary shock, how do you deploy those COVID-era tools to keep these economic enterprises alive and ensure that there are no job losses?
How much?
Sajid, just to get the numbers out of the way, so 25% India can compete, 50% complete, of course, it's an embargo. 1% of GDP is at risk, but you're saying that 1% is large because the indirect effect is much larger. And you're saying once you get into the cycle of job losses, etc., it becomes much more harder to contain. So immediately urgent sector-wise COVID-like support measures are necessary, right? Over the next few weeks.
That's right, Prashant. I would say days and weeks. And I say this because this is one of those shocks where the costs will, if this gets over in a month's time, that would be a demand shock that we can easily absorb. The longer the shock proceeds, my worry is the more the costs build, because the initial shock is a loss of demand. The secondary shock becomes the hit to employment, and then the knock-on effect to subsequent consumption losses because of employment losses. And then the tertiary shock is the longer this continues, that animal spirits, investment, China plus one gets impacted. Now, I'm hopeful, however, that this will not be a very long shock. The good news about US capriciousness is that we've seen this movie before with many other countries, where standards have changed over time, and one fine day the US is amenable to striking a deal. So I think the key is, while we are undertaking these mitigation measures, we have to continue talking to the US, keep negotiating in good faith, and hope that eventually wiser counsel prevails on their end.
We take that point entirely. Sajid, just a two-part question here. One, immediately, what in your assessment could be the amount that should be deployed to support these sectors? How much would it cost the government? And then to the second point, you said, methods of boosting consumption. The government has already foregone some amount on account of the income tax cuts that have come by. Then there are the PLI schemes, all those measures to increase, growth out there, losing some of the government revenue. And then there are the GST cuts as well. All in all, the question is, how much would it cost the fisc?
And it's, these are very early days, because it's not clear how long the shock is going to last. The longer it lasts, the more it will cost. I think the good news is, because we've got a playbook that we've just used in COVID a few years ago, and given, the tremendous advances India has made on technology and the ability to target, enterprises and certain sectors, this needs to be, I think, a very targeted response, right? And because we can identify which sectors, which exporters. And I think the other element to consider here is that while this is 1% of GDP, the sectors that we're speaking about, the US constitutes a large market share in those sectors. And so I think ensuring that these firms and sectors remain viable is the key. I think the fiscal costs, too early to estimate what they are, but I'll make a larger point. I think even if it costs the exchequer something in the near term, in the long run, this will more than pay itself back. Because if you're preserving the viability of enterprises, preserving employment, preserving consumption, that will more than pay itself back. Now, you raise a more important issue, which is, if you step back, this is a year where we'll have to manage the fiscal carefully. And for no other reason, because we'll get a GDP number today, which should be relatively strong, fingers crossed, close to 7% almost. But nominal GDP today, I think, will be an equally important story. And nominal GDP is expected to soften to about 8% today. You could have a year where the WPI deflator is so soft that nominal GDP this year could be 8% or below 8%. Now, with that kind of nominal GDP, tax collections will need to be realistically assessed. It's hard to get 12, 13, 14% growth in taxes if nominal GDP is at 8%. The good news is we have some buffer from non-tax revenues, but we have to manage the fiscal carefully this year for these three reasons. A, you've got softer nominal GDP. B, you require some targeted fiscal support for sectors under stress. And C, you've got a GST tax cut. Now, the key there again is going to be how much of that is revenue neutral.
Absolutely. And I was just coming to that point, Sajid, to sort of cap it off. I mean, we can't control what the Americans are doing. All we can control is what we are doing, right? So you're saying more targeted measures. So if you could give us some sense of what is the fiscal space for what size of a package of measures for these sectors, A, and B, this GST cut. I was just asking the previous set of guests. Now, the estimates are that the revenue implication could be as much as 1 lakh crore, the revenue loss. It's not going to be revenue neutral. So then again, how does one do the whole balancing act and the adjustment? And will this extra spend, if I could call it, it's a revenue loss, let's just consider it spend, will it do the job of actually spurring the local economy, local level consumption here?
Yeah, that's a great question there. I think let's wait and see. I don't want to presuppose what the GST Council is going to say on September 4th and 5th. I think let's step back. Before we talk about revenue losses, the fact that we're reforming the GST, simplifying it, make compliance easier, is a hugely important structural reform. So I think that's the bigger picture here, right? That you're going from 4 slabs to 2 slabs. If you make compliance easier, I think over the long term, this is unambiguously positive. Now, we need to be a little bit careful about, what the revenue losses are, because this is not temporary support, right? That once you reform the GST, again, another reason to do that is because the ratio of indirect taxes to direct taxes in India are very high. Indirect taxes tend to be regressive at a time when consumption needs support. Bringing indirect taxes down and reducing the cost of consumption, again, necessary, warranted. But I'm just being a little bit careful from the medium-term perspective, because, if nominal GDP is going to be lower, then stabilizing debt means you have to bring fiscal deficits down. And the GST tax cut, as important as it is structurally, if there's a very large revenue loss, it's not a one-time effect, it's a permanent effect over the years. So we need to balance both these considerations. How much stimulus should you inject in the economy in a year like this? But how do you preserve fiscal sustainability in the medium term? I'm sure the GST Council will be thinking carefully about how to achieve this balancing act.
Absolutely. But I think the headline out of this interview, Sajid, of course, this very impassioned plea that the government must act and must act now over the next few days and weeks to support sectors which are hit and avoid, the cycle of job losses and, of course, what comes out of that. But I think point very well taken. Sajid, foreign flows have been very, very negative. Continue to be extremely, $4.5 billion in August. Big numbers, right? When in your conversation with clients, the dollar rupee is at a low. What is your sense on the fixed income rupee side? How are things looking?
I think clients don't worry about this for a couple of reasons. One is, yes, the capital account, has been volatile over the last year, FDI flows, debt flows, equity flows. But the fact is India's current account starting points are very benign. We have a year with current account, 0.6% of GDP in the year that just passed. Yes, there'll be some expansion if net exports get hit. If some of that 1% of GDP in value add gets impacted temporarily, the current account could widen. But the fact is that Reserve Bank of India is sitting on a war chest of reserves. So nobody worries about what the BOP implications are, because there's plenty of ammunition and plenty of buffer. 2 other quick points I'll make. I think given what's happening in the US, both cyclically and structurally, we're seeing the dollar weaken a lot. When the dollar weakens, it just takes the pressure off, emerging market currencies. If the Fed's going to be cutting, at least for the next couple of meetings, it'll provide relief to emerging markets. And thirdly, calibrated rupee depreciation in the next few months is not necessarily a bad thing. In a world in which, for example, our Asian neighbors have tariffs of 19 or 20%, and let's hope that, we claw it back to 25% or perhaps even lower. You want to get every percent of competitiveness that you can get. And so in a world in which the rupee is in a non-disruptive, gradual way depreciating, actually helping India's case on the export front, it serves to partially offset the impact of some of the tariffs. So I think, that's a policy choice that we will make, but really no reason to panic on macro. We can have a discussion on growth and jobs and consumption, but as we've discussed before, on macro fundamentals, when it comes to the current account, when it comes to inflation, when it comes to reserves, absolutely no concerns on India.
All right, that's great to hear. Sajid, fantastic conversation, and I hope Mumbai is listening. I hope Delhi is listening as well. Thank you very much for being here with a very astute sort of observation, and of course, what needs to be done from here. What we'll do is take a quick commercial break here. We'll come back and we'll focus on Mumbai once again. And there's a big conference which is kicking off. The Motilal Oswal Annual Investor Meet is kicking off from Monday. And we have two very busy gentlemen who will join us on the other side. They're right here in our studios, and we'll go across to them on the other side. Stay tuned.
Well, we were talking about the markets having started fairly well. Now it's taken a turn for the worse right now. The frontline indices are mildly in the red. The mid-cap index even more so. The story of the day so far can be summed up in the crisscross lines that come up for you. When we opened the markets, we had 1,500 stocks which are advancing for about 600 stocks which are declining. Now those lines have intersected and we have, 1,400 stocks which are in the red for just about 1,200 stocks which are in the green. That's actually a perfect time to weigh in on what investors are seeking from, everyone, the corporates, the institutions, and the whole ecosystem. So the 21st Motilal Oswal Annual Global Investor Conference, MOAGIC as we know it, kicks off from September 1. For the curtain raiser, now we have Rajat Rajgaria, who's obviously the Managing Director and CEO, Institutional Equities, and Sachi Shahane, who is obviously the Head of Sales, Institutional Equities, joining us in our studio as well. The conversation was promised. Thanks a lot, Rajat and Sachin, for joining in.
Thank you for having us. Thanks
at
for
a
having
time
us.
when so much is happening, the question is, what would be the top few questions on everyone's mind, and what are you doing to ensure that those questions will be answered?
Yeah. So, this 21st edition of our conference is happening on a very interesting backdrop.
Yes.
The last 1 to 2 months of events have given a lot of reasons for people to engage with companies, with investors, to find out what lies ahead. When we started planning for this conference, it looked like a one-way street this year for India. But I think 2-3 things that have happened. The last quarter earnings have not been that great. Right. We are still grappling with a single-digit earnings growth. Second, I think you are seeing this entire tariff, and suddenly it looks like that this tariff war is like for us only in this world. And the third, So we are seeing now RBI and government both coordinating very well to stimulate the economy in every possible manner. All these factors have important consequences on every company that comes at the conference. So I think investors would have very directed questions to know from the companies to what extent they get impacted by all of these and what are they doing to mitigate this, right?
I'm curious to know, when you say investors, what are the queries already? What is the participation going to be like from the foreigners?
Yeah.
Because they're the ones who've been sitting at the edges. And in fact, because it became very clear, like you were saying, that India is being singled out, and as it became more and more apparent that we're not getting a trade deal immediately, the selling intensified. It was 17,800 crores last month. August now, it's now almost 29,000-30,000 crores. And they're going to other markets. They're going to Korea, China, which is okay.
Yeah.
But what's the sense you have from the foreign participation side?
So, we have large teams from multiple long-only global foreign investors, be it the sovereign funds or be it the largest of the investors, right? But I think, let me give you a flavor that when you look at Motilal Oswal conference, when we say it's a large conference, we have 1,200 plus investors who attend this event. We have closer to 200 companies. But more importantly, our track, which features 16 speakers, and these are speakers from all walks of life, listed, unlisted, corporate expert, right? It's not just about a stock conference. It's about a framework. It's about a philosophy. It's about how do you see this country. This is a century of opportunities. We just completed a quarter of a century. And we all have been benefited from this quarter of the century growth, right? Last 25 years, we grew from a base of 400 billion, 10% compounded, to today reach 4 trillion. Next 25 years, we will grow at 10% compounded on a base of 4 trillion. So imagine you are going to build one India next year, which existed in 2000. I think this conference is about how do we widen our scope of investing so that we capture the bigger opportunities, point number one. And point number two, of course, while the big picture remains always good, in the short term, you have to face the adversities to make sure that you don't get caught off guard.
So foreign participation isn't lower this year at the conference compared to previous years? No, there's adequate interest.
In fact, I would say that the domestic participation is just growing every year, as you can see in the market and as you can see in our conference.
आप सारे FIS को एक conference room में बंद कर लीजिए.
Just lock the door from outside.
अब आप तभी निकलेंगे.
See the big picture.
Per person, $1 million.
Right वाला बटन दबाएंगे आप.
That's a good idea.
मैंने बोला मत बोलिएगा, but you must have seen Akash Prakash wrote a piece recently saying valuations still kind of high relatively compared to EMs, but he said his point essentially was, the punch to me was, you can't have an expensive market with just 10% kind of earnings growth, which you also alluded to, that earnings growth has been kind of poor. And that is the reason why, and this question, why are FIs such big sellers? And Sajid just told it has nothing to do with tariffs, this 50%, etc. It's earnings growth. We spoke with Rajiv Batsra of JP Morgan, who kind of also identified poor earnings growth as the number one reason. What is your sense, Rajat? Is this a write-off here? Do we need to roll over to F527, which the market anyway will do? What's your sense?
Yeah, I think bang on. The single most reason for our market underperformance is earnings, right? If we grow at 15-16%, 20p is attractive. If we grow at 5%, 20p is expensive.
Right.
Our P is not going to come down. So if markets will stay here till the time the earnings growth don't happen. Point number one. Point number two, whenever earnings growth aggregate is slow, whichever pockets grow, they get disproportionate premium. So even in today's market, I can tell you 5 stocks which are still doing very well, and they were not that they are surprisingly doing well. They were supposed to do well because their numbers were doing well. So that's the second point. Third, on the aggregate earnings, I think there are some both structural and cyclical factors which have come together to make this 5% growth coming, right? Like IT, which has always been a bedrock of earnings for corporate India. I think structurally they are into a single-digit earnings growth mode now because of the way businesses are shaping up. But many of the domestic consumption, industrials, financials, they have to come and make up for that. They are in a cyclical low right now. And I'm more positive that the low base of the last 12 months, a lot of the stimulus which has come from RBI already, which will take effect, and the government stimulus which is likely to come over the next few months, should at least push our aggregate growth rate from this 5-6% to more like a 12%. Is 12% good enough? That markets will decide, right? But I think the P's are unlikely to contract much. The earnings has to move up for the market performance to return.
So to that extent, then the obvious question is to the corporates that you're getting on, the conference. What is the mix of those corporates like? What sectors are they predominantly from? You said unlisted, listed. And what do you think would be, their idea on growth in earnings? I mean, because earnings growth is what will drive the market, everyone will be asking those questions to the corporates as well. What is it that will drive your earnings growth? Because you can, on the one hand, speak about the macros, blame the macros, or benefit from the macros. Eventually, it is your company is doing that will take the earnings higher.
Absolutely. So, I think this year is also a transitory year on many regulations impacting the earnings. For example, if you look at capital markets, you had regulations which came in, especially on the broking side, which has impacted earnings. If you look at, suppose, the GST cuts, we keep hearing there can be postponement of purchases, which can lead to some inventory impact. That will also come in. If you look at the way this tariff thing can kick in, right, this will also have. So I think people will at least try to focus how much impact in the very short term is going to come. But more importantly, there will be some businesses which will weather this very well. We have 180 companies at the conference, but each investor needs just 5 ideas.
That's what. So I was going to ask you, so which are the five fastest growing companies of, let's say, FY27, which will come at the conference?
Or the tracks where most amount of investors have said, okay, this
I'll assure you, I will come next Wednesday when the conference gets over.
Just to share
something a little more flavor on the company.
Yeah, so just to share on the question which you just asked, so a lot of interest in logistics names, a lot of interest in consumer discretionary, industrials.
What companies would they be? And you have unlisted as well. So,
but these are largely listed names which I'm talking about, where there is, so all the listed names in this space. And as Rajat just mentioned, non-lending financials is again a very big space where there is.
Unlisted companies at the conference?
Roughly about 15% of the conference would be unlisted.
And how much of that 15% is up for listing next 1-2 years?
Not at least the next 6 to 12 months.
And from which spaces are the unlisted companies?
Essentially, new age, consumer, logistics. Look, because I think unlisted companies come with a very different perspective to share with investors, right? So we always try to make a blend of at least 15% of the conference to be unlisted companies.
So a lot of interest you said was on logistics, consumer discretionary and non-lending.
Industrials, non-lending financials and auto anchs as well.
What about the IT guys? You said, it's structurally low. I'm sure at this point in time, a lot of the investors would want to know what are they doing to mitigate this AI storm which is coming in? How is it that my IT portfolio can look a lot better? How will the earnings increase?
Yeah. So, in the case of IT first, their corporate access anyways is top notch. They meet people very frequently. Their quarterly disclosures is pretty high. So it's very little to again figure out we still have good participation, but I think businesses are more predictable right now, even though they are slow. In a conference, I think people try to figure out 2 things. Stocks in my portfolio which I think are not going to grow well, and stocks in my portfolio which I don't have which are likely to grow well. So that kind of an adjustment people want to do. I think suffice to say that 1,200 investors, 180 companies, roughly about 15,000 meetings that we are doing, right? Each one of the investor is getting their share of what they want, right? Hopefully, at the end of this conference, they get some actionable to do for themselves.
I asked this question to Ramdevji just the other day. Yesterday, we had him on, right? And I was asking him what the local HNI money is doing, the non-retail money. The retail money is nicely doing their SIPs and they're keeping the market up. So he was laughing about it. Jokingly, he said that the problem with that money is that it'll be on the sidelines. Jab tak bazaar thanda hai. The moment there is momentum, they'll all quickly jump onto the bandwagon. But your assessment, you or Sachi, the one when you talked, because there are large participants as well. So the non-mutual fund domestic money that we're talking about.
So just to share a data point on that, the AIF side, which is largely the HNI and very high net worth retail money, that is seen commitments of almost 14 trillion. So which is a jump of 14 trillion INR, I'm saying. So that is a jump of almost 20% year on year. This is a data shared by SEBI some time back. And of which still there is a dry powder of almost 8 trillion, which is sitting on the sidelines.
8 lakh crores of
8 lakh
HNI
crores.
liquidity.
AIF money sitting on the sidelines.
And a lot of the HNIs are interested in not unlisted. That's
Increasingly.
that is
I
where
was just focusing. If you look at today, NSE shareholding. In the last 5 years, the entire VCP, FII holding has come to India, to the HNIs and the family offices. You looked at the Zepto deal that as a house we did, a large number of HNI. I think a lot of the HNI money, what Prashant is mentioning, is finding way, right? Typically, that used to be the space for private equity or funds that has become for...
I'm not joking, Rajat. I was talking to a venture capital fund in Bangalore, and I was just chatting about strategy. I said, well, looks like some of these guys in Bombay have more companies than we do. They've been in the VC fund for 20, 25 years.
Yeah.
So it's absolutely correct. It's completely transformed last couple of years.
That's something that Uday Kota keeps squibbling about, right? That the second generation is now looking at venture capital investing as against...
these are old, 30-year-old veterans in the market, public market investing, who now they're kind of doing backward integration. They're going,
offices, but
finding companies earlier and earlier in that sense.
So, we focus a lot on the mutual fund daily flows, monthly SIP flows, right? What we don't capture is the non-mutual fund flows into the equities, which come in multiple forms. Insurance, HNI money, AIFs, etc. That someday, I think somewhere we will...
Motilal Oswal should come up with a report every month on the
quarterly. We will do that. Thank you. That's a second idea. First idea was to lock people into...
No.
Second idea.
The second is the more actionable idea.
It's a very doable idea.
It's all the best to you as you organize this massive conference. It's always great to have both of you to kind of sort of preview the conference for our viewers. Really appreciate it, Rajat Sachin.
Thank you.
Thank you.
Have a good time.
Thank you.
We'll take a quick commercial break here. Don't go anywhere. We'll come back in just a bit from now. And it's the economy with Lata. And there's a lot to discuss. I mean, the GST news break from last night. And of course, the 50% tariff implications for the economy. Srinivas Varadarajan is of Deutsche Bank India. He'll be the guest on the program in just a bit. Stay tuned.
Welcome to It's the Economy. Actually, I'm discussing bond markets. The bank Nifty has been one of the big underperformers this quarter. This index, Bank Nifty, has fallen 3.3% in the month of August, and it has fallen 6.4% since July 1st. And the reason actually is bond prices. Bond prices have crashed and yields have risen. The 10-year bond yield, for instance, has risen from 6.2% on June 1st to 6.29% on July 1st to 6.35% on August 1st and went to 6.6% on Tuesday. Today it's just adjusted a bit to 6.56, shows every tendency of going up again to 6.6. So while the last quarter banks reported trading gains on their bonds, in the second quarter they are all going to report trading losses, which explains why bank stocks are falling in the first place. Rising yields also make it expensive for companies to borrow from the bond market. And what is surprising is, since June, the Reserve Bank has cut interest rates by 50 basis, but market yields have gone up by 40 basis points because there are no buyers for bonds. To understand why yields are rising, why have buyers disappeared, how do we bring the buyers back, I have with me Srinivas Varadarajan, Managing Director, Global Emerging Markets at Deutsche Bank India. Srinivas, good morning and thank you very much indeed for joining us. Well, first up, why such a paucity of buyers? Why are yields just going up and bond prices tumbling?
Firstly, thank you, Lata, for having me on your show. A pleasure to always chat up with you. I think if you look at the proximate cause right now, and it's a bit of a storm in the teacup, is really concerns around the fiscal bit, right, which is a little bit blown out of proportion. If you look at some of the numbers, the shortfall that the market is talking about, there is a shortfall on account of rejigging the GST slabs of about 50,000 crores. There's a shortfall, a bigger shortfall possibly coming in from the reduction in the nominal GDP growth from 10%, which was there in the budget, to around 9%, given what's happened to the deflator. So that could lead to a net tax revenue shortfall of about 80,000 crores. In addition to that, they could, the disinvestment shortfall, I think, could be around 15,000 crores. So you're looking at a net shortfall of about 1,45,000 crores. To fill this shortfall, you've got a couple of levers already going for you. One is the increase in the RBI dividend of about 40,000 crores, the excise duty hikes that you did on petrol and diesel in April, that can bring you about 30,000 crores. The compensation cess, you can try and, there is a surplus of about 50,000 crores, presume 50% goes to the center, about 25,000 crores coming in from the compensation cess. And of course, you can reduce capex by 20,000 crores. So this kind of all adds up to 1,15,000 crores versus 1,45,000 crores of shortfall. So there's a net shortfall of about 30,000 crores. And 30,000 crores could easily be met in terms of financing that from treasury bills. Remember, the budget had penciled in net financing from T-bills at zero. So you can clearly finance this. It shouldn't really be much of a problem. I think the bigger issue, really, if you go back to the June policy and August, I think the June policy was when, of course, the stance was kind of changed back to neutral. And the guidance was that the bar for a rate cut is pretty high. But if you really look at the August policy, the inference is that the bar for possibly a rate hike, of course, sometime early next financial year is pretty low, because if you look at the forecasts, you're looking at a Q1 inflation forecast of about 490. You're looking at a growth forecast of 660 for Q1 of next year. So effectively, what that tells you, if you smell the coffee, it tells you that the output gap is completely closed, and you actually have a positive inflation drift of 1%. And that leaves you with, plugging this into a simple Taylor rule kind of tells you that the real rates are close to zero. If you need to plug in even real rates of 0.5%, that tells you that the effective policy rates, if those forecasts eventuate, should be 6%. So that's basically a bit of concern that's kind of plaguing the market.
Actually, Srinivas, I've not heard anybody talking about a hike just yet. I mean, if the RBI has looked through 2% inflation, they logically ought to look through 4.9% inflation also. So, I mean, I don't think people are speaking about a hike 1 year down the line or 9 months down the line. The point is, right now, are there any tools or is there any need? Is the Reserve Bank even wanting to talk up the yields?
So if you look at it, if you look at the price action, Lata, since June, there's a lot that's actually been priced in the bond market. Forget about the 10-year bond yield, right? We all know that from a low of 20, it's gone up to 60 and 55 right now, 655. But you look at the 15-year government bond, for example, that's right now it's about 690. And when the easing cycle began in November, it was again 690. So it's, it went to a low of about 635 and it's come back up again. You look at the 15-year SDL, state development loans, for example, which is right now at 7.5, which is higher than when the rate cut cycle began. It was 730 at that point in time. So a lot has happened. The market is also aligning itself with steeper yield curves globally, and given what's basically happened. And really coming to hikes, I'm really looking at it from the RBI forecast perspective. So there is information content in terms of those forecasts that we follow pretty closely. I mean, if you really want to provide some palliative to the market today, you can, if I were to put on the hat of an institutional RBI to kind of look at how best to solve the problem that we have right now in terms of high yields, if it is indeed a problem, is at the outset, the Reserve Bank of India conducts monthly switch auctions about 20,000 crores. You can try and reduce the amount of switches that come into the market to reduce the injection of duration, which the market needs to contend with. You could look, for example, to start off by devolving some of the government bond auctions if you want to provide a signal. If that too doesn't help, then maybe cancel some auctions now, but you can reintroduce it back the second half of the financial year if you require it from a fiscal perspective. Or alternatively, why not look at basically an Operation Twist? If you recollect back in DEC of 2019, RBI had basically started off with Operation Twist. They did about 20,000 crores, totally did about 40,000 crores into COVID as well. So if you want to basically keep the bank reserve position neutral, then maybe you can try and come out with an Operation Twist if you want to basically provide a yield signal. And there's one other thought, but again, needs very, very careful consideration, and it's not really an easy call, is, if you want to provide a yield signal, maybe look at, for some part of the CRR, replacing that with open market purchases, right? So you still provide liquidity to the system to offset some of the outflows because of maturing forwards. And at the same time, you're providing a bit of a yield signal.
Mm-hmm. Okay, well, I don't know if the RBI will take your last suggestion because the entire banking community will be on their case. You've promised a CRR and now you're taking it away. The stock market will protest. And I think that will also hurt RBI's credibility. There is no way they can promise something and not deliver it when there is no, big pressing reason. But that is my point really. Is the Reserve Bank worried at all that the yield is at 6.56? Maybe they are not. Maybe you bond dealers are because banks and bond dealers are sitting on losses. But Reserve Bank thinks 6.5 yield is fine. Do you suspect that?
Maybe not. Maybe if you look at the spot yield, it's just moved by 30, 35 basis points. Big deal, right? In the bigger scheme of things, it hardly matters, right? But you look at what's happened fundamentally is that your yield curve is steepened. You look at your 10 cross 15, which is close to zero, it's kind of gone up to about 35 basis points. Your 10 cross 30 is 75 basis points. The yield curve is steepened. Your spreads are widened. You look at the SDL GSEC spread, which at the lows was about 35 basis points. That's right now about 75 basis points. Yield curve is steepened. And
so you're saying they should worry about growth, that things have gotten a bit out of hand?
I don't. I don't think we are there yet. I don't think we are there. There's no cause for worry yet. But there's also a lot basically happening in the background. Look at the forward market, right? For example, look at the 5-year forward 30-year, right? That's close to about 780. Look at the 5-year forward 15-year, that's about 7.5%. Even a 5-year forward, 10 years at 7%. So lots basically happening in the bond market. I don't think there's cause for worry. And also on the CRR bit, just to clarify, I don't think it should, if you want to think a little bit out of the box, you could consider it. But of course, there are pros and cons in terms of doing that. But a better option would be to try and, implement an operation twist. And again, given what's, really what's been happening on the external sector because of trade, I think one option to consider, if you look at it from a currency perspective, Lata, the 40 currency real in July was about 100, and it's probably lower now, given lower exchange rate and a lower dollar index. And if you kind of look at what happened in 2017, when the renminbi kind of depreciated against the dollar to offset the tariff impact, one policy that could be considered and debated about in the policy-making circles is whether it makes sense to aid a depreciation of the rupee against some of our export competitors, who have lower tariffs, like China's got 30%, Vietnam 20%, Korea 15%. You can try and do that, and maybe that would kind of aid, and that would also be a loosening of policy, which could be considered.
I'm sure, they would be thinking of depreciation. It's just that the dollar is also depreciating. But I'm sure the Reserve Bank thinks about currency in many ways. We will have to wait and see whether Reserve Bank is actually as much worried about yields. We have a big auction coming today. Let us see whether they look to devolve that one. That would be a signal that the Reserve Bank doesn't like the yields to rise so much. We have to wait and see. Thank you very much, Srinivas, for joining in and giving us a 360-degree perspective of this yield rise issue and how the Reserve Bank may want to address it. Wrap up on Buzz Out on that note. Chartbusters coming up.
So volatile start on D Street. The Nifty slips below 24,500 but then reclaims that mark as well. Most stress sectors trade with losses, but we do have some gainers in the form of FMCG and private bankers, while realty and autos see some bit of profit taking.
And FMCG stocks are some of the few gainers on the D Street today as stocks surge in anticipation of GST rate cuts. Colgate and Britannia are the top stock gainers.
Stocks of Dr. Agarwal's Eye Hospital surge as Morgan Stanley issues an overweight rating with a target of 494 rupees per share. The brokerage expects single listed entity structure to improve transparency and trigger a re-rating in the stock. Remember, the stocks of both the listed entities were sharply lower in yesterday's session.
And Kotak Institutional Equities upgrades Clean Sciences to a buy rating with a target price of 1,370 rupees, citing favorable risk reward and a healthy pipeline of growth projects. The stock is higher by about 2%.
CG Power is higher in today's trading session by almost 3%. Launches India's first semiconductor assembly and test facility in Gujarat. First chips from the plant set to roll out next year.
Hello, good morning. You've tuned into Chartbusters, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangalam Malu as well. Mangalam, good morning. And an interesting day shaping up, right? We are seeing a bit of a volatile session is what we could say. Flip-flopping between the red and the green for the Nifty. And underperformance is actually coming in from that broader end of the market, though.
Yep, we do have more stocks which are, declining, but now that has been flipping because it's been fairly volatile. The Nifty at one point was in the red. From that dip, it has seen a move once again above that 24,500 mark. And interestingly, the crisscross lines come up for you on the screen as well. At one point, the mid-cap index was actually down 0.6%. That's now virtually moved into the green, down by about just 40, 45 odd points. And those lines which were crissing and crossing for a large part of the morning were, with a red line above the green one, and now it's moved in favor of the advances. So 1,500 stocks which are advancing for about 1,100 stocks which are declining. Just moments ago, this number was reversed. So perfect time to actually get in Manas Jaiswal for a quick technical check on the market. Manas, we've been consolidating. The last couple of series have not particularly gone the bull's way. We've lost about 1,050 points between July and August series. Start of September series, FII ownership is at a record low at around 8% on the long side. Client ownership is higher and a lot of triggers for this series as well. What are your thoughts? Do you think the consolidation will continue, or maybe at some point there will be a major move on either side?
Good morning, Mangalam. So I am still very much cautious on this market because Nifty is trading below 100-day moving average. On the monthly chart last month, Nifty has made a dark cloud curve pattern, which is a bearish sign. So I believe that till Nifty is trading below 24,800, I think this is a sell on rallies market. I believe that Nifty can even test its recent swing low of 24,344. And if it breaks that, then it can go down and test its 200-day moving average, which is placed near 24,250. So I'm still bearish on the markets, and I think on every rally, one should exit from the long position, and even one can create short position with a stop loss of 24,800. However, on Bank Nifty, Bank Nifty is trading very near its 200-day moving average. That is why we have seen some buying interest today. But again, here also, I think Bank Nifty is trading below 55,000. Yeah. I think here also, this is a sell on rallies market. If it breaks 53,500, which is its 200-day moving average, then you may see the level of around 52,300.
Okay, Manas, thank you so much for that. We'll be keeping an eye out on those levels over there for Nifty as well as Bank Nifty. But that was on the equity front. Let's shift focus and talk about the commodities market now. Manisha is joining in with us. And Manisha, what is that one commodity that you're tracking today?
Well, I'm looking at precious metals right now because we've seen very strong gains in both of these. There is safe haven buying returning back into the markets. The decline in the US dollar index clearly favoring that. So when you look at the gold prices, they're trading at a 5-week highs, and we've seen decline in dollar support buying in these metals. Well, apart from that, the markets also are pricing in an almost 89% probability of the first US Fed rate cut coming in for the month of September by 25 basis points. That seems to be getting baked into the prices also. And then there's a good buying happening
happening in many other Asian countries. China, for one example, if you look at the gold imports via Hong Kong, have surged by 126% for the month of July. China's central bank also has continued to add gold for a 9th straight month in the month of July, one of the major central banks which continues to buy gold for many, many months now. Not just China, take a look at Vietnam, and that also is the 3rd largest gold importer in Asia. Seems to be making a chase and decree now. Until now, it was only the Vietnam government that could be buying gold. But now Vietnam has issued a decree to abolish this 13-year-old state monopoly on gold trading. The gold buying is now open for commercial banks and authorized dealers as well. So that clearly seems to be supporting markets there. But the major story clearly seems to be in silver, which is trading at an all-time highs in the Indian markets. On MCX, we've seen the prices go beyond 117,000 rupees a kg. But in the spot markets, after you've had taxes and making charges, etc., silver is trading at 1,20,000 rupees a kg already, a level that many people thought would come in only by the time it's Diwali or end of this year. But clearly, silver seems to be making those moves even right now. So while the Indian markets are trading at all-time highs, the COMEX silver is trading at a 1-month high and not too far away from its 14-year highs of around $39 an ounce. For silver, there are various supportive factors that you see in the market. You're looking at strong China industrial demand. China solar cells have seen an export of up by nearly 70% for the first half of 2025. Also, when it comes to photovoltaic demand, China has installed 93 gigawatt solar capacity in the month of May alone, which has been 300% higher on an year-on-year basis. So when it comes to industrial demand, retail demand, investment demand, all has been on the stronger side. Within the industrial demand, you have solar energy. The global demand estimated is at 1.2 billion ounces, and this is going to be a 4th straight year when silver is in deficit in the international markets. That clearly has been supportive for the silver prices, which are up, by the way, 35% in 2025 till time. Well, for the Indian markets as well, we've seen strong investment demand. India imports nearly 60% of its requirement, and India is looking to achieve nearly 500 gigawatt in sense of photovoltaic. So you will see that demand continuing to be on the stronger side. Also, India's goal for EV penetration by 2030 is one of the reasons that you are looking at silver imports into India continuing onto a very strong side. So if you were looking to invest in silver, well, you could be doing it by physical. There is silver ETF available. It also is by digital silver that you can buy. And then MCX futures is yet another thing. But it all comes to the PCE inflation data that comes in from US today. That would give you further direction on whether or not we see further gains before the weekends or not.
Right, Manisha, thanks a lot for that. So we will definitely keep an eye out on the US PCE inflation data coming in today, and then we have the US FOMC meet towards the end of the month as well. Take a short break, come back, focus on the markets and a lot of individual stocks. The auto stocks actually are picking pace right now. Bajaj Auto is off the lows by about 1.5%, just under the red line. So we'll watch out for whether there is some recovery after the initial sell-on news that took place. The Nifty and the Sensex have seen massive recoveries as well. Ticker team telling us 300 points off lows for the Sensex. Take a short break. On the other side, more on the markets and individual stocks. Welcome back. On a day when all the consumption stocks are doing well, we have Varun Beverages, which has moved to the low point of trade, and perhaps the reason for that could be GST as well, because for aerated beverages, caffeinated aerated beverages, etc., the slab will shift from 28% to 40%. So as a result of which, makers of some of these products not as happy as the other staples products, which are gaining in today's trading session as well. But that's about micros. Let's get to macro. An important data release that will happen this evening. The National Statistics Organization will release the GDP for the April to June quarter, the first quarter, that is, today. A CNBC-TV18 poll sees the Q1 GDP at 6.8%. To decode all of that, we have Lata in the studio. Lata.
Yep, that's the biggest number, the real GDP that everyone will watch out for, expected to come at 6.8, quite a good number at 6.8, something any country will give an arm and a leg. The GVA, which is the more important number because GDP has all those taxes included, that comes at 6.5, exactly the same it was a year ago. Again, not a very sad number. It is the nominal GDP that people are going to watch out for the first time. The NSO collects the nominal GDP, collects goods and services at today's prices, deflates it to get the real GDP. This nominal GDP we normally ignore, but it becomes important now because it's only going to come at 8.2%. Some people say 8%. And this is much lower than what it was a year ago. And look at what the budget was anticipating. The budget is factoring in a 10.1% growth in nominal GDP. If that falls, then taxes also fall because taxes are usually a move along with nominal GDP. Earnings growth of corporates moves. So this nominal GDP fall is going to be taken badly. Let me come to the other internals. You will have... okay, by the way, the nominal GDP is dragged down because prices are lower. WPI has actually been negative. So that is why the deflator is small and the nominal GDP is not going to be very impressive. And like I told you, you will see the impact on taxes and on corporate earnings. Coming to the internals of the GDP itself, it is agriculture that's going to be pretty good at about 5.8% or thereabouts. Industry at 5.3, not very impressive. Agriculture can't grow at 5%. It is still doing that. Industry ought to grow at 8-10%. It's growing only at 5.3. That's because power, etc., didn't do too well given the early monsoon. And services at 7.1 is a middling kind of number. Nothing much to complain. The GDP is going to be good at 6.8, like I told you, primarily because the government has done very good capex in the first quarter, especially when you compare it to the year-ago quarter where because of elections they spent nothing. So it was a superb capex spend that is going to push up the GDP. All said and done, today's number will be good. The nominal number will be something to watch out for. But that doesn't mean markets are going to get fired up by this number simply because the second half is where GDP is expected to fall below 6%, partly because of this tariff problem. So some minor celebration when the numbers come, but it may not last.
Okay, Lata, thank you so much for that. And we'll keep an eye out on the data that will be coming in from the GDP front this afternoon, but keep an eye out on that. Now, let's move on and talk about New India Assurance. Now, we're having these insurance companies that are in focus. A lot that has happened around that, right? So what are we going to be discussing with New India Assurance today? One is the impact of the floods that we're seeing in North India. What does this mean for companies? What does this mean for insurers? Other than that, we'll also be discussing the concerns over cashless insurance. That is going to be a key point to understand from here on what are we going to be seeing on that front. And GST, if there is any cut that comes in, ITC factor, the input tax credit, what does that mean? That is going to be key to watch out for as well. So these are the three important points that we're going to be talking about. And on that, tiff with hospitals that's been going on, is that going to be denting the growth, is key to watch out for. Now, on that note, let's bring on board Girija Subramanian, who's the CMD at New India Assurance, joining us on the show right now to talk to us about all of these factors and where are we headed and where is the insurance space headed from here on. Girija, good morning. Thank you so much for joining us on the show this morning. Let's start by talking about the recent events that have come in terms of the floods, which have become a major issue in the north, right? So, one, what is the impact that we could, see coming in on insurers, given that, in the past, whenever there have been severe floods, there has been a likely impact. So, what is your assessment? What are the claims coming in? What is it in terms of the likely loss amount of time? What are you watching out for right now here?
Actually, it's too early right now to comment on numbers. We are collecting data. As of now, there have been very few claims that have been reported. And we expect that these numbers in a couple of months or 3-4 months down the line, maybe we would be in a better position to comment. It takes some time for these claims to develop. As of now, the claims registered are not really very relevant.
What in terms of exposure would be the industry and your particular exposure to the northern part of the country? You would have the geographical spread, right?
No, we are, for New India, I can speak, cannot speak for the industry. But for the New India, for the western and southern zones, we are more focused. And we have more exposures on these two zones. North is not very heavy, especially the areas where these cats have operated. We don't have very heavy exposure.
All right. And you know, what's interesting is that after the first quarter, you gave very strong guidance. You did say that, you know, you would expect at least 15% in premium growth in FY26 versus 6% in FY25. Strong improvement in combined ratio as well, for which you haven't given the number. If you could give us that number, that'd be great. And, you know, now there is this boost which has come in on account of GST revision on health insurance. That's expected, reported by our colleagues from their sources in the finance ministry. How much further can your premium growth be? And in particular, your combined ratio, how much more can that grow in FY26 by?
Actually, the premium growth, even in the first quarter, we have grown at 15.5% and exceeded the industry average. And I believe that the rest of the year will also be at the same pace. Now, combined ratio, we will not be able to give you a number right now on where we will end at the end of the year. It will we'll be able to have this number only as we go each quarter. So that is, and on the health GST, I think it doesn't have, the health GST is applied over and above the premium. So the premium per se remains the same. The GST is applied over and above that. But the change could be in terms of the input tax element, wherein below 5% GST are not allowed to take input tax credit. So to that extent, there could be some change in premium, but the overall benefit to the customer will definitely be there. And all the benefit that accrues out of GST without, including the input tax credit for the company, I think the overall maximum benefit will be passed on to the customer.
Maximum benefit will be passed on to the customers. Just a quick one, ma'am. In terms of the tiff that is going on with hospitals, any concerns in terms of growth that we're watching out for, or resolutions are underway?
I think as we talk, there are, the talks are going on for resolution. So I don't think that this will continue for long, and we will find the hospital industry and the insurers would definitely find a way to coexist peacefully and to see that we are able to give customers the best benefit of our services.
All right, we take that point. Thank you so much for joining in. It was a short conversation, but a fruitful one nevertheless. We, leave you with a promise to join us back once again, where we have the modalities of the GST Council meet and the outcome, the specifics, which will come back as well. So that way you will have a better handle on, what the immediate impact could be for players like yourselves and the industry. Thank you for joining in. With that, we are out of time on this edition of Chartbusters, but you stay tuned to CNBC-TV18. A short break and a big market voice coming up for you right after this break on Trading Hour. From Vinny, me, thank you so much for watching.
Hello and welcome to our special edition of Market Masters. The big talking point is this: will US President Donald Trump's 50% tariff on Indian imports trigger a deeper market correction? Does India's long-term story stay intact despite the hit to exports? To make sense of what this means for investors, I'm joined by a market veteran and one of Dalal Street's most respected voices. Ramesh Damani is with me on the program now. Mr. Damani, great to have you with us here as always. It's a pleasure, sir. So let's just get the ball rolling with just your initial thoughts on how you think about these tariffs. And I must say, you were absolutely bang on when President Trump was elected. You were one of the few voices on Dalal Street who was very circumspect in terms of how this is likely to play out for a country like India. So in that sense, you've got it absolutely right. So, we're dealing with 50%, which has gone into effect in terms of tariffs. Opening thoughts, Mr. Damani.
Yeah, Prashant, thank you. I think what I said at that time was that the world is changing on its axis, and that's precisely what has happened. But Trump talks about making America great again. And let me give you some examples in history that actually made America great. In the 1940s, when America had beaten Germany and Japan in World War II, what they did was they announced a Marshall Plan to rebuild Germany and Japan of $100 billion. And that's what made America great again, not what imposing tariffs is. Closer to home, Prashant, in 1960s, when India was suffering a famine and was the leader of the so-called non-aligned movement, Indonesia, Egypt, and India were the leaders of the non-aligned movement out there. But India was suffering from a famine. So Kennedy and Johnson administration sent PL 480, Public Law 480 food and grains to India to avert the storage. That's what made America great again. Even later in the 70s, when America was stuck in a quagmire with Vietnam a few years ago, what they did was just a few years after the war ended, you could go to the Vietnamese War Memorial, which was basically bashing America, and buy a Coke by paying US dollars. That's what made America great again. So America has this outward, sunny disposition of taking the world along with it. What I'm afraid the president is doing a self-goal that will in the long term hurt America's interests, because, it's the old fable in Aesop that, you want to kill the goose that lays the golden egg. And I think they're forming some part of strategy of that, not understanding that when the world prospers, America prospers. So I'm, somewhat disappointed in the direction and tone of US policy.
You were apprehensive and now you're disappointed. What next, though, is the question. You said, the world kind of the expectation was that it's being turned on its axis. Will it remain turned, Mr. Damani? I mean, is this kind of the new normal, or it'll snap back in some ways? I'm not talking about a specific thing here, but is this kind of fissure, break permanent in your opinion?
See, I'm not a geopolitics expert, Prashant, but I'll tell you one thing, having played in a schoolyard, that if a bully comes at you, you have to stand up to the bully. Because it's not that he wants a better deal from you or he wants one particular thing. He wants to dominate you. And I don't think we fought for independence to be dominated by an economic power as important and as preeminent as America is. So I think there will be no deal that satisfy him. You look, he renegotiated NAFTA with Canada and Mexico. Then he made a deal with them, and now he's gone back on the deal. So no deal will really satisfy him. He wants dominance. He wants to prove that he is, the most important global historical figure, worthy of the Nobel Prize, worthy of the Nobel Prize in economics also perhaps. And I don't think any deal will satisfy him. I think over time, we will have to forge new relationships. And while I hope the 50% tariff will not last, I think at least for the next 3 to 4 years, America is proving itself to be a fairly unreliable partner, not only internationally, but also in what it's doing to its domestic institutions, whether it's the Federal Reserve or whether it's the Ministry of Health. I think it's proved to be a very unreliable partner. And I think that while India will pay a price for it, but as I go across this country, the last 6 months, I visited various companies across this country, And I come back always sunny and optimistic about the prospects, about the entrepreneurial vision of these businesses. And I'm investing myself in a wide range of businesses, even at the current time. So while there will be some pain for the textile people, for the jewelry people, for the shrimp exporters, and the like, I think it's bearable pain. I think what the government is doing is the right thing. For example, by recalibrating GST, by trying to subsidize a little bit of exports that India is doing. And I think not only will we survive, but God willing, we will thrive.
I think that's absolutely well put. Got to stand up to a bully because he doesn't want this or that. He just basically wants domination. Mr. Damani, for now, right, this, I know it's up in the air, we don't know, and there have been so many instances where actions have been ad hoc. Something has been announced. I'm talking about US and other countries over the last couple of months. Something's been announced, it's been deferred, it's been pushed back, something has been said, something else has happened. So we don't know. I mean, it's possible that this additional 25% goes off tomorrow, but what is your own sense? You're a keen follower of global news flow and you read a lot. What is your own sense, Mr. Damani? Because the longer this 50% stays, I mean, the larger the hit. I was talking to Sajid Chinoy of JP Morgan, who was making that exact same point. Sir.
I mean, I can't really speculate as to how long it will stay. But my sense is that it's very slowly getting baked into the economic forecasts of India and America. You know, America doesn't, at this point, really need Indian exports as much as it needs India's services. And I think that is a point that we should, look at least. We obviously have a lot of service exports to America, but America has a lot of service exports to India too, in terms of usage of Google, WhatsApp, Facebook, and the like. And, like China, for example, has followed a policy of domestic first. I mean, it's something that I'm sure they're considering, the mandarins in Delhi are considering that, if you will. I think the only way they said they can get from 50 to 25% is not by buying Russian oil. I'm not sure you want to give up Russia because at the end of the day, during the 71 crisis, during the recent crisis, they stood by India as a decent friend. So I think we can. I don't know. The geopolitics is a different ball of game. I'm not really conversant with that. But I'm not sure we should abandon Russia altogether. And it's very hard for me to say it because I'm unabashed American admirer. I truly believe America is one of the great countries of moral force of the world. But if Trump is so determined to unmantle 50, 75 years of development of the world, I think we have to look at other options. And I think the world will come up with other options. I'm very confident the next year or two, there will be other options in the world. And America will see its own preeminence decline over a period of time.
Absolutely. I mean, 50%, of course, can't be a permanent rate in that sense. But whether this will be brought lower through negotiation, what's the off-ramp, or organically, right? At some point next year, US consumers will start to hurt as prices go up. And that'll, midterms... Sorry, go on.
Yeah, I think you're right, Prashant. What the off-ramp is basically that when inflation strikes up in America, or when the economy does badly ahead of the midterm elections, or, we've been through this as a country. We know in the 70s and 80s, Indians were used to high tariffs and shoddy goods and a low standard of living. I mean, that's the same thing that's going to happen to America. America is such an innovative and competitive economy. Just to give you perspective, Prashant, when I was there as a student in the 80s, it was one of the biggest market for consumer electronics. And yet, even as early as the 1980s, it had no consumer brand that was American. All the electronics, the television sets, the radios, the tape recorders, the VCRs, were all, Japanese or Korean or, Singapore brands. They didn't have a domestic brand left of consumer electronics, because it was an economy that thrived on innovation and moving ahead. So just right now, as it's powering ahead with AI and with data centers and with so many other things and leaving the other fields behind, I don't think Trump understands that. I think the feeling that he's going to bring back manufacturing to America, in my opinion, is a pipe dream. It's not going to happen. It's just so clear it's not going to happen. And as that reality sinks in after 6 months or 1 year, as the midterm elections rolls around the corner and the president is answerable to voters, I think that will be the off-ramp where he will change it. Right now, he's almost walking on water. Whatever he says is happening. Everyone is falling in line with him, whether it's the Fed Reserve, whether it's the Health Department. I have to believe that at some point, the road will hit the rubber and he will have to recalibrate the policy, because I absolutely refuse to believe that tariffs, inflation, low standards of living, shoddy living are something that Americans will accept willingly.
Absolutely. Mr. Damani, we'll get to markets in just a bit and what they're pricing in and whether more needs to be priced in. You said economic models and forecasts are slowly baking this in. But just one point. I mean, this is also such a critical moment in this the apex technology of our times is artificial intelligence, right? And US is clearly leading. And China is close on the heels. And some believe that this is, every technology cycle, of course, in the beginning seems like it's going to completely demolish the older order, but some truly believe this one in a way will, because it is so transformative. Given the 50% tariff is one thing, but it also kind of this, tiff with the US in that sense also hurts us in these ways, right? Technology transfer, integration into that tech value chain, etc., etc. Are you worried about that, Mr. Damani, at all, if this goes on for a bit longer?
I tell you, the thing that I don't worry about is that we have 1.4 billion consumers, and as much as America may sneer at it, they need those consumers. I think Facebook, WhatsApp, Google, search would be much poorer offerings without the ability to tap into that 1.4 billion Indian consumers, So I think a lot of the language learning models are based on Indian databases. A lot of user cases for AI comes from India. So, I'm not really scared that they would, stop the technology transfer to India. I mean, that would be another example of self-goal that they would be doing. And if not, there'll be plenty of European companies willing to do it, or American companies setting up shop in India to do it. I think at some point there will be a reckoning, high noon for Trump's economic policies. It has perhaps been delayed. I thought it would be earlier than it's been now. I think 6 months into this draconian, I think he would have started feeling the effects. Clearly he has not, because the Dow is making a new high altogether, and the American markets are showing a lot of confidence. But somehow I feel that confidence is a bit misplaced, and maybe this will not be a drip, drip, drip type of bear market, but one fall day, it will be a straw that broke the camel's back. Something will happen that will trigger a fall in the market, and then the reality of how to deal with it will strike them. But I think what is going for India, Prashant, right now, is that we are 1.4 billion consumers strong, a very strongly domestic-focused economy. While there will be damage on the periphery, you cannot ignore that. There will be some damage on the periphery. I think India is well positioned to recover from that, because basically only about 1-2% of our GDP is consisting of US exports. So while it's important, I don't want to undermine the importance of that. I think it's an overcomable problem.
You mentioned markets briefly, Mr. Damani. That's exactly what we're going to focus on. But I have to take a quick commercial break. Stay with us. We're right back with Ramesh Damani on markets and what are they pricing in. Stay tuned. Welcome back. We're in conversation with market veteran Ramesh Damani, who's with us. We've been talking, of course, about the India-US tariff tiff, 50%, what happens to it. And Mr. Damani, of course, so you clearly believe that, businesses here remain vibrant and we've got a large consuming class, which, as I put it, I think last week before last, is our rare earth, if I can use that terminology. I mean, that leverage or whatever you want to call it. Mr. Damani, let's talk about markets. Are markets adequately pricing all of this in right now? I'm talking about the markets here in India, although you alluded to US markets and what they may do. But here in India, what is your sense? Is all of this getting priced in?
I think, on the D-date, the markets were surprised that there was not a rollback. I think the market expectation was that it would be rolled back. It didn't happen, so the market has taken it on the chin for the next few days after that. So I think even as we speak to you, it is kind of pricing that in there. But, the impact is not on the domestic phase economy. The construction companies, the telecom companies, the hotel companies. I mean, I don't see why they would go down per se, because that is like throwing the baby out with the bathwater. There are certain export-oriented sectors which are a bit labor-intensive, but not very, very important to the Indian economy. Jewelry, shrimp exports, textiles, which will probably experience a slowdown. But the rest of the economy remains fairly well sheltered from that, because we are a domestic economy, like I've often said, and there's a lot of domestic-facing industry that will continue to do well. Thank you.
Yeah. Okay, fair enough. Markets have been, investors broadly for the last 1 year, Mr. Damani, you would agree. Of course, there are always cases, one-offs and some stocks which do well in any kind of market. But for the first time in the last few years, things have been flattish, Mr. Damani, right? What is your own expectation? I'm not asking for a near-term forecast, but what is your sense? A bunch of people we've spoken to recently have said, and foreigners have been big sellers, although local investors have been even big buyers, but foreign buying does matter. I think as this episode and past episodes also show, for markets to do well. What is your sense, Mr. Damani? Next 2 quarters, 3 quarters, will we make a bit of a bottom? As far as earnings go, will earnings start to perform better on an overall basis? And consequently, what does markets do?
Yeah, it's a question that, of course, perplexes me every day, Prashant. But we've had almost a stellar run since the COVID lows. We've gone up 3-4x on the index level. Individual stocks have obviously done far better out there. So if it remains range-bound or sideways for the next years, 18 months, I'm okay with that. I mean, there's no indication yet to suggest that the bull market that began in COVID is over, that it will continue. And markets go through long periods of consolidation before they move up. Having said that, I mean, when I go and visit companies or I go and visit entrepreneurs, I go and visit speakers, understand what they're saying at conferences, I see no reason to be bearish. I see attractive opportunities to invest at valuations I understand and in businesses I believe in over the next few years, and that is both in the listed space and in the private equity space. So, from my end, I remain sanguine. I think it's a good time to invest in great businesses. And that's always been the mantra. Rather than invest in any old thing, is find a good business and remain invested in that business. I think the market consolidates for the next, say, 6 months, 12 months. It's fine by me. I mean, markets are not of the creature that should go up year on year, year on year. It happens in the first years of a bull market, then consolidate, and then picks up steam again. So I think we may be at best in a good consolidation phase. I certainly don't think we're in a bearish phase of the market. And I would expect that in some due course, the market will pick up and, challenge the old highs.
Mr. Damani, have you, dramatically shifted your focus to the private equity space, unlisted space in that sense? Many investors in your peer set that we speak to seem to suggest that. You're smiling, but is that correct? And do you think that's a function of valuations? I mean, you want to kind of go back and back to find, better starting points in terms of PE multiples. Go on, sir.
I don't know, Prashant. It's one of those things. Yes, I have done it. I moved a bit more money into private equity. Some of it has worked out pretty well for me.
Yeah.
So I think that kind of reinforces that. So you tend to do more of that if it happened. But I would say as an overall, say if you ask me my percentage, I don't think more than 10% of my portfolio is in private equity right now. But, yes, I have. It used to be like 98% listed equities, 2% private equity. So it's up to 10%. So it is, getting, to be serious amount. But I think some of the early decisions have proved to be correct, or they made me money. So you tend to, do a bit more of what's making you money. And some of the valuations are, a bit stretched in the secondary market, which is fine. But I'm categorically telling you, thumping the table, I find as I visit companies, a lot of opportunities in the secondary markets too. So, I'm happy doing a mix of both.
That's interesting. Mr. Damani, you were bullish on the defense space in a big way. Lots of companies you own. Could you give us a relative sense of your exposure there compared to the peak?
I mean, they have been significantly reduced, but, I just got prices that, I believe were, forecasting, 2-3 years of growth. So I was happy to get rid of some of them. But some of them I've still kept. I mean, so it's not that I've exited all the defense. In fact, I haven't exited any of the defense names broadly. I've kept them. Some of them I've, lightened my position, just took some money off the table, if you will. But I think if you look at some of the public sector stocks in, say, the construction space, or you look at in the rare earth space, I think there are plenty of opportunities even in that sector in those businesses. So we have moved some money from, say, defense into, say, construction, rare earths, that kind of space, yes.
E-governance solutions, right? I mean, I think has been something that you backed, and you've done that in a way in different ways, right? I mean, on the private side as well. Still remain bullish, Mr. Damani?
To be honest, and I'd use this public medium first to explain this point to you, is that I'm not on any public medium other than coming on television. So people ascribe a lot of shares to me, which I may or may not own. But having said that, so please don't follow social media. I mean, if I speak on TV, I am not on any other social media. But I have been bullish on this digital public infrastructure. The stock hasn't worked out. It had a pretty sharp fall. But it seems to have found its legs. Some new orders are coming in. The market seems to have bottomed out. So, I remain bullish on that. But I think I clearly probably overpaid for it. I think that was the risk in the stock. But, the opportunity still looks pretty promising. I wish I had done it at a low rate. But, that's the nature of the market.
Specialty chemicals, another area you like, Mr. Damani?
I have bet a few shares. I have a friend who knows that area particularly well. So he's kind of guided me into that area. Having said that, Prashant, I think the more important point I'm trying to make is that I'm not fully invested in the market, but I'm well on my way to being fully invested in the market. But as always, I'm over 85-90% invested in Indian markets. And I continue to look and hunt for opportunities to find good businesses. I'm not getting rattled by the tariffs or by other things. I think the expansion will continue to take place in India. There's continued opportunities to make money in India. And we are happy if, markets consolidate 2 years. I mean, I'm not certainly of the camp that says that if the market doesn't go up 20% this year, it's been a disaster. I mean, that's just not been my experience.
Well, that's very well put. And I think that nicely brings us to a close in this conversation, Mr. Damani. Thank you so much for your time, sir. And it's reassuring. And, of course, lots of insights in that conversation as well. We started, of course, with a bigger picture, 30,000 feet. US and its relations with the world, India, and, of course, a bit about the markets towards the end as well. Really appreciate your time here on this episode of Market Masters.
Thank you, Prashant.
Well, that's it from me. Stay tuned. More coming up after a quick commercial break.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always as Hormuz Fatakia and Reema Tendulkar. Well, a Friday morning and we are seeing gains of around 53 points on the Nifty. We've seen almost 100-point recovery from the lows as well. There was this sharp fall that we saw around 10:30 that has seen a massive recovery as well. FMCG names are batting it for the bulls, so 0.7% higher on that one. Private banking index is doing really well. So Bank Nifty overall is up around 0.3%. We do have the small cap index and the mid caps doing well. So across the board, it is a green looking screen. The GST boost that is expected to come by is something which is making these moves on the major names as well. Mid caps, by the way, at the day's high. It's only autos and IT which are bucking the trend right now. And autos, despite all the news that flow that we've been seeing, that Jeffrey's addition in the portfolio, but autos seem to be bucking the trend. But again, that also has recovered from the lows.
Indeed. And also bear in mind, for the last 4 trading sessions, the Nifty is down 600 points. So, markets have been very edgy. They've been very nervous. So today there is that rebound. But there are 2 important triggers lined up. One is the GDP print back home at 4 o'clock. And then you've got the Reliance AGM starting 2 p.m. So that will keep markets on their tenterhooks.
In fact, it was Reliance yesterday that ensured that the Nifty closed above that 24,500 mark, just at that. So for now, we still trade above that 78.6% retracement that we had from the August 8th low, which was 24,337, to the 21st of August high, which was 25,150 odd. So we are above that level, which was around 24,512. So we are above that. So at least for now, it's a steady start to the September series, if you could call it that, for the index. But of course, there are a lot of movers in the broader markets that we are talking about. Of course, Yes Bank is the top gainer on the mid-cap index today, 4% higher on that stock. Indus Towers is another one, 3% higher on that name. And the stock that has gained every single day this week, this truncated week, and that has been Ola Electric. So 2.5% higher on that stock even in today's session. So the stock is at 56, and the stock now heading towards its 200-day moving average, which is at 59. And this 35% surge that the stock has seen in August will be the best month the stock has had since listing. But some of the other movers then that I wanted to mention in our link for the top buzzers, Advanced Enzymes was one of them. And the stock was up yesterday in a market which sold off sharply. The stock is up today as well. So 16% higher in the last 2 trading sessions. And look at the volumes here. 90 lakh shares have already changed hands compared to a 20-day average of just 3.5 lakh. And in fact, the stock was up yesterday as well. So the volumes have already surpassed yesterday's volumes. So on very strong volumes for Advanced Enzymes, and considering the fact that the stock has moved higher, it has just about managed to recover all of its losses, and it could well be the 6th straight month that the stock has gained this year. The other one, of course, is Vardhman Textiles. We spoke about that in Closing Bell yesterday. We highlighted it in today's edition of Bazaar as well, seeing some profit booking after yesterday's sharp surge. But the only commonality is that the volumes continue to remain on the higher side. Even today's session, we have already seen 52 lakh shares change hands. The 20-day average is just 3 lakh shares. So that is another one. And barring yesterday's session, the last 7 sessions has seen the stock decline in 6 of them. So Vardhman Textiles continues to remain under pressure. Yes Bank, as I just mentioned. Now, this is possibly going to be the 3rd straight session of 10 crore plus shares in a single trading session this week itself. Barring yesterday's session, the stock had 10 crore shares traded on Tuesday and on Monday as well. And it's about to set for that today. So 8.5 crore already compared to a 20-day average of almost 3 crore. And with this move, the 4% move, the stock is now trading above its 200-day moving average of 19.2. The other one, of course, the last one on the list is BSE. Has a very forgettable week. Down today's session as well. Has been down all 4 days this week. down almost 9% so far on a week-to-date basis. Today's volumes were 35 lakh shares traded compared to a 20-day average of almost 20 lakh. And the way it's hurtling down, the next important level that you can see on the downside is the 200-day moving average, which comes up to around 2072. So still around 70 rupees away from those levels, BSE, but it's been a fairly forgettable week for the stock.
In fact, it's been a forgettable week for many of the capital market plays, right? So Angel One is down 11% this week. CDSL is down close to about 8.5%. So these stocks continue. And despite the relief that we're seeing a little bit in today's trading session, for the week we're still down. The Nifty is down about 1.25%, while the mid-cap index is down close to about 2.3%. But remember, for the prior 2 weeks, we ended on a positive note. There were weekly gains, but this week we will snap that. There is a recovery, though, which is currently afoot. We'll slip into a very short break. On the other side, we'll discuss market fundamentals. So stay tuned for that discussion. Welcome back. Looking at the large cap screen, Shriram Finance is your top gainer, but this is after struggling in the early part of the week. Even after today's 2.5% gain, the stock is down 5% so far this week. Trend seems to be the big beneficiary of the sweeping GST reforms. The threshold for the application of 5% GST on ready-made garments will be raised, according to the sources, from 1,000 to 2,500. So that should benefit a stock like Trend. It's one of the big movers, 2% higher on that. Kotak Mahindra Bank has seen an upgrade from UBS. They've put the target price at 2,540. That's about a 25% upside from current levels. UBS argues the stock has underperformed. The Nifty by nearly 11% in the past 6 months, plus valuations at 1.7 times price to book is fairly attractive. But Sudarshan is now at the F&O desk with the latest trends.
So market has seen a recovery from opening hour lows, but we can't say as of now that if we are out of the danger zone. For that to happen, Nifty has to cross the level of 24,600. It's still away from that. And today's support is coming mainly from FMCG sector. Companies like Trend is moving higher on the back of basically on the expectation of GST cut. As far as volatility index is concerned, there is some stability. That indication we are getting from that, it's back below 12. PCR, it's at 0.89 versus 0.91. Now, if we talk about the Nifty Bank, which is the biggest contributor to market, now support would be today's intraday low, that is 53,800. But any buying in that can happen only when Nifty Bank crosses the level of 55,000. We are much away from that. Now coming to Nifty, two options. On the call side, I have taken 24,700, which is seeing a huge option build-up, but there is a minor fall in the premium. Currently, it's at 54 versus yesterday's close of 54. Currently, it's at 44 versus yesterday's close of 54. As far as put option is concerned, big move is seen in 24,500 option, where premium has fallen to 64 versus yesterday's close of 95. So it tells you for now, 24,500 seems to be protected for Nifty. So support would be 24,460 to 24,500. Resistance will come only, buying basically will come only when Nifty moves above 24,675, that is 100-day moving average. Two stocks that I have taken, CG Power, that is seeing fresh longs, and Capital Marketplace remain under pressure, and BSE is seeing fresh shorts.
All right, Sudarshan, thank you so much for joining us with the FNO setup and also the individual names which are in focus. We'll do one thing, we'll slip into another break. We'll talk about the big story next that's moving the markets.
Welcome back. Now, the big story of the day that we've all been talking about through the morning, and it has to be the sectors and stocks that will be impacted amidst the upcoming GST rejig and our exclusive news break on the developments. Now, to help understand and break this down for our viewers, Mangalam, Vinny, Sudarshan, all of them are here to tell us the impact of the sectors and the stocks. Mangalam, first to you, what are the stocks that are likely to see a thumbs up because of this rate rationalization?
I don't think you need me to tell you that, Hormaz. You know, the ticker is telling you that already. A lot of these consumer staples are doing extremely well. So you have the likes of Colgate, HUL, Godrej Consumer, Dabur, Britannia, all of them doing well in today's trading session. Though the one stock which is not doing well is Varun Beverages. That's the one which is under pressure in an otherwise fairly steady market, at least as far as the consumption space is concerned. Remember, consumers were expected to show better performance in the second half of this year. So this GST cut will only come as an additional kicker to the overall sentiment. Over the last few quarters, if you notice, urban consumption was weak, rural consumption was gradually picking up. Now the street believes that maybe the worst is behind, and now this adds only as a further fuel to the fire which was already there in the consumption stocks, add to all of the underperformance that we've seen in the staples lately as well. So what our colleague Timsy has been gathering from her sources in the ministry is that there's talcum powder, face powder, hair oil, shampoo, toothpaste, dental floss, soap, toothbrushes, all of them which were currently taxed anywhere between 12 to 18% will come down to 5%, which basically means lower price that you and I as consumers have to pay, which implies that lower price, higher demand for these products and increased FMCG volumes. The only reason why names like Varun Beverages are sulking is because, carbonated beverages or caffeinated carbonated beverages, which were currently taxed at 28%, are now likely to be pushed into the 40% bracket. So that makes it a little expensive. GST on biscuits too, likely to be 5%. That's why Britannia is buzzing. Then you have the footwear stocks which are buzzing as well. We have Bata and Relaxo, because GST on footwear priced above 2,500 rupees will come down from 18% to 12%, and below 2,500, remember as a nation, more than 90% of the footwear sold in the organized market is below 2,500 rupees. That will come down from 12% to 5%. And finally, we have the hotel stocks as well in focus. There is a bit of a devil in detail that we'll have to track, which is the input tax credit. Currently 12% plus input tax credit proposed for hotel prices for sub 7,500 per night to be 5% X input tax credit. So this is something that we'll have to currently watch out for. Even for ready-made garments, the increase has, or the reduction in GST has increased the prospects for players like Trent.
Okay, all right. But input tax credit, that continues to remain the big talking point. We'll discuss that and understand that in greater detail. But let's talk about textiles. Vinny, earlier it was tariff, now it is GST. So it's been a busy time for the textile industry overall.
Absolutely a busy time for them, but this is at least a relief coming in, right, where we are seeing higher tariffs. Hope this actually something that will boost the consumption. Now, obviously, in terms of GST, what are the proposed changes that have come in? And this is according to CNBC sources. They are saying that a synthetic yarn, sewing threads, there are other forms of yarns that could see a shift. Currently, that GST is at 12%, could shift to 5%. Now, some products, including carpets, gauze, that could move to 5% as well from previously 12%. Now, the interesting part that has come in this time is the hike in that threshold price, right, for ready-made garments. Currently, what we were looking at is there was a 5% GST for products that are 1,000 rupees, right? If they are 1,000 and above, then you would be charged 5% GST. Now, that has moved up to 2,500 rupees. So that is the most interesting part that has come in right now, because then a lot more players will start benefiting from this one. And ready-made garments priced about 2,500 rupees were previously would attract now 18% GST from 12%. So up to 2,500 rupees, maybe that 5% GST, and then above that, we would see 18% GST. So yes, if they're exclusively, expensive items, that would become more expensive. But yes, still 2,500 rupees, it will be cheaper. And that is why we're seeing, positive signs that could come in for ABFRL, Arvind Fashion, Page Industries, Vardhaman Textile, Vedant Fashions, among some of the names.
Thank you very much for that. And let's round up this discussion with Sudarshan joining on auto and cement.
So both the auto and cement sector will see a reduction in GST as far as like what information we are getting from sources. So first talk about the auto sector. Most of the companies will benefit as we are expecting the GST rate might be reduced to 18% from the current rate of 28%. So first talking about ambulance vehicle, motor vehicles, that might see a reduction to 18%, and the biggest beneficiary of this would be Maruti. Second, for petrol, diesel, LPG and CNG vehicles, there might be a reduction, but for petrol vehicles, it should have the capacity up to 1200 cc, and in length it should be of 4000. For diesel, it should have the capacity up to 1500 cc, and in length 4000. Biggest beneficiary if GST rate is cut would be Maruti, M&M, Hyundai and Tata Motors. Now coming to bikes. So for bikes and three-wheelers, again reduction is seen to 18% from 28%. And for motorcycles, it should be up to 350 cc. So biggest beneficiary would be Eicher. So for Eicher, almost 86% of their portfolio have the bike with capacity less than 350 cc. And similarly for Hero Moto, almost 95% of their portfolio have the capacity less than 350 cc. So both of them would be biggest beneficiaries. Auto parts also would benefit because there also we might see a reduction, and biggest beneficiaries here might be Endurance Technology, Bellrise or Sona BLW. But for certain segments, there might be an increase in GST to 40% from 28%, and those are racing cars, motor bikes having capacity of more than 350 cc, and motor vehicles having capacity of more than 1200 cc, and in length, if it is more than 4000. Now, in the cement segment, overall rate is going to be reduced to 18% from 28%, and brokerages believe that if rate is reduced, now price would come down by 7 to 8%. So overall, it would benefit companies like Ultratech, Shree Cement or Dalmia Bharat.
Okay, all right. Thank you so much for explaining that to us, Sudarshan. But more on the GST front, General Insurance Council reaches out to FinMin is seeking inverted duty structure if GST exempt on health insurance. Yash has all the details.
Well, Sonal, insurance and particularly health insurance is one sector which stands to lose out if GST is taken to the exempt category from the current 18%. That's because the first disappointment which got known to the market was that when GST moves to exempt category on health insurance from 18% currently, there won't be any input tax credit benefits which the industry would get to offset the cost which it makes on securing that health insurance premium. What the industry was hoping for on the other side would be that the government would do away with the inverted duty structure, which means if it is, paying no GST to the government as far as the exempt category is concerned, it won't have to pay any GST on the input expenses that it makes on securing that premium. What we've been given to understand is that the General Insurance Council has written to FinMin, asking them to do away with the inverted duty structure. But at the same time, we are learning from our sources that the government is unlikely to do that and continue with the inverted duty structure along with GST exempt. And this could lead to a price increase of about 7 to 10% for insurance companies.
All right, Yash, thank you so much for joining in. So that's all about GST, our big story. Let's move on and get in Shubhani Sarkar Kurian, who's the head equity research and fund manager at Kotak Mahindra AMC. We're going to discuss their latest note on the chemical sector and a lot more. Shubhani, good morning. Thank you so much for joining in. Well, in this note, you're talking about how big of an opportunity the chemicals industry could be in terms of growth going forward. The data given suggests that India has seen a market share of 2% in 2003, which has just risen to 3% in 2023. That's basically 1% gain in something that we've seen in the last 2 decades. What makes you so hopeful that the next decade could be for India? Because now we have the tariff issue looming, and China, despite all the shutdowns, has always been the leader in chemicals industry. Even Europe is not far behind. So what's making you so optimistic here?
Hi and good morning. So you're right. When you look at India's market share today in the overall global chemical construct, we are at about 2.5 to 3%, while China, of course, is the leader by far at about 40%. Now, when you take a step back and look at what has happened in the chemical space, maybe over the last 3 years or so, 2 factors. One, global demand has slowed down because of macro factors, and that had led to destocking. And of course, China having a significant capacity, had been dumping in terms of the global export market, and that had led to a significant price correction as well. But now when you look at what's incrementally happening and why we are positive on the sector, one, after a period of muted growth, now there are signs of stability. Also, as far as pricing is concerned, there is a big change that is taking place in China, which is called the anti-involution policy. And this policy essentially aims at curbing overproduction, focusing on quality over quantity. And this over a period of time should also help in terms of reducing the pricing war. Now, you're right that India, in terms of market share, is still fairly small in the global chemical construct, but India has also built significant capacity and capability as far as specialty chemicals go. And that is where we believe that there is potential for the country to gain market share, especially as the China Plus One strategy plays out over the next few years. And hence, if you look at today, the chemical space in terms of valuations, the sector is trading at multiples in comparison to its own history where multiples are attractive. We are now seeing signs of growth stability come back, and hopefully growth should improve from here. Pricing wars also should start to abate. And given the fact that there is a significant amount of capacity building that has been done as far as India is concerned, India remains fairly well placed to incrementally gain market share over the next few years. So it's a fairly medium-term construct for the chemical space.
Shibani, will this benefit all the sector? My question is this a rising tide which will lift all boats? Which are the segments that you like? And tell us a little bit more about the growth expectations. Is this an industry, or the sub-segments, will they see a 10% plus kind of an earnings growth for the next 5-10 years, or 15%? And you spoke about valuations being attractive. Can you put numbers to that?
Sure. So, of course, the chemical space in India is fairly large, and India is present in different segments of chemicals. But in terms of areas of growth, there are three key areas that we're looking at. First, of course, is the pharma segment, where chemicals and players who are supplying in terms of pharma intermediaries, CDMOs, there is considerable potential to grow. And here, again, India's penetration in terms of the global markets are still in low single digits. And therefore, with rising healthcare demand, we believe that the export potential as far as pharma intermediaries are concerned within the overall chemical construct, that is one area of growth. The second area of growth is the agrochemical segment. Here, we believe that crop protection demand overall should see some amount of rebound. Even within, of course, India, demand has been growing. And therefore, research seems to suggest that, if you look at major global agrochemical inventories, that is at multi-year lows. And therefore, from here on, volumes and margins could recover over the next couple of years. So agrochem is the second space. And third, of course, is the advanced materials segment, which includes segments such as refrigerant gases, battery, energy, chemicals, and the others, where again, India can, gain market share, and these could be key drivers for growth. If you look at a broader construct in terms of growth expectations over the medium term, there have been studies which now suggest that high single-digit growth, maybe in the range of 7 to 9% is possible for the Indian chemical sector over the medium term. And that we believe should be the key driver. Of course, the segments that we spoke about, the pharma intermediary, agrochem, as well as advanced materials in some terms of segments such as refrigerant gases, could see higher growth. And that we believe should help in terms of multiples re-rate for the sector as a whole.
Right. Pleasure having you as always, Shibani. Thank you for sparing time and joining us today with your views on this entire specialty chemical space. The next decade possibly could belong to India. Now, as promised, let's shift focus to the crypto space. Manisha is here with more on this.
Well, on Crypto Corner today, we are talking about three very important developments that we've seen in the last couple of days in the international markets there. The major one clearly comes in from the fact that the US government is now publishing GDP on blockchain. The US report suggests that they are not replacing the usual ways of sharing the data, but they are adding a new one onto this one. Well, the US has put out second quarter 2025 GDP data on 9 blockchains. This is, remember, the blockchains are transparent, they are tamper-proof, and this is a new way and new progress that the US government seems to be making. So the 9 blockchains that have been utilized or used as of now, where the data has been shared on, is blockchain, Ethereum, Solana, Tron, Stellar, Avalanche, you have Arbitrum 1, Polygon POS, and optimism. So clearly a new beginning now coming in from US government there. The second important thing that I want to draw your attention to is the JP Morgan report, which says that the Bitcoin falling volatility is making it appealing to the institutional investors therein. So when you look at the last couple of years, the volatility in Bitcoin has reduced sharply, making it way more buyable or attractive really for various family houses, for institutions, even companies for that matter. So capital inflows should match that of gold in coming some time, and that requires 13% increase in market cap. This also comes in from the report from JP Morgan. In addition to that, the JP Morgan report also says that Bitcoin could see more upside. It is undervalued currently by $16,000. Well, that's my second one. But third is even more important. The US President Trump and family are planning for a digital asset treasury company. Now, Trump Media and Tech Group has announced that they are partnering with Crypto.com. Now, what brings this to the table is that there are plans to build Corona's treasury with nearly $6.42 billion with the backing of Trump Media, York, and this also would have Crypto.com as a founding partner. So this is what we are seeing as a new coming up. Apart from that, the Trump Media is also expected to announce or introduce a reward system on Truth Social and Truth platforms. And then Trump Media is planning to use Crypto.com also for digital wallet infrastructure and adopting of Kronos as the utility token. So three major things, as I told you, that have happened in the international markets in the last couple of days.
Never a dull moment when it comes to Trump, the headlines, though they enter into the long weekend, the US markets. Well, that brings us to a close on this edition of Trading Hour from the entire team. Thank you for watching.
Even as US tariffs cast a shadow, a glimmer of hope appears in the proposed GST revisions. FMCG and other consumer durables take a positive cue, but IT and auto continue to drag.
Reliance Industries holds its AGM this afternoon amid expectations of fresh insights into developments in its new energy business, even as indications on the expansion of its Jio, retail and O2C verticals are keenly awaited.
A raft of changes across sectors are proposed by the group of ministers spanning automobiles, FMCG, consumer durables, apparel and more. Most experts believe the proposed revisions will give a significant boost to consumption.
A group of ministers bats for the common man in its GST review, while daily consumer products like toothpaste see a sharper tax cut. Even economy class cars, bikes and airline tickets along with hotel rooms will get cheaper, and luxury premium goods services will get dearer.
Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Mangalam Malu as well as Vinny Motiwala. Well, it is turning out to be a day where we're just about buying time, consolidating, and that's largely been the trend for us in the past couple of trading sessions. So currently the Nifty just about higher by around 40 odd points. We have the Bank Nifty which is up around 130 odd points, so doing a little better on that front, but marginally, and the mid-cap index seeing a little bit of a bounce back today. Well, it is all about the worries with regards to the tariffs of around 50% and what the impact could be on the economy. But yes, what the GST rationalization or the proposed rationalization could do to offset that is possibly keeping sentiment a little buoyant at this point in time. A lot of stocks in focus, guys.
A lot of stocks in focus, Ekta. Indeed, as we speak, we have the consumption stocks, none in more focus than those FMCG stocks, though it's been very choppy for the frontline index as well. We saw a good opening that after that was sold into, that tip was bought into, we went higher, and now we're off highs once again. So the Nifty holding, meandering around that 24,450 to 24,550 sort of mark. Right now, as we speak, a lot of these insurance stocks are picking pace. So HDFC Life comes up for you on the screen. Bajaj Finserv comes up for you on the screen as well. And alongside that, we have some traction that we've seen built on a couple of these other names like CG Power and, LIC Housing Finance as well. These stocks higher. By and large, more stocks higher than the number of stocks which are lower. But then again, we're still not out of danger, not out of the woods.
Absolutely. Good afternoon, guys. So, interesting day, I would say, given that at one point of time, we were seeing that underperformance coming in from the mid and small cap. Now, as of now, managing to hold on to some bit of a gain right now, 0.4% for mid cap, small cap, also managing to hold on to gains. And obviously, advance decline ratio is in the favor of advances versus declines as of now. And during this week, we've seen a lot of move that has come in from Ola Electric as well. Now, obviously, in this week itself, it's up almost 18-19%. This month, it was up almost 35% as well. And in our unusual mover segment, Sudarshan will focus on Ola Electric, which has surged more than 35% this month, like I was saying. Sudarshan, what's charging the stock this month, this week that we're seeing? What is leading to this run-up?
So first, talking about the stock move, this month it's set for the biggest monthly gain that stock has ever seen since listing. So it's up 36% this month so far and 19% this week. Also, another trigger is that company is set to become the number 2 player amongst all the electric two-wheelers. So if you take a look till the last week, Ather was the number 2 player, but just yesterday, Ola Electric has once again taken over. Now, as per Vahan registration data, registration for Ola Electric is more than Ather Energy. So as per Vahan registration data, Ola Electric's registration as of yesterday was 15,514 units against Ather Energy's registration of 15,457 units. Now, let's take a look at trading volume. So yesterday, total trading volume was around 85 lakhs, and that was against 7-day average of 53 lakhs. So it tells you that on a daily basis, Ola Electric continues to see huge trading volumes. Last week on one day, we had seen trading volume of more than 100 crore even. Now it's near the 200 daily moving average of 59.24, and from the low of 40 it has seen a sharp recovery. We'll have to see if it manages to cross the 200 day moving average of 59. Now let's take a look at the tailwinds going forward. So recently company has secured PLI certification for Gen 3 scooters. Remember, Gen 3 scooter forms majority part of its volumes, almost 60 to 64% of total volumes. Now receiving the certification for Gen 3 scooters, the company had already PLI certification for Gen 2 scooters, and now it's eligible for incentives in the range of 13 to 18% of total sales value, and that will be valid till 2028. Apart from this, after Q1 earnings, company had told that auto business EBITDA margin will turn positive in Q2, and for FY26, company is expecting auto business EBITDA margin to be 5% or more than that, and also it believes that after receiving PLI certification, profit is expected to improve further in Q2. So overall, it's looking positive for Ola Electric, not only in the stock price front, but even on the fundamental basis.
Okay, all right, Sudarshan, thanks very much for that. So that's Ola Electric buzzing in today's trading session, up around 2% at this point in time. Just watch out for Zydus because they've come out with a press release indicating that one of their key drugs, which is sarglitazar, which is basically being studied for liver conditions, has met some endpoints or seen a successful phase 2 study or phase 3 study. So we'll try and get you more details. It's a phase 2B study, so they've seen a successful outcome on that, and that's important for them because sarglitazar, which is basically a liver condition drug, is being looked at very closely for Zydus Life. More details on that later, but just keep that stock on your radar. We'll take a short break. We'll get you more markets and stocks on the other side. Stay tuned. Welcome back. Well, for the markets, it's turning out to be a bit of a steady session. So let's see how that pans out. Currently, we have the mid-cap index, which is up around 0.4%. Just want to point out a couple of stocks from the broader markets, which seem to be gaining some amount of steam. So we have Shriram Finance, which is up around 2.5%. Trent, which is not doing too badly, so up around 2% at this point in time. So a couple of these stocks are really leading from the front, you'd have to say, for the Nifty space. From the broader markets, just watch out for Granules India, because that is showing a good amount of momentum. In fact, it's gained around 10% this week, and majority of the gains have come in at this point. Today itself, it's up around 8% Year to date, not done great, so it's still down around 14% on a year to date basis. That's Granules for you. That stock at around 507 rupees, and RBL Bank, which is up around 5% as well. But let's talk about a couple of stocks which are in focus on account of the GST impact. Mangalam, tell us more about the FMCG sector and what can we expect?
Well, a couple of things. One, the sector was already on its way up after the last 2 quarters. In fact, the sector has been struggling for the last 6 to 8 quarters when it comes to growth, etc. So the street was hoping for some sort of revival to happen. Add to that, this additional push that, the government has given over and above the tax cuts and the interest rate cuts by the RBI will only lead to more money in the hands of people, which the belief is will lead to a further uptick in the consumer staples consumption or the volume growth itself. And that's exactly why these stocks are buzzing around. If you look at the biggest gainer right now, it's Colgate. Remember, the street was fearing that maybe the rate on toothpaste may not come down from 18%. But now that we understand from sources that Tim C has been speaking to, that it will come down to 5%. There is that additional kicker that has come in. So Colgate, which has been an underperformer, is now catching up to all the other players as well. But the others, HUL, it's been doing well, ever since its first quarter numbers. Godrej Consumer has been doing well as well. So they are seeing some sort of gains, similar the kind of gains that we're seeing for Dabur and Britannia. What is it that is not doing well? We have Varun Beverages, because the expectation was that for carbonated beverages, the 28% slab moves all the way up to 40%. So 18 to 5% goes down on all the categories which are there for you on the screen. And for carbonated beverages, goes from 28% to 40%. Footwear stocks, now they're buzzing. More importantly, because out there is a unilateral decline in the taxes. So the current tax at around 18% for footwear above 2,500 rupees comes down to 12%. And similarly, for footwear which is below 2,500, the tax comes down from 12% to 5%. And remember, over 90% of the country's footwear volumes that are sold are, in the organized space at least, are sub 2,500 rupees. In fact, a lot more than that. So that's a big positive for the entire space. And the ones that are offering value footwear, which is the likes of Bata and Relaxo, are benefiting the most. Relaxo, a stock which has been an underperformer, also bouncing back. And finally, we'll watch out for hotel stocks. We have the likes of Lemon Tree, etc. They're doing well. Not the luxury hotel space, because the cap is for 7,500, the rooms under 7,500 rupees per night. And out there, the only thing we'll have to watch out for is the catch, which is the input tax credit. Currently, they are proposing that the 12% rate, which is along with the input tax credit, goes down to 5% without the input tax credit. What the modalities of that would be is something we'll have to await and watch out for from the GST Council meet outcome.
Okay, all right. So that will be something that we will be watching out for in terms of the impact of GST on FMCG. Well, on that note, we're going to take a short break, but we'll get you a lot more in terms of buzzing stocks. It's a very live market in terms of stocks. So all that and more after a short break.
Welcome back to Half Round Report on CNBC-TV18. Nifty, as of now, is managing to hold on to gains of 50-odd points as of now. Not much of a gain there. 24,550 is what it's managing to hold on to. A lot of movers on the back of volume, right? We're seeing today that is Samman Capital is among one of them. We have RBL Bank, Granules, also managing to hold on to very, very strong gains, 8% gains as of now. And CG Power also is managing to hold on to gains on the back of a news flow that is coming in as well. Specifically in the last, 20, 30 odd minutes that we're seeing a sharp move coming in for GE T&D. Keep an eye out on that one. 1% up in the last 20 odd minutes. We have SPFC Finance that has seen a bit of a gain, and Aadhar Housing Finance. These are some of the names also that have seen a run up coming in the last 20 minutes is what I'm highlighting, right? See a bit of a spike up from the day's lowest point. We're surely seeing all these are seeing a bit of an up move. Other housing managing to hold on to gains of almost 1% as well. Among some of these losers in the last 1 hour, we have Vodafone Idea. That's a bit under pressure today. Keep an eye out on that. Ola Electric has come off the day's highest point right now. So keep an eye out on Ola Electric. Chambal Fertilizers, a bit off the day's highest point that these stocks have moved. So off the lows is what we're seeing coming in for these stocks in today's trading session. But let's move on and talk about some of these other stocks that are buzzing in trade. And Vamakshi is joining with us for those details. Vamakshi?
Well, absolutely, Vinny. Take a look at Jindal Poly. There was a very sharp spike in the stock today. In fact, the company posted the biggest intraday advance that it has seen since December 2nd, 2024. Now, over 6.3 lakh shares have been traded so far, which is almost 19 times higher as compared to the 30-day average volume. But despite the kind of strong up move that we're seeing yesterday, the stock is still down almost 40% in 2025 so far. The next stock that we're focusing on is Apollo Micro. The stock has managed to hit an all-time high. In fact, it has managed to post gains in 8 out of the last 10 sessions. So it has been having a good run. In fact, up almost 47% in the last 30 days. And this move that we're seeing today is coming on the back of very strong volumes, almost over 3 crore shares traded so far, which is twice the volume that we saw yesterday. Samman Capital is another counter that is on our radar today. The company has managed to snap a 4-day declining streak. This is because the stock has started trading as an F&O stock today. We have over 3.6 crore shares that have been traded so far, which is almost 3 times higher as compared to the 30-day average. But despite that, the stock has not done well over the last year, down almost 23%. But apart from that, take a look at Orient Cement. On the downside, it has hit a 52-week low. We are seeing consistent pressure on this counter over the past 5 days, and year to date, the stock has declined over 36%. And lastly, take a look at Sun TV as well. This stock too has hit a 52-week low in today's trading session, marking the 7th consecutive day of decline for this particular counter. The stock has not been doing well in the past 1 year itself, down almost 30%.
Okay, all right, Vamakshi, thanks very much for that. Yes, a lot of buzzing stocks in today's trading session. We'll take a short break, but we'll get you a lot more on the markets, a lot of opinion on the other side as well. Stay tuned. Welcome back. Giving up a little bit of gains for the Nifty, so just about higher by around 32 odd points. We have the mid-cap index also, which has cooled off a little bit. So both these indices should come up for you. As you can see, there's a little bit of a nick which has taken place just in the past couple of minutes. But Mangalam is now joining in to tell us what he's tracking on the F&O side. Mangalam, over to you now.
If you look at the markets, there have been higher, but they've been off highs as well. So it's choppy, but green is what the street will like. So if you look at the Nifty Bank, the mid-cap index is the one which is actually outperforming today. The Nifty holding up with gains of just about 0.25%. And the advanced decline ratio, the crisscross lines tell you that there are way more number of stocks which are advancing after the first hour of volatility. Now the green line firmly above the red line itself. And all of that is reflected in the way the volatility index, the India VIX, has cooled off as well. Last I checked was down about 3%. Right now, as we look at it, it's down about 3.76%. So sub that 12 mark. So on an absolute basis, extremely important as well. Now, active Nifty options. Let's look at the ones, because the next weekly expiry for the Nifty happens on Tuesday. Remember, yesterday was the last Thursday expiry for Nifty for the NSE options. Now, coming week, we have the first expiry, the weekly options expiry on September 2nd itself. And the street believes that there would be strong support around that 24,450 to 24,500 mark, because the 24,500 put is extremely active, nearly 2 crore shares in open interest. On the way up, though, we will see some supply coming in at 24,650 to 24,750. That's what the call writers at 25,600 and 25,700, rather 24,600 and 24,700 are bracing themselves for. A bunch of stocks that are on our radar on day one of September series. It's Samman Capital, the erstwhile Indiabulls Housing Finance. Samman Capital is now in focus on account of the re-entry in F&O in September series. The stock, earlier named Indiabulls Housing Finance, excluded from F&O trading since December 2023, and the high that time was around 236. So Samman Capital is definitely the stock we're watching out for. There have been fresh longs added on both Samvardhana and RBL Bank, and a lot of shorts covered in Colgate. And finally, I'm watching out for names like Granules and IRB. The intraday chart of Granules and IRB come up for you. Both of them doing extremely well. You'd wonder, why am I talking about these cash stocks in F&O? Because until yesterday they were in F&O. Now they are cash stocks. So Granules picking up, IRB doing well. On the other side, we have Jindal Stainless and SJVN. Both of them seeing some selling as they were been excluded from F&O trade, currently lower in trade.
Okay, Mangalam, thank you so much for that. Keeping an eye out on all those names over there as well. But let's, on that note, bring on board Ajit Mishra of Reliance Broking to talk to us about the technicals on the market front as well. Ajit, good afternoon. Thank you so much for giving us your time. Just give us the levels that you are keeping an eye out on this new series, Nifty and Nifty Bank, as well as which are the stocks that you're keeping an eye out on.
Yeah, good afternoon, Vinay. So, yes, see, the last 2 weeks, we were seeing that markets were witnessing a bit of a profit-taking, rather recovery. And this week, again, the profit-taking has resumed, largely due to the underperformance of the banking space. Banking index in today's session, so we have tested the 200 EMA. Nifty has gradually inching towards the same level, means we've started this recovery from 24,350 last time. And the long-term averages are placed around 24,250. So this 100-point zone, 24,250 to 350, will continue to be the strong support area for the index, with banking already looking oversold and trading closer to its long-term averages. Possibility of consolidation and some rebound is there. Upside, still we feel that 24,650 to 800 will be the area where Nifty is going to face resistance. So for a time being now, it's prudent to stick with the stock-specific approach, wherein we are seeing strength, relatively higher strength. It could be across pockets. So today, Cipla is one stock in the pharma basket, which has been inching gradually higher post the consolidation range breakout. 1660 is what we are eyeing in the near future. So 1550, with that as a stop loss, one can accumulate Cipla at current levels. At the same time, while the banking index looks oversold, and there could be some bit of a rebound, IndusInd Bank is still struggling. Means it's been underperforming within the sector and it's gradually drifting lower. Indications are in the favor of more pain ahead, with 7 point being the next immediate target. So with stop at 760, one can go short in IndusInd Bank even at current levels.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and giving us all of those technical calls. So that's the update coming in on the markets. But let's shift focus to what has been an interesting topic in the past couple of days, where the Association of Healthcare Providers of India, remember, had advised member hospitals in the north to stop providing cashless treatment facilities for policyholders of Bajaj Allianz. They held a meeting yesterday, and now the outcome of the meeting is that the AHPI has revoked the order withdrawing cashless facility for Bajaj Allianz members. So now we have with us Dr. Giridhar Gyani, who is the Director General, Association of Healthcare Providers, to take us through what the meeting was and what the way forward would be. Dr. Gyani, thank you very much for joining in. So tell us now, the Association of Healthcare Providers of India, you all met with Bajaj Allianz and you all have withdrawn the ban against Bajaj Allianz now? Okay, I think there's a little bit of an issue in terms of the audio there. We'll get back to Dr. Gyani. But, Vinny, this was interesting because we do understand that now the cashless treatment is going to be allowed, but it's still a way forward in terms of the discussion.
Isn't it a bit of a worry? Because I think cashless is one of the services that really help, patients at a time like that.
Exactly. So, as of now, the hospitals and the insurance companies have to really discuss and come to a common ground in terms of the issues that they have. So, for example, they had issues with regards to new empanelment, rates revisions, where insurers have not revised rates for years, leading to undue financial stress on the hospitals, and other issues such as deductions. Maybe we have Dr. Gyani back with us? Okay, we'll do one thing. We'll take a break on that note, but we'll get back and discuss this issue with Dr. Gyani just after a short bit. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. As of now, the Nifty is still holding on to 24,500 levels. Keep an eye out on that. But now it's time to put the spotlight on crude and precious metals. Manisha Gupta caught up with Commodities big voice Peter McGuire to determine the direction for crude oil, gold and silver. Take a look at what he had to say.
And I look at the market and I say, right, it is having a little bit of a bounce to the upside. You can't deny that. 68.20 for Brent and 64.15 sort of number for WTI. Now, it's had a little bit of a, and you had that US dollar, running at around about 98. I'm fairly confident that you're going to see softer prices rolling into Q4. At the meantime, you've had a bounce up, as you mentioned, the situation with Ukraine and Russia hasn't been put to bed in any fashion or form, and they're now saying that they may not meet. So I understood that from Germany and Mr. Merz. So the situation could actually escalate further, and that's going to probably cause more geopolitical concerns in the fabric of the energy markets, Manisha. So that's the situation at the moment, and traders are enjoying the volatility.
Oh, they sure are. Peter, what's your sense then? You've been maintaining that the crude oil prices will be on a range going forward for the rest of this year as well. Would you continue to reiterate that at a pivot 70s, perhaps what we're looking at in sense of prices?
Well, look, they might put a little bit further on, Manisha, but I think the overall consensus is, from the people that I'm talking to, the situation with OPEC Plus, you're probably going to see increasing production, as we all know. And the other side, of course, is going to be when that starts to drip feed into the market and really take some heat out of it. I'm sure that you're going to see low 60s and possibly into the 50s running into Q4 sometime. And then you've got, I think that'll maintain over that Northern Hemisphere winter period.
Peter, it's not just crude, but we've also seen gasoline prices, heating oil prices come under some pressure in the recent few days. Overnight, of course, has been a slightly stronger market. But what are the fundamentals you're watching here? Because with the Labor Day long weekend, the summer driving demand season in US comes to an end. How much of a pressure would that put on prices from here?
Well, I think, Manisha, I've listened to quite a few, discussions as far as petrol prices in the States. And a lot of those cities and a lot of drives are now experiencing sub $3 a gallon, which is a good sign. And some are even, much lower than that. And that is going to be a good sign for the economy. The absolute, I think, situation is going to be, again, cheaper prices. The whole storyline is one of, the big moving parts. But I'm pretty sure that you're going to see that situation as it starts to unfold. The demand side is going to probably wane a little bit because, as you mentioned, summer driving season comes to an end, and more production is going to be a wonderful situation for inflation. And I think the overall consensus is softer energy prices leading into Christmas.
Well, that got to be good news for many consumers there. But I also want to talk about silver, Peter, and we're trading at all-time highs in the Indian markets when it comes to silver. Global prices are still around that 14-year highs, but kind of run-up that we've seen in India, and that too especially ahead of festivals. The retail demand clearly has been on the higher side. Where do you see silver from here? Because investment demand, retail demand, industrial demand, all of those boxes seem to be getting ticked.
Oh, they're getting ticked, absolutely. You're running at 39.50, 39.55 at the moment, and it's had a really nice run up, and there it is, as far as Indian prices. As you said, all-time highs. I'm fairly confident that you're going to snap through 40 very, very shortly, and the overall momentum, I think, is going to be a continuation to the upside running into the last 4 months of the year, Manisha. We've got 8 months down nearly come tonight's trading. And then we start again, 1st of September on Monday. So I think the theme is going to be higher prices, US dollar again coming under more pressure to the downside, and it's going to probably take its big brother up for another ride to the upside as well.
You talked about gold, and yes, we're not too far away from all-time highs onto that one as well. 3,400 plus kind of levels holding. Are you looking at 3,500 taking out anytime soon?
Yeah, I think so. It's at 34.70. I'm looking at the screens. I mean, I think it's got the momentum at the moment to really charge ahead. Let's have a look and see what the Fed does. I think it's pretty much baked in. You're going to see a 25 basis point cut. So if that was to materialise, possibly it is already felt in the market, but that I think is going to run, I think, more pressure to the downside for US dollar, and the overall momentum is going to be one of, jumping into precious metals and continuing that, the attraction to traders. And I mean, the market has been extraordinary this year. You can't deny it. I mean, just mind-blowing what you've seen as far as uplift for gold and silver. So, yeah, I don't think the party's going to stop anytime soon, Manisha.
All right. So where are we headed? 36, 3,800? I mean, those are the levels that we've been talking about.
Absolutely. I mean, you're running 4 months till the end of the year. I think it's got the capacity to take those sort of numbers. Let's see where we are with Fed policy. And if they were to cut, are they looking at another cut, which seems to be, again, everyone's saying you'll probably see another cut as far as, November, say. So that's going to force more pressure to the US dollar to the downside and more uplift as far as what will happen with precious metals.
Okay, gold continues to shine. 5-week peak there for the markets, just about consolidating. Advanced decline ratio in positive terrain. So 2,400 stocks advancing to around 1,500 stocks declining. Let's see whether that sustains. As of now, sustaining with a good gap. We'll take a short break and be back with more. Stay tuned.
Welcome back to Halftime Report on CNBC-TV18. As of now, Nifty managing to hold on to gains of what we'd seen at the start of the show, right? 50 points. Not much of a move coming in on that front. IT, that's the one that we're seeing some pressure coming in on. So keep an eye out on the IT pack. Mid-cap managing to hold on to the gains that we're seeing coming in as well right now. So that is interesting to watch out for, where the broader end of the market will be moving in the second half of the day as well. But Reliance's 48th annual general meeting is just hours away. Let us bring you the key expectations, and Sonal is joining in with us to tell us about the expectations from the O2C business and the new energy business. Afternoon, Sonal.
Hey, thanks for that. Well, let me just sum up first the consolidated expectations. Of course, we'll discuss that in greater detail as well. The updates in consumer and enterprise digital business is something we'll be watching out for. The update on fast fashion business as well, and quick commerce in the retail segment. Any updates on the new energy business? Very important, because there have been a lot of developments in the last couple of financial years. And we'll also be watching out for any value unlocking or strategic announcements, because remember, the company had mentioned in 2019 that they will be looking at an IPO for telco and retail within 5 years itself. So that's something we'll be watching out for. For oil to chemicals business, let's start with that first up. Huge petchem capacity expansion, be it in polyester, vinyl, carbon fiber, all of them by FY27. That capex will be important to watch out for. In 2025, ramp-up of new refineries is something which has led to lower cracks. However, there are expected closures as well. So that is something which could balance the refining margins, and that could see an uptick from there on. Now, demand for downstream chemicals products is expected to grow ahead of GDP overall in the country, and this is something that will be driven by demand that we'll see in infrastructure, packaging, autos and agriculture as well. Now let's talk about oil and gas business, because Reliance contributes substantially to overall consumption in the country. 28.5 MMSCMD of natural gas production, which is 30% share of India's gas supply itself. So that's a big chunk coming in from Reliance Industries itself. They do have plans to drill additional wells, and also in the KG Basin, they plan to enhance production. All of that will be key to watch. New energy, a very important part of the business from here on. The update on the fully integrated polysilicon to module, electrolyzer, battery manufacturing facility, and they also aim to operationalize new energy platform in next 4 to 6 quarters, which could add meaningfully to the SOTP as well. They will be seeing new operations in the new energy business in the next few years in solar, battery gigafactories. Once the engineering work is completed, equipment deliveries are also expected by 2025. Procurement has been finalized, and the scale solar PV module line has recently commenced operations. So how that adds to the overall business, what's the outlook going forward? New energy is one of the most important commentary that we'll be watching out for.
Okay, all right, Sonal, thanks very much for that. So yes, it's definitely going to be something to watch out for when it comes to the Reliance AGM. Well, for the markets, it's given up a little more in terms of gains. So the mid-cap index is absolutely flattened out now. So just about higher by around 60 odd points. The Nifty also just about holding with a gain of around 44 odd points. So there's definitely been a selling from the top which has taken place for all of the indices. The Bank Nifty also just about trading with a gain of around 0.2%. Just about holding their head above the water at this point in time. The mid-cap index seeing the most incremental selling at the top amongst all of the indices. For the advanced decline ratio, it's still holding, but let's see whether that sustains or not as we go along. Let's see whether we, even see any kind of dip into the red for the markets. But next up is Jio. Rima joins in with the key expectations from the Reliance AGM.
Thanks so much for that. What everyone's watching, unlocking in Reliance Jio. It was in the 2019 AGM where Mukesh Ambani had first hinted about an IPO. He said it will take 5 years. But since then, the plans got delayed because the company was looking to strengthen the business. According to UBS, a Jio IPO, though, is still about 12 to 18 months away. So that said, what else will we watch? Well, strategy. Because in the last AGM, Mukesh Ambani spoke about doubling Jio's EBITDA in the next 3 to 4 years. So how do they plan to get about that? Also on broadband. Now, the company's made a lot of strides. Broadband is about 20 million households, but their goal is an ambitious $100 million in terms of households. How are they planning? How are they deploying artificial intelligence across the entire ecosystem, plus their space plans? And finally, let me leave you with the statistics as Reliance Jio currently stands. It's been aggressively adding subscriber. The subscriber base is, as of the June Q1 FY26 numbers, stands at nearly 500 million subscribers. 5G accounts accounts for 42% of that. Broadband is 20 million. The ARPU has now crossed the 200 mark. About 4 or 5 quarters back, the ARPU of the company was about 181. It now stands at 208. And AirFiber customers are also at 7.4 million. But the one which will grab the headlines will be any talk about value unlocking. Back to you.
Absolutely. What we'll watch out for if there's any talk coming in for value unlocking there as well. So those were the key expectations that we saw coming in from Reliance, the O2C side of the business, new energy business, Jio, a lot of important updates that we will watch out for on that front. But next up, let's talk about Reliance retail part as well. And what are we expecting here? Mangalam is joining in with us for that. Mangalam?
Well, Reliance's retail business has definitely been the growth driver. In fact, it's, wowed the street with the kind of numbers that it's delivered in a relatively short period. So FY25 was extremely strong, crossed the gross revenue of 3,30,000 crores with an EBITDA upwards of 25,000 crores. In fact, bigger than all the other retailers put together. And that's how big Reliance Retail was. Opened 2,659 new stores, which is more than, all the others that they operate as well. And the total stores are at 19,340 with a customer base upwards of 349 million. Strong growth from large format expansion is what came by, hyper-local deliveries and non-food catalog, which was widened. And it was also reinforced as a partner of choice for Shein, ASOS, Delta Galil, Saks Fifth Avenue and JioMart. That scaled catalog as well, along with quick commerce capability. Ajio saw an expanded capability and catalog. Premium brands actually did a lot better. And there was steady performance coming in their fast fashion business. So all these things means that we have to watch out for what the growth prognosis for the next year would be. And one of the crown jewels of the company this time around has been the consumer business. The Reliance FMCG business now does 11,450 crore in sales. And this is just in second year of their operation. So the fastest growing FMCG company in the country right now belongs to Reliance. In fact, it's expanded its reach as well across general trade, leading to a nearly 3.5 times growth in sales coming in for Reliance consumer products. And Campa gained about double-digit market share. We had, Tags food acquisition that happened during the quarter, Independence, Allen's, Enzo, Ravalgaon, all these brands. So what is it that we'll be watching out for? Any sort of view on the strategy for next year? Alongside that, any new partnerships that they will come up with, any new large formats that they will open, what they do in quick commerce, but most importantly, any word on value unlocking, demerger of the FMCG business or the retail business itself is something that the street will eye very, very closely.
Okay, absolutely. So not much time to go for the AGM speech, which begins at 2 p.m. On that note, it's a wrap on Halftime Report. Thanks very much for watching. Business Lunch will take all of the action forward.
Even as tariffs cast a shadow, a glimmer of hope appears in the proposed GST revisions. FMCG and consumer durables take a positive cue, but auto and IT are the big drags. Reliance Industries holds its AGM in a few minutes from now amidst expectations of fresh insights into the developments in its new energy business, even as the indications on the expansion of its Jio, retail and O2C verticals are keenly awaited. A raft of changes across sectors are proposed by the group of ministers spanning automobiles, FMCG, consumer durables, apparel and more. Most experts believe that the proposed revisions will give a significant boost to consumption. The group of ministers bats for the common man in its GST review, while daily consumer products like toothpaste see a sharp tax cut, even as economy class cars, bikes and airline tickets and hotel rooms will get cheaper, even as luxury and premium goods and services will get dearer. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Vamakshi Thoria, as always. The last couple of hours of what has been a forgettable week for the bulls. But in these last couple of hours, we have two very important triggers to track. Of course, the AGM of Reliance Industries in just a few minutes from now. And of course, the GDP data that will be reported at 4 this evening. So two very important triggers to track for our domestic markets. And of course, for our international markets, the PCE inflation data that will be reported later this evening, which could also determine whether the Fed will cut its interest rates in its September policy. For now, markets absolutely flat, be it the benchmark indices or the broader markets, all of them staying near the flat line. The Reliance Industries stock price as well has remained at the flat line all through the trading session. But the Nifty has traded in 100 points range so far, Vamakshi, but it's been a fairly forgettable week for the bulls.
Well, absolutely, Hormaz. It's not been such a great week so far. In fact, the broader market as well is reflecting that. The mid-cap as well as the small-cap index, which was earlier trading in the green, has now slipped in the red. The mid-cap index is down almost 0.1%. The small-cap index too is trading largely flat, but slightly with a negative bias. Apart from that, let's take a look at specific sectors then. The only sector that is doing extremely well in today's trading session is the FMCG pack. Colgate is up almost 3.3%. Britannia is also up almost 2.18%. We also have ITC, Marico. All of these counters are doing extremely well in today's trading session. Some stocks from the media pack as well. Take a look at Nazara. Over the last couple of trading sessions, that stock had not been doing well at all, given the constraints on, real money gaming. In the last 14 days, the stock is down 17%, and today that stock is seeing some bit of recovery, up almost 2.7%. But the whole pack that is not doing too well is the realty pack. Take a look at Sobha. That stock is down almost 2.5%. Brigade is also trading with a cut of almost 2.1%. And over the last 14 days, it's been a downward trend as far as all of these counters are concerned. Now, on to the latest on the GST front then. Sources say that the group of ministers on rate rationalization are likely to table the centre's proposal to do away with 12% and 28% slabs. My colleague Timsy brings us the details. Timsy, over to you.
Well, the upcoming GST Council meeting on 3rd and 4th of September is likely to see a major GST overhaul, especially trying to give a consumption boost to the domestic economy. What we are given to understand from sources that the union government has put forward their proposal to shift to a two-slab structure where massive GST cuts are expected. Firstly, beginning with automobiles, there is a massive GST cut that is expected from current 28% plus cess to certain categories, that is the small car category, coming down to 18%, whereas the other cars, that is mid-segment and higher-end segment cars, which are likely to be in 40%. Similarly, for two-wheelers, that is motorbikes below 350cc, are likely to see a cut to 18%, and those above 350cc will also be under 40% only. Apart from that, tractors are being brought down from 12% to 5%. Entire value chain of tractors are also coming down to 5%. Cement, fertilizers, all are likely to see a cut. Cement likely to come down from 28% to 18%. Fertilizers to be brought down to 5%. All medicines are likely to come down to 12%. Rather, a few rare disease drugs and cancer drugs are likely to be exempt. When it comes to daily needs such as biscuits, shampoo, hair oil, ghee, all are going to see a massive cut. Also, when it comes to footwear and ready-made garments, there is a current price cap of 1,000 rupees. That is likely to be hiked to 2,500 rupees. So all footwear and ready-made garments below 2,500 rupees are likely to fall under 5%, whereas this was currently divided in 12% and 18%. So massive cuts are being proposed. To be seen is whether states agree to this proposal on the 3rd and 4th, and whether these cuts come in as soon as, even before the festival season kicks in.
Timsy, thank you for that update. Timsy has been on top of these GST news breaks throughout this entire GST debate. And moving on then, the government will release the GDP data for the April to June quarter. Now, a CNBC-TV18 poll shows that the GDP may rise to 6.8% in the first quarter, and the gross value added will remain at 6.5%. Now, while the GDP is being seen propped up by higher capex and advanced buying of exports, things may become clearer once the impact of the US tariffs will be seen in the upcoming quarters.
Well, afraid that President Trump's actions will hurt America's interest in the long term, says Ramesh, Damani, who's the member of PSC. Now, in an exclusive conversation, he says that America is proving to be a somewhat unreliable trade partner. Let's listen in.
What I'm afraid the president is doing a self-goal that will in the long term hurt America's interests, because, it's the old fable in Aesop that, you want to kill the goose that lays the golden egg. And I think they're forming some part of strategy of that, not understanding that when the world prospers, America prospers. I think, at least for the next 3 to 4 years, America is proving itself to be a fairly unreliable partner, not only internationally, but also in what it's doing to its domestic institutions, whether it's the Federal Reserve or whether it's the Ministry of Health. I think it's proved to be a very unreliable partner. And I think that while India will pay a price for it, but as I go across this country, the last 6 months, I visited various companies across this country, and I come back always sunny and optimistic about the prospects, about the entrepreneurial vision of these businesses, and I'm investing myself in a wide range of businesses, even at the current time. So while there will be some pain for the textile people, for the jewelry people, for the shrimp exporters, and the like, I think it's bearable pain. I think what the government is doing is the right thing. For example, by recalibrating GST, by trying to subsidize a little bit of exports that India is doing. And I think not only will we survive, but God willing, we will thrive.
Well, take a short break, then more news and updates follow on the other side, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC TV18. Well, Prime Minister Narendra Modi arrived in Tokyo earlier on Friday for a two-day visit. He was welcomed by the Japanese community in a traditional way. He also interacted with the Indian community in Tokyo on arrival. Later, he addressed industry titans at the India-Japan Economic Forum. The Prime Minister described India as a powerhouse of talent and called on business leaders in Japan to make in India, make for the world.
Now, heavy rainfalls and flash floods have wreaked havoc in several parts of North India, causing significant damage to infrastructure. The Jammu-Srinagar National Highway remains closed for the fourth day after heavy rainfall triggered landslides in the region. Over 600 vehicles remain stranded. The death toll in the Union Territory has already crossed 40, with the Vaishno Devi landslide accounting for most of the fatalities. Several places in Himachal have been battered by the rains as well. Now, the NDRF is carrying out rescue operations in Kangra and Chamba districts. A portion of the Chandigarh-Manali highway was also washed away. More than a dozen villages in Punjab continue to remain inundated due to the overflowing Beas River. Now, schools in Fazilka, Jalandhar and other districts remain shut. The Indian Army has deployed its advanced amphibian mobility vehicle for its rescue operations in Amritsar. Now, more than 8 people have been killed in rain-related incidents in Chandigarh as well.
I'll take a short break then. More news and updates follow on the other side, so don't go anywhere.
Welcome back. The Nifty has given up all of its gains and has slipped into the red again now, below the 24,500 mark as we speak. Just before the Reliance Industries AGM, what has slipped to the lowest point of the day though is Swiggy, and that has now down 3% as we speak. What is also down is Eternal. The Eternal is also down 2%. So the food delivery aggregator is not doing fairly well. Some of the other movers, though, Colgate-Palmolive doing well for itself, of course, on the potential GST cut on toothpaste, and that stock is up 3.5%. What is also doing well is Granules India. Remember, that stock was excluded from the F&O segment just yesterday, and that stock is now up 9% as we speak. The other one, which is a new entrant to the F&O space, is Samman Capital, and that stock is also doing well. It's first day as an F&O stock, and the stock has surged almost 6.75%. So good going for a lot of these names. What is not doing well, though, on the downside includes the likes of, say, Genus Power is one of them. Panama Petro is another one. Both of them are down around 6 to 7% each. Vardhaman Textiles continues to see profit booking. Sai Silk Kalamandir is also down around 4%. Remember, so that is one of the stocks that is not doing too well. Now, of course, we're talking about Reliance Industries. The 48th AGM will begin shortly. Here is a look back at how the year that was panned out for Reliance Industries.
The world of today brings both hope and concern. On one hand, we are living in the best of times with revolutionary breakthroughs in science and technology, especially in artificial intelligence, computing, robotics, and life sciences.
In a year of geopolitical tumult and uncertainty, the net worth of Reliance Industries crossed 10 lakh crore rupees for the first time. It also reported record profits of over 81,000 crore rupees. Market capitalization crossed 20 lakh crore rupees, making it the first listed company in India to achieve the milestone. It contributed over 2 lakh crore rupees to the national exchequer.
Over the past year, we faced a complex global landscape characterized by geopolitical conflicts and weak economic growth in Western countries, leading to subdued demand. Despite these challenges, I am pleased to report that Reliance navigated through the headwinds to deliver industry-leading performance.
Reliance is all set to undertake a massive capacity expansion at its oil-to-chemicals business, which is the company's biggest growth engine. By FY27, polyester capacity is projected to hit 5 million tons per annum, vinyl to touch nearly 4 million tons per annum, and carbon fiber at 20,000 tons per annum. Investors will have their eyes fixed on the AGM speech to find out the progress with natural gas production. Currently at 28.5 MMSCMD, Reliance contributes nearly 30% of India's gas supply. The company is planning to drill additional wells to offset the natural decline at the KG D6 basin. The outlook for the oil demand remains a concern. Ramping up of new refineries is likely to lead to weaker product cracks, but the expected closures could also increase upside potential for refining margins. Demand for downstream chemical products in India is expected to grow ahead of GDP growth rate. This will be driven by demand from infrastructure, packaging, automobiles, and agriculture.
With nearly 500 million subscribers, Reliance Jio is the largest telecom service provider in the world and also the largest wireless broadband service provider. Last year saw cumulative data consumption of more than 185 billion gigabytes.
Today, Jio's network carries nearly 8% of global mobile traffic, surpassing even major global operators, including those in developed markets. And we have done this while maintaining the highest service quality, setting new benchmarks on the global stage. Jio's commitment to affordability has made its service accessible to all, with current data prices that are 1/4 of the global average and just 10% of those in developed countries.
Reliance Jio remains a key driver of growth for the conglomerate. Revenue from digital services rose 16% to almost 1.5 lakh crore rupees. Margins steady around 50% and operating profits grew almost 15%. The company commands 488 million subscribers, Of that, nearly 191 million subscribers, that's 40%, are 5G subscribers. And this has resulted in a steady increase in the company's ARPU, average revenue per user, which has grown from nearly 180 rupees a year back to almost 208 rupees as things currently stand. Nearly 20 million households in India are connected through Jio broadband services. Jio is also building its own satellite communication platform and partnering with SpaceX to offer Starlink's broadband internet services to its customers in India. It is also betting big expanding services to enterprises.
These are just a few ways we're bringing advanced AI through connected intelligence to every Indian simply and effectively. We'll keep bringing you AI solutions that works hand in hand with our network and cloud, making life easier and better for everyone in India.
From digital services to retail, Reliance Retail reported an 8% increase in gross revenue last year. It opened over 2,600 new stores, taking its total store count to 19,340, making it the largest retailer in India with a customer base of nearly 350 million.
I'm happy to inform that Reliance Retail is now amongst the top 5 global retailers in terms of number of stores, amongst the top 10 retailers in terms of market capitalization, amongst the top 20 retailers in terms of number of employees, and amongst the top 30 retailers in terms of revenue.
Reliance Retail in FY25 saw strong growth through large format expansion coupled with hyper-local deliveries. It provided the growth momentum for the company. In fact, it crossed the coveted 3 lakh crore revenue milestone for the retail vertical as well. Amidst all of this, the crown jewel was Reliance Consumer Brands, the FMCG business, the fastest growing FMCG in the country, which in its second year of operations itself achieved over 11,450 crore in revenue. In fact, it was locked by its inorganic and organic growth. It closed the acquisition of Tags Foods, also launched new variants under brands like Campa, which in its operations year actually crossed 10% of market share, Independence, Allen's, Enzo and Ravalgaon among others as well. The question, what will investors look out for in this year's annual general meeting? Guidance for store expansion, productivity and network optimization roadmap for growth in quick commerce in particular, along with expanding density of dark stores. But most importantly, investors will watch out for any new international brand tie-ups, along with the many that they've done, and an announcement on the possible listing and demerger of the FMCG business or further value unlocking in retail, something we'll be watching out for.
To further accelerate our deep tech and AI native capabilities, we are investing in companies with proven expertise. With the strong foundation we have built, I am confident that we will achieve our goal of doubling our retail business in the next 3 to 4 years.
It was a pivotal year for the media business. The merger between Viacom18 and Disney India became effective in November of last year, and in May we saw the launch of the first ever World Audiovisual and Entertainment Summit, or WAVES.
India's media and entertainment industry today stands at $28 billion. We can easily grow this 5 times to over $100 billion in the next decade. This will give birth to huge new opportunities in employment and entrepreneurship in diverse fields.
The merger between Viacom18 and Disney India led to the creation of JioStar, India's largest media platform, which combines Colors, Star Plus, Star Gold, Star Sport, along with Jio Cinema. Jio Hotstar app saw 280 million paying subscribers during the last year's Indian Premier League. The media business now accounts for a TV entertainment share of 34% in India.
The 1.2 billion mobile phones in India are potentially 1.2 billion screens on which users can access entertainment and even share user-generated content. With all humility, I can say that Jio has made a leading contribution to India's digital and entertainment revolution by making high-speed internet affordable and available to all. With Jio Cinema, We have broken viewership records, revolutionized IP streaming, and made immersive, multi-language, interactive sports viewing a global standard. And this is just the beginning. Jio's partnership with Disney marks the dawn of a new era in digital storytelling.
Reliance Foundation continues to provide impetus to the conglomerate's philanthropic activities, from rural transformation to education, sport to animal welfare. It has programs across 350 districts touching the lives of nearly 15 million people.
Mukesh and I are on a mission to enable quality education in our lifetime for 250 million school-going children of our country. India today has the largest number of young people in the world, with over 50% of our population under the age of 30. We are committed to empowering this generation to become the driving force of a new, resurgent, and unstoppable India, a truly Viksit Bharat.
FY25 also delivered robust cash flows from the O2C and oil and gas businesses. Digital and retail businesses saw rapid expansion, and the new energy business is beginning to bear fruit. All eyes now on the AGM speech this year, where Chairman Mukesh Ambani will outline Reliance's growth agenda.
Now is the time for all businesses in India to work together as a grand coalition with the spirit of cooperation, collaboration, and mutual support.
Well, we're all counting down to RIL's AGM that is set to begin in the next 30 minutes or so. All eyes will be on the comments that come from the management. But with that, that's all the action that we have on this edition of Business Lunch. Don't go anywhere. Closing bell comes up next.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Well, 2 hours to go before we round up this week, and important cues lined up. The Reliance AGM will begin in about 2 hours, in about 30 minutes from now, and then at 4 o'clock we've got the Q1 GDP. And Surbhi is here with me. I'm Reema Tendulkar, and you're watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Not at the day's low, which was about 24,464, but not quite at the highs also. Again, from the higher levels, we are seeing a bit of selling pressure. The Nifty is holding on to 24,500, but considering we've had 4 days of losses, I mean, in the last 4 days, the Nifty is down close to about 600 points. Yeah. Today's recovery is very, very feeble. So in that sense, disappointing.
It's, not much of a recovery really, Reema. I mean, the market's been managing 20, 30 points here and there right from the morning, and the net result is we are flat. And even at a broader market level, at least at an index level, you don't have a sense of momentum at all, either on the way up or on the day down. Listless, directionless, call it what you want. In fact, even broader stocks, if you talk about today's decisive trend, or if you want to pick out a sector of the day, the only story that comes to mind is really consumer. And that's all thanks to the proposed GST cuts that we've been reporting right from yesterday that have been that are part of the GST bill, and they go on to the GST Council. So the FMCG index, even stocks beyond FMCG, other parts of consumption, whether it's footwear, whether it's apparel, bits and pieces, it's showing up here and there. But aside of that, there is no real directional movement, neither in the market nor in the stock that we're going to focus on. Reliance, for the time being, has been really, really flat. And of course, it's going to be all about the Reliance Industries AGM starting 2 p.m. The stock itself has had an interesting trajectory. Actually, it's outperformed the Nifty. If you look at it on a 6-month horizon or even a 1-year horizon, Reliance has done better. 6 months, it's up 15%. The question is, what next from here? Will we hear something that could take the stock in a decisively higher trajectory from here on? And obviously, that will spell great news for the market as well. So that's, of course, the consolidation that the market as well as Reliance have been in the last 12-odd months. So let's now talk about what we are covering on the show today. It's going to be all eyes on the Reliance Industries AGM. Mr. Mukesh Ambani will be beginning that address in just under 30 minutes from now. So we'll, have a full tilt focus on Reliance Industries. In fact, we'll have experts joining in as well to decode all of those announcements. The Nifty, of course, has been holding on to a very, very range-bound session, absolutely unchanged, almost unchanged, 12 points higher. We'll put the spotlight on a lot of these consumer stocks which are buzzing the trend, which are bucking the trend, which are still buzzing around. So we'll have Mangalam weigh in on some of the cuts and the anticipation as they're stacked up right now. After that, of course, we turn full focus on Reliance Industries, from the retail business to Jio, oil to chemicals, new energy, a lot of excitement and announcements that the market is anticipating and watching out for. So all that's coming up, but let's get started first with the technical calls as we are looking at trade in the last 2 hours of the day and the week. Nagraj Shetty is with us. Nagraj, great to have you on. So tell us, absolutely directionless as far as the indices are concerned. Would you have any trade, Nifty, Bank Nifty, if not the indices, and what about stocks?
Hi, good afternoon, Surbhi. Nifty, no doubt, has been in a downtrend over the last 4-5 sessions. The way market has declined with a strong momentum, it is indicating that today's bounce is just lacking the strength, and I'm not expecting any bigger upside on this pullback rally. But overall, the trend remains weak. The important support has been broken. The gap area of around 24,700 levels of 18th of August has been decisively broken, and Nifty is currently trading lower below that gap support. So I'm expecting Nifty to come down further. The next important support to be watched is around 24,300 to 24,200 levels, previous swing lows, as well as 200-day EMA. These are some feasible base for the market to bounce back from the lower levels in the short term. And the Bank Nifty as well. Bank Nifty was showing some sharp, violent declines, though placed at the 200-day EMA. I'm not expecting any significant recovery is shown in the chart, and eventually we could see Bank Nifty coming down below 53,700, 600 levels, and the next lower supports to be watched is around 53,000 for the short term. I have a mixed trend in the stocks in terms, one is from the long side, one is from the short side. And the CG Power chartically has been in a larger consolidation phase over the last few months, in fact, and today made an attempt of breakout of the consolidation. Technically, we believe after the range bound action, whenever the underlying moves up with a strong buzz and a volume, that is a breakout candidate, and I'm expecting this stock to move up further. So one can look to buy CG Power, currently trading around 695. The immediate target would be around 740, and one can place a stop loss at 665. Second one is from a sell side, CESC. Chartically, CESC, after range bound action, broken down sharply in the last few sessions back, and currently the weak trend is going on. Currently trading around 152.70, one can look to sell at this point of time. 144 is going to be the next support, which is going to be the next target, downside target for the stocks, and one can place a stop loss at 157.
Thank you very much for that. The mid-cap index is in the red now. The advanced decline ratio, which at the start of the trading session was about 5 stocks advancing for 2 in the red, the gap between the two has also narrowed considerably. Now 1,500 stocks in the green for 1,200 in the red. Though individual stocks catch your attention, LG Rubber, big volumes, Jindal Poly and Jindal Worldwide have a double-digit gain. Apollo Microsystems, very large volumes, 40 lakh shares, 8.5% uptick on that. Advanced Enzyme, Relaxo Footwear, Idea Forge, Aether Energy. Ola has been capturing all the attention in the headlines. It got that PLI for its Gen 3 scooters. Ola continues to do well, but today you are seeing that up move coming through on Aether. But in the large cap screen, what dominates the action are many of these consumer names. So names like Colgate, Britannia, ITC up 2, 3, 4%. Mangalam is joining in, and he's going to outline the stocks which will be impacted with the upcoming GST rejig.
Well, the message is fairly clear. Small ticket consumption needs to be boosted in our country, and that was something that was unilaterally, focused on by the budget as well, that after the RBI policy coming in, and now from the GST as well, Prime Minister's speech on Independence Day. What we gather from our sources, as Timsy has been reporting, is that items of daily use, the essentials, we have the likes of, talcum powder, you have soaps, you have toothpastes, and you have biscuits, etc. All of them would be brought to the 5% bracket, which would spur consumption, at least at the lower end of the spectrum. And that is what is expected to, boost volumes for a lot of the players who have been parched for volume growth. The likes of Britannia, Dabur, you have HUL, you have, Godrej Consumer, all of them in focus in today's trading session, doing well. And as we move towards the festive season, there is expected pickup in the revenue for these companies as well. Even if you go down the discretionary side of things, where footwear is concerned, pairs which are priced sub 2,500 rupees will be actually taxed at 5%. And in terms of volumes, this 25%, 2,500 rupee and below accounts for more than 90% of the overall country's footwear, organized footwear market. So to that extent, players like Bata and Relaxo are buzzing around in today's trading session as well. So we'll watch out for small ticket consumption items where the focus is on by the GST committee. So any outcome that happens on September 4th, which further rationalizes these rates, as Timsy has been reporting, would be a positive.
Okay, all right, got it. Thanks for that, Mangalam. That's the only sparkle in the market, so to speak, right now, and it's showing up in multiple stocks. Well, let's discuss this and more with Prakash Devan. Prakash, before we start talking Reliance, just thought we'll get your thoughts on this. This is the only real hope. Now, I mean, for someone who wants to position their portfolio for this GST boost or bonanza, which are some of the stocks you'd pick? Maybe there'll be some auto names. There's a lot of expectation over there. Would you look at consumer FMCG at all?
Good afternoon, Sabhi. So, my sense is the news flow has been a bit ahead of the actual changes that will start happening and impacting companies and P&Ls. So there's no hurry. You'll get time, wait for the announcement, see how that gets digested, and the criticality of how soon and to what extent companies are able to benefit out of passing on these reductions in duties in GST to augment sales. So if revenue growth, volume growth actually picks up, then it's a very different thing. So which players will benefit? And this, of course, it's too difficult to guess. I mean, you could keep speculating, but broadly, I think the sector will get re-rated. So there will be an appetite post the announcement, and that will kind of help some of the PE expansion happen, which has been kind of overdue, because last 3 years, I don't think an HUL or a Britannia have really done anything significant. So they're poised for very good times ahead, but there's still about a month and a half for that to really happen.
By the way, should also take a look at the currency markets. Let's pull up the rupee if we can, because the rupee anyway has been under pressure today, but the new headline is that we've hit a fresh all-time low today. Dollar rupee currently on my screen at 88.05. That's a real sharp depreciation in the currency. A 0.5% slide that's come through. So that's also something that's really perhaps weighing. Though, of course, economists will tell you, and we had Sajid Chinoy in the morning saying exactly this, that a calibrated decline of the rupee perhaps is not bad at all. I mean, to some extent, perhaps it helps us mitigate some of these tariff concerns, because remember, even at 25%, India is at the higher end of tariffs compared to a lot of the other Asian nations. So that's a big headline as well. The rupee falling 0.5% today. Prakash, on exporter stocks, I mean, is the worst over? Is there any point looking at that entire basket, whether it's names like Gokuldas, etc., or would you just completely stay away right now?
No, absolutely. See, while you were speaking, the rupees actually made a new low of 88.07. So, of course, 2 basis points lower than what you mentioned, but still, nevertheless, it looks like a fall that's not we've not seen the last of. What I think is going to happen is this whole anticipation of tariffs getting revised favorably has actually numbed a lot of people into inaction. And when finally the tariffs hit and the reality hits you, it's going to be quite significant. My sense is, a lot of these companies will have to really do very disruptive kind of thinking in terms of where they want to reset and recalibrate their supply chains and all. So it's not going to be easy, and it's best to kind of let that storm pass through, see what's the damage, and then kind of start rebuilding. But there could be far more second order impact also, and it's not just like textiles or gems and jewelry which will get impacted. You have a lot of issues related to the downstream employment opportunities and all the spin-offs from there. So I think it's going to be quite a bit, and that's exactly why the market is getting into this state zone where it doesn't want to move up. Good news is also not getting rewarded. And there are a lot of things which are in the pipeline for which the impact will still have to be awaited. So my sense is that you'll get wonderful opportunities to buy into your favorite stocks and sectors once the impact is kind of digested or felt by the market.
I just want to also point out, let's pull up the rupee chart again, because suddenly there's more momentum now on the downside on the currency. When I was checking it just about 5-7 minutes back, it had not crossed 88, but the moment that psychological mark got crossed, and there was added pressure coming in. The FPI selling has been absolutely relentless as well, Rima. We know that. I mean, after selling over 17,000 crores in July, the selling in August is nearing 30,000 crores. So that just, has been adding to the pressure.
But the dollar index is not that it's strengthened. I think the dollar index is sub 98, and it has been very listless. It's not that the dollar index has been very strong, which explains the rupee, the fall in the rupee. Just putting that in the global context. So I guess just people are edgy, a bit nervous about what's happening with India and the way this US-India tariffs is going to find a resolution, how long it takes, and what form and shape. But I think now the headline is, and as you pointed out, right, it's rapidly falling now, 88.12. Just 2 minutes back, it was 88.09. Now it's 88.12. So the fall is now picking up momentum. Sanjay Parekh, founder and CIO at Soham Asset Managers, is now joining in. Sanjay, you just want to quickly comment on what's happening? The Indian markets have been very listless. On one hand, you could call it resilient because it's still so much better than what it was compared to the April levels. But it's still a marked underperformance versus emerging markets. And see what's happening with the rupee now.
Yes. So, first on the markets, earnings growth was weak. We know that it happened in Q4, Q1 as well. We saw downgrade in earnings, but there were definitely positives in terms of rate cuts. The heavy lifting was clearly done by RBI. And then we also were expecting, because of the tax rate cuts on the fiscal side, also helping us. But very clearly, one of the issue was the Trump tariff, where the direct impact maybe $25 billion, $10 billion each in jewelry and apparels and a little more and the rest of it. But I think the second order effect is what also we need to watch. And then we have that, those are the negatives. The positives, as we know, are the GST rate cuts. So I think we need to navigate this. And then we also have an uncertainty of what happened in the interim, right? If I am a car buyer today, I certainly differ for a while. So there's an interim hiccup as well. So I think that we have to navigate this quarter a bit. There will be volatility in markets and economy. And then I think, hopefully there is some semblance in terms of bilateral relation and it gets better. And market is taking note of it. And we think strongly that, the next 2, 3, 4% for Nifty, all of it will be the price, and that will give us good opportunity to buy.
Okay, there could be an opportunity which emerges in the next 2 to 4 months. But Sanjay, what about the risk that, the second order impact derails the earnings recovery narrative that's building up, especially starting Q3? Yes. We were the first ones to try and stitch a deal with the US, but we've been unsuccessful so far, and now we're worse off. Yes. I mean, no one knows how it's going to play out, what the probability of this is, but at least as things stand right now, what is the second order impact on the earnings recovery, which is expected?
No, you're right. You're absolutely right. So, the starting point was earnings growth was weak. And now we saw the Trump tariff, where it will have impact as it's visible in few sectors. But the second order effect always is there. Like if there's an SME in apparels, which can have an asset quality problem, which can percolate into banks. So you can't avoid it. And in jewelries, the margins are 5 to 7%. How can you have such high? So it's going to have, definitely, you can't say there's no pain and it's a $4 trillion, the impact is less. I think we should not ignore it totally. So only thing is, government is very well aware. The heavy lifting has been done by RBI. The government also hacked the fiscal space. Now, after doing all this, as today Sajid also said, we would not have that fiscal space if we were to do, if the nominal GDP were to be slow and tax collections are going to be used for GST. So it will get a little tighter. And that is reflecting also where the CAD was very comfortable. Now it doesn't look to be that comfortable, and it's showing up in rupee. And also on the 10-year, which is where market is saying, the debt market is saying that maybe the borrowings can be a little more, and the fiscal deficit could, normally they cut the spend, but then it has a ramification on growth. So how do we navigate that? And at least the debt market and forex markets are showing a bit of uncertainty, which is a very, very valid reason.
Okay, well, as far as the market is concerned, as of now, there is hardly any move and not too many clear trends. There's some stocks which are actually beyond the consumer space. L&T, for instance, can be noticed. Let's pull up L&T if we can. 1.5% up. Shriram Finance, which had a really bad week, at least up until today, Friday. Shriram Finance is undoing a lot of the week's decline. Up till yesterday, Shriram was down almost 7%. Now it's cut the weekly loss to about 5%, thanks to today's rally, 2.5% up over there. There's BEL, which is up about 1.5%. So, Sanjay, hi. I mean, the question is from here on, for the next couple of months at least, will you give your portfolio more of a consumer flavor than, say, a capex/industrials flavor? Will you make any tweaks expecting a consumer move to last?
Yes, so, one is, I think, you don't get great levels and great news together. We need to be aware that when there is uncertainty, that's exactly where it throws up opportunity. So I think at least we feel that, the time correction also has happened. And the next, as I said, 2, 3, maybe 4% max is where, if we go down on Nifty, that will throw up very good opportunities, And our, all throughout, we have been domestic overweight, global underweight, and that will continue for us. While our FMCG weight is negligible, which certainly paid us recently, but there again, we are not comfortable with valuation. We also want to watch whether this GST benefit will percolate into the demand on the consumption side. But now they are still cheap, and have not delivered growth as yet. So we will be in consumption through, telecom or through auto discretionary space. We will want to be in consumption in maybe even at a point financials. So through Bajaj Finance. So we would want to navigate. We will have representation to consumption, but overall there will be domestic overweight, global underweight would be our strategy.
Okay, all right, Sanjay, we'll leave it on that note. Shorter conversation today. Thank you very much for joining in. We have to look at the currency once again because the rupee is moving like a stock. I mean, imagine that. 5 minutes ago, we checked it was a 0.5% decline. Now it's approaching a 0.8% decline. Lata is with us. Lata, look at that chart. It looks like a mid-cap stock moving,
No, it is a very big move suddenly. Earlier, actually, dealers were telling us that since morning, there has been a decent demand from both corporates, okay? Importers, probably exporters who are importing in a hurry so as to value add and supply quickly because September 17th is the deadline until when goods will be accepted. So there has been a scamper as well, corporates as well as FPIs who have anyway been demanding dollars for some time now. Apparently, the RBI was supplying dollars in early trade, but probably they had a limit and it got exhausted. This is all dealer guesses. And when once 88 got crossed, this is, typical dealer and, hedger mentality. You have your cells at a particular point, but once it crosses that level, then you start becoming a buyer of dollars. And that's exactly what happened. Stop losses got triggered. And once it crossed 88, a previous low is of February 10th, I think, when the low that we touched was 87.97. So 88 as a round figure was a line in the sand. Once that got crossed, so many of, shorts got closed. And there was extraordinary demand in the last half an hour or so. The currency has gained that 30 pies. The rupee, that is, has lost about 30 pies. The dollar has gained, and we are heading towards nearly 1%. It was 0.5%, like you said, until just an hour ago. But things have just become a perfect storm.
So I guess perhaps the fact that we're approaching this September 17th deadline only exacerbating some of the moves.
It is many things. Yeah. I mean, the dollar is slightly stronger, and therefore you are seeing it stronger against Asian currencies. But the rest of them, the Thai baht and the Filipino peso, are all down by about 0.3, 0.2.
Yeah.
We have a big problem. I mean, we have a lot of capital outflows, and we have, a larger probably exporter-importer buying as well. All this has compounded. Sentiment is not in our favor at all. Yeah. And that also leads to more speculative positions getting taken. And I guess the Reserve Bank will come with a new level and intervene. But this has come as a bolt from the blue.
And is there any connection with, the fact that yields are rising in India? There are fiscal deficit concerns because we're losing revenue on the GST front, so the government will have to borrow. I mean, is there any connection to that?
These are not new. The fact that the Indian yields have been rising is, I think, about a 3-week-old story. That we have been, the 10-year has been at 6.5 to 6.6. So that's not new, nor is the likely fiscal pressure because of the 50% tariffs new. Yeah. But these things, suddenly
it's all adding together. Yeah, it's all adding up. Got it, Lata. Thanks very much. That's really helpful perspective. Big slide on the currency today. Well, on that note, we do have to take a very quick break. But when we come back, it's going to be Reliance Industries full throttle. All eyes on that AGM, and we'll get our continuous coverage started. The countdown is on, less than 30 seconds to go. Will investors get more clues and cues into the next big steps in the RIL vision, whether it's the new energy business scale-up, whether it's AI, or whether it's the much-anticipated listing of the company's telecommunications as well as retail arm. So all eyes, and I think we'll have Mr. Money speak shortly.
Ladies and gentlemen, good afternoon. It is 2 p.m. and time to start the meeting. I welcome all of you to the 48th Annual General Meeting of the company. This meeting is held through video conferencing in compliance with the circulars issued by the regulators. The company has taken all feasible steps to ensure that the shareholders are provided an opportunity to participate in the annual general meeting. Adequate video conferencing facility and live webcast of the proceedings of this meeting have also been provided. Requisite quorum is present, and therefore I call the meeting to order. Register of directors and key managerial personnel and their shareholding, the register of contracts or arrangements in which directors are interested, and certificate from the secretarial auditor on employees' stock option scheme are available for inspection by the members. I wish to introduce, for the benefit of new members, my colleagues on the board of our company. Dr. Shumit Banerjee, Srimati Arundhati Bhattacharya, His Excellency Yasir Al-Rumayyan, Shri K.V. Chaudhary, Shri K.V. Kamath, Shri Haigriv Khaitan, Shri Dinesh Kanabar, Shri Nikhil Meswani, Shri Hital Meswani, Shri PMS Prasad, Shri Anant Ambani, Mrs. Isha Ambani Piramal, Shri Akash Ambani. All directors of the company are present at this meeting. Shri V. Shrikant, Chief Financial Officer, Srimati Savitri Parekh, our Company Secretary, Shri K. Sethuraman, and the representatives of our statutory auditors and the secretarial auditors of the company are also present at this meeting. Ladies and gentlemen, notice dated August 6, 2025, convening this annual general meeting and a copy of the annual report for the financial year ended March 31, 2025, have already been circulated electronically to the members of the company. With your permission, I shall take them as read. The auditor's report on the standalone and the consolidated financial statements and the secretarial audit report of the company for the financial year ended 31st March 2025 do not contain any qualification, reservation, adverse remark, or disclaimer. Accordingly, these reports are not required to be read out as provided in the Companies Act 2013. Now I will begin my formal address to the shareholders. My dear share owners, Namaste, and a very warm welcome to the 48th Annual General Meeting of Reliance Industries Limited. We meet today on the most auspicious occasion of Ganesh Chaturthi. Lord Ganesh has arrived in our homes and in pandals on our streets. Let us begin this meeting by seeking the blessings of Bhagwan Ganesh for you, your families, the entire Reliance Parivar, and for all the people of India and the world. Friends, the global economy today is navigating through an era of great uncertainty. Geopolitical tensions are rising, volatility is persistent, and predictability is scarce. The world is realizing that conflict produces no winners, whereas cooperation ensures shared prosperity. When nations cooperate, trade flows freely, investments flourish, and everyone wins. In today's interdependent world, the prosperity of each country is inseparably linked to the prosperity of all. Paradoxically, while uncertainty surrounds us, humanity also stands at the threshold of a golden age in the 21st century. An age defined no longer by scarcity, but by superabundance and super affordability for all the 8 billion people on this planet. This has become possible because of the convergence of three powerful technological transformations. Breakthroughs in clean energy are unlocking a future of abundance, sustainability, and security, raising hopes for overcoming the climate crisis. Breakthroughs in genomics promise dramatic improvements in cure of diseases, longevity, and overall health. Breakthroughs in artificial intelligence and allied deep technologies have already begun to boost productivity, efficiency, and human potential to unimaginable levels. Because of the miraculous power, AI can now be called the new Kamdhenu, the divine wish-fulfilling cow of our age. At Reliance, we see these three convergent transformations not as distant possibilities, but as immediate opportunities for India. Therefore, we are building the world's most advanced clean energy ecosystems. We are expanding into the frontiers of digital health, life sciences, and genomics. And we are developing AI as a new growth engine besides embedding AI across all our businesses from retail to telecom, from energy to entertainment. India, with its scale, talent, and entrepreneurial spirit, is uniquely positioned to lead in this new era of AI, clean energy, and genomics. And Reliance has positioned itself confidently to lead our nation's mission to ensure that abundance and affordability become the birthright of every Indian. This is our solemn promise. Friends, the possibilities created by these new technologies are staggering. The global GDP today is at $110 trillion, has the potential to reach $500 trillion within the next 25 to 30 years. Imagine, in our own lifetime, we can end poverty globally and ensure that every human being has access to all basic needs. For this vision to be realized, it is our hope that the world leaders choose cooperation over conflict, dialogue over discord, and win-win agreements over zero-sum rivalries. Despite geopolitical uncertainty, one truth is crystal clear. India is on the rise, and India's rise is unstoppable. Today, India already ranks among the world's top 4 global economies. Under the determined leadership of our visionary Prime Minister, Shri Narendra Bhai Modi ji, India's GDP is growing faster than all major economies. With the right set of reforms, advanced manufacturing capabilities, and a national priority on deep tech, our economy can grow at 10% annually. This will mean that the per capita income of Indians could rise 4 to 5 times within the next 2 decades, making India not just a prosperous nation, but also a more equal nation. And more importantly, India need not copy any foreign model. We have the ability and the responsibility to create an India-first model of development. This model will use deep tech to bring prosperity and security to India, improve the quality of life of each and every Indian, and protect the environment. This model will also harmonize technology with democracy, economy with culture, spirituality with science, and national aspirations with friendship across all nations. This is the collective dream of nearly 1.5 billion Indians to build a nation that leads with both prosperity and compassion. This, my dear shareholders, is the Indian dream. Dear shareholders, as Reliance approaches the close of its golden decade, we rededicate ourselves to the rapid realization of this Indian dream. We are resolutely transforming our operating model to become a deep tech company with advanced manufacturing capabilities. We are making every one of our businesses AI native, positioning them for hyper growth. Our corporate philosophy of we care compels us to continuously improve the quality of our products and services in ways that promote the well-being of both people and planet. Our operating model is now led more by innovation than capital intensity. That is why we are attracting and empowering super talented young leaders who will drive the next wave of value creation with bold innovations. Reliance has never rested on its past laurels. Our founder and forever guide, Shri Dhirubhai Ambani, instilled in us a DNA of relentless reinvention and reimagination. Again and again, we will reimagine and re-engineer ourselves to create greater wealth for our nation and higher value for our society. This is my solemn commitment to you. Dear shareholders, I am happy to share with you the details of yet another stellar year of business and financial performance achieved despite multiple challenges. In the financial year 25, Reliance delivered a record consolidated revenue of 10.71 lakh crores, becoming India's first ever company to cross $125 billion in annual revenues. Reliance's EBITDA stood at 1,83,422 crores and net profit grew to 81,309 crores. Reliance's exports were at 2,83,719 crores, contributing to 7.6% of India's total merchandise exports. Reliance invested cumulatively rupees 5.6 lakh crores in the last 3 years. Reliance remains the single largest contributor to the national exchequer, contributing rupees 2,10,269 crores in the financial year 25. In the last 6 years, Reliance's contribution to the national exchequer crossed rupees 10 lakh crores. I am also proud to report that Reliance's CSR spending in the financial year 25 rose to 2,156 crores. Reliance's cumulative CSR expenditure over the last 3 years crossed rupees 5,000 crores. This is a clear reflection of our unwavering commitment to social impact. Friends, employment generation for India's talented youth is a national priority. It is also a priority for Reliance. Globally, the dynamics of employments are undergoing a shift towards flexibility, driven mainly by AI and automation. Reliance has also adopted modern engagement formats that combine opportunities for upskilling, entrepreneurial drive, job satisfaction, and higher earning potential. Today, our conventional and non-conventional workforce has grown to nearly 6.8 lakh people. I see this growing to more than 10 lakh people over the next few years. It gives me immense satisfaction to say that we continue to be amongst the most admired employers and rank among the largest job creators in India. Reliance continues to lead across every key growth parameter: revenues, profitability, exports, market value, investments, contribution to the exchequer, and social impact. I am confident that Reliance will continue to break its own records in business performance next year and beyond. Dear friends, let me begin by sharing with you the impressive performance of our digital business. Just a week from now, Jio will enter its 10th year of service to the nation. Looking back, these years have been the most glorious in India's digital history. Today, I'm proud to share with you that the Jio family has crossed 500 million customers. The 500 million milestone is a symbol of your unwavering trust and support. I offer my heartfelt gratitude to each and every one of you. I have heard people say, Jio changed my life, and I love Jio. But I say from my heart, actually, each and every Indian built Jio by simply making it a part of their lives. Let me present a short video of our Jio journey, how 500 million Indians made Jio. All of you made Jio.
आइए दोस्तों, देश के अलग अलग हिस्सों में चलते हैं और भारत ने जियो कैसे बनाया उन किस्सों को सुनते हैं। ये है मुंबई के टीचर अभिषेक साठे, जो हर रोज कमाल कर रहे हैं।
बच्चा पार्टी, अपना अपना कैमरा ऑन करो। किसी को पीछे छूटने नहीं दिया जब हर एक बच्चे को पढ़ाया। जियो मैंने बनाया।
ऐसे कर्मठ टीचर्स की वजह से भारत का आने वाला कल कभी पीछे नहीं छूटा। जी हाँ देवी जी,
हमारी बहू रानी ने ना क्या कहा था, यूपी
माझे यूपीआई। जब मैंने यूपीआई से बिजनेस चलाया तब जियो मैंने बनाया।
वाह, कितने गर्व की बात। इनकी तरह आज 5 करोड़ छोटे बड़े दुकानदार यूपीआई का इस्तेमाल करके अपना बिजनेस फैला रहे हैं। आइए देखते हैं यहाँ क्या चल रहा है।
जब के ड्रामा को गांव में ट्रेंड कराया तब जियो मैंने बनाया।
आज देश के 50 करोड़ लोग मनोरंजन का मजा फूंक फूंक के नहीं बल्कि दिल खोल के उठा रहे हैं।
हम सब बेस पर सही सलामत लौट आए हैं।
ये तेरा बेटा।
बॉर्डर ऑपरेशन के बाद जब पापा को भरोसा दिलाया तब जियो मैंने बनाया।
अब मिलते हैं उस माँ से जिसकी ममता का सफर बस अभी अभी शुरू हुआ है।
मदरहुड की जिम्मेदारी के साथ साथ ऑफिस भी निभाया। जियो मैंने बनाया।
जहां देश की लाखों महिलाएं अपने ऑफिस से रिमोटली जुड़ी, वहीं कोविड के मुश्किल दौर में लाखों जानें भी बची।
जब वीडियो कॉल्स के थ्रू मैंने अपने पेशेंट्स तक इलाज पहुंचाया तब जियो मैंने बनाया।
जब से मन ने इस फोन को अपना घना यार बनाया तब से जियो मन ने बनाया। तू मन ने यो बता, यो हॉर्टिकल्चर से उपज कैसे बढ़ सके?
सही जानकारी के साथ यारी करने का लाभ आज दूर दराज के गांव के 10 करोड़ किसान उठा रहे हैं।
देसी कारीगरी को दुनिया तक पहुंचाया। जियो मैंने बनाया।
करोड़ों व्यापारी अपने ऑर्डर्स का ग्राफ बढ़ा रहे हैं और मेक इन इंडिया का झंडा लहरा रहे हैं। जब भारत की जनता ने हर छक्के, हर चौके को जश्न की तरह मनाया, तब जियो मैंने
बनाया।
सही तो कह रहे हैं। जियो को 50 करोड़ देशवासियों ने मिलकर बनाया और हम सबको डिजिटल इंडिया के नए युग में पहुंचाया। और ये तो नए डिजिटल इंडिया की बस शुरुआत है।
Friends, Jio was conceived at a time when India's road to digital transformation was blocked. Prohibitive data prices, poor connectivity, and even poorer speeds had stifled the digital aspirations of Indians. That is when we said, this must end. And Jio ended India's digital poverty within a few years. Jio's bold, deep tech initiatives sparked India's technological revolution and became the backbone of our Prime Minister's Digital India mission. Let me mention only 5 major achievements of Jio which were previously unimaginable. First, Jio made voice calls free from anywhere to everywhere in India. Second, Jio made it a habit for common Indians to watch videos on their mobile and do digital payments also on their mobiles. Third, Jio laid the foundation for India's digital public infrastructure, such as Aadhaar, UPI, Jan Dhan, direct bank transfer, and empowered a confident new generation. Fourth, Jio enabled the creation of the world's third largest startup ecosystem in India with over 100+ unicorns. Fifth, Jio's nationwide 5G rollout, the fastest in the world, has laid the foundation for the AI revolution in India. Dear shareholders, as a result of these achievements, the financial performance of Jio is scaling new heights with every passing year. Jio's revenue was 1,28,218 crores, a growth of 17% year on year for the financial year 25, and our EBITDA was 64,170 crores. These figures are a testimony to the enormous value Jio has already created and the still greater value it is destined to create. Today, it is my proud privilege to announce that Jio is making all arrangements to file for its IPO. We are aiming to list Jio by the first half of 2026, subject to all necessary approvals. I assure you that this will demonstrate that Jio is capable of creating the same quantum of value as our global counterparts. I am sure that it will be a very attractive opportunity for all investors. Friends, Jio's plans for the future are even more ambitious. They rest on 5 assurances. 1, Jio will connect every Indian on mobile and home broadband. 2, Jio will empower every Indian home with digital services like Jio Smart Home, Jio TV Plus, Jio TV OS, and seamless automation. 3, Jio will digitize every Indian business and enterprise with simple, scalable, and secure platforms. 4, Jio will herald the AI revolution in India. Our motto is AI everywhere for everyone. And 5, Jio will expand its operations outside India with our own technology to people around the world. I am extremely confident that the path ahead for Jio is even brighter than its journey so far. I now invite Akash, who spearheads Jio, to take you through what lies ahead in the company's exciting journey.
Thank you, Chairman. Jio is where I began my professional journey, faced challenges, learned lessons, and found my purpose. I have grown with Jio, and today, to see it come into its own as an independent company is both humbling and exhilarating. Jio is part of me. Chairman, sir, I want to thank you for your trust, your vision, and your guidance. I assure you that Jio is on the path to build on your vision with renewed energy and unwavering resolve to serve India's digital future. Dear friends, as we take this next step in Jio's journey, it gives me great pride to reflect on how far we've come. Today, Jio serves over 500 million happy customers. To put that into perspective, it's more than the combined population of the United States, the United Kingdom, and France. This isn't just a milestone in terms of scale. It's a testament to the deep and widespread trust that Jio has earned from every corner of India. Very few companies in the world have the privilege of serving 500 million people. Fewer still do it with the consistency, commitment, and care that Jio has demonstrated. This achievement, therefore, belongs not just to Jio, but to each and every individual who believed in Jio and stood by it. And with that belief comes responsibility. The responsibility to lead, to innovate, and to serve with purpose. Not to sell, but to truly serve the customer, putting their needs at the heart of every innovation. Today, Jio carries the largest wireless data traffic in the world. India's next digital leap and Jio's next growth engine will come from businesses large and small. Jio is building simple, scalable, and secure platforms for MSMEs and enterprises alike. From franchisee management to AI-powered solutions across verticals, we're enabling every business to compete globally. This is not just digitization, it's the democratization of enterprise-grade technology. Jio's transformation into a deep tech company is now unmistakable. We've done it on a technology stack that is designed, developed, and deployed entirely in India by Jio's own engineers. From developing our own 5G core to rolling out the fastest 5G services in the world, and now deploying our global first Home Connect technology, we have cemented our place as a deep tech company. Our proprietary Home Connect technology, UBR, an industry-first innovation, has revolutionized home broadband, offering gigabit speeds while avoiding cable cut disruptions and supporting high-end applications. Jio AirFiber is now the largest fixed wireless provider in the world, adding over 1 million homes per month. And now, with the integration of AI, we're building a stack that will power intelligent services across India. From Gen AI-enabled customer journeys to AI-powered diagnostics and automation, Jio is laying the foundation for India to become the world's first AI-native digital economy. Building on this foundation, Jio through 5G has redefined speed, reliability, and the reach of digital connectivity. Today, more than 220 million users are benefiting from Jio's true 5G network. Friends, at the heart of all our offerings is our customer. At Jio, customer service is not a department, it is a promise. We are redesigning every touchpoint to delight the user, not just serve them. Whether it's discovering, buying, using, or resolving issues, our systems are now event-driven and API-enabled with Gen AI at the forefront. This transformation is structural, aligning our architecture and feedback loops to deliver precision and delight at scale. This relentless focus on innovation has also driven our strongest financial performance yet, with record revenue, profitability, and customer engagement. As we look ahead, Jio's journey will be beyond India. Our innovative technologies are now ready to be deployed globally and solve global challenges. With strategic partnerships and a clear roadmap, we will take Jio services international, creating value for partners and shareholders alike. Behind every achievement is a mission to serve customers with heart, to connect the unconnected, uplift every citizen. As we move forward, Jio remains committed to this service, ensuring that our technology empowers all of you. To give you a glimpse of where the mission is headed next, I now invite my colleague Kiran to join me to showcase some of Jio's latest innovations.
Thank you, Akash. Today, Jio is the only operator that can activate gigabit speed internet in under 24 hours across India. In the past, getting broadband installed, even in our largest cities, meant waiting, delays, and multiple site visits before installation could even begin. It was frustrating for homes and small businesses that simply wanted to be connected. At Jio, we decided India deserves better. And we completely reimagined this using our deep tech platforms. We built something no one else has attempted at this scale, a digital twin of India's physical infrastructure. This is a living, breathing 3D model of our entire nation, covering every terrain, every locality, and every single building. The moment a customer places an order, Jio's digital twin system allows our engineers to check the local network conditions for that specific customer and precisely plan the entire installation instantly right from their offices. And within 24 hours, the rooftop unit is installed and the customer's premises is live with gigabit speeds. This homegrown capability puts India and Jio at the forefront of technology innovation and sets a new benchmark in serving customers at scale. Now, last year in our AGM, we introduced Jio AI Cloud with up to 100 gigabits of free cloud storage for all Jio users. More than 40 million Indians have trusted Jio AI Cloud to back up their most important photographs, files, and videos, all securely. Today, we unveil the next generation of Jio AI Cloud that is more than just storage, but an AI-powered memory companion. Imagine being able to find and relive your most precious moments simply by speaking in your own language. You could, for example, say, "Hello Jio, मुझे last year Ganpati Visarjan के photo दिखाओ." And Jio AI Cloud will search your entire library and instantly bring back vibrant images of your celebrations. Jio AI Cloud also makes everyday organization effortless. For example, when you scan a receipt, it categorizes it automatically under bills. Or when you upload a picture of your Aadhaar card, it again automatically categorizes it under identity documents. And with our new AI Create Hub, Jio AI Cloud becomes not just a place to store memories, but also to create them. Anyone can turn simple photographs into shareable reels, collages, or promo videos with no expert skills required at all. Imagine a small shopkeeper creating a professional product reel in minutes, or a parent compiling a family album with just one click. We are making Jio AI Cloud smarter and more human, and are excited for you to try these very soon to be released features. And now back to you, Akash.
Thank you, Kiran. Jio's vision is to empower every connected home and business with advanced digital services. Today, we are proud to announce another leap forward called Jio PC. Our world is being reshaped by AI, but for AI to be truly inclusive, it must be present in every Indian home and business. Jio PC is that revolutionary product that transforms your TV or any other screen into a full-feature AI-ready computer. You can easily get started by connecting a keyboard to your Jio set-top box. Instantly, you get a virtual computer powered from Jio's cloud with no upfront investment. You simply pay for what you use. And because Jio PC lives in the cloud, it's always up to date, secure, and you can remotely upgrade your memory, storage, and computing power based on your growing needs. For the first time, anyone in India can tap into high-performance compute on demand. You can go from creating documents to running advanced simulations, all on the same Jio PC. We are partnering with leading providers to bring a rich library of applications and powerful AI tools to boost your productivity and creativity. Jio PC is not just about giving people a computer. It's about giving every student, every professional, every entrepreneur in India the same AI-ready power that only few have had so far. This is computing for India reimagined. Next up, we're proud to give you a first look at one of our most exciting upcoming products, Jio Frames. Jio Frames is an AI-powered wearable platform, an ecosystem made for India. With support for multiple Indian languages at launch, you can simply speak to Jio's multilingual AI voice assistant. It is a hands-free AI-powered companion designed for the way India lives, works, and plays. With Jio Frames, you can capture your world like never before. Take HD photos, record videos, or go live. Every memory is instantly stored in Jio AI Cloud. Jio Frames goes beyond capturing moments. Reading a book? Just ask for a summary or an explanation. Cooking a new dish? Get a step-by-step guide while your hands are busy. Traveling to a new city? Instantly learn about the landmarks around you. You can make calls, take meetings, listen to music, or enjoy podcasts. With built-in open-ear speakers, you hear crystal clear audio while staying aware of the world around you. GeoFrames brings the power of AI into your everyday life in the most natural way possible. Intelligence will not just be in your pocket, it will be right in front of your eyes. Dear shareholders, let me now talk about our media and entertainment business. The formation of JioStar marked a defining moment for India's media ecosystem. In just a few months, we have created a revolution by strategically leveraging content, AI, and technology to reshape how stories are told, delivered, and experienced. JioStar offers 320,000 hours of content, 6 times more than the next 2 OTT platforms combined, with 30,000 hours added every year. Our advanced AI tools and technology innovations are empowering viewers like never before. As a result, our media and entertainment business delivered a record-breaking performance. The launch of Jio Hotstar brought over 600 million users on board within 3 months. This included over 75 million connected TVs. With 300 million paying subscribers, Jio Hotstar is now the world's second largest streaming platform, achieved entirely in our country, India. This record shows the immense potential of Indian consumers. In addition, with a 34% TV market share, equal to the next 3 networks combined, we are well on our path to serve 1 billion screens across mobile, TV, and connected devices. JioStar will continue to expand across platforms and geographies. We have created an experience that combines the best of content, software, and AI through Jio Hotstar. We always want to push the boundaries and give our customers a more elevated experience. And now, let me give you a glimpse of what's coming to Jio Hotstar. Finding what to watch from thousands of hours of content can feel overwhelming. That's why we have built Ria, your new voice-enabled search assistant that makes discovering content effortless. Ria is built for the way you think and speak. Whether it's key moments from your favorite shows, highlight reels of your favorite players, or even a deep dive match analysis, Ria understands you. Just say what you want across years, seasons, and episodes, and Ria will curate it for you. No more scrolling, no more searching. Just ask and Ria delivers. Now introducing VoicePrint, the next leap in immersive storytelling. For the first time on Jio Hotstar, you will be able to enjoy sports and entertainment in your favorite Indian language without losing the magic of the original performance. With the power of AI voice cloning and lip sync technology, your favorite stars won't just get dubbed, they will actually speak in your language in their own voice with perfect lip sync on screen. Here's a closer look.
Guys, अरे उठो यार, देखो तो ब्रॉड क्या बोल रहा है. Let me talk you through how I would plan an over. Bella desbull mateni mukhyana blai short ball same che. Enter field setting lu, nyan fielders ne fine leg, deep square leg lumpin ne thirdum. लेकिन मैं बाउंसर नहीं करूंगा क्योंकि वो बाउंसर एक्सपेक्ट कर रहे होंगे. तो मैं उनके स्टंप्स पर मारने की कोशिश करूंगा. அவரை இரட்டை யுக்தியில் சிக்க வைக்க முயற்சி செய்வேன். அடுத்து என்னால் முடிந்த அளவு அதிக வேகத்துல பவுன்சரை வீசுவேன்.
So whether it's a cricket match or a blockbuster movie, you can now watch it in your own language in the most natural and authentic way. Paramount to our success has been the unmatched viewing experience we've delivered, and we are always pushing boundaries further. Today, we're excited to introduce Jio Lens, a breakthrough that lets you experience your favorite content like never before. With Jio Lens, you can explore multiple viewing options that adapt to your personal preferences in a single click. It's your content on your screen exactly the way you want to see it. Next, let's look at MaxView, a global first innovation that transformed how cricket is watched on mobile. Now, we're taking it even further with MaxView 3.0, a revolutionary upgrade that puts all your favorite Jio Hotstar features at your fingertips. Multiple camera angles, choices of language, instant highlights, and live scorecards. Everything right there on the same screen, accessible with a simple swipe. This cricket viewing experience has been designed around the way you naturally hold your phone, making it more immersive, more intuitive, and closer to the action than ever before. Head over to jio.com and ril.com to see even more exclusive demos about the exciting features we have planned to launch. With that, let me invite our chairman back onto stage.
Thank you, Akash and Kiran. We are proud of Akash and the entire Jio leadership team for their achievements. I am sure that you will surpass your successes in the future. Dear friends, Disney, which is amongst the largest entertainment companies globally, has partnered with Reliance to form JioStar. I would now like to invite my good friend, Bob Iger, the CEO of Disney, to share his views on our exciting partnership.
It's a privilege to address the Reliance Annual General Meeting and to mark what is already proving to be an extraordinary partnership between the Walt Disney Company and Reliance. And I especially want to thank Chairman Ambani for his leadership and for inviting me to speak to you today. India is one of the most important and exciting markets for Disney globally. Its scale, diversity, and deep love for storytelling present enormous opportunities. And through JioStar, we are delivering the very best in entertainment and sports, reaching audiences at an unprecedented scale. By bringing together Reliance's digital reach, execution, and understanding of the Indian consumer, combined with Disney's rich library of world-class storytelling and beloved IP, and of course India's strong passion for cricket, JioStar has quickly established itself as a global force in media and entertainment, with nearly 300 million paid subscribers. That is truly a remarkable accomplishment in such a short span of time. And we're incredibly proud of what we've achieved so far, and even more excited about what lies ahead. So on behalf of all of us at Disney, thank you for your partnership and enjoy the meeting.
Thank you, Bob, and we look forward to a very strong partnership with Disney. Dear shareholders, let me update you on our news and current affairs business. Network 18 is pioneering disruptive models with sharp focus on credible journalism, creative content, and innovation. Money Control has consolidated its leadership as India's largest platform for business news, financial markets data, and investment analytics. With over 1 million paid subscribers, Money Control Pro ranks among the top 15 subscription platforms globally, alongside the Wall Street Journal and the New York Times. First Post is growing rapidly as India's digital-first global view of the world with a strong presence across platforms. In May this year, it recorded over 400 million video views, becoming the most viewed Indian English news channel on YouTube globally. It is now India's first truly global news brand for geopolitics, strategic affairs, culture, and lifestyle. In the coming year, First Post will expand further with new bureaus in key world capitals. Network 18 continues to lead with CNN News 18, the #1 general news channel for 3 consecutive years. CNBC-TV18 has retained its leadership in business news for more than 2 decades with an overwhelming market share. With CNBC-TV18 Prime and CNBC-TV18 Access, it is delivering premium content to CXOs and decision makers nationwide. It is now looking beyond India for global mind share, market share, and revenue share, delivering delight across screens and platforms. I'm counting on the leadership team at Network 18 to carry the flag of Indian journalism around the world. Dear shareholders, I'm proud that artificial intelligence is already at the heart of Reliance's transformation into a deep tech enterprise. To bring even more focus and speed to this agenda, today it is my great pleasure and privilege to announce the formation of a new wholly owned subsidiary of Reliance called Reliance Intelligence. This new company is conceived with 4 clear missions. 1, to house India's next generation AI infrastructure. Reliance Intelligence will build gigawatt scale AI-ready data centers powered by green energy and engineered for training and inference at national scale. Work has already begun on the gigawatt scale AI-ready data centers in Jamnagar. These facilities will be delivered in phases aligned to India's growing needs, powered by Reliance's new energy ecosystem and purpose-built for AI training and inference. 2, to house global partnerships. Reliance Intelligence will bring the world's best tech companies and open source communities together with Reliance's deep domain expertise and execution strength to deliver performance, leadership, resilient supply, and India-first compliance for AI. 3, to build AI services for India. Reliance Intelligence will deliver trusted, easy-to-use AI services for consumers, small businesses, and enterprises, and solutions for sectors of national importance, such as education, healthcare, and agriculture, reliable at scale and affordable for every Indian. And 4, to house talent for AI. Above all, Reliance Intelligence will create a home for world-class researchers, engineers, designers, and product builders, combining the speed of research with the rigor of engineering so that ideas become innovations and applications, providing solutions to India and the world. Friends, today I am delighted to announce a deeper, holistic partnership for AI with our long-standing partner, Google. Through this partnership, we are marrying Reliance's proven capability to build world-class assets and execute at India's scale with Google's leading cloud and AI technologies so that developers, startups, and enterprises can innovate faster, operate more securely, and reach every corner of India. Let me now invite my dear friend, Mr. Sundar Pichai, CEO of Alphabet and Google, to share a message.
Namaste, and thank you for the invitation to speak today, Mukesh. India is a special place. It's home to some of the world's most dynamic businesses, a thriving startup ecosystem, and incredible amounts of creativity and ambition. We've long been investing in India's digital future, and our partnership with Reliance and Jio has been an important part of how we do that. Our work together over the last decade has helped bring affordable internet access to millions, helping to power India's digital revolution. And now we are building on this to help shape the next leap with AI. The AI opportunity in India is immense. It will transform every industry and organization, from the largest enterprises to the smallest kirana store. Google and Reliance are partnering to help all of Reliance's businesses transform using AI, from energy and retail to telecom and financial services. To support this AI adoption, together we are establishing a Jamnagar cloud region built for and dedicated to Reliance. It will bring world-class AI and compute from Google Cloud, powered by clean energy from Reliance, and connected by Jio's advanced network. As Reliance's largest public cloud partner, Google Cloud is not only powering the company's mission-critical workloads, we are innovating with you on advanced AI initiatives. And with Reliance and the Jio ecosystem, we are excited to put AI into the hands of more people and businesses so they can do extraordinary things as well. This is only the beginning. Thank you, and I look forward to building India's AI future together.
Thank you, Sundar. Dear shareholders, today I am also pleased to unveil a new India-focused AI joint venture with our close partner, Meta. Together, we want to pair the power of open source AI with Reliance's deep domain knowledge across industries. That is why we are forming a dedicated joint venture with Meta to combine open models and tools with our execution in energy, retail, telecom, media, and manufacturing, and to deliver sovereign, enterprise-ready AI for India. May I now welcome my dear friend, Mr. Mark Zuckerberg, founder and CEO of Meta, to share a message with us.
Hey everyone, great to be here with Mukesh, the Reliance team, and all of you. We are at a really exciting moment in time right now. We're seeing glimpses of our AI systems starting to improve themselves. And it seems clear that soon superintelligence is going to greatly improve all of our existing systems and let us build things that we can't even imagine today. At Meta, we want to deliver personal superintelligence to everyone. We believe that this technology has the potential to bring a new era of personal empowerment to people so that they have greater agency to improve the world in all of the directions that they choose. And that's why I am excited about this partnership. It is a key step forward towards ensuring that everyone has access to AI and eventually superintelligence. Meta and Reliance are going to deliver our open source AI models to Indian businesses to help them fuel their work. With Llama, we've seen how AI can amplify human potential, boosting productivity, inspiring creativity, and accelerating innovation. And now, with Reliance's reach and scale, we can bring this to every corner of India. Llama's open source foundation means that whether it's deployed in the cloud, on premises, or through dedicated infrastructure, this technology can be tailored to fit the unique needs of every business, from small startups in remote towns to large enterprises in the biggest cities. With this partnership, we're beginning to build our vision for the future where every entrepreneur, creator, and company has the tools that they need to succeed. I believe that this venture will become a model for how AI and one day superintelligence can be delivered to everyone. This is just the beginning. Thank you.
Thank you, Mark. Our joint venture with Meta is a game changer for Indian enterprises and for sectors of national importance. It will bring transparency, portability, and community-driven progress, enable sovereign hosting and governance within India, and lower inference costs while raising safety and trust. So adoption accelerates from pilot to production across the Indian economy. Dear friends, another exciting frontier for AI is robotics, especially humanoid robotics. Astonishing advances are taking place in this field. Intelligent automation will transform factories into adaptive production systems, warehouses into autonomous supply chains, and hospitals into centers of precision care. We are investing to make India a leader in human-centric robotics powered by AI, creating new types of industries and services, new types of agriculture, new types of jobs, and attractive new opportunities for our youth. Dear shareholders, a decade ago, digital services became a new growth engine for Reliance. The opportunity before us with AI is just as large, if not larger. Jio promised and delivered digital everywhere and for every Indian. Similarly, Reliance Intelligence promises to deliver AI everywhere and for every Indian. With Reliance Intelligence and our strong partnerships, green infrastructure, and India-first governance, we are building for the next decade with confidence and ambition. I am excited about what we will achieve, and I look forward to keeping you updated on our progress in the coming years. Dear shareholders, it fills me with immense pride to stand before you today and speak about one of the most impactful growth journeys in modern India, the journey of Reliance Retail. We have today India's most advanced, scalable, and inclusive retail ecosystem, delivering the highest quality and the widest choice at affordable prices across the country. And it is amongst the fastest growing retailers globally with scale and depth that is unparalleled in the world. Reliance Retail is now ready to write the next chapter of its super growth. Reliance Consumer Products had an outstanding growth in its very first year of operations. It has achieved a turnover of rupees 11,500 crores, making it the fastest growing FMCG company ever. It is bringing some of India's most loved brands like Campa to the consumers in a new avatar, making everyone love them once again. I will now ask Isha, who heads our retail business, to tell you about what she and her team have achieved in the past year and about their future plans. She will also share with you the achievements and the growth strategy of Reliance Consumer Products, which will become a direct subsidiary of Reliance Industries.
Thank you, Chairman. Good afternoon. Esteemed shareholders, Reliance Retail today is a national movement, a mission to benefit both consumers and producers, accelerate the economy, ignite aspirations, and enhance the quality of life of all Indians. Our performance this year reflects not only scale, but the underlying strength and resilience of our business model. Gross revenues grew 8% to 3,30,943 crores. EBITDA rose 8.6% to 25,094 crores. These are not just financial milestones. They're proof that ambition, discipline, innovation, and execution can work hand in hand to create long-term, sustainable value. Looking ahead, we are confident of delivering 20% plus CAGR in retail revenues over the next 3 years. This is not an aspirational slogan. It is a prediction grounded in the scale of our capabilities and the depth of opportunity ahead of us, something that no other retailer in India possesses. It is anchored in the fact that our every engine of our growth, offline, online, and B2B, is already proven, profitable at scale, and primed for acceleration. Each one of our large consumption baskets, grocery, fashion and lifestyle, and consumer electronics, has structural growth tailwinds. This year, we added 2,659 new stores, taking our total to 19,340 stores, covering 77 million square feet in over 7,000 towns. Stores remain the backbone of our retail revenues, contributing around 70% and will continue to grow through high single-digit like-for-like gains, plus steady expansion of 2,000 to 3,000 new stores annually. In many locations, we have been the first modern trade retailer to enter, securing a first-mover advantage and locking in consumer loyalty. When a Reliance retail store opens in a small town, it creates immense excitement and pride, as people feel they have entered India's urban mainstream. Our unmatched digital strength is another accelerator of our retail business. Our online channels currently contribute a high single-digit share of retail revenues, but will grow to over 20% within 3 years. We also lead in hyperlocal quick commerce using our incomparable store network, strategically located dark stores, and deep consumer data to offer faster, more reliable deliveries than any competitor. Our registered customer base has grown to 349 million, up 15% year on year. We processed around 1.4 billion transactions in the year, nearly matching the population of India, a scale that only reinforces our ability to grow profitably. Besides these inherent strengths, our confidence in achieving 20% plus CAGR is grounded in 8 growth enablers, each with measurable proof of performance. First, we know the Indian consumer better than anyone. Our unmatched insights are drawn from scientific data mining, from billions of real transactions across every state, every income segment, and every lifestyle pattern. This is why formats like Fresh Signature in Tier 2 cities and the introduction of exotic fruits into mainstream grocery have taken off so quickly. Second, our product development engine is creating powerful own brands such as Independence in grocery, Avasa in fashion, and Kelvinator in electronics. These brands deliver global quality at Indian prices. They not only expand our margins, but also deepen consumer loyalty. Third, our superior sourcing ecosystem is a strategic advantage. From farm to fork in grocery to a 30-day mine-to-shelf cycle in fashion, we can move products from concept to consumer faster than our competitors, while enriching farmers, artisans, tribal communities, designers, small suppliers, and logistics partners. It gives me special happiness to mention that we are sourcing more products from women-led enterprises. Fourth, our omnichannel architecture integrates the best of digital and physical retail, maximizing consumer delight. Whether through smart carts, self-checkout, AI kiosks in stores, or the endless aisle of JioMart online, we offer convenience, choice, and consistency to customers across every touchpoint. Fifth, our unsurpassed market reach of nearly 20,000 stores is supported by India's largest tech-enabled supply chain, which enables 10-minute quick commerce in metros and scheduled deliveries in remote villages alike. This reach is a moat that is hard to replicate at scale. Sixth, we empower India's 42 lakh merchants, kiranas, traders, and HoReCa businesses through our B2B formats Metro and JioMart Digital, giving them access to products, technology, and financing. Kiranas have always been the backbone of India's local economy and an integral part of our neighborhood communities. We ensure that Kiranas and other merchants grow first so that we grow along with them. Hence, ours is a growth model of partnership and shared prosperity. Seventh, our tech-led capabilities, from AI-driven demand forecasting to robotics-enabled warehouses. This allows us to scale with precision and efficiency, ensuring profitability even in aggressive growth phases. Eighth, our people. 2.5 lakh strong, our people are the soul of Reliance Retail. They're trained, empowered, motivated, and mandated to deliver. Last year, we invested over 45,000 man-hours in their skill development across new competencies like AI, ensuring our talent stays ahead of market trends. For the fourth consecutive year, we have been certified as a great place to work, a recognition of the high-trust, high-performance culture that fuels our execution. All these trends translate directly into guaranteed and growing profitability across our segments. Dear friends, another factor that puts our retail business on a growth runway is that we are operating in categories where growth is continuous and non-cyclical. In grocery, we sold 18 crore liters of milk, 14 crore liters of cold beverages, 11 lakh metric tons of staples, and 3.8 lakh metric tons of fruits and vegetables last year. The category will grow through large format expansion, hyperlocal quick commerce, and subscription services. In fashion and lifestyle, Jio has grown 7 times in the last 5 years. New formats like Yousta and Azort are capturing younger audiences. And our Shein partnership brings global fashion to India at affordable prices. Tira is not just redefining beauty in India, it is inspiring confidence, creativity, and self-expression for an entire generation. Swadesh connects thousands of artisans to mainstream retail, turning heritage into an opportunity. In consumer electronics, we grew 3 times faster than the market. Our rescue after-sales service now operates in over 300 cities. Acquiring the Kelvinator IP strengthens our consumer durables range. And JioMart continues to expand across quick commerce, scheduled delivery, and subscriptions, while JioMart Digital helps small retailers match the service levels of modern trade. Our supply chain, powered by automation, AI, and robotics, is designed to deliver reliability at any scale. Dear shareholders, Reliance Retail is not just participating in India's consumption boom. We are propelling it. And we are doing so with the discipline and confidence that comes from funding growth through strong internal cash flows. This is why 20% plus CAGR is not just achievable, it is a target we're going to surpass. We have the market, we have the model, we have the means, and most importantly, we have the mindset to make it happen. With your trust and support, we will continue to fuel India's retail story and light the way to a brighter, more prosperous future for all our stakeholders. Dear shareholders, let me now turn to one of our most promising growth engines, our consumer products business. Reliance Consumer Products Limited is set to become a direct subsidiary of Reliance Industries. This will consolidate our consumer brands into a single, sharply focused company. Let me explain the benefits of this decision. First, India's consumer market is a $2 trillion high-growth opportunity, expanding at over 8% annually. We need a strategic approach to seize this opportunity. Second, our 350 million middle-class households have a combined purchasing power exceeding 100 lakh crores. They represent 600 million digitally native and increasingly brand-conscious consumers who seek premium experiences at affordable prices. Third, for the first time in India's history, rural markets consisting of 900 million consumers are driving 65% of FMCG growth. They are adopting global quality branded products faster than urban markets, with penetration growing at 35% annually. This combination of a rising middle class and accelerating rural adoption marks an unmissable consumption opportunity. Fourth, RCPL is not just observing this transformation, we are shaping it by becoming a manufacturing company to deliver global quality products at Indian prices. RCPL as a separate company will give this business the independence to focus exclusively on its markets, products, and customers without competing for management bandwidth. It will provide the agility to respond quickly to changing consumer trends and competitive dynamics. It will also allow us to attract the best talent in the industry, offering them a clear mandate and an exciting growth platform. This structure will enable sharper execution, faster innovation cycles, and deeper operational focus, all critical to winning in consumer markets. Our performance already speaks volumes about our ability to capture this opportunity. In just 3 years, RCPL has achieved what took other companies decades. Last year alone, we had revenues of 11,500 crores, making us the fastest growing FMCG player in India. Campa Cola now holds double-digit market share across many states, breaking a 30-year MNC duopoly. Campa Energy gained 2 million social media followers in just 90 days, faster than established brands with decades of presence. Our daily essentials brand, Independence, has crossed 1,000 crore in revenue. We started in India, have entered West Asia, Sri Lanka, and Nepal, and are now also exporting to West Africa. Our target is to enter at least 25 countries in the next 12 months, building an Indian consumer brands powerhouse with global reach. We believe that Brand India will shine bright globally when Indian consumers and tech brands conquer the global markets. Our competitive strength rests on 4 pillars. The first is deep tech innovation. We have established a 150,000 square foot R&D hub with over 100 scientists and 15 patents filed. Its mandate is clear: better than market quality, first to India products, and first to world innovations. The second is manufacturing scale. We have invested 3,000 crores in 12 state-of-the-art facilities equipped with Industry 4.0 technologies, achieving the highest efficiency rates in Indian FMCG. Over the next 3 years, we will invest 40,000 crores to create Asia's largest integrated food parks with AI-driven automation, robotics, and sustainable technologies, securing lasting cost leadership. The third is distribution reach. In just 18 months, we have reached 1.5 million outlets, 5 times faster than any competitor in Indian FMCG history. Our omni-channel network will cover 95% of India's population through retail, digital, and B2B channels. Our signature partner program offers higher retailer margins, enrolling over 10,000 new partners every month. Our integrated marketing across cricket, entertainment, and digital platforms reaches 800 million Indians, creating matchless brand visibility. And fourth, at the heart of this is our people. We're attracting the best talent across categories and functions. They are building brands that consumers love and trust. And this is only just the beginning. This FMCG business will also be the blueprint for expansion into apparel, electronics, and other large and high-value consumer categories, built on deep consumer insight, design excellence, deep tech manufacturing scale, and unmatched distribution. Our near-term ambition is clear: to be the fastest-growing consumer brands company to reach 1 lakh crore revenue within 5 years. Our long-term ambition is to become India's largest FMCG company with a global presence. This will make RCPL a big new value-creating engine for Reliance Industries, comparing it to a retail business in both size and profitability. Thank you. I now invite our chairman back onto the stage.
Thank you, Isha. Dear shareholders, let's applaud Isha and the entire retail team for their superlative achievements. Isha has presented a truly ambitious growth path for our retail and consumer products business. We will achieve these ambitious goals by riding India's growth wave, powered by technology and driven by our passion to create products that inspire loyalty and love. Dear shareholders, now we turn to our energy business. Let me invite Anand to present the progress of our E&P, oil to chemicals, and new energy businesses. This is the first time he is addressing you at a Reliance AGM. I am as excited as all of you to see him make a debut on our AGM platform.
Most esteemed shareholders, our respected chairman, my honorable seniors and friends, aap sabko mera pranam. Jai Shri Krishna. My dear friends, it is my proud privilege to present our performance and plans of our energy and materials business. Our exploration and production business is a cornerstone of India's energy security. It contributes nearly 30% of the nation's natural gas output. As you know, natural gas is vital to India's clean and green energy transition. In the financial year 25, exploration and production delivered a record EBITDA of 21,188 crore. This was driven by higher output from both Krishna Godavari Basin and coal bed methane. KG-D6 production rose 4% to 28 million metric standard cubic meters per day of gas and 21,000 barrels of oil per day. We plan to add more new wells in the next fiscal. In the KG Basin, we are advancing infrastructure-led exploration with fresh drilling scheduled for 2026. CBM output increased by 30% to 0.8 MMSCMD. This was powered by India's first 40-well multilateral drilling campaign. A second campaign is already underway. We are embracing deep tech in every part of E&P. Our digital operations control center, engineering twins, and process twins set new benchmarks in safety, reliability, and operational excellence. Dear shareholders, I am pleased to present the performance of our oil to chemicals business. This is not merely a legacy business. It is the backbone of Reliance's transformation into an integrated energy company, positioned for the next decade of global energy evolution. The past year brought extraordinary complexity in global energy markets. Supply chain disruptions, trade shifts, and petrochemical overcapacity posed major challenges. In this dynamic environment, Reliance delivered industry-leading performance. This demonstrates the resilience of our integrated model. Our success rests on advantages unique to us: operational excellence, feedstock flexibility, supply chain agility, deep market reach, technology-driven innovation. Our operational excellence is evident in 100% capacity utilization, far higher than the global average of 80%. This directly translates into superior capital returns, and it validates the strength of our model. Dear friends, our refineries processed a record 72.2 million tons of crude in the year 25. Our petcoke gasification complex also delivered record output. Our diversified crude basket of over 250 grades gives unmatched flexibility. It allows us to adapt rapidly to market volatility and optimize processing margin. These achievements powered 11% revenue growth to 6,26,921 crore and EBITDA of 54,988 crore. These strong margins prove our ability to deliver returns even under the most volatile environment. Dear friends, our net carbon zero commitment by 2035 is not just a business pledge. It is our commitment to protect Mother Earth from the climate crisis. Our SEZ refinery has been recognized as the world's most energy efficient facility. Across facilities, we are shifting to clean fuels. Our efficiency programs have delivered 10 million gigajoules of energy savings in 3 years. Our circular economy initiatives, waste plastic pyrolysis, biomass fuels, hydrogen, make Reliance a leader in sustainable materials. This is a strong competitive advantage as sustainability drives value creation. Friends, hydrocarbons will remain vital for India for several years. Our strategy is clear. Excel in traditional energy while building the system of the future. We are developing an integrated portfolio spanning conventional fuels, biofuels, green hydrogen, and clean solutions. Our three-pillar strategy is firm. Deepen feedstock integration, convert commodities into specialty chemicals, and accelerate green chemistry leadership. Our capital allocation is disciplined, with growth aimed at superior returns. We are investing 75,000 crore in new projects as follows. In Nagothane, Maharashtra, 1.2 million ton PVC plant. In Dahej, Gujarat, an expanded CPVC and 3 million ton PTA facility. In Palghar, Maharashtra, a 1 million ton specialty polyester facility. These projects are positioned to meet India's rising demand. Our Hazira carbon fiber facility will be among the world's largest. It will serve the aerospace, defense, and advanced materials industries. Friends, our oil-to-chemical strategy anticipated today's dynamics. With the convergence of energy and materials, the premiumization of petrochemicals, and integrated feedstock optimization, we have created a resilient, future-ready platform for sustained value creation. We consistently outperform global peers across cycles. This proves the strength of our execution and positioning. Our integrated platform technology leadership and strategic partnerships uniquely position Reliance. We are committed to delivering superior shareholder returns through every energy cycle. Dear friends, let me also update you on the progress of Jio BP. Over the past year, Jio BP has strengthened its position as one of India's fastest growing fuel and mobility players. We have expanded our retail network to serve customers across key highways, urban hubs, and growth corridors. We have introduced differentiated fuels with active technology, delivering better mileage and engine performance. Our EV charging and swapping infrastructure has grown rapidly, making Jio BP a trusted partner in India's pivot to electric mobility. We are working closely with fleet operators, last-mile delivery companies, and urban transport systems to offer integrated energy solutions. We will continue to expand our network, scale our EV infrastructure, and introduce new green fuels, including biofuels and hydrogen. Jio BP will play a vital role in powering India's mobility needs while driving the transition to a cleaner, more sustainable future. My dear shareholders, let me now turn to the most ambitious and transformational mission of Reliance in this decade, our new energy business. When our chairman unveiled this vision last year, he spoke about three convictions. First, that India must lead the new energy revolution. Second, that India must achieve true energy self-reliance. And third, that India must emerge as a global leader in new energy. I am happy to share with you in the past 12 months, this vision has moved from ambition to execution. We are making a tangible and rapid progress. We are building the world's most integrated new energy ecosystem, from sand to electrons to green molecules, at a scale unmatched anywhere in the world. Our AI-driven smart gigafactories are designed to be future-proof, keeping Reliance ahead in technology, ahead in cost efficiency, and ahead in reliability. Products from the gigafactories would be deployed for delivering round-the-clock renewable power and producing green chemicals, including green ammonia, e-methanol, and sustainable aviation fuel. With immense pride, I can say that Reliance will be the world's only fully integrated, self-sufficient company in new energy. Dear shareholders, at Jamnagar, work on the Dhirubhai Ambani Giga Energy Complex is progressing at a record pace. Here is the first glimpse of the construction on this site. It will be unmatched globally in size, scale, and integration. 5 million man-hours of engineering, 44 million square feet of building area, equivalent to 4 times the size of the Tesla Gigafactory, 3.4 million cubic meters of concrete, 7 lakh tons of steel equal to 100 Eiffel Towers, 1 lakh kilometers of cable, enough to reach the moon and back, over 50,000 workers at peak, supported by extensive construction automation. We have partnered with the world's leading engineering and construction companies to achieve best-in-class quality, cost, and schedule. Jamnagar will be the cradle of both the world's largest conventional energy complex and the world's largest new energy complex. Jamnagar is the face of New Reliance and New India. My dear friends, our solar PV manufacturing platform is already operational. It is demonstrating industry-leading performance. We have successfully produced our first 200 megawatt of HJT modules. These deliver 10% higher energy yield, 20% better temperature performance, and 25% lower degradation. We are scaling rapidly in the coming quarters. We will expand to 10 gigawatt power per annum of fully integrated annual solar PV manufacturing capacity. Then we will scale further to 20 gigawatt power capacity. This will be the largest solar manufacturing facility and the most integrated single-site solar complex globally. In parallel, we are rapidly constructing our battery and electrolyzer gigafactories. Our battery gigafactory will start in 2026. It will begin with 40 gigawatt hours per year and expand modularly to 100 gigawatt hours per year. Our electrolyzer gigafactory will also be operational by end 2026, with the ability to scale up to 3 gigawatt per year. It will enable cost-competitive green hydrogen production at a global scale, backed by exclusive global technology partnerships and strengthened by our in-house capabilities. Together, these platforms will create a multi-pronged gigawatt-scale clean energy ecosystem: solar, battery storage, hydrogen, all under one roof. This integrated approach delivers scale. It also builds a sustainable competitive moat in cost, in technology, and in supply chain resilience, positioning Reliance to capture significant value as the global energy transition accelerates. My dear shareholders, in Kutch, Gujarat, we are developing one of the world's largest single-site solar projects, spanning 550,000 acres of arid land, 3 times the size of Singapore. At peak, we will deploy 55 megawatt of solar modules every day and 150 megawatt hour of battery containers every day. This will be among the fastest installations globally. This single site could meet nearly 10% of India's electricity needs within the next decade. Our marine and land infrastructure at Jamnagar and Kandla will connect seamlessly with solar and hydrogen at Kutch. We will produce and export green ammonia, green methanol, and sustainable aviation fuel. This will make India a global hub for cost-competitive green hydrogen and its derivatives. While our initial focus will be to meet Reliance's own large captive demand, we plan to scale up to 3 million metric tons per annum of green hydrogen by 2032. This will unlock a powerful growth engine for global markets. My dear shareholders, let me now share the progress of one of our new energy initiatives. Reliance entered the bioenergy business with a clear mission: to help India achieve energy independence and empower millions of farmers. Hamare annadata ab banege urjadata. This year, we are building 55 CBG plants with an annual capacity of 0.5 million tons. Our target is to scale up to 500 plus CBG plants by 2027. At Jamnagar, we have set up the world's largest bioenergy technology and R&D center. Here, we are developing advanced enzymes and high-yield energy crops. We are also realizing our chairman's vision of growing energy plantations on wastelands. This includes building the world's first integrated energy hub, combining smart farms, modular CBG and green hydrogen plants, agrivoltaics, and batteries. I am specially proud of our agrovoltaics business, where compressed biogas, CBG, and solar PV are deployed on the same land. By capturing biogenic CO2 from CBG plants, these hubs will become platforms for green chemicals aiming at fossil parity. This module creates triple value for Indian farmers: green gas, green electricity, and higher rural incomes. It will be a powerful growth engine for India's clean energy future. हम हमारे आदरणीय चेयरमैन के सभी सपनों को साकार करेंगे. Thank you. Let me now invite our chairman once again. Jai Shri Krishna.
Thank you, Anant. Let me congratulate the entire leadership team of our energy business for their operational excellence in these challenging times. I am sure that the leadership team at New Energy will set global benchmarks in executing all their projects, making New Energy a large growth engine for Reliance. May I now request Neeta to tell all of us about the amazing progress Reliance Foundation has made since our last AGM.
Thank you, Mukesh. Dear members of the Reliance family, our esteemed shareholders, Namaskar. I join Mukesh in sending Ganesh Chaturthi greetings to you and your families. May the blessings of Bapa bring health, happiness, and prosperity into every home. As I stand before you today, my heart is full. This year marks a very special milestone for me personally and for all of us at Reliance Foundation. It has been 15 years since we began this journey of care and compassion. Today, I feel humbled and grateful to share that Reliance Foundation has reached out to over 87 million Indians from the remotest towns to the largest metros. We work in every single state and in more than 91,500 villages. That is, 1 in every 7 villages of India. Over these years, we have nurtured children through world-class education, empowered women with more opportunities and livelihoods, healed families through affordable healthcare, provided relief in every natural calamity, inspired youth and athletes with training and global exposure, supported artisans by preserving their craft and dignity, and safeguarded our planet by protecting wildlife and embracing sustainability. Reliance Foundation is our solemn commitment to shaping a new India, a Viksit Bharat, as envisioned by our Honorable Prime Minister, Shri Narendra Bhai Modi. Let me take you through the work and key highlights of Reliance Foundation's impact. And Atmanirbhar Bharat begins with the Atmanirbhar Gaon. This year, our rural transformation initiatives touched the lives of nearly 1.5 million people across 55,000 villages. We worked on strengthening rural India, not just at a community level, but within every single household by enabling water security, empowering fishing communities, promoting resilient farming techniques, supporting women with opportunities, and children with education. One of the pillars of early childhood education in rural India are the Anganwadis. I'm happy to share that Reliance Foundation, in partnership with the state governments of Maharashtra and Telangana, has transformed over 1,100 Anganwadis into vibrant, play-based learning centers. Our aim is to bring world-class early childhood education to over 10 million children in every corner of India. Dear shareholders, education empowers the mind, health strengthens the body. The key to a happy India lies in a healthy India. Last year, our Sir H.N. Reliance Foundation Hospital in Mumbai completed a decade of service. Recognized as the #1 multi-speciality hospital in India, it has had the privilege of serving 3.3 million Indians so far. At the heart of this journey is our guiding philosophy: respect for life. For us, every life is precious. At Sir H.N. Reliance Foundation Hospital, we are also opening an entire new extension named Jeevan, a cutting-edge wing dedicated to chemotherapy and immunotherapy, especially focusing on advanced pediatric chemotherapy designed to heal our little ones with world-class care and a mother's warmth. I'm happy to share that we are also developing a state-of-the-art 2,000-bed medical city in the heart of Mumbai. This will not be just another hospital. It will be India's new beacon of healthcare innovation, where AI-powered diagnostics, cutting-edge medical technology, and some of the finest doctors from India and the world will come together to deliver care that will meet the best standards anywhere in the world. Today, some of the best doctors globally come from India. And therefore, I'm delighted to share that this hospital will include a transformative medical college that we hope our country will be proud of and the world will look up to. We are determined to carry forward our mission to make world-class healthcare accessible and affordable to every Indian. Dear shareholders, another pillar of Reliance Foundation is education and sports. Through our Education and Sports for All program, we have now reached out to over 23 million children across India. Reliance Foundation is committed to scouting, nurturing, and training young talent in multiple sports in the remotest corners of our country. From playgrounds to podiums, our resolve is to help young Indians run faster, leap higher, and dream bigger. One of India's favorite sporting dreams is cricket. I'm happy to share that our Mumbai Indians family has now expanded with 7 teams in 4 continents, and our teams have won a tournament in every single continent that they have played in, adding up to a total of 13 titles globally. But the biggest wins in sports are not always the trophies or medals. They are in the quiet stories of the triumph of human spirit. I would like to share one such heartwarming moment from this year's IPL. Robin Mintz, a young boy from a tribal village in Jharkhand, became the first Adivasi cricketer ever to play in the IPL. He grew up with limited means, but his parents made many sacrifices for their son's cricketing dream. From carving a bat from a chunk of wood to borrowing money to afford his first kit. Today, despite all odds, Robin is a proud member of the Mumbai Indians squad and is known for his fearless batting. His story tells every child in India that no dream is too far and no barrier too big if you pursue your dreams with honesty, passion, and determination. Talent can come from anywhere and reach the pinnacle of success. This is a transformational power of sport. Another great example of that are the women of Indian sport who have made the country proud on national and international platforms, despite all the challenges in their path. Here, I would like to acknowledge our Mumbai Indians women's team who have won the WPL in India twice in 3 years. More power to them and to all our young girls and boys. At Reliance Foundation, we also remain deeply committed to helping realize Honorable Prime Minister's dream of hosting the 2036 Olympic and Paralympic Games in India. As a proud Indian and a member of the International Olympic Committee, I'm happy to share that we continue to make strong progress towards this mission. As the fastest growing major economy with the largest youth population, India is not only ready but destined to be the home of the Olympic Games. This is a dream shared by all of us, 1.4 billion Indians. Dear shareholders, the soul of a nation is measured not only in its achievement, but also in how it treats its most vulnerable, including the voiceless. Last year, we introduced you to Vantara, a global movement for wildlife conservation, founded by our youngest son Anand and supported by Reliance Foundation. At Vantara, more than 1.5 lakh animals, abused, injured, orphaned, and endangered, have found their home. A home where they are cared for and live with the dignity they deserve for the rest of their lives. In March this year, it was our greatest honor to have the Honorable Prime Minister, Shri Narendra Bhai Modi, inaugurate Vantara and give his support and blessings to the sacred movement. I am humbled to share that Vantara has received the Prani Mitra Award, India's highest honor in animal welfare. Guided by the wisdom of Vasudhaiva Kutumbakam, Vantara is the embodiment of our shared dream for a compassionate world where every being is protected, cherished, and respected, where humanity and nature thrive together in complete harmony. Dear shareholders, now, especially for all fellow Mumbaikars, I want to share something very close to our hearts. Reliance is proud and honored to take up the responsibility of developing and caring for the new coastal road gardens, a green lung for generations to come. Spanning 130 acres, the coastal road gardens and adjoining promenade will be the first of its kind public space featuring walkways, cycling tracks, and plazas with trees and flowers in abundance, taking people back to nature. We will nurture this space as a living, breathing, and health-promoting gift to Mumbai. A ribbon of green will now hug our city's edge, a space for every Mumbaikar to catch a breath of fresh air and enjoy magical sunsets by the sea. This is a deeply personal project for me. It's about giving back to the city that has given so much to all Mumbaikars. And it is a responsibility we promise to fulfill with pride and purpose. The coastal road gardens will stand as a legacy of care for our Mumbai, a symbol of balance between development and environment, between progress and preservation. Friends, before I end, I would like to talk about a dream that came to life 2 years ago in the form of the Nita Mukesh Ambani Cultural Center, a space to honor the arts, the artist, and the audience. Over the last 2 years, we showcased the best of the world and India at NMACC. From award-winning Broadway shows to masters of Indian classical music. Earlier this year, we opened Swadesh's flagship store in Mumbai's historic Eros building. And soon, we will be opening our first store in Delhi. And once again, this is only the beginning. Dear shareholders, in today's ever-changing world, Reliance Foundation stands for something eternal: care. Seva, dharmaha, paramaha, samarthaha. Service is remembered as the highest dharma. Care has always been a way of life at Reliance, in the legacy and blessings of our founder chairman, my father-in-law, Shri Dhirubhai Ambani, and my mother-in-law, Srimati Kokilaben Ambani. On behalf of Mukesh and me, our children, the entire Reliance family, and the fantastic Reliance Foundation team, I thank each and every one of you for your trust, support, and enthusiasm. By 2035, in the landmark year of our Silver Jubilee, Reliance Foundation is preparing to amplify our impact fivefold. Not in numbers alone, but in the lives we touch, the futures we shape, and the legacy we leave behind. During the next decade, we aim to reach 400 million Indians, provide quality education to 300 million school-going children, transform the lives of 100 million women, and empower 15 million rural households. This is not just about growth. This is about transformation in every city, every village, and the remotest corners of India. Let us imagine a new India, an India that shines not just through its economic might, but through the strength of its values and heritage and the compassion of its people. This is the India we believe in, an India of culture, spirituality, innovation, inspiration, and progress. An India that will lead the world. Thank you. Dhanyavad. Jai Hind.
Hearty congratulations, Nita. What Reliance Foundation has achieved in the past 15 years is, of course, highly impressive, but you have raised the bar far higher by aiming to amplify its impact fivefold by 2035, when Reliance Foundation celebrates its Silver Jubilee. More power to you and your highly motivated team. Dear share owners, I shall now share with you our value creation roadmap for the coming year and beyond. It is with immense pride and with even greater humility and gratitude that I look back on our shared extraordinary journey of value creation of over past 5 decades. In just one generation, Reliance has transformed itself from a Fortune 1000 company to a Fortune 40 global powerhouse, creating over 200 billion in value, all within India. We have achieved this by staying true to the first principles I have often shared with you. 1, what is good for India is good for Reliance. 2, build businesses of the future. 3, build them world-class and at mega scale the largest and the most competitive globally with the highest standards of governance. And 4, invest in world-class talent and cutting-edge technologies. Faithful adherence to these principles has been our value creation dharma. Dear shareholders, as I look to the future, I see our oil to chemicals business achieving substantial growth and delivering stable returns as geopolitical tensions subside. I also see rapid innovation-driven growth in our materials business. We are well positioned to produce high-value green fuels and chemicals, which India and the world will need. Our new and clean energy business is being built with a singular purpose: to make India self-sufficient in energy and to resolve India's energy trilemma of security, affordability, and sustainability. Through world-scale giga manufacturing, through round-the-clock renewable electricity, and through green fuels and chemicals at global scale, this goal may look impossible to achieve now, but we are laying a robust foundation for our country's energy transition so that freedom from imports can be achieved by the time India celebrates 100 years of independence in 2047. I am sure that our new energy business will be a major driver of growth for many decades, with the potential to become as big as our oil to chemicals business in the next 5 to 7 years. In scale, ambition, and impact, it will surpass everything Reliance has done so far. It will create unprecedented perpetual value for both India and Reliance. Dear shareholders, Jio today is the largest data company globally. Its multiple inherent strengths guarantee accelerated growth. All of Jio's 500 million and growing subscribers will move to 5G and eventually 6G by 2030. Jio's home and enterprise digital services businesses are growing at phenomenal speed. Friends, Reliance Retail, now synonymous with the consumption basket of over 300 million Indians every month, is another testament to our ability to create hyper value. In just 5 years, it has leapfrogged from top 100 to the top 25 global retailers, powered by an unbeatable physical digital B2B network that reaches every corner of India. Retail will continue to grow in both B2B and B2C spaces with our customer-centric omni-channel strategy. I can clearly see its revenues grow multifold in the coming years. This year, I announced the creation of 2 new large growth engines, Reliance Consumer Products and Reliance Intelligence. Each of them has the potential to grow larger than our existing business segments. RCPL, as a subsidiary of RIL, is a strategic move to create India's largest FMCG company. RCPL's phenomenal growth is guaranteed by the consumption boom in India, our world-class supply chain, and advanced manufacturing capabilities. Our new intelligence business will drive the AI revolution in India. This will enable Indians to adopt AI at scale and make our country a global force in AI. Recognizing these strengths, Gartner, the globally reputed technology research and advisory firm, has ranked Reliance Industries alongside Microsoft, Amazon, Google, Meta, and Alibaba, stating that these entities are the new superpowers. They are setting the terms for the next global economy. Dear shareholders, our value creation philosophy is deeply rooted in our work culture. The work culture of Reliance is guided by the wise principle of Mahatma Gandhi, articulated nearly a century ago. A customer is the most important visitor on our premise. He is not dependent on us. We are dependent on him. With this principle, we have fundamentally changed the operating model of all our consumer-facing businesses. We don't sell, we serve. Our engagement with customers, suppliers, and partners is not transaction-based. It is trust-based and therefore enduring. The national wealth, employment, and societal impact created by our businesses and philanthropic initiatives are already so huge that they make me both humble and proud. But the best of Reliance is yet to come. In 2022, I made a promise that we will double Reliance by the end of our golden decade in 2028. At that time, our EBITDA was about 1.25 lakh crores. I reiterate that Reliance will more than double its EBITDA by the end of its golden decade in 2027. Thank you for your trust, your partnership, and your belief in our shared vision. Dear friends, at Reliance, we believe that institutional longevity and perpetual growth are guaranteed only by constant self-renewal. This demands 4 elements: a deep bench of capable leadership at all levels, unshakable core values, a resilient work culture, and a never-changing commitment to the original purpose of the organization. We are strengthening all 4 deliberately and decisively. A major milestone in this journey has been the evolution of our next generation leaders, Isha, Akash, and Anant, who have now completed 2 transformative years on the board of Reliance Industries. Fully embedded in operations and decision-making, they are shaping our businesses with energy, conviction, and clarity of purpose. Under the mentorship of senior leaders and independent directors, they are becoming the kind of leaders this era demands: agile, accountable, ambitious, empathetic, and consultative. They are supported by hundreds of young leaders in 30s and 40s with domain expertise and the same passion and ambition that built Reliance. Friends, leadership development at Reliance is not a program, but a foundational strategy. We have institutionalized systems to identify high potential talent across businesses, empowering them with responsibilities, global exposure, and AI tools to lead boldly in a complex world. We are also constantly perfecting our HR practices to enrich our people capital. I want everyone at Reliance to feel the pride of being part of the Reliance Parivar, united by the commitment to serve India and larger humanity. As Reliance, what sets us apart and grounds us are the purpose, philosophy, passion, and pioneering spirit of our founding chairman, Dhirubhai Ambani. His legacy continues to guide us as we innovate and grow, ensuring we stay rooted in our Indian identity and values. As India accelerates into her next horizon, so must Reliance. Expectations are rising from all quarters, our people, partners, our country, as well as the international community. We are not just preparing for that future, we are shaping it. Dear shareholders, it has been my privilege to serve your company since its inception and to attend every single AGM of Reliance for the past 48 years. This has given me the opportunity to watch and participate in every phase of Reliance's evolution. I have also witnessed India's incredible journey in these 5 decades, from a third world country to one now on the threshold of becoming a first world power. The most important lesson this journey has taught us is that there is no substitute for economic strength. This lesson is reinforced by recent geopolitical developments. India must gain greater economic strength and do so with a sense of urgency. Our Prime Minister, Shri Narendra Modi ji, rightly exhorted us in his Independence Day speech that the yardstick of Atma Samman, self-respect, is Atma Nirbharta, self-reliance. India must become self-reliant to the maximum extent in key technologies, critical industries, and other vital sectors of the global economy. Throughout our history, Reliance has contributed to this mission of building a strong India, a Balwan Bharat. I assure our respected Prime Minister that Reliance will follow his command with redoubled efforts. However, the magnitude of the challenge is so large that all Indian businesses must work together with unity as a grand coalition in the spirit of cooperation, mutual learning, and mutual support. I had made this suggestion in the last year's AGM, and I repeat it today. There is strength in unity and collective endeavor. And this is what the nation today expects from its business community. On behalf of all our shareholders, I extend my heartfelt thanks to our board of directors for their guidance and oversight. My deepest appreciation goes to all our employees, our greatest asset, whose dedication and commitment have enabled the company to reach new heights. I also thank our business partners for their unwavering support in delivering quality solutions. Above all, I remain profoundly grateful to India and all Indians for their enduring faith in brand Reliance. Thank you, Jai Hind and Jai Shri Krishna. I will now take up.
All right, that is the RIL chairman, Mr. Mukesh Ambani, showing, of course, the vision for the company forward, all of its different businesses forward, and also ending with a very, very strong message, echoing sentiments of the Prime Minister about Atmanirbharta being the need of the hour, the message that self-reliance is the way of attaining self-respect. Let's quickly run through some of the highlights, because we do have some big announcements coming in. And Rima, the biggest one of them all is finally we have an IPO timeline for Reliance Jio, and this promises to be the biggest IPO that India has seen till date.
The biggest IPO. In fact, estimates are that it's going to be more than $100 billion. But here's what he said. Jio IPO is planned for H1 of 2026. This is something that the street was awaiting for a very long time, for close to about 1.5 years, and that is coming. So that's headline number one. Jio IPO is coming. H1 2026, we have a timeline. The second one is AI everywhere for everyone. You know what he basically said? He's like, when Jio entered the telecom market, they democratized data. And now they want to do the same thing with AI, the AI revolution, which is why they're calling it AI everywhere for everyone. Democratize AI with this revolution. The third one, and this is also a big one, Reliance Intelligence. The company will be forming a new wholly owned subsidiary called Reliance Intelligence. And along with this, they will be partnering with Meta. It's a $100 million partnership, a JV, and a partnership with Google also, both the tech giants. And they also spoke about some product launches. So Jio PC was one, and another one was Jio Frames, AI-powered smart glasses for everyone.
Absolutely. So there was a lot of AI and talk about Jio. And then, of course, more headlines. Reliance's growth target is to double its EBITDA by 2027. We have more targets for Reliance Retail as well, for the retail business, target of 20% CAGR growth for the next 3 years, and a target of 1 lakh crores in revenues for Reliance's FMCG business in the next 5 years, and net carbon zero by 2035. Well, those were some of the key highlights from the AGM. We'll take a very quick break and come back with a panel of experts to decode some of these big news points.
Hello and welcome to our special broadcast. I'm Shireen Bhan. Towering plans for Jio, pressing the accelerator on AI and fast-tracking the rise of its FMCG business. The annual general meeting of Reliance Industries saw Mukesh Ambani lay out the growth blueprint for the oil-to-tech conglomerate. The big news, Reliance Jio is all set to go public in what is potentially the biggest listing in the history of the Indian capital market. This was the big headline at the Reliance AGM. Reliance chairman Mukesh Ambani also announced the telecom giant's plans to expand beyond Indian shores. Jio now has more than 500 million subscribers. So the Jio IPO, much anticipated, an announcement coming in. The second big headline, Reliance has pressed the pedal on artificial intelligence. Mukesh Ambani announcing the formation of a new AI subsidiary called Reliance Intelligence, laying out a four-pronged approach. This includes housing, and also global partnerships to build AI services and AI talent. Signing a joint venture with Facebook's parent Meta, Jio chairman Mukesh Ambani also launched a slew of products, including an AI-powered smart glass. He also launched Jio PC, which will provide an AI-ready computer on any screen. The Reliance AGM also laid out the company's growth roadmap. It is eyeing doubling its EBITDA by 2027, powered by growth in the FMCG and AI businesses. For the FMCG business, the plan is to hit 1 lakh crore rupees in revenue within 5 years.
It is my proud privilege to announce that Jio is making all arrangements to file for its IPO. We are aiming to list Jio by the first half of 2026. Subject to all necessary approvals.
Google and Reliance are partnering to help all of Reliance's businesses transform using AI, from energy and retail to telecom and financial services. To support this AI adoption, together we are establishing a Jamnagar cloud region.
With strategic partnerships and a clear roadmap, we will take Jio services international, creating value for partners and shareholders alike.
Meta and Reliance are going to deliver our open source AI models to Indian businesses to help them fuel their work. With Llama, we've seen how AI can amplify human potential, boosting productivity, inspiring creativity, and accelerating innovation. And now, with Reliance's reach and scale, we can bring this to every corner of India.
In just 3 years, RCPL has achieved what took other companies decades. Last year alone, we had revenues of 11,500 crores, making us the fastest growing FMCG player in India.
Across facilities, we are shifting to clean fuels. Our efficiency programs have delivered 10 million gigajoules of energy savings in 3 years.
Well, the big stories there coming in from the Reliance AGM. For reactions, we're now joined by Rohit Pandarkar, partner tech consulting at EY India. Also with us, Prakash Diwan, market expert, Karan Taurani, executive vice president at Lara Capital, and Gurmeet Chadda, managing partner and CIO at Complete Circle. Gentlemen, appreciate you joining us. Prakash, let me start with you. Much anticipated, and finally the announcement coming in as far as the Jio IPO is concerned, H1 of 2026. What do you make of that, Prakash?
I think it's brilliant. The news is, getting a timeline, and that too within probably the next 12 months is very, very promising. And also, it's not just a timeline that's been announced, Shireen. It's, a lot of milestones that go along with that, which means that, a company that's already a multinational, it has a 500 million kind of base. I mean, you're talking about a scale which is phenomenal. So I think exciting times will redefine India's capital markets as well in terms of participation, depth, so many things. So I can't stop listing out all the good stuff that will happen, but very, very, very promising.
Very promising, and of course, Jio also planning to go international. But on balance, Prakash, many announcements across different businesses, from Jio FMCG, of course, to oil to chemicals. What would be the key takeaway for the market from the announcements that came in today?
I think the first sense that you get when you listen to all these flurry of positive announcements is the company is so sharply focused on to growing Jio and the retail business to such a scale that we didn't imagine this when last time when Mr. Ambani mentioned that these will be the front runners of the growth engines of the company. Look at how things are transforming and so rapidly. You have an RCPL, which was just a fledgling idea of sorts about a year back, and today it's already clocked 11,500 crores of revenue. It's talking about going into international markets. 25 countries in 12 months. That's phenomenal. That's almost like 2 new markets every month. So the kind of pace of growth, the aggression underlying this thing, and as Isha Ambani said, we have the means and we have the mindset to do that, which is, I think, going to redefine this company in terms of no more putting too much of weightage on the O2C business or the E&P business.
Yeah.
Those will, of course, remain great contributors, but the new growth engines, the new vectors are going to come from the telecom and the retail side, and those are far, far bigger than what we thought.
Well, speaking of new growth engines, Reliance Intelligence being launched. Rohit, the announcements that have come in on the AI front, specifically the partnerships with Google and Meta. What do you make of Reliance's foray into the world of AI?
Shireen, first of all, I think it's great for India as a nation, because just the way Reliance did the digital revolution by making digital data and videos available to every Indian everywhere. Today, Mukesh Ambani said the Reliance ambition is to make AI available for everyone everywhere in India at affordable rates. So I think the partnerships with Meta and Reliance would mean that India has data sovereignty and AI sovereignty, which is very important. The GPU clouds to be hosted out of Jamnagar facility will add a lot of supply for AI GPUs that are required for building chatbots and AI intelligence.
Well, yes, that is the big announcement that's coming on the AI front, and that joint venture with Meta, significant investment being made by both Meta as well as Reliance to get things started. On balance, Rohit, if I were to ask you for your big takeaway and your big headline from what you heard by way of announcements from Mr. Ambani today?
Yeah, another big takeaway is that the open source integration into India for distribution to enterprises and Indian folks, especially multi-sectoral and multilingual, which means as India is known as a nation where every few kilometers the dialect and language changes, India will have its own AI and LLMs that will speak the Indian languages, and is available at affordable rates to people because it's open source. Alongside, they announced services like education, healthcare, agriculture, and SMEs powered by AI, which means imagine a student out of a rural village can actually learn physics by talking to an LLM bot without any cost, without any four-walled school structure. Additionally, think of an Anganwadi worker out of a rural village, again, without much of facilities, being able to take a photo of the child or ask questions to the AI bot in her local vernacular language and get the diagnosis or some suggestions on the treatment, all free of cost. That will revolutionize the way India is operating today.
Well, let me bring in Karan into the conversation as well. Karan, the new engines for growth as well as the old engines that continue to fire. What do you make of the many announcements as well as the outlook that came in from Mukesh Ambani and the material implications that it has as far as the stock is concerned?
Hi, Shireen. I think most importantly, they have guided for more than 20% growth in the Reliance retail business. Now, that is some sort of comfort, which is there because if you look at the Reliance retail business performance over the last 3 to 4 quarters, we have seen growth rates converge. It's majorly been because of reasons in terms of expansion plans being on hold, rationalization of stores. This process has taken about 3 to 4 quarters. Probably talking of 20% plus growth does indicate that, things are just, the worst seems to be over in terms of retail business. They might start expanding stores again a couple of quarters down the line. So there is respite for growth prospects. Secondly, I think with so much of rationalization in place now, there is also a potential for margin improvement in the Reliance retail business, which will also augur well for the valuation of the company. Third very important piece is they are trying to build AI on all the retail businesses that they have, right from white goods to apparel, fashion, JioMart, quick commerce, FMCG. all these things put together. So I think even that will have a big positive impact because I think they are operating at a very large scale because they are a conglomerate and they have got expertise in terms of technology with the large global MNC giants in terms of partnerships that they have created. If they are able to leverage AI in the retail business and they're able to execute well on all the digital businesses, it can really lead to a very big scale. And that's other multiple because if you look at Reliance as a company, their contribution from digital businesses has not moved up significantly over the past 4 to 5 years. So because of AI-led initiatives, if they're able to do well over there, we could see a scale on digital businesses as well within the retail segment.
So finally, Karan, as far as the stock is concerned, the outlook from here?
I think in terms of outlook, it will be taken positively because AI-led investments is the next big thing, and if they have the first mover advantage here, it will create a lot of efficiency in the system, right from margin improvement and also going better in digital business because that's the faster growing segment for Reliance Retail as a business.
Well, gentlemen, thanks very much for joining us and taking us through the big announcements that have come in from Reliance Industries Chairman Mukesh Ambani at the company's AGM, with the big stories that have come in from the AGM, specifically as far as the Jio IPO is concerned, and of course on the Reliance Intelligence launch. That's the big story. A quick break. GDP numbers coming up. Big surprise there on the positive. The Indian economy grows by 7.8%. We look at the numbers when we return. Well, the other big story of the day, the Indian economy grew at 7.8% in the first quarter of the fiscal. This has come as a surprise. Services sector and government spending are the key growth drivers. Lata joins us now to decode the numbers. Positive surprise coming in there, 7.8%. That's higher than our poll, Lata.
Actually, it's an outstanding number. I mean, eye-popping. Even in the entire breadth of my numbers and respondents, no one went above 7%. There were people who expected 7%, but that was, countered by people who were expecting 6.6 and 6.5. But no one had 7.8, so it's a damn good number. Usually this is because subsidies are very low, indirect taxes are high. So what you call net taxes makes the difference. But that is not the case here because the GVA is shorn of taxes. Even that number is 7.6. Our average was 6.5. So even that's a very good number. The only number you can squabble with and say that it is spoiling the picture is that nominal GDP is only 8.8. Like I've been telling you, the government of India in its budget had estimated that we would grow at 10.1% in nominal terms. That's exactly what the NSO actually measures. Goods and services in current prices is nominal GDP. That's, coming in at 8.8 because inflation is not very high. And if you deflate it with the inflation of just 1%, WPI plus CPI, inflation is very low because WPI is minus in couple of months. Therefore, if you deflate it, then optically the real GDP looks high. Nominal GDP at 8.8, you deflate it by only 1% and you get a real GDP of 7.8. In prior years, we had to deflate it by 5% because inflation was high. Now, because you're not deflating it, real GDP looks very good. That would be the complaint of many economists. Don't get carried away by this number. Regardless, you'll have to say that services is done very well. Again, it is deflated by WPI of 0.5%, so it looks very good. You will have to say the services number of trade, hotels, transport and communication is particularly good at 8.6%. This is a flattering number because this is an employment intensive number. Traders, hotels, transport and communication, ST buses, that is labor intensive and that's grown by 8.6%. Again, helped by the very low deflator. Finance has grown by 9.5%, again very good. And the biggest contributor is government. Public administration and other services, as we call it, that's grown by 9.8%. So damn good contribution. And we know that government has spent a lot. Revenue expenditure and capital expenditure has been very good. That reflects even when you look at GDP from the expenditure side. So those are the ones that have taken the GDP higher. If you looked at GDP from the expenditure side, private consumption grown at 7%. Quite good. Government consumption, the one that's really the flag bearer, that's grown at 7.4% and capex up 7.8%. So you will have to say that both consumption and investment have fired. There were some people who believed that maybe we exported more, advance exports because of the tariff. That's not shown in the numbers because exports have grown only 6.3%. That's not an outstanding number. So this looks like it's great government spend on capex and revenue ex revex, as well decent growth in services sector. That's what has led to this very high GDP number. Again, due credit be given. It's because inflation is low that the real GDP looks very good. Regardless, even keeping that aside, this is a damn good growth number. Now there will be more and more people who will veer towards the RBI full year in GDP number of 6.5. The rest of the world was sitting at 6.1 and 6.2. Now you will start to see upgrades.
Yes, start to see upgrades. And this comes at a time when we are facing challenges on the tariff front. And this certainly comes as a shot in the arm for the government. This GDP print coming in higher than what the expectation was. Lata, you wanted to say something?
No, nothing much. Just that the other big headline is the rupee, which has hit an all-time low today. I just wanted to add that by way of an important news development, both versus the yuan and versus the renminbi, yuan and the dollar, the rupee has hit an all-time low.
Yes, the rupee at an all-time low. The macro, as far as the GDP print is concerned, looking good at this point in time. A pleasant surprise coming in. Lata, we'll, of course, come back to you for more analysis. But let's talk about the market action as well. The markets fell today for the third session. The Nifty ending at a 3-week low. Reliance and financial heavyweights lost ground today. Auto stocks saw some profit booking as well, with stocks falling up to 3%. For the week, though, the markets have seen the biggest weekly fall in the last 5 months, with the Sensex and the Nifty falling nearly 2% each. The Bank Nifty also fell almost 3%. The mid-cap index recorded a fall of more than 3%. So that's the trading highlights for you, the markets today and this week. Going back to the issue of tariffs, Commerce Minister Piyush Goyal says India will not bow down to any form of discrimination. These were his first comments since the 50% US tariffs kicked in. Minister Goyal did not explicitly name the US, but he promised to expand markets for Indian exporters. He believes exports this year will be higher than last year. Here's the Commerce Minister.
कोई हमारे साथ भेदभाव करने की कोशिश करे, कोई हमारे साथ अच्छा फ्री ट्रेड एग्रीमेंट करना चाहे तो उसके लिए तो हम सदैव तैयार हैं, पर किसी भी प्रकार का भेदभाव मुझे लगता है भारत का 140 करोड़ देशवासियों का जो आत्मविश्वास है, आत्मसम्मान है, उसको मद्देनजर रखते हुए हम ना तो कभी झुकेंगे, ना कभी कमजोर होंगे। एक साथ मिलकर हम आगे बढ़ते रहेंगे, नई मार्केट्स कैप्चर करेंगे। मैं आपको दावे से कह सकता हूं इस साल हमारी एक्सपोर्ट पिछले साल से ज्यादा होगी।
That is the Commerce Minister saying we will not bow to any pressure. And with that, we wrap up this edition of Business 360. There's a lot more coming up. Don't go anywhere. We will recap the day's top stories, the top macro and market developments right here on CNBC-TV18. Back in a moment.
The Lal Street takes it on the chin this week. It records its biggest weekly fall in nearly 5 months. The Sensex and the Nifty are down about 2% each. And except FMCG, all sectoral indices have recorded losses for the week. Over the next 30-odd minutes, we will decode the week gone by, the reasons behind this weakness, and take you through some of the most important takeaways from the Reliance AGM, talk about the GDP numbers, the weakness in the Indian rupee, and put the spotlight on FMCG, which was really the only green island in the market. Hello and welcome. You're with us on the Editors Roundtable. I'm Surabhi Upadhyay, and with me, as always, Reema, Nimesh, and Prashant. Guys, well, thank God it's Friday. The bulls will definitely be saying that after a week like this.
Yeah, 1% down on Nifty, 2% down on Bank Nifty. It was a tough week.
Yeah, and despite all the festivities in the air,
yeah.
I think the markets today were reflecting the chaos in Mumbai streets.
I'll just say that look at the other two markets, right? Dollar rupees at an all-time high, rupees at all-time low. Look at what's happening to yields. It's complete. Bonds are sold off aggressively, and Lata, I guess, will join us in just a little bit. Actually, the only thing which is still standing is the equity market. Now, I was just thinking, and Devina will also join us in just a bit from now, Ramesh. From the Liberation Day low, when the April tariffs happened, right? Markets all sold off because everybody got handed 35, 50, all kinds of tariff numbers. From that point, from that low, Nifty is still up about 11% from the lows, April lows, Liberation Day lows. Everybody else has got not sweet deals, but I mean, it's no longer
Better
40,
deals.
50, better deals,
Yeah,
right?
better deals than us.
We've gone the complete opposite end, opposite way, right? We're at 50%. Effective is 34%.
34.
We are still up 11% from the Liberation Day lows. So just food for thought. I don't know. I'm not saying that we go back to those lows.
This is excellent Friday optimism. Completely new perspective.
No, but
looking at things.
yeah, but you sold off. Global markets all sold off because tariffs were high and hard, etc., etc. But yeah, I mean, from that point on, remember at that point the optimism here that we're going to get through this the fastest. We're talking to, and of course it's been acknowledged by people like Scott Bessent, etc. But it's not happened. I mean, things have gone completely sour.
But the market is still up. It's Prashant's green color shirt. That's where the optimism is coming in from. But very quickly, let's recap the week's numbers and just look at what the tally is finally looking like. So we have ended at the lowest point of the week on Friday. We're also just a stone's throw away from those 3-month lows on the Nifty that we are talking about. And what has happened is, let's look at the different indices. It's not just a large cap specific fall or, one or two sectors falling. The overall market has fallen. So the Nifty is down 1.7%, mid cap index is down a little over 3%. The small cap index is down almost 4%. Now, you'd wonder, are there any new triggers? Well, it's not new, but it's all of it coming together. First and foremost, that 50% tariff reality. It's finally hitting home. And as we keep talking about it, the first order effect is not what the market's concerned about. It's the second order concern that's actually showing up. And some of that obviously brings us to the next point, which is FPI selling. August has been once again a brutal month in terms of the FPI outflows. We saw those outflows in July. The July figure was almost 17,700 crores. The August figure is now nearing 29,000 crores at last count. We'll have the updated numbers in the first week of September, but the numbers have been pretty bleak. And finally, this whole earnings pickup story on which hopes are pinged, here is where there is concern going by valuations. Very quickly, let's talk about the sectors. Worst performers of the week. Capital markets down 7.6%. Real estate down 4%. PSU banks down 3.5%, oil and gas 3%, even the broader financials, Nifty financials down about 3%. So short point, no place to hide, barring the consumer hope. The Nifty FMCG index managed out about a 0.5% gain. And really, Nimesh, that's what it's all about, right?
Yeah.
Hopes that the festive season, this GST cut will work some magic for the bulls.
If it was my piece last week, right? And I said clearly that there could be a shift from capex to consumption. And it clearly played out this week. The index is actually outperformed everybody else, right? The Nifty is down, Bank Nifty is down, but FMCG index is up. And look, the kind of opinions which are coming in, the kind of notes which are coming in throughout this whole week. In fact, today itself, we had two big, global strategists adding auto names, which is like a consumption story for India, into their model portfolios. Jonathan Kahn has added M&M, and Chris Wood has added Maruti. So again, it's the other way around. But both have added the two auto names this week. Also, there was a CLS note in the middle of the week, and he very clearly said that if the GST cuts have come, or when it comes, you might see further impetus for the consumption stocks to do well. vis-a-vis capex can suffer, and also some revenue sectors like OMCs can suffer. So clearly, you know, the market orientation seems to be heading towards consumption, at least for the time being. And if there is a very aggressive GST cut, you might see this momentum to just go on in the consumption path.
How did we finally end? Because when we started...
we lowest point of
We ended
day.
the lowest point, 70 points.
No, I'm saying autos and... because in the morning, auto index was down.
Auto index was down.
And FMCG was up.
Yeah.
That's how we closed?
That's how it was. FMCG was the only green spot. There were some names like L&T and BEL from the industrial side, but largely it was...
So, and we were making this point in the morning, auto month to date, till yesterday's close, the index is up almost 7%.
Correct.
That is...
So there's a bit of preemptive
kind of thing. And FMCG is actually just 0.5% change.
Yeah.
Till yesterday, month to date, coming into the GST actual
But you know, we are
announcement.
heading into the GST,
So,
the FMCG index overall for the last couple of years have underperformed.
Oh,
there
yeah,
is a bit of
big time.
Big underperformance, and of course, valuations are not out of the whack compared to the historical averages. They're still in that medium range. So there is a valuation comfort, and there is this big tailwind comfort which can come in.
Yeah, let's actually ask Devina this big question. Devina, thank you so much for joining in, and happy Friday to you. So what's the sense? I mean, is this hope on consumption revival? Is it really well placed? Would you be advocating for any kind of portfolio tweaks in favor of autos or consumer, FMCG, or even consumer durables for that matter?
Hi, Surabhi. So, I mean, I have been talking about a consumption revival even before this GST talk came about. And consumption actually had started accelerating towards the end of last financial year itself. And then you had the better than expected GDP numbers. And more than that, the cooling down of inflation, and especially of crude oil and food products. So to my mind, these were the things which would help boost the consumption plays, both on the revenue side and the margin side. I think I spoke about it last time I was on your channel too, which was before this GST talk, that in a household budget, when food prices are too high in a place like India, it crowds out even routine FMCG type consumption. So that there's going to be relief, and also crude prices coming down mean a lot of downstream chemical and petrochemical prices coming down, which again are input for a lot of industries, including FMCG. So both those fronts I was expecting a boost, and we have been overweight both FMCG and more auto components than autos for a while, and along with the pharma healthcare. So these have been areas where we have been overweight. So that pretty much continues. Of course, in the short term, you know, this uncertainty on the GST, even though it's a positive, on the positive side, would mean I'd expected the earnings picture to be better in the second quarter. Now, I think it might get pushed a little because some of those purchases might get deferred. But I think the market will look through that, because this is like just a temporary blip or a postponement. And in the end, it's going to be beneficial for the industry. So, but it definitely means that the acceleration in earnings that I thought would come through in Q2 may not come through to that extent on an aggregate basis. And also, I mean, talking of markets, I think to some extent the indexes are not even capturing the real red in the portfolios. So, as this is not a current number, it's probably a week old or so. We were looking at that between all the indices, they were down about 7 to 10% from the top, whereas 90% of the stocks were down more than 10%. So that's huge. In normal markets, something like 40 to 50% of stocks outperform. Even 25, 30% outperformance means the market is narrow. To have less than 10% stocks outperform the index is very drastic.
And that's actually, Devina, we were discussing this, Nimesh, right? Just that it's a tough nobody's
market.
making money. I mean, we seem to be talking to a lot of people, and whatever you do, eventually you're not ending up with gains that you get to keep. And that's been true for the last few months now. But Rima, the Jio IPO,
Actually, there were a lot of headlines. The big one, of course, was the Jio IPO. It's now, the timeline has been set, H1 of 2026. The second one was an AI. Just the way Reliance Industries democratized data with Jio, now they're planning to democratize AI. It's AI everywhere for everyone. They've also set up a new wholly owned subsidiary. It's called Reliance Intelligence. They've announced a partnership with Google, a $100 million JV with Meta too. On consumer, the big headline is that the company, has the potential to grow at 20% CAGR. They're targeting a 1 lakh crore revenue in the next 5 years and become India's top FMCG company. On the new energy business, what he said is that it has the potential to become as large or even bigger than the traditional O2C business in the next 5 to 6 years. But in a nutshell, he sees a lot of growth opportunities, whether it's O2C, whether it's FMCG, whether it's Reliance Intelligence. And on the whole, they reiterated that Reliance's EBITDA will double by 2027. So, there are quite a few catalysts, but the surprising thing is the stock ended, much lower, and it kept falling as the announcements trickled in.
Guys, that's what I say, and that's what at times you wonder. How negative is this market feeling? And maybe Devina come in on this. You have a GST announcement and a massive big one. The market pop lasts for barely 2 days, 3 days. The Jio IPO has finally been announced, and it's not like Reliance rallied some 5-6% going into the AGM announcement, and yet the market's reaction. So the market is also indicating something. What would you read through from the market reaction to some, seemingly really positive news announcements? Now we'll have this GDP number reaction on Monday, but what's your sense?
Let me just finish what I was saying earlier, that now this time 22% of the stocks have fallen more than 50%. So that's like one skew. GST, we haven't yet got the announcements. We have only got an indication. And of course, that's, I was just joking with someone that when I used to work for Citibank, we had gone on an offsite and a department talked about how they were working day and night to put some system which had crashed into place. And then at the end of it, they kind of stopped for applause from the bosses. And the boss kind of gave a cold look and said, but you created the mess. So GST to some extent is, could have had a simpler system to start with. But nevertheless, let's see what the exact numbers come out to be. As far as the Jio IPO is concerned, I think there are some valid concerns about how good will it be for the Reliance shareholders, because I haven't seen it properly, but from what I just, I saw, that was that the shareholders don't get anything, and normally holding company discounts are pretty steep in India. So holding companies typically don't get valued for what they are holding to the full extent or anywhere close to the full extent. And Reliance, and on the energy side also, while they've got this cheap crude, Russian crude, again, it has not been fully captured in the profitability of the company as far as I can see. So, there have been some gray areas there, probably that those are the causes for concern as far as that particular stock is concerned. But I think overall, see, any of these tariff announcements and things like that, mostly there is a knee-jerk reaction, just as there is to a geopolitical development. But after a while, the market thinks through who will it impact, how much will it impact, and if that impact is not so significant, then slowly the market finds its equilibrium again, the stock prices find their equilibrium again.
No, absolutely. Devina, just coming back to you, but let me go across to Lata now, who's also with us. GDP numbers have surprised to the upside. Lata, tell us, stronger than what everyone thought?
Stronger is a very weak word. It is an outstanding number, and the market better sit up and notice this number. 7.8 is a number to kill for. Even the best estimate I got and I had taken some 15 estimates, the best estimate was 7%. This is a very good number. Compares with, of course, 6.8% a quarter ago and 6.5% year ago. The GVA is also good. Sometimes, it's just because of indirect taxes and low subsidies that the GDP tends to look good. No such tomfoolery over here. It is at 8.8. Now, I was worrying that whether that would be very low at 8% or something, because the wholesale inflation is very low. But 8.8 is good. The budget estimate is actually for 8.1. Compared to that as well, this 8.8 looks very good. The specific numbers, contributors which are very good are the services sector. Trade, hotels, transport and communication, a very good employment sector. Employment intensive sector has grown at 8.6, very good number. Government has done its bit. Obviously, CapEx and RevX have been good. That's why you have a public administration contribution of 9.8%. Again, if you look at GDP from the expenditure side, both consumption and capital formation are good. Private consumption growing 7%, capital formation growing 7.8%. So the bottom line is it's much better than what the street expected. Street has to take note of this number. I expect all economists to push up their full year numbers.
Wow.
I wonder, and this is Mr. Trump's definition of a quote-unquote dead economy, really? Yeah, that's okay. We'll take it. But Lata, let's talk about the other thing, and that was maybe a little more concerning. This sharp fall in the rupee. I know you've been saying that maybe a gradual decline is something that's actually good for India, but what happened on Friday was rather dramatic.
Yes, it is. Once up until 87.95 thereabouts, it looked like the PSU banks were selling on behalf of RBI and supplying. We saw a goodish bit of demand in the morning from companies as well as from FPIs who have been taking away dollars. But once RBI let go that 88, then it just cascaded to 88.30. And then again, of course, you saw a lot of supplies coming from the Reserve Bank. Clearly, there are concerns. At 87.95 thereabouts, there were a lot of people who are supplying. The exporters are supplying at that point, but then they suddenly become short sellers. Because the rupee has crossed 88, and thereafter you saw them covering the shorts, and then you saw new importers coming in and hedging because they didn't expect 88 to be crossed. Then it becomes a bit self-fulfilling. So now, people will start talking about 89 very easily because that 88 Lakshman Rekha is crossed. The positive in this whole thing is that maybe the Reserve Bank is also letting go by design because it helps your exporters. And also, today we touched a historic low versus the renminbi. Again, I would think this is by design. At 12.32 rupees per yuan, this is the lowest that we have touched. A little bit is actually positive for beating the exporter blues.
Sure.
Okay, all right, Lata, thank you very much for that. So on that note, we have to take a very quick break, come back and some more questions with Devina in just a bit.
Welcome back. You're with us here on Editors Roundtable. Devina is, of course, with us. Devina, so let me ask you. It's been a tough kind of market. 3-4 years we had very good, back-to-back years, and last 1 year we kind of flattened out. And you gave those statistics about market breadth. It felt that bad. I think you put numbers to it. So what's the thing to do? Of course, from a portfolio standpoint, I guess you maintain the course. But would you be a little opportunistic with regards to these tariffs? The 50% tariffs have not really hurt markets in a significant way. Maybe some stocks here, some stocks there. Listed exposure in any case is slightly lower. But any opportunity to be opportunistic? Let me put it that way. Devina.
I think not yet. I mean, definitely there's no good news on the tariffs. I mean, it can only be little less bad news. But as you were saying, that the point is that the sectors that are hurting are significant from the economy or employment point of view, but probably not the listed space point of view, which is things like textiles and gems and jewelry and things like that. And pharma is still in the no man's land, so to speak. It know nothing yet on what will happen there. And while, as I said, we have been overweight auto components and pharma healthcare, we had examined our portfolio, and those are mostly domestic-oriented companies, so not that much export exposure there. So that's partly by design, partly by accident. That's where we are mostly, and so that. As I said, on the listed space and overall for the economy, also of course, we all know the numbers that we are not a very export-oriented economy, and probably in the last 10, 12 years, our exports as a percentage of our economy have fallen. So we are even less outward-oriented. We have faced harder sanctions, proper sanctions in the past after the nuclear blasts. We lived through it. So I don't think any of this is going to be such a big disaster as far as India is concerned. Of course, US is unnecessarily playing hardball, which is something I wrote about yesterday, that China holds the aces. We have nothing really to hold over the US. But as of now, it is not something which is going to change things too much for India, and or for that matter, the investment strategy. So my thing remains the same, that don't be 100% in equity, but whatever is your equity allocation, it's definitely time to be invested, not sitting it out.
So Devina, on that note, tell us, I mean, this is a good time, right? At least stock prices are not running away. Usually fund managers and stock pickers complain that it's impossible to catch, stocks at a reasonable valuation. So you tell us any new ideas, any new thoughts, any companies or areas that you're researching, if not added already to the portfolio. What's new on your mind?
Probably what has got added in the last few rebalances, one has been FMCG has been creeping up, though there have been some changes. So we bought something, sold something else, but FMCG in general has been going up. We've added some specialty chemicals, I think, in the last couple of rebalances. But chemicals is a very large and diverse space, so it depends on exactly which segment you are picking there. As I said, pharma, healthcare, auto components, we have been overweight for a while. So that's broadly it. On the currency also, I mean, we were talking about the difference in the headline and the actual stock movements. On the currency also, one thing which gets missed out very often is how much we have fallen this year versus currencies other than the dollar. So from the beginning of the year, we are down 16-17% versus the euro and the Swiss franc. I think of the order of 10% against the GBP, the pound. And all those currencies are becoming more relevant because a lot of people don't want, for example, to go to the US to study and have to look at other places. And that's where the rupee has actually been declining. So currency is one area where I think the pressure will remain.
Okay, all right, Devina, we will wrap it up on that note. Food for thought there, and more homework for everybody to do with respect to their portfolios, I suppose. Thanks so much for joining in. Good conversation as always. And with that, guys, it's time to call it a week.
Yep.
Okay.
I just want to say one thing. Sajid Chinoy was with us in the morning, right? And I think I thought he made some pretty good points, and that plea that the government over the next, and it should happen in a few days, if not weeks, that the government must, if this 50% is to stay, and who's to say how long this stays, there has to be targeted help. I mean, I spoke, for example, with the Association of Textile Exporters out of Tirupur. 10 lakh people work there. And they're saying, things are already starting to shut down.
Yeah.
Same with gems jewelry. I mean, I think I was talking to Manisha earlier, who tracks the space closely. It's not started happening yet. But places like Surat, etc. The thing is, second derivative, third derivative kind of impact, it's impossible to know. That when we look at that 1% hit to GDP, but it's never that. It's always indirect, etc. It's tough to say. And I thought that's the reason why I thought Sajid, very, very forceful, almost impassioned kind of plea that the government must act.
Yeah.
So maybe in the coming week, that's one thing to track.
Yeah. Absolutely. Well, with that, we wrap up this edition of Editors Roundtable. Thank you very much for watching. Have a great weekend. We'll see you with the markets bright and early on Monday morning.
Hello and welcome to Indianomics. It's a jubilant Indianomics. It's a stunning growth number that we are looking at. India's first quarter GDP growth has come in far higher than expected at 7.8%. The CNBC-TV18 poll indicated an expectation of just 6.8%, and we were still higher than many people on the street. The contribution from government expenses, both capex and revenue expenses, and the services sector is particularly impressive. Let's decode the numbers with our experts. I'm joined by Radhika Rao, the senior economist from DBS Bank, Sakshi Gupta from HDFC Bank, all senior economists, Kanika Pasricha of Union Bank, and Aditi Nair, the chief economist at ICRA. Ladies, what a pleasure that all of us are going to discuss an extremely encouraging and optimistic number that we have. Just a word to our viewers before I come to you. The 7.8% number sometimes gets overstated because there is indirect taxes, very low subsidies and very high indirect taxes compared to the base year makes the GDP look very good. No such tomfoolery over here. The GVA, which is net of the taxes, is also very high at 7.6%. It's a 6-quarter high. The GDP is a 5-quarter high. So, it's abashedly and unadulterated a good number. The other argument we normally have is that nominal GDP at 8.8 is not all that high. It's because inflation is very low. So you are deflating the nominal GDP by a very small 1%. WPI being negative for 2 months has led to the GDP looking very good. Even that argument doesn't wash because from the poll I got, even the nominal GDP came in only at 8%, whereas the actual number is 8.8. So the data has outshone what economists were expecting on every parameter. This is a damn good number. I was expecting that economists will have to revise their forecast lower after they see the first quarter. Now they will revise their number, but mostly higher. Likewise, the RBI, we thought, will be forced to bring down its GDP forecast. It stands at 6.5% higher than the rest of the market. Now it will probably revise it higher. But let me, with that preface, get to our experts. Sakshi, you go first. What surprised you, and will you be revising your numbers?
Right, Lata, I think at the headline level, of course, this number is very, very surprising for all of us. You already spoke about the fact that this growth is being underpinned by a strong services sector growth. But let me just point out that, the deflator for services is in fact very, very low for Q1. It's just about 1.9, which is much lower than what we have seen over the last, I think, 5 to 6 quarters. Be that as it may, I think the biggest surprise for me actually in this data was, 2 numbers. One was agriculture growth, which in my opinion is much lower than what we were anticipating, especially given the fact how, the Rabi crop performed, also that this number is coming on a very low base. So I think 3.7 to me seemed like a low number. On the other hand, I think the manufacturing growth number that we have in this data is 7.7. Which is significantly higher than what we were estimating. And I think it doesn't completely align with, some of the high frequency indicators that, we had tracked for Q1, for instance, IIP growth. We must remember that, a caveat that we must remember that, quarterly numbers are prone to revisions going forward. Be that as it may, you are right that this number does show that economic activity held up in the first quarter. But the problem is that, I think the pain from things like tariffs are yet to be seen, and that was very much expected even before this number came out, right? So my estimate for the year, I'm keeping it unchanged for now at 6.3. I think that we'll have to wait and watch how some of the impact of the 50% tariffs is going to start playing out in the second quarter, and I think consequently the numbers that we see are going to be lower.
Okay, fair point. Actually, exactly the same number surprised me as well. My average for agriculture came in at 5.8%. So this 3.7% is a surprise even versus our poll. Likewise, manufacturing for us had come in at 5.3%. Here at close to 8%, that also is a surprise. So clearly, the numbers have surprised not just you, but all the respondents whom we polled for the CNBC-TV18 poll. Aditi Nair, if you can look at the GDP from the expenditure side, Personal consumption 7%, government consumption 7.4%, and capital formation 7.8%. Any surprises there?
Thank you, Lata. So certainly as far as the expenditure side is concerned, with the investment indicators, particularly government capital expenditure having grown very sharply on a small election curtailed base, we were expecting that GFCF will post a very healthy growth. So no surprises there. And a similar argument for the government part of consumption expenditure and overall government spending. I think I'm just a little bit surprised. If we look at the last 5-6 quarters of the private final consumption expenditure data, the growth all ranges between 6 to 8%. And here, I mean, quarter after quarter, we've been lamenting about the state of consumption, clutching at straws that rural consumption is doing a little better, urban is uneven, it's only being driven by the high-income households. And we have a 7% consumption growth for the private final consumption expenditure in this quarter. So I think, like what Sakshi said, if we look at the sectoral side and compare it with the high frequencies we had and compared with the kind of earnings we've seen, there is a discrepancy. Similarly, within the expenditure side, it's not really gelling with the kind of commentary we keep hearing and the narrative we keep discussing on the consumption side. And discrepancies, again, I think have turned around. There's a large increase in discrepancies between Q1 of FY25 and Q1 of FY26. So that will also have some impact on the underlying expenditure side aggregates. So overall, I would say I totally agree with Sakshi. This number has come in much better than what we expected. But the pain entirely lies ahead.
No, I take your point that, the number has come in higher than expected, and it is not gelling with some of the high-frequency numbers that we see on a daily basis. FMCG companies, complaining that they don't see too much consumption. I mean, we see it all over the place, and therefore the number does surprise us that both consumption and capital goods have come in good. Kanika, the export number, I thought, that one of the reasons why GDP would do well would be that people will advance book exports. But it's only up 6.3%. So it looks like we may, in the second quarter, for July, August, also see a very good export number because it doesn't seem to be pre-booked over here.
So you're right, Lata. Maybe, the number for July and August in terms of exports may throw up some positive surprises. But see, Lata, what is very important is, yes, exports growth. While we all said that the reason, so we were at 7% for this quarter, while the consensus was 6.7. And one of the reasons we were at 7% is the theme, the underlying fundamental framework was that everything is front-loaded in this quarter. Exports, US didn't slip into a recession. Global demand has not slowed as much as feared. And of course, it's front-loading ahead of tariffs. Apart from the favorable base effect because of election quarters, same period last year. But very important point to note is, while exports growth is looking relatively tamed, your imports growth is also held up. So we were looking at percentage point contribution of net exports to GDP. In the last quarter, of course, it was a surplus. So it was +2, +3% percentage point contribution. In this quarter, it becomes a negative. Yes. -1, -2. So there's a switch over as well, which is also weighing on overall growth dynamics. So while we thought exports front loading may help in this quarter, it has not happened. Maybe some impact will be seen in the second quarter, though I would still say September may be a washout. The kind of scary stories we are hearing from the MSME exporters is not so positive to take back home. But very important, in our view, this number is not due to front-loading of exports. The surprise is coming from consumption, as both Sakshi and Aditi pointed out, which is why trade is up 8.5%. Very important. And private consumption is up around from 6% to 7% March to June. That's one. Second, even real estate and financial services have done well. That number at 9.5% is also a very positive surprise, apart from, of course, manufacturing. Thanks.
No, absolutely. That was precisely my point. I would have thought exports would have been very good, but it's a very pale 6.3%, which means something else has fired up since the overall number also is above everyone's expectation. And it is not even because of exports, which means domestic consumption and domestic capital formation has done so well, so much better than the general expectation. Radhika, from your perch, do you think now the global view of India will change? It may perhaps be able to weather the tariff storm better.
Hi, Lata. Certainly, I think this number does come. I think it's more than 1% higher than where the market consensus was, heading into this data. So it does show that even as a starting point, growth was at a much, much stronger level. And what you've seen is that, where you spoke about deflators earlier on, and that is a bit of technicality because an industry breakdown, deflators don't impact as much as services does. So services does is adjusted for deflators because you're getting from volume to value. So from that point of view, there is a bit of a technical push to the headline, but certainly anything above 7% in an environment where dark clouds are gathering, so to speak, is a very strong starting point. Now, looking at some of the breakdown as well, I think you spoke about trade briefly. And what we are seeing in the region as well as in India's case is that growth to exports to the US, for example, have done very well. There's a lot of signs of front loading there. But if you see rest of the world, you don't necessarily see that bump up. And that could be one of the reasons why overall exports, you really don't see that amount of pickup. And coming to the other growth drivers, certainly domestic anchor remains very, very important. I think the global environment, global trade, that's going to get a lot tougher. But I think insofar as consumption holds up, investment by the government spending point of view holds up, that works very well. And I think the other bit on services, we look quite closely at the trade and that breakdown, and that which is labor intensive, that has also grown by upwards of 8%. So certainly a lot of positives in this outcome. And I think, but when you look at the rest of the year, there's going to be two-way forces. There are still positives by way of the GST rationalization that's coming up. And rate cuts hopefully transmission as well. But on the other side, you're going to see the impact of the tariff, I think, which will be more obvious in the second half of the year. I think there's one more quarter where we could see decent, growth and not really affected by tariffs as yet, because this was a late August phenomenon.
Absolutely. And we have a very low base for the second quarter. So I wouldn't be surprised with another 7% plus number going by the momentum that the economy seems to have shown in the first quarter, which has taken everyone by surprise. You touched about rates and taxes. Now will not the Reserve Bank ask itself, why do you need a rate cut for a 7.8% growth economy? Aditi, first to you, Sakshi. You think we should give up rate cut hopes?
I think even before this number, the possibility of further rate cuts from the RBI, given the last meeting, I think were very low. Right. I think that, people were talking about perhaps another 25 basis points if there are, very big downside surprises to growth. So that is one thing. The second thing is, I think that from a monetary policy perspective, I think what is now more important is what happens to activity from here on. Right? Because Q1 is something that has already happened. Yeah. I think that that's backward looking, but monetary policy needs to be forward looking. And if we are going into this year with 50% tariffs, I think one can argue that if the impact of that and the second round impact of that is high, from an investment perspective or from a labor market perspective, there is still space for the central bank to kind of look at rate cuts. But I think that's a question that we only able to answer, by the end of next month, once we have better understanding of what's happening to MSMEs or exporters.
Fair point. Since all of you are talking about the second half likely to be, impacted, let me first get your idea of how you'll see your full year numbers changing after this first quarter number. And then we will come to the other internals of the GDP. Let me start with you, Sakshi. What will your final number be? You remain at 6.3?
Yes, so we are at 6.3. Before this number, we saw a downside risk to our number of about 30 to 40 basis points. But now with this number, I think for now, I'm keeping it unchanged.
Okay. Aditi, your old number and what may be your new number? Full year GDP?
So Lata, I was at 6% and I'm going to argue that I'm going to stay at 6% and I'll tell you why. A lot of the early numbers for July aren't looking that great. So Q1 is done and dusted. Exactly what Sakshi said. Let's not look behind to the momentum from Q1. Government capex from Government of India has contracted in July. That's the number we just got about half an hour, 45 minutes back. With the heavy rainfall, mining and electricity are not likely to give us any support in Q2 either. And with the very heavy rains we've seen recently, in fact, agricultural output, I mean, this is a little bit of a negative. I am surprised that the Q1 number is so low for agriculture, but the last few weeks of the monsoon turnout are not that positive for agriculture in the immediate term either, although heavy rainfall and healthy reservoir levels obviously are very good for H2 for the Rabi crop. So I think, it's my 6% forecast for the full year still requires the economy to grow by 5.5% in the last 3 quarters. And in a scenario of 50% tariffs, that's still a tall ask. So I am not increasing my forecast up from 6%. I'm keeping it over there.
Yeah, but it's important that in spite of the tariffs, it's not going below 6%, which was a fear. Kanika, old and new number. A little quickly, because I have to cover other questions. What are your forecasts?
So, Lata, acknowledging 6.3%, that's what I forecast. If I keep all other numbers for the quarters unchanged, you actually move up to 6.5, 6.6. I'll still keep it unchanged because of the tariff uncertainty.
Okay. So 6.3 is your number. I'm sorry, I'm rushing you. Your new number is, your remains at 6.3.
Yes, thanks.
Right. Radhika, what were you expecting and what are you likely to change it to?
I think my number was at 6.3%. I would have an upward bias to that number. I think because otherwise we need the second half of the year to, optically and technically to be much, much weaker, though there is going to be impact from tariffs and, the other cyclical factors as well. I would lend a bit of an upside surprise to my forecast.
Okay, absolutely. Because, if the current quarter has a base of only 5.6%, so I would expect that this quarter also will show a decent number. Also, if exports are front-loaded to the United States, then, I don't know if the remaining 2 quarters should be as bad as 5%, that we should get an average so low. Let's see what the Reserve Bank says on September 30th. Now let me come to the tax part. Aditi Nair, you were the one who pointed out to me that although the February budget said that the nominal GDP has to grow by 10.1%, because we saw a bump up in last year's nominal GDP, now the asking rate is only 8%. Nominal GDP, and we have delivered 8.8 in the first quarter. So do you think now taxes and other numbers, fiscal deficit issue should not be a problem?
So Lata, I'll just kind of give you my little fiscal summary based on the July numbers that we've seen today. I'm still not worried on the nominal GDP side. Like what I had said earlier, because the FY25 base got bumped up.
We may over-deliver is my point. Yeah. It may do better than what we thought.
Right. So otherwise, we think that the government has leeway of about 50,000 crore to either, absorb lower taxes from GST or from direct taxes, or to provide higher capex, or to provide some sort of package for exporters. So 50,000 crore is the total leeway that we see in the budget as compared to the budget estimates to take care of any of these 4 eventualities. I would rather see some sort of fiscal package for exporters than a rate cut. Given the overall growth inflation forward-looking numbers that we think will turn out to be the case.
Okay. Radhika, would you say that now even a consumption boost is not even needed? That when the GST Council meets, they can actually trim down the kind of consumption boost they need to give. The economy is not at all in a bad shape.
Certainly, I think, but we should also remember that one of the points we spoke about was the kind of gap between what high-frequency numbers look like and what the headline GDP seems to suggest. And I think no one other than states will feel that on the ground. We should remember states are facing 2 other factors. One is this GST rationalization, which I think they will probably have a bigger say when their council meets. And the other one is the tariffs. Now, tariffs, what kind of support to give businesses? While the center government will provide some support, I think states will have to lend their hand, because end of the day, they are the ones who are dealing with the manufacturing firms. We spoke about Tirupur briefly, so that is another one of the examples of textile manufacturers. So they are the ones who also on the ground who need to be providing support.
Yeah.
They have the bandwidth to provide that support. At this point, not many states have that, especially the ones that collect a lot more GST.
Yeah.
So I think it would while it makes it easier going into the GST Council, but I think there will be a big pushback in terms of timeline for this, because again there are multiple other headwinds that the states are facing as well. But at the headline level, of course, the growth, like we already discussed, it looks very, very, very strong.
Yeah, pointing. Actually, we are out of time, but that's a great point to end this conversation. That the fiscal push is needed for exporters, especially in affected areas like Tirupur or the gems and jewelry area of Surat. Radhika Rao, Sakshi Gupta, Kanika Pasricha and Aditi Nair, thank you very much for joining me in this conversation. The takeaway from this is that the nominal GDP at 8.8 is also much higher than what the asking rate is, and therefore we may have a larger nominal GDP at the end of the year, in which case the government may be able to manage a higher fiscal deficit number. It was supposed to be 15.9 lakh crore. They can probably go up to 17 lakh crore and still remain at 4.4% of the GDP. That may give them some elbow room actually to design a fiscal package for the exports, export sector that is faced with the tariffs from the United States. All told, it's an excellent number. The one thing that it takes home is that it reduces chances of a rate cut from the Reserve Bank on September 30th, and it also reduces some kind of pessimism about the economy. It seems to be doing well, but we don't know whether to believe the lead indicators that we see or this GDP number, but this is for the moment an excellent GDP number. On that note, we wrap up on this edition of Indianomics. More news and updates are lined up for you.
Hello and welcome to our special edition of Market Masters. The big talking point is this: will US President Donald Trump's 50% tariff on Indian imports trigger a deeper market correction? Does India's long-term story stay intact despite the hit to exports? To make sense of what this means for investors, I'm joined by a market veteran and one of Dalal Street's most respected voices. Ramesh Damani is with me on the program now. Mr. Damani, great to have you with us here as always. It's a pleasure, sir. So let's just get the ball rolling with just your initial thoughts on how you think about these tariffs. And I must say, you were absolutely bang on when President Trump was elected. You were one of the few voices on Dalal Street who was very circumspect in terms of how this is likely to play out for a country like India. So in that sense, you've got it absolutely right. We're dealing with 50%, which has gone into effect in terms of tariffs. Opening thoughts, Mr. Damani.
Yeah, Prashant, thank you. I think what I said at that time was that the world is changing on its axis, and that's precisely what has happened. But Trump talks about making America great again. And let me give you some examples in history that actually made America great. In the 1940s, when America had beaten Germany and Japan in World War II, what they did was they announced a Marshall Plan to rebuild Germany and Japan of $100 billion. And that's what made America great again, not what imposing tariffs is. Closer to home, Prashant, in 1960s, when India was suffering a famine and was the leader of the so-called non-aligned movement, Indonesia, Egypt, and India were the leaders of the non-aligned movement out there. But India was suffering from a famine. So Kennedy and Johnson administration sent PL 480, Public Law 480, food and grains to India to avert the storage. That's what made America great again. Even later in 70s, when America was stuck in a quagmire with Vietnam a few years ago, what they did was just a few years after the war ended, you could go to the Vietnamese War Memorial, which was basically bashing America, and buy a Coke by paying US dollars. That's what made America great again. So America has this outward, sunny disposition of taking the world along with it. What I'm afraid the president is doing a self-goal that will in the long term hurt America's interests, because it's the old fable in Aesop that you want to kill the goose that lays the golden egg. And I think they're forming some part of strategy of that, not understanding that when the world prospers, America prospers. So I'm somewhat disappointed in the direction and tone of US policy.
You were apprehensive and now you're disappointed. What next, though, is the question. You said, the world kind of the expectation was that it's being turned on its axis. Will it remain turned, Mr. Damani? I mean, is this kind of the new normal, or, it'll snap back in some ways? I'm not talking about a specific thing here, but is this kind of fissure, break permanent in your opinion?
See, I'm not a geopolitics expert, Prashant, but I'll tell you one thing, having played in a schoolyard, that if a bully comes at you, you have to stand up to the bully. Because it's not that he wants a better deal from you or he wants one particular thing. He wants to dominate you. And I don't think we fought for independence to be dominated by an economic power as important and as preeminent as America is. So I think there will be no deal that satisfies him. You look, he renegotiated NAFTA with Canada and Mexico. Then he made a deal with them, and now he's gone back on the deal. So no deal will really satisfy him. He wants dominance. He wants to prove that he is, the most important global historical figure, worthy of the Nobel Prize, worthy of the Nobel Prize in economics also perhaps. And I don't think any deal will satisfy him. I think over time, we will have to forge new relationships. And while I hope the 50% tariff will not last, I think at least for the next 3 to 4 years, America is proving itself to be a fairly unreliable partner, not only internationally, but also in what it's doing to its domestic institutions, whether it's the Federal Reserve or whether it's the Ministry of Health. I think it's proved to be a very unreliable partner. And I think that while India will pay a price for it, but as I go across this country, the last 6 months, I visited various companies across this country, And I come back always sunny and optimistic about the prospects, about the entrepreneurial vision of these businesses. And I'm investing myself in a wide range of businesses, even at the current time. So while there will be some pain for the textile people, for the jewelry people, for the shrimp exporters, and the like, I think it's bearable pain. I think what the government is doing is the right thing. For example, by recalibrating GST, by trying to subsidize a little bit of exports that India is doing. And I think not only will we survive, but God willing, we will thrive.
I think that's absolutely well put. Got to stand up to a bully because he doesn't want this or that. He just basically wants domination. Mr. Damani, for now, right, this, I know it's up in the air, we don't know, and there have been so many instances where actions have been ad hoc. Something has been announced. I'm talking about US and other countries over the last couple of months. Something's been announced, it's been deferred, it's been pushed back. Something has been said, something else has happened. So we don't know. I mean, it's possible that this additional 25% goes off tomorrow. But what is your own sense? You're a keen follower of global news flow, and you read a lot. What is your own sense, Mr. Damani? Because the longer this 50% stays, I mean, the larger the hit. I was talking to Sajid Chinoy of JP Morgan, who was making that exact same point. Sir.
I mean, I can't really speculate as to how long it will stay. But my sense is that it's very slowly getting baked into the economic forecasts of India and America. You know, America doesn't, at this point, really need Indian exports as much as needs India's services. And I think that is a point that we should, look at least. We obviously have a lot of service exports to America, but America has a lot of service exports to India too, in terms of usage of Google, WhatsApp, Facebook, and the like. And, like China, for example, has followed a policy of domestic first. I mean, it's something that I'm sure they're considering, the Mandarins in Delhi are considering that, if you will. I think the only way they said they can get from 50 to 25% is not by buying Russian oil. I'm not sure you want to give up Russia, because at the end of the day, during the 71 crisis, during the recent crisis, they stood by India as a decent friend. So I think we can, I don't know, the geopolitics is a different ball of game. I'm not really conversant with that. But I'm not sure we should abandon Russia altogether. And it's very hard for me to say it because I'm unabashed American admirer. I truly believe America is one of the great countries of moral force of the world. But if Trump is so determined to unmantle 50, 75 years of development of the world, I think we have to look at other options. And I think the world will come up with other options. I'm very confident the next year or two, there will be other options in the world. And America will see its own preeminence decline over a period of time.
Absolutely. I mean, 50%, of course, can't be a permanent rate in that sense. But whether this will be brought lower through negotiation, what's the off-ramp, or organically, right? At some point next year, US consumers will start to hurt as prices go up. And that'll, the midterms. Yeah, sorry, go on.
Yeah, I think you're right, Prashant. What the off-ramp is basically that when inflation strikes up in America, or when the economy does badly ahead of the midterm elections, or, we've been through this as a country. We know in the 70s and 80s, Indians were used to high tariffs and shoddy goods and a low standard of living. I mean, that's the same thing that's going to happen to America. America is such an innovative and competitive economy. Just to give you perspective, Prashant, when I was there as a student in the 80s, it was one of the biggest market for consumer electronics. And yet, even as early as the 1980s, it had no consumer brand that was American. All the electronics, the television sets, the radios, the tape recorders, the VCRs, were all, Japanese or Korean or, Singapore brands. They didn't have a domestic brand left of consumer electronics, because it was an economy that thrived on innovation and moving ahead. So just right now, as it's powering ahead with AI and with data centers and with so many other things, and leaving the other fields behind, I don't think Trump understands that. I think the feeling that he's going to bring back manufacturing to America, in my opinion, is a pipe dream. It's not going to happen. It's just so clear it's not going to happen. And as that reality sinks in after 6 months or 1 year, as the midterm elections rolls around the corner and the president is answerable to voters, I think that will be the off-ramp where he will change it. Right now, he's almost walking on water. Whatever he says is happening. Everyone is falling in line with him, whether it's the Fed Reserve, whether it's the Health Department. I have to believe that at some point, the road will hit the rubber and he will have to recalibrate the policy, because I absolutely refuse to believe that tariffs, inflation, low standards of living, shoddy living are something that Americans will accept willingly.
Absolutely. Mr. Damani, we'll get to markets in just a bit and what they're pricing in and whether more needs to be priced in. You said economic models and forecasts are slowly baking this in. But just one point, I mean, this is also such a critical moment in this the apex technology of our times is artificial intelligence, right? And US is clearly leading and China is close on the heels. And some believe that this is, every technology cycle, of course, in the beginning seems like it's going to completely demolish the older order, but some truly believe this one in a way will, because it's so transformative. Given the 50% tariff is one thing, but it also kind of this, tiff with the US in that sense also hurts us in these ways, right? Technology transfer, integration into that tech value chain, et cetera, et cetera. Are you worried about that, Mr. Damani, at all, if this goes on for a bit longer?
I tell you, the thing that I don't worry about is that we have 1.4 billion consumers, and as much as America may sneer at it, they need those consumers. I think Facebook, WhatsApp, Google, search would be much poorer offerings without the ability to tap into that 1.4 billion Indian consumers, So I think a lot of the language learning models are based on Indian databases. A lot of user cases for AI comes from India. So, I'm not really scared that they would, stop the technology transfer to India. I mean, that would be another example of self-goal that they would be doing. And if not, there'll be plenty of European companies willing to do it, or American companies setting up shop in India to do it. I think at some point there will be a reckoning, high noon for Trump's economic policies. It has perhaps been delayed. I thought it would be earlier than it's been now. I think 6 months into this draconian, I think he would have started feeling the effects. Clearly he has not, because the Dow is making a new high altogether, and the American markets are showing a lot of confidence. But somehow I feel that confidence is a bit misplaced, and maybe this will not be a drip, drip, drip type of bear market, but one fall day, it will be a straw that broke the camel's back. Something will happen that will trigger a fall in the market, and then the reality of how to deal with it will strike them. But I think what is going for India, Prashant, right now, is that we are 1.4 billion consumers strong, a very strongly domestic-focused economy. While there will be damage on the periphery, you cannot ignore that. There will be some damage on the periphery. I think India is well positioned to recover from that, because basically only about 1-2% of our GDP is consisting of US exports. So while it's important, I don't want to undermine the importance of that. I think it's an overcomable problem.
You mentioned markets briefly, Mr. Damani. That's exactly what we're going to focus on. But I have to take a quick commercial break. Stay with us. We're right back with Ramesh Damani on markets and what are they pricing in. Stay tuned. Welcome back. We're in conversation with market veteran Ramesh Damani, who's with us. We've been talking, of course, about the India-US tariff tiff, 50%, what happens to it. And Mr. Damani, of course, so you clearly believe that, businesses here remain vibrant and we've got a large consuming class, which, as I put it, I think last week before last, is our rare earth, if I can use that terminology. I mean, that leverage or whatever you want to call it. Mr. Damani, let's talk about markets. Are markets adequately pricing all of this in right now? I'm talking about the markets here in India, although you alluded to US markets and what they may do. But here in India, what is your sense? Is all of this getting priced in?
I think, on the D-date, the markets were surprised that there was not a rollback. I think the market expectation was that it would be rolled back. It didn't happen, so the market has taken it on the chin for the next few days after that. So I think even as we speak to you, it is kind of pricing that in there. But, the impact is not on the domestic phase economy. The construction company, the telecom companies, the hotel companies. I mean, I don't see why they would go down per se, because that is like throwing the baby out with the bathwater. There are certain export-oriented sectors which are a bit labor-intensive, but not very, very important to the Indian economy. Jewelry, shrimp exports, textiles, which will probably experience a slowdown. But the rest of the economy remains fairly well sheltered from that, because we are a domestic economy, like I've often said, and there's a lot of domestic-facing industry that will continue to do well. Thank you.
Yeah. Okay, fair enough. Markets have been, investors broadly for the last 1 year, Mr. Damani, you would agree. Of course, there are always cases, one-offs and some stocks which do well in any kind of market. But for the first time in the last few years, things have been flattish, Mr. Damani, right? What is your own expectation? I'm not asking for a near-term forecast, but what is your sense? A bunch of people we've spoken to recently have said, and foreigners have been big sellers, although local investors have been even big buyers, but foreign buying does matter. I think as this episode and past episodes also show, for markets to do well. What is your sense, Mr. Damani? Next 2 quarters, 3 quarters, will we make a bit of a bottom? As far as earnings go, will earnings start to perform better on an overall basis? And consequently, what does markets do?
Yeah, it's a question that, of course, perplexes me every day, Prashant. But we've had almost a stellar run since the COVID lows. We've gone up 3-4x on the index level. Individual stocks have obviously done far better out there. So if it remains range bound or sideways for the next years, 18 months, I'm okay with that. I mean, there's no indication yet to suggest that the bull market that began in COVID is over, that it will continue. And markets go through long periods of consolidation before they move up. Having said that, I mean, when I go and visit companies or I go and visit entrepreneurs, I go and visit speakers, understand what they're saying at conferences, I see no reason to be bearish. I see attractive opportunities to invest at valuations I understand and in businesses I believe in over the next few years, and that is both in the listed space and in the private equity space. So, from my end, I remain sanguine. I think it's a good time to invest in great businesses. And that's always been the mantra, rather than invest in any old thing, is find a good business and remain invested in that business. I think if the market consolidates for the next, say, 6 months, 12 months, it's fine by me. I mean, markets are not of the creature that should go up year on year. It happens in the first years of a bull market, then consolidate, and then picks up steam again. So I think we may be at best in a good consolidation phase. I certainly don't think we're in a bearish phase of the market. And I would expect that in some due course, the market will pick up and, challenge the old highs.
Mr. Damani, have you, dramatically shifted your focus to the private equity space, unlisted space in that sense? Many investors in your peer set that we speak to seem to suggest that. You're smiling, but is that correct? And do you think that's a function of valuations? I mean, you want to kind of go back and back to find, better starting points in terms of PE multiples. Go on, sir.
I don't know, Prashant. It's one of those things. Yes, I have done it. I moved a bit more money to private equity. Some of it has worked out pretty well for me.
Yeah.
So I think that kind of reinforces that. So you tend to do more of that if it happened. But I would say as an overall, say if you ask me my percentage, I don't think more than 10% of my portfolio is in private equity right now. But, yes, I have. It used to be like 98% listed equities, 2% private equity. So it's up to 10%. So it is, getting, to be serious amount. But I think some of the early decisions have proved to be correct, or they made me money. So you tend to, do a bit more of what's making you money. And some of the valuations are, a bit stretched in the secondary market, which is fine. But I'm categorically telling you, thumping the table, I find as I visit companies, a lot of opportunities in the secondary markets too. So, I'm happy doing a mix of both.
That's interesting. Mr. Damani, you were bullish on the defense space in a big way. Lots of companies you own. Could you give us a relative sense of your exposure there compared to the peak?
I mean, they have been significantly reduced, but, I just got prices that, I believe were, forecasting, 2-3 years of growth. So I was happy to get rid of some of them. But some of them I've still kept. I mean, so it's not that I've exited all the defense. In fact, I haven't exited any of the defense names broadly. I've kept them. Some of them I've, lightened my position, just took some money off the table, if you will. But I think if you look at some of the public sector stocks in, say, the construction space, or you look at in the rare earth space, I think there are plenty of opportunities even in that sector in those businesses. So we have moved some money from, say, defense into, say, construction, rare earths, that kind of space, yes.
E-governance solutions, right? I mean, I think has been something that you backed, and you've done that in a way in different ways, right? I mean, on the private side as well. Still remain bullish, Mr. Damani?
To be honest, and I'd use this public medium first to explain this point to you, is that I'm not on any public medium other than coming on television. People ascribe a lot of shares to me, which I may or may not own. But having said that, so please don't follow social media. I mean, if I speak on TV, I am not on any other social media. But I have been bullish on this digital public infrastructure. The stock hasn't worked out. It had a pretty sharp fall. But it seems to have found its legs. Some new orders are coming in. The market seems to have bottomed out. So, I remain bullish on that. But I think I clearly probably overpaid for it. I think that was the risk in the stock. But, the opportunity still looks pretty promising. I wish I had done it at a low rate. But, that's the nature of the market.
Specialty chemicals, another area you like, Mr. Damani?
I have bet a few shares. I have a friend who knows that area particularly well. So he's kind of guided me into that area. Having said that, Prashant, I think the more important point I'm trying to make is that I'm not fully invested in the market, but I'm well on my way to being fully invested in the market. But as always, I'm over 85-90% invested in Indian markets. And I continue to look and hunt for opportunities to find good businesses. I'm not getting rattled by the tariffs or by other things. I think the expansion will continue to take place in India. There's continued opportunities to make money in India. And we are happy if, markets consolidate 2 years. I mean, I'm not certainly of the camp that says that if the market doesn't go up 20% this year, it's been a disaster. I mean, that's just not been my experience.
Well, that's very well put. And I think that nicely brings us to a close in this conversation, Mr. Damani. Thank you so much for your time, sir. And it's reassuring. And of course, lots of insights in that conversation as well. We started, of course, with a bigger picture, 30,000 feet. I mean, US and its relations with the world, India, and of course, a bit about the markets towards the end as well. Really appreciate your time here on this episode of Market Masters.
Thank you, Prashant.
Well, that's it from me. Stay tuned. More coming up after a quick commercial break.
Hello, welcome to Global Eye. I'm Parikshit Luthra. India is staring at 50% tariffs on American exports after the additional 25% penalty levy came into force this week. More than 60% of India's exports to the US now face 50% tariffs. Only India and Brazil have been hit with the highest tariff rate of 50%. President Trump has accused India of fueling Moscow's war machine by buying Russian oil. United States has also ramped up the rhetoric. Earlier this week, trade advisor Peter Navarro termed Indian negotiators arrogant and dubbed Russia's Ukraine invasion as Modi's war. Later, in an extensive post on social media, Navarro highlighted that the 50% tariffs are also aimed at cutting off the financial lifeline India has extended to Putin's war machinery. He wrote that before Russia's invasion of Ukraine, Russian oil made up less than 1% of India's imports, and today it accounts for over 30%, amounting to more than 1.5 million barrels a day. Navarro also claiming that all proceeds from buying Russian oil flow into Indian energy companies and directly into Putin's war chest. The big question we're asking today is who is really funding the Ukraine war, and why is the United States targeting India when China and EU are bigger buyers of Russian energy? We will come to that in just a bit, but first, let's listen in to US Treasury Secretary Scott Bessent's critique on India.
President Trump and Prime Minister Modi have very good relationships at that level. And it's not just over the Russian oil. The Indians came in very early after Liberation Day to start negotiating on tariffs, and we still don't have a deal. I thought that we would have a deal in May, June. I thought India could be one of the earlier deals. And they've kind of tapped us along in terms of the negotiations. And then there is also the aspect of the Russian crude purchases, which they've been profiteering on. So there are many levels going on here. I do think India is the world's largest democracy. The U.S. is the world's largest economy. I think at the end of the day, we will come together.
While White House Trade and Manufacturing Advisor Peter Navarro has blamed India for giving a financial lifeline to Putin's war machine by buying Russian oil, statistics show India is not the only buyer of discounted Russian crude. If you look at the top 5 buyers till August this year, then India is not alone. According to data sourced by CNBC-TV18 from Kepler, China is the biggest buyer at 1.8 to 1.9 million barrels per day, followed by India at 1.7 million barrels per day. Turkey at number 3 at 305,000 barrels per day. And then you've got Syria and Brunei. This trend continued in August, with China being the biggest buyer, followed by India, then Turkey at number 3 and Syria at number 4, followed by Azerbaijan. Going forward, in September, China is expected to remain the biggest buyer, followed by India and Russian crude imports. By Turkey will also remain steady. Purchase of Russian oil by India, like in the case of China and Turkey, has led to cost savings. As per Kepler, if the average imports are 1.7 million barrels per day and the average discount is $5 per barrel, then the annual saving would be $3.1 billion, and with higher discounts, the savings could rise to $5 to $7 billion. While Navarro has blamed Indian refiners for flipping black market Russian crude and selling it in the international market for profits, here's what the data shows. India's total exports of oil and petroleum products in 2025 was around 1.3 million barrels per day. Exports were for largely refined products like diesel, jet fuel and naphtha. This was driven by India's strong refining sector and re-export of Russian crude-derived fuels, which other nations do as well. Finally, who are the major buyers of Indian energy exports? It was UAE at 142,000 barrels per day, Singapore at 135,000 barrels per day, US at 80,000 barrels per day, Australia at 80,000, Netherlands at 60,000 barrels per day. To take this discussion forward, we are now joined by Mohan Kumar, former ambassador, and Ashok Malik, partner and chair of the India practice for the Asia Group. Thank you very much for joining us on the program, gentlemen. Ambassador Kumar, let me begin by asking you. We have President Trump's advisor, Peter Navarro, saying that 50% tariffs on Indian imports are now in effect. This isn't just about India's unfair trade. It's about cutting off the financial lifeline India has extended to Putin's war machine. He has also gone on to say India uses our dollars to buy discounted Russian crude. How do you see this argument that the US and Peter Navarro are making to justify these penalty tariffs against India?
Thank you very much for having me on the show. I think, frankly, that the arguments are fallacious at best and outrageous at worst. There is absolutely no basis for this claim. You actually, what India is doing is they're maintaining the price stability of international oil. That's number one. Number two, we are taking care of energy poverty in our country, which is a very serious problem. And last but not least, we are also in compliance with international law. Not very much into the past, the US was actually telling us continue to buy, otherwise price of the oil will shoot up. I think, frankly, it's very hard to think of it as nothing other than a pretext by Peter Navarro. The way things are working in DC now is that if the boss wants a line and there is only one man who is calling the shots, other people are just latching on, piling on to it and giving different reasons as to why the argument is correct and the decision is correct. So frankly, the only argument I would say, Parikshit, frankly, which has a bit of merit, everything else is absolutely outrageous. But the one argument that Peter Navarro makes, and I want to tackle it if you don't mind, is that he says we increased our share of Russian oil from something like 1% to 30% of our crude imports. That, I think, is a valid point. The only argument we can make against it is that we actually have 400 to 500 million people who live in energy poverty, as I call it. There is a symbiotic link between economic poverty and energy poverty, and we have to deal with it. And wherever we get cheap oil prices, we simply have to buy. The argument that we import oil, then refine it, and then export it to make money is a load of rubbish. Because if you look at the statistics of exports of refined petroleum products from India to the world, they have remained constant. So really the only argument is, before the conflict erupted in Ukraine, Russian oil constituted only 1%. Today, it is true that it constitutes 32%, but there is a very, very good reason for it. The Europeans stopped buying Russian oil prices crashed. It was in our interest to buy oil. It was not to profiteer. It was to take care of the energy security of at least 500 million people in India who live in energy poverty.
Right. And as we've shown also on the program earlier, India is not the only buyer of Russian energy. China is the biggest buyer. You've got countries like Turkey as well. Let me go across to Ashok Malik at this point. Mr. Malik, you know, Peter Navarro, and I'm also reading from his thread, he's gone on to say that Indian refiners, with their silent Russian partners, refine and flip the black market oil for big profits on the international market, while Russia pockets hard currency to fund its war on Ukraine. Now, this is unfair against India because, you know, for a very long time, there have been countries which have been buying Indian energy products. Also, there are other nations which buy Russian crude, refine it, and then sell those products as well.
2 points here, Parikshit. Thank you for having me. One needs to recognize that India has fairly modern refineries, as opposed to countries in the West which have refineries of an earlier age. Indian refineries have a very high complexity index, which means they can refine all types of crude, which is why they source crude from across the world, including now Russian crude, which is actually very high sulfur crude, and they do it well. So refining is a strength of India. irrespective of the Ukraine conflict, irrespective of the Russia-Ukraine crisis. And India is a big exporter of refined petroleum, of refined crude products to various countries, including European countries. Second, in terms of hard currency being earned by Russia, by Putin's Russia, thanks to India, quite honestly, Putin's Russia is earning hard currency from a variety of sources. Energy, crude oil and refined oil are being bought by not just Turkey, they're being bought by China, by India, by a number of European countries which have carve-outs. LNG and natural gas is being bought by a variety of European countries. Crude oil refined in India is being sold to European countries and to the US. Uranium is being brought from Russia by the US. 20% of the uranium used in nuclear plants in the US today comes from Russia. Exports to Russia continue. The European Union has officially slashed its exports to Russia, but unofficially, exports to Central Asian countries and the Caucasus countries have ballooned, have surged. And that is now seen as a route for transshipment of exports from Europe, particularly from Germany and Italy, to Russia, which is benefiting Russia and benefiting Europe as well. So why India is being singled out for not breaking any rules, but adhering to an internationally determined price cap and importing crude oil from Russia defeats me. It's completely preposterous and it's not fair at all. It leads me to believe that there's perhaps something else behind this campaign against India. It's not about Russia or about Ukraine or about crude oil at all. It is another form of coercion related to our trade negotiations with the US.
That's an important point. Let me go back to Ambassador Mohan Kumar. Ambassador Mohan Kumar, Peter Navarro has gone on to say that India's big oil lobby has turned the largest democracy in the world into a massive refining hub and oil money laundromat for the Kremlin. Indian refiners buy cheap Russian oil, process it and export fuels to Europe, Africa and Asia, shielded from sanctions under the pretense of neutrality. But the fact is, Indian refiners, the Indian government, we've always followed international law and internationally laid down norms.
Yes, in addition to what Mr. Malik said, I think it was a valid point that, there is a degree of complexity involved. I also made a point earlier, which I'd like to reiterate, which is that our refined petroleum exports have remained more or less consistent. So that argument falls flat, frankly. I don't think it is true at all that we are used as a laundromat. I really believe this is part of pre-negotiation posturing, and it's a way of ratcheting up pressure on India ahead of the trade negotiations, which are continuing. That is really the only reason I can think of. And just to put it in perspective, if you look at bilateral trade between Russia and various countries, and I'm not just talking of oil, but also talking of liquefied natural gas, and other products, the India-Russia trade is about $68.7 billion US. EU-Russia is $78 billion. So actually EU trades more with Russia in dollar terms than India. And yet EU got away with 15% tariff while we are stuck with 50% tariff. China does trade to the extent of $130 billion with Russia. And today, their trade negotiator is in Washington. They are having trade talks, and it is very likely they end up with a tariff which is below India. So frankly, it doesn't make sense. And frankly, it defies logic. So whichever way you look at it, the only argument, as I said earlier, Parikshit, which can be made in good faith is we imported only 1% of our requirements from Russia before the conflict. After the conflict, we have gone up to 32%. As I said, we are doing the world a favor, because if we also started buying oil at higher prices, the price of Brent crude would shoot up, and that would affect everybody, including the United States. Secondly, You cannot ignore the energy security needs of 400 to 500 million people in this country. Everybody cannot pay more for petrol, diesel, and so on. It is an imperative necessity that India fulfills the energy security of its population, which lives below the poverty line.
Right. Ashok Malik, the US officials and Peter Navarro have also gone on to say that India slaps some of the highest tariffs in the world on US products, uses US dollars to buy Russian oil. How would you respond to this? Because we also have to see the US-India partnership in a larger light, in a more long-term light. This is a relationship that both nations have been investing in for over 2 decades.
Look, there are two things here. One, India sells to a lot of countries, sells a lot of goods to a lot of countries. It sells goods and services to the US, to Europe, and so on. The money it makes from those sales, it uses to buy goods from many countries, including the US. So, that is what international trade is about. That is trade 101. You can't say that the money India earns from the US, it spends on Russia. That sort of granularity is simply not possible. That's not how international trade is calibrated. Second, by making this point about India's so-called high tariffs and how India is beggaring the US, this actually gives away the game. The game is really about coercing India to make even greater concessions in its trade negotiations with the US. The Indian trade negotiators have made a very ambitious and a very good offer to the US, which offers deeper tariff cuts for US imports into India, as well as a wider basket of goods to which market access is being made available. Now, obviously, the US wants more, which is fair enough, but it doesn't want more by negotiating at the table. It wants more by using extraneous factors such as this one. And in a sense, Peter Navarro is the silent trade negotiator for the US. That's the only way I can interpret this.
Okay, I'm going to take a short break, but I'll request both Ashok Malik and Ambassador Mohan Kumar to stay with us. We'll be right back. Welcome back. You're watching Global Eye. We're discussing the impact of 50% tariff on Indian products being exported to the United States. And Peter Navarro, White House Trade and Manufacturing Advisor to the President, he has gone on to say that India is fueling Russia's war against Ukraine. Let me get in Ambassador Mohan Kumar at this point. Ambassador Mohan Kumar, Peter Navarro had said that things don't stop here. India continues to buy Russian weapons while demanding that US firms transfer sensitive military technology and build plants in India. This is strategic freeloading. While, yes, we have a dependence on Russian defense sector, we do import a lot of defense products to Russia because there is a long-standing partnership. But at the same time, we have been increasing our imports from US of defense equipments on a year-on-year basis.
So it shows a complete absence of what has happened between India and the United States over the last 25 years. And that is what pains me, frankly. As a longtime Foreign Service officer, I joined the service in 1981 when really our worldview was very different. But following the nuclear tests in 98 and then from 2000 onwards, there has been such a gigantic effort, a monumental effort on the part of people in India and the United States to build this strategic partnership brick by brick. And so if you come today and tell me that, listen, why are you buying Russian weapons and, that's bad and so on, that just betrays a complete lack of what has happened between India and the United States over the last 25 years. Anybody will tell you that in 2000, the defense relationship between India and the US was virtually zero, complete zero. And today, if you take the kind of defense partnership we have, which runs into billions of dollars, I think you will easily see that India has made a good faith effort not to put all its eggs in one basket and try to diversify. Of course, not just with the US, but also with Israel, also with France, and so on. So frankly, what can I say to that point, except that it's a very short-sighted view and it does not take into account the monumental changes that have happened and that have made leaders on both sides say just a year or two ago that this is the most consequential partnership, the most defining partnership for the 21st century. So what do you want me to say? I mean, I think somebody has to look at what has happened to the relationship over the last 10 years, 20 years, and then take the medium to long view. But that is not what is being done. So frankly, Parikshit, my analysis is that there are three reasons why I think the US is behaving the way it is. Number one, President Trump may not be seeing India as a counterweight to China. And that's an important point, because if you stop seeing India as a counterweight to China, then you start treating India very differently. So maybe there is a recalibration going on in President Trump's mind. There are other factors as well, which have nothing to do with trade, but I see that you want to also conclude your show, but I'll stop here.
Yes.
I think I'm
Mohan
merely
Kumar.
saying that you need an appreciation of the relationship to understand better. That's all.
That's true. My final question to Ashok Malik, very quickly, sir, we've run out of time. Peter Navarro has said that if India, the world's largest democracy, wants to be treated like a strategic partner of the US, it needs to act like one. The road to peace in Ukraine runs through New Delhi. If you had to give advice on how to stop the war in Ukraine, what would you say and respond?
Look, I'm not here to solve the Ukraine-Russia conflict. I think to expect India to resolve that problem is a bit rich. Even if India stops buying oil from Russia, the fact is the war will not stop. That oil will then go to China. China will buy it, store it for its own use. It might not export it. It might keep it for its own use. And Mr. Putin and the Russian government will keep making money. That is the blunt truth. So if the war has to be stopped, Mr. Trump is negotiating between President Zelensky and President Putin. He has to find a way. The road to peace does lie through Delhi.
All right. Road to peace in Ukraine doesn't lie through Delhi. Thank you very much, Mr. Malik and Ambassador Mohan Kumar, for joining us on the program. We've completely run out of time. Thank you for watching. Goodbye.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and with me is Ritu Singh. These are the top headlines from the startup space. Elevation Capital has raised $400 million in a new fund which will be dedicated solely towards late-stage investments. Elevation will write $20 to $50 million checks and focus on new age companies that are close to a public market listing. Mukesh Ambani announces the formation of a new AI subsidiary called Reliance Intelligence to bolster its AI offering, signs a joint venture with Facebook's parent Meta. Jio also launches a slew of products, including AI-powered smart glasses, among others. Website design platform Framer has notched a valuation of $2 billion while raising $100 million in its Series D round, led by current investors Meritech and Atomico. The company reached $50 million in annual recurring revenue this year and aims to cross the $100 million threshold next year. Venture capital firm Andreessen Horowitz is joining other major Silicon Valley investors in backing a new $100 million political network that seeks to influence U.S. artificial intelligence policy, deepening the tech industry's involvement in politics under President Donald Trump, said Bloomberg. Elon Musk filed a motion to dismiss the U.S. Securities and Exchange Commission's civil lawsuit that accused him of waiting too long in 2022 to reveal his large stake in social media platform Twitter, later renamed as X. The lawsuit sought to force Musk to pay a civil fine and give up profits that the SEC said were a result of the violations.
Well, those are the headlines that we're tracking for you today on Startup Street. Now, corporate banking has lagged behind retail when it comes to technology, still relying on spreadsheets, RM calls, and fragmented portals. Transbank, which is a fintech infrastructure platform founded in 2022, has just raised $25 million in a Series B round that was led by Bessemer to change just that. The company is building a common operating system for fintechs and institutions to access the banking ecosystem. Its single-window platform lets clients use APIs from multiple banks for seamless onboarding, transactions, and reconciliations. But to discuss what's next for the company, joining us now is the company's CEO and co-founder, Vaibhav Tambe. Vaibhav, thanks very much for your time here on CNBC-TV18. But before we get to that funding, start by telling us a bit about the company. You claim retail banking has seen innovation, but corporate still lags. What makes this the right time and the right financial climate for someone like Transbank to step in?
So thanks for this. And I think what we were getting the request from all our customers during our banking days. So the founders, we all are bankers. Most of the time, they used to ask us for these kind of platforms, especially because the UPI has seen a great outcome in India and globally, right? So we all are transaction bankers, spend 15 plus years ourselves in this particular business, and we understand most of the client requirements well. And so is our team, right? So that actually differentiates us for the building this stack. And of course, the banking partnerships, because we come from the same fraternity.
Vaibhav, in the context of RBI pushing banks to invest more in technology, build internal systems, I wanted to understand what really stops a traditional core banking provider or even a bank themselves from replicating what you're building.
No, banks are extremely excited about building this, but the customer requirement, if you're an enterprise customer, right, be it a lender, be it a real estate developer, or be it, let's say, a media balance, you would require a multi-bank platform, right? You wouldn't really have a single bank catering to all your requirements, especially the large corporate banking guys, right? That's why it's very difficult for banks to build this, because of course one bank, it has to be a network like UPI, right? And that's where we become the differentiated player. And most of the existing big tech vendors in this space have been working on a monolithic stacks, which are again legacy systems. So we come in as a SaaS service provider with a lot of business aspect and a lot of domain expertise into it. So there are two differentiators against the existing incumbents.
Okay, let's get to that funding then. $25 million in Series B. What are the immediate priorities for this capital? Will you look at more tech, talent, or market expansion?
So a couple of things. One, of course, we want to contextualize, the entire, business. For example, if we are serving NBFCs or mutual funds today as a client segment, there are a lot of nuances in that segment. So we want to basically contextualize real estate, pharma, media at some point of time, or maybe let's say FMCG, e-com, right? So we want to hire specific product guys in those areas. And of course, we require to expand our tech team. We actually have a massive amount of requirement on tech sites. And third, of course, would be the geographical expansion, because the stack is required, multiple geographical banking on a single stack, right?
Well, quickly, in terms of financials, you've hit double-digit million-dollar revenues in under 2 years, and you claim capital efficiency and profitability. Could you break down your revenue model for us and where the margins sit at today?
So, being in the pure tech play, we work with approximately 80 to 85% margin on most of the product lines, right? From the revenue perspective, we have a SaaS or platform piece, which is one of the component with which we start the engagement. And then whenever the transactions happen, we have pay per use or per transaction revenue, or maybe sometimes the products are where we have AUM, asset under management linked revenues, which is percentage of, let's say, a particular amount.
So Vaibhav, you have 220 clients and integrations with more than 40 banks, but I wanted to know how diversified the revenue really is. Is it that a few large institutions account for most of it? Or how do you mitigate dependency risk then? And at what pace is this base of clients or even growing?
Yeah, great question. So, good part is because we are, after our Series A, we diversified. Initially, we were quite focused on lenders, and our 70-80%, revenue was coming from NBFCs. And now we are pretty much diversified across corporates, fintech, startups, and then lenders. So right now, good part is none of our customer is more than 5-7% of the overall revenue.
And finally, in terms of expansion plans beyond India into Southeast Asia and Middle East, how do the economics of transaction banking infrastructure differ in those markets compared to what you're doing in India? And what sort of financial benchmarks will you track there?
So, see, good part is if you talk about the segment of transaction banking or the business banking overall space, the 85 to 90% of the problem statement remains the same, right? You need to ensure the liquidity management, supply chain finance, or maybe the corporate net banking channels, reconciliation. So most of the fundamental part of the stack would remain the same. What would change in every market is, of course, the banking ecosystem, how mature the particular banking ecosystem is in that market, as well as how open these banks are to extend the APIs or to extend the information, right? So that's why I think probably being a pure tech play, it's a very it's a very logical step to expand in geographies, and we have seen in the last 6 months we've done some pilots. It's a phenomenal response. See, from unit economics perspective, naturally we would have better margins and better kind of outcome in terms of willingness to pay in those markets. Indian customers are, of course, great customers, and but it's a very competitive market. And of course, we are actually kind of leader in digital payments now, UPI being the story for the globe. But of course, when we expand geographically, the margins would improve.
Well, Vaibhav, that's all the time we had, but thank you so much for joining us here, and we wish you the very best. Thank you.
Moving on, baby care commerce is getting a quick upgrade. Bengaluru-based Pico has raised $3.2 million in seed funding led by Stellaris Venture Partners to build a specialized baby care quick commerce platform. Founded by IIT alumni, Pico aims to solve parents' biggest pain points, catalog fatigue, inconsistent product quality, and long delivery timelines by offering a curated range of baby care products delivered in under 60 minutes with try and buy and instant return options. Now, the fresh capital will be used to expand supply across categories, hire talent, and scale operations starting with Bangalore before piloting in other metros. Joining me now to discuss this further is Chetan Sharma, the co-founder of Pico, and Mayank Jain, principal at Stellaris Venture Partners. Gentlemen, thank you so much for taking time out and being here with us on Startup Street. Chetan, let me start with you. What specific gap in the baby care market are you trying to solve for that doesn't sort of exist already in the e-commerce and offline player space, right? If you could take us through what's on offer and how you plan to spend the funds that you've raised.
So thanks, Andhani, for having us over here. So these are two very different segments. One is e-commerce and another is quick commerce. Currently, the problems which my parents are facing, and especially moms, as you rightly pointed out, that there's a huge catalog fatigue while the need is very value-seeking and utilitarian, whereas the catalog is like 2 to 3 like SKUs, which does not really serve their needs, as well as it's served in a very delayed timeline. Moms, especially in the parenting years, they are very time constrained in the early parenting years, and over there, convenience matters a lot. So we come in over there to provide the right product assortment for the consumer and give convenience. And convenience is not just defined by the under 60 minutes delivery. It is also defined by the try and buy model, because in the baby care segment, it's a very nuanced topic that touch and feel matters a lot. So what your baby is wearing, what products your babies are going to use, until unless you check that, you are not very sure whether you want to use that for your baby or not. So that whole enabling the touch and feel via try and buy and instant return is also the part of the whole convenience bucket. We believe that neither in the e-commerce and neither in the quick commerce, this segment is entirely served properly for all the categories. While the horizontal quick commerce are covering the section like diaper, wipes, and personal care item, but that is hardly around 15 to 20% of the total consumption. The remaining 80% of the consumption, which is your apparel, accessories, shoes, toys, which also needs a very good curation as well as that try and buy, touch and feel kind of thing, is entirely missing in the quick commerce segment. So we come in to fill that particular space where we are trying to provide the entire segment which a baby care market needs, while enabling convenience through under 60 minutes.
Sure.
And buy.
Absolutely. And this promise of 60-minute delivery, right, with try and buy and instant returns, how do you sort of plan to build and sustain the supply chain required for this model? If you could quickly tell us.
Sure. So there's a very interesting point when it comes to the baby care segment, right? The try and buy for a baby is actually not more than 30 seconds, because when let's say a mom receives a product, a parent receives a product, the touch and feel for them is they literally open the packet, they'll touch the cloth, whether it's a right soft fabric, cotton fabric or not, and then they will just size to the shoulder or if it's a top, right? Whereas if you see compared to the adult category, the person would actually wear it, try to assess whether it's the right product for them or not. So that can take anywhere between 10 to 15 minutes for an adult, but for a baby, it's hardly a 30-second process. So if in that 30 seconds or extra 1 to 2 minutes, our delivery partner can wait at the house of our customer, outside out of the customer, it's a win-win for both of us. First, customer gets all that convenience as well as the right assortment delivered at their homes. Whereas for us, it's a very strong unit economics, because the delivery partner does not really need to go back again to take the return, which happens very frequently in the baby care segment.
Right, absolutely. Chetan, we're running out of time, but Mayank, if you could tell us what made you confident that Pico can succeed in a category where traditional e-commerce players have struggled to sort of crack deep penetration?
So, like Chetan was referring to, a large part of the category is apparels and toys. If you look at these two categories, these are predominantly unbranded categories, fragmented, unorganized categories, and very, very offline dominant categories. While e-commerce has a share, but it's not a meaningful share. We think that quick commerce presents an opportunity to provide the reliability, the touch and feel, visual inspection that an offline offers. Also, the instant gratification that offline offers. You go to a shop, you get it, along with the doorstep convenience of e-commerce. So it can marry the best of two worlds and potentially disrupt the categories, specifically the two subcategories I spoke about.
Sure. So you think that it could disrupt these categories. But, Mayank, Chetan, in 30 seconds, if you could tell us, you plan to expand beyond Bengaluru in the next 12 to 18 months, right? Which markets will you prioritize first, and what's your strategy for expansion?
So we'll first try to establish ourselves and get a playbook ready from Bangalore. And then from here, we'll start expanding to the metro cities first.
All right. And Mayank, quick commerce is becoming a crowded space, right? So what makes Pico's positioning in baby care unique from an investor's perspective? And if you would also shed light on some of the other sectors that are looking exciting to you.
So look, at least from our vantage, at the moment, it's not competitive, this category. We don't fully, consider horizontal quick commerce companies as a competition, because this category needs specialization. It has a long tail of inventory. So it needs focus and effort. Sure, over a period of time, given the size of price, we do expect challenger brands to come in. And at least our belief is on the team to win against the challenges that might come down the road.
And any other sectors that are looking exciting for you from an investor's perspective right now?
Absolutely. Even in the quick commerce category, several verticals are very, very interesting, including fresh food, including beauty. And I'm sure there are more interesting categories that as investors we can't imagine. And of course, there's an omni-channel business model that we are quite keen on, and the list goes on.
So some exciting sectors there in this space itself. All right, Chetan and Mayank, we're completely out of time, but thank you so much for joining us on the show today.
Thank you.
Thank you so much.
On that note, it is time for us to head into a short break, but don't go anywhere. Beauty brand Reliance Cosmetics has raised $30 million in its Series C funding round. We put the founder on the hot seat to find out more. Stay tuned. Welcome back. It's still with us on Startup Street. Beauty brand Reliance Cosmetics has raised $30 million in its Series C funding round at a valuation of $200 million. The round was led by Playbook with secondaries from MIDAs, including a mix of primary and secondary investments, with plans to double down on product innovation, offline expansion, and tech-led marketing. Rene Cosmetics is already clocking an ARR of 500 crore rupees and is aiming to hit the 1,000 crore rupee milestone in the next 2 years. Joining me now to talk about the growth playbook and what's next for Rene is Ashutosh Valani, the co-founder of Rene Cosmetics. Ashutosh, thank you so much for taking time out and being here with us on Startup Street. You know, with this $30 million that you've raised at a $200 million valuation, if you could sort of take us through what this fundraise means for Rene at this stage of your journey, and how do you plan to allocate the funds?
Thank you for having me today. I think this is one of the inflection points for the brand where we are now looking to break out. So we really want to use these funds into sort of product development, distribution, and of course, marketing. So those are our three major points that we really look to use these funds into. We also feel to achieve that 1,000 crore in the next 2 years, this will be a very crucial point for us and the use of these funds, of course.
All right, sure. You know, you have grown nearly 3x in the last 18 months, right? So what's driving this pace of growth in such a competitive beauty market? You also have, you know, plans to double your ARR from 500 crore rupees to 1,000 crore rupees in 2 years. So what's sort of the growth playbook here?
I think one of the most underrated your qualities of a team is actually execution. So while you absolutely have to understand the market, the consumer, the product, but you have to implement and execute the strategies at the right time with the right mindset. And I think that is what we have done really well to actually bring this growth around, right? Otherwise, what happens is people normally plan it, but are not able to achieve. And I think this is the difference between the team that we have today, and hence you see the kind of explosive growth in the past few months that we have shown. Hope this will also continue in the future as well.
All right. And you know, Rene is currently present in about 15,000 outlets, and you have said there's a 10x headroom in the offline retail space, right? So how are you planning to crack distribution and scale presence in tier 2 and 3 cities?
10x is actually a very, I would say, conservative number. We think that the uptake here could be 20x from here. India is a much larger market. What we need to do is we just have to identify the stores, open distributors, have feet on ground, and then just start a sort of geographical, strategical sort of distribution in those stores. And I think that's about it. While we do that, we also focus on the marketing so that there is enough brand pull from these particular stores. I think what we have done for the first 15,000 stores, we just have to repeat 10 times. And I think sort of the numbers will come and show for itself.
All right. You know, and Rene has also built a portfolio of about 200 plus SKUs, right? So what's in the pipeline? What new offerings should we be watching out for? If you could also throw some light on the role technology plays in shaping Rene's next phase.
The exciting times ahead. So we have always been the brand who really innovates and sort of experiments and brings the first of its kinds products into the beauty space in India. We are hellbound to do that even in the future, and you will see a lot more sort of innovative products that I'm not at liberty to say today, but you will see in the very near future, probably in the coming few weeks as well. While we plan to do that, we also plan to expand the IPs that we have already created. IPs like Midnight, IPs like Bollywood Filter, Lumi Glow, and so on and so forth, right? So I think that's one of the plays. Apart from that, I think technology we are using to get accurate data analysis, to get product formulations in place. We're also using it to understand of how a consumer is really behaving towards the repeat of the usage of product, right? So we are trying.
We seem to have lost Ashutosh's connection there. We're just trying to, connect him back. But in the meanwhile, I can just fill you in on what Rene Cosmetics has done. They have raised $30 million in a Series C round and is now valued at $200 million. They have a portfolio of over 200 plus SKUs and are currently present in 15,000 outlets. Ashutosh, do we have you? Can you hear me now?
Yes, I can.
Yeah, hi. Yeah, you were talking to us about, your SKUs and how you plan to grow it.
Yeah, so I think what we're planning to do is expand the existing IPs like Bollywood Filter, Lumi Glow, Midnight Kajal that we just have. So we are going to expand that particular portfolio while we use technology into sort of bettering the formulation and also understanding the consumer behavior towards the product ranges, right? So that we can give better products every batch. So I think that's our focus and goal for the very near future.
And if you could sort of quickly tell us, you have also tested waters in the US, UAE and Australia, right? How do you see sort of the global markets contributing to your growth story going forward?
Oh, absolutely. In the next 2-3 years, see, I think UAE is going to be the entry level to GCC. So I think that is going to be a very interesting story for us. But also, there has not been a big India to the world story, right? And we want Rene to become that particular brand that becomes an international calling for beauty. So I think that's why we are also looking at US and Australian markets and to try and be there very strongly. But I think that will come in the next few quarters, probably not very immediately, but probably in the next 4 or 5 quarters.
Sure. So in the next 4 or 5 quarters. All right, Ashutosh, thank you so much for joining us on the show today.
Thank you for having me.
And moving on, it is Friday and it's time to take stock of all the big deals from the startup world. This week saw a total of 15 deals valued at $101 million. Some of the notable deals include banking infra startup Transbank raising $25 million from Bessemer, Arkham Ventures, Fundamentum and others, while RuPay credit card issuer GoKiwi bagged $24 million from Nexus Vertex Ventures, Omidyar Network and Stellaris Venture Partners. Fintech startup CredRite got $10 million from Abler Nordic, Michael and Susan Dell Foundation and Unleash Capital Partners. That's not all. Biofuel Circle will raise $8 million from Spectrum, Impact and others, while sales enabler for wholesalers Wiz Commerce got $8 million from Alpha Wave Global, Bloom Ventures and Peak 15 Partners. According to Venture Intelligence, there have been 599 deals this year worth $5.3 billion. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Well, this is the big story, isn't it? More than 60% of India's exports to the US now face a 50% tariff rate. Only India and Brazil have been hit with the highest tariff rate of 50%, and just hours after the new rates kicked in, top White House officials ramped up the rhetoric against India. Treasury Secretary Scott Bessent was in fact the more measured one. While he said the relationship with India is complicated, he accused New Delhi of, and I quote, tapping the US along in the negotiations. Trade advisor Peter Navarro has termed Indian negotiators, I quote again, as arrogant and has dubbed Russia's Ukraine invasion as, and I quote again, as Modi's war. The Indian stock markets have shown resilience. Till now, the impact of the GDP this year is likely to be less than 1%, but this trade standoff has created trust deficit in the bilateral relationship. Now, Prime Minister Modi separately will be visiting China for the first time in 7 years, and sources say the government could in fact ease some of the stringent rules imposed 5 years ago to facilitate Chinese investments. So there continues to be a re-engagement with China. The Prime Minister is also expected to meet with Vladimir Putin at the SCO summit. Our gang of editors here now to discuss how India can navigate this difficult scenario. Prashant, to you first. And, you know, the reason why we started by highlighting those comments that came in from US officials, and the one that I'm particularly worried about, is the statement from Peter Navarro. And it's not just the absurdity of the statement itself, calling the war Modi's war, which is in itself an absurd statement, but the fact that Navarro is making that statement. I mean, he's as inner coterie to the Trump administration as it gets. And that is what I guess is causing some concern. But what about the market, Prashant? How's the market reading the statements? I mean, the tariff imposition was already factored in because it was a given. There was some element of hope. But, you know, 3 days, that's also been factored in that this is a reality, at least for now. What is the market factoring in or weighing at this point in time?
Shireen, you're absolutely right. I mean, you know, bizarre kind of comments coming through. I'll tell you what, markets are worried at one level. They have been worried for some time because, you know, the fact is that 2 months back, 3 months back, we were, and Scott Besson himself said it, right? It looked like India is going to be, we reached out first, talk started first between India and US, looked like we'd get an early deal, tariffs would be low, we'd get an advantage over some of the ASEAN competitors, and it's completely flipped. We are now the second highest tariffed country. So that worry 100% is there, but there is also, I mean, you know, stock market beings are intrinsically optimistic, you know, by nature. You've got to be, right? I mean, you can't be negative and be in the markets. That's just a fundamental truth. I mean, you can be if you're sort of, you know, short seller of some sort. But the point is,
I was just going to say Hindenburg, but
the realization, you know, the belief is that it will get resolved. I know it sounds, you know, weird saying this on the day, the first day of trading when tariffs have taken effect, etc. But that belief is there. You know, markets also always work on kind of extremes. Okay, now 50% has happened. Ab kya hoga? You know, will 50, can 50 go to 75? Okay, so it goes to 75. I mean, 50 is like a trade embargo for most products which go to the US. So what will another 25% do? So, you know, that often used phrase, can things get better? Worst is priced in. It's like a cliche. But it's also, in a way, you know, at some level true. Of course, things can go wrong, etc. And maybe the only fear is how long will this take for it to get resolved, right? There's an important other factor, Shireen, and I think many have highlighted this. Two sort of, you know, most impacted sectors, textiles and jewelry, right? The labor intensive, etc. This and the season is coming up for both these in the US as well, because festival, Christmas, all the way leading up to Christmas, etc. Indian textile makers especially have already shipped what they would have shipped over the next 3-4 months to avoid the tariff deadlines. I mean, that product has already been shipped. And product which is on the sea and sort of gets to the US before the 17th of September is not, I mean, is exempt from these tariffs. So in that sense, maybe that season is not lost. And can a deal happen between now and over the next 1 month? You know, hopefully that's essentially is what, you know, the bet really is at. No one really knows what will happen, but the belief is it cannot be permanent. I mean, you know, 50% definitely cannot be permanent. And it's seen as back and forth, negotiation, whatever, and that it'll get negotiated lower.
The point is that I think what you said, right? Trump and Navarro are frustrated. They are basically saying that they thought Russia-Ukraine war will be the easiest to stop. They thought India will be the easiest deal to crack. It just goes on to show how bad they are with forecasting. So they have to find another person to do that.
Yeah, Shireen.
No, I just want to bring up that point that Sriram alluded to just now on the Russia-Ukraine war. And I think what worries me also, and we've just been dealing with that news, the attacks on Kyiv that have taken place, and it's been a fairly significant attack that's happened. Now, you know, this is almost 2 weeks from that peace summit that President Trump had orchestrated, had choreographed, and the hope was that, you know, he's going to get all warring sides to the table and so on and so forth. We haven't had any update on that. There's been no update on a meeting between Zelensky and Putin, and Russia, in fact, if anything, has gone on to escalate matters in the past 2 weeks. So my fear is, what is this going to result in as far as President Trump's threat of future action is concerned? Because remember, when he was last asked that, you know, are you going to do anything more? He said, well, let's wait for 2 weeks and then we'll take a call on whether we need to do anything further. So we'll have to just wait to see what whether we're going to be hit with a tweet barrage anytime soon. But that's my worry as well. Yeah, go ahead, Sriram.
So the answer has already come from J.D. Vance. J.D. Vance said that the pressure on India was put to so that as a an additional pressure on Russia. So we were not the target of this pressure, Russia was. So if Russia raises the stakes, then it doesn't matter, like you said, 50 going to 75 or even 100 is immaterial to us, whereas to Russia, the problem for America doesn't get solved. Putin doesn't budge either way. So I think the answer is there is no additional benefit incentive for the US in adding pressure on India after this point.
So, coming back to the point on market...
That certainly would be the hope. Yes, Surabhi, go ahead.
Yeah, absolutely. And it's, if anything, it's gone on to show us that all these grand diplomatic gestures in Washington, which took place just about a week or so back, I mean, they haven't yielded desired results, not even the desired direction, because the bombs are still falling on Kyiv. But on the market point, I completely take what Prashant is saying, that, I mean, eventually markets always rise, and eventually you always move ahead beyond every crisis, and eventually the Nifty will always be higher. But having said that, at the start of January, not many people would have predicted that this is going to be a year of underperformance by India. This is going to be a year of consolidation so far. And even now, I think the only risk is, and this has been the case for the last couple of months, an element of somewhat complacency, perhaps in anticipating how this is going to be, that India will be first off the block.
I think that's what Prashant described as optimism.
Exactly, which is, like he said, markets are eternally optimistic.
Yeah.
We spoke to two market veterans today as well. Again, eternal optimism. But sometimes you have to lace it with a little bit of caution and nuance, I feel, which at times is missing. Because even now, look at the rhetoric. I mean, all the statements that Shireen was alluding to, the rhetoric from the US side hasn't died down. What's happening with, Ukraine and Russia, that hasn't dialed down. And let's forget all this. Let's focus on what we have at hand, the numbers we have at hand, which is earnings. And the earnings season Q1 is telling us it's a soft start. Already most estimates were cut by about 2%. So we started the year with great optimism, 14% earnings growth is returning. Those expectations have been dialed down to now 11-12%. And all hopes are pinned on this festive season. It is such a big make or break season. I can't remember in the last memory, Ramesh, come in on this, that, the GST cut and this festive season is so important to ensure that the market's back doesn't break. Right now, the market's flat. It's not falling, because local money is coming in. There is hope that earnings will revive, and hopefully that thesis actually plays through.
Shireen, I missed out hearing a little bit of what you had to say, but frankly, beyond tariffs, I was reading a couple of notes and all. I think, couple of macro things which is going to be challenging for India in the very near future. We saw that, the gaming has been banned, so that revenue is gone for the center and for the states. We're looking at rationalizing the GST rates. That will further put pressure on lesser revenues, right? So somewhere they'll have to build up on this revenue. And there are only few pockets from where the government can earn some more money. And one of the sector which can be vulnerable now, where there is a question mark now, is the OMCs. We've already seen 10% underperformance on OMC stocks, but now there is a real fear that, this is one sector from where the government will try to take more revenues and compensate for the loss on the gaming side, as well as for the loss on the GST side. So,
but
that is something
OMCs will also lose if India decides to cut down Russian purchases even more.
Yeah, absolutely. So again,
but right now they've been leading the profits. I mean, in the first quarter, it is OMCs all the way, oil and gas.
So that
they've had
windfall is
growth.
over.
Yeah.
So
no, they're still making windfall.
No, I'm saying eventually it has to stop.
The LPG subsidy, they're making a windfall. So if now there is a fuel price cut, and there is a LPG subsidy going forward, which has not been paid for. Again, LPG subsidy is a 12-month installment now, not a one upfront money. So what I'm saying is, this is one sector where there are now question marks, and there is now doubt on how the government is going to fund if they want to maintain the fiscal discipline. There is going to be a bit of a question mark on how they're going to. And again, remember this year. Even the capital gain tax will be much lesser, right? People have not made money. There is no capital gain.
Painful
capital gain tax.
By the way, on capital markets, weekly options. That is the other.
That is
that's the other hit.
STT collections will be lower because volumes overall are lower now.
Barring tariffs, we just have to be a bit mindful on the second half numbers as well, as to where the government is going to raise.
And anyway, income tax collections are going to be lower because of the tax.
But the growth estimates have been corrected very sharply. Right now, estimates are around 8% nominal growth, which I think we alerted about this on CNBC-TV18 Access. For those of you who aren't members yet, you should become. Because this conversation about nominal growth in the market started in the last week and a half. We've been writing about it for more than a month and a half now, that the risk really exists. And at that time, the estimates were close to 10%. Today, it's at 8%. And that would definitely stretch the fisc.
But again, I'll say we should wait and watch as to what comes in the GST.
Correct.
That's going to be a big make or break, at least in the very near.
That's what I wanted to come in on. And this is again like the narrative that we're hearing from people within government, but also people who watch the government closely, are suggesting that this is an opportunity for the government to go all out and bat for reforms. You know, do what you need to do as far as the GST is concerned. That's going to be the next big ticket item. The meeting is on the 3rd and the 4th. Will we finally see a decision as far as that rate rationalization is concerned? You know, forget the revenue impact, and of course, states are worried about that, but some sort of a compensation arrangement will have to be worked out. But that's going to be the next big trigger, so to speak, you know, as far as reforms, what happens on the GST rationalization and how quickly do we move, because we don't want to lose the festive season by postponing now this anticipated GST cut. What else can be done? You know, we brought up that aspect of China. Press Note 3, this was a big one. A lot of the companies in the component space and so on and so forth were saying that, look, let's review Press Note 3. Amitabh Kant, in his conversation with me, has been pushing for that as well. Now we're hearing that the government may, in fact, consider reviewing Press Note 3 to make it easier for Chinese investments and so on and so forth. So I would imagine, and that's the indication coming in from the government, in fact, you know, officials speaking to our colleague Abhimanyu saying that, you know, SOS measures, band-aids at this point in time for textiles and other exporters is a one-off, it's a given, but we now need to think about longer-term reforms that will negate the impact, because, you know, some single-digit benefits are not going to negate the 50% tariff hit. So will this, in fact, push the government to do much more on the reform and ease of doing business agenda like they're doing with GST? I think that's the question, and that's perhaps also the hope that people like Madhu were alluding to, Prashant.
No, absolutely, Shireen. And that point about a lot more apart from GST in terms of simplifying laws and regulations, etc., more structural stuff, but also emergency measures. You know, company after company in the textile space, gems and jewelry, etc., because these are very labor-intensive. Share of value add is much higher. Share of labor employed in these sectors is much higher, and it will not show up in terms of, you know, the listed universe, but it will show up because, I mean, if people lose jobs, and a lot of the workforce in all of this is essentially, in that sense, temporary. I mean, you know, you get orders and you have you have the labor available, which starts to work on it, and they get paid. So if order cancellations happen, and this is the feedback. Today I spoke with the head of the textile apparel export organization, and they said, you know, what has gone to the US in terms of beating the deadline is out, but fresh orders, I mean, there will be an immediate freeze, you know, with these. So that is the thing. So I think
because we don't have the capacity to absorb that 50% tariff hit. I mean, the margins just don't allow you to do that. So, as you pointed out, it is effectively an embargo for a whole host of sectors as far as the US is concerned.
So, like COVID, and this is what a banker also told me, like COVID, you will have to have some immediate measures. And not like, I'm not talking about maybe rate subventions, etc. work, but something which helps immediately, for textiles, like, you know, for the lack of a better phrase, cash in the hand.
So that's what they've done, for example, with cotton today, right? Extended it till December, the import duty cut. That is one. And there is a risk for banks also, because a lot of these are MSME borrowers, right? And their money has to rotate. If they don't get fresh orders in past, loans can't be paid. So there is a risk for banks as well.
Ritu did mention, when we had her on Closing Bell earlier, and she did mention that right now the exposure of the banking system as a whole is very minuscule. So it's not such a big threat. But I want to point out
that's what they always say. Okay, next quarter they will admit to it.
In banking terms, minuscule is 6-7 lakh crores. So it's about 3.5%.
Iron and steel and all of that, which is a problem.
But the point is that, you know, is employment, you know, and the feed through indirect impact, jobs lost, income loss, impact to consumption, lower end, mass market once again, and maybe higher end as well. And of course, eventually credit.
But here, no, I completely take your point, you know, Prashant, on this. But here I want to offer a hopeful, you know, maybe a counter if it can be. Guys, look at auto. And look at what's happening in auto. Look at what R.C. Bhargava, you know, of Maruti, the veteran, has spoken himself because of this GST. And the auto index has been showing that. Last 1 month, Nifty is flat. Auto index is actually up 7%. If auto sales really take off, whether it's two-wheelers or even four-wheelers, smaller cars, then the entire supply chain is a massive supply chain. It could perhaps offset the weakness we'll get from gems and jewelry and from textile.
Frankly, for now, even in the autos, what's going to help is just clean the inventory. There is a massive inventory piled up. So what's going to help the GST rate cuts is just to clean up the inventory very fast. Because right from two-wheelers to four-wheelers, you ask any dealers and they are sitting on huge inventory. So again, you know, from the GST rate cut point of view, I guess the sectors where there is massive inventory, and if there is a GST rate cut, that will help the industry to clean out the inventory, and that's how the cycle will.
But there is a problem in this conversation. I want to sort of one issue I have.
But
I don't know. We can continue.
Cut, apart from the inventory clear up, which I completely take your point, Ramesh. Apart from that, if, for instance, when Bajaj Auto has always been maintaining that the cost of ownership is high, Maruti has been saying that the cost of ownership, especially at the lower level, is high. So 10% reduction in the price, thanks to this GST cut, if that triggers a more sustainable buying cycle, then of course it could be perhaps
The
very,
problem is that right now the bigger problem is Trump. We are asking what
at local remedies because we don't know what to do
exactly
with him.
right. I mean, we have a headache and we are taking pain medicines for the leg. So
no. But Sriram, on that. While I get the point that you're making, but there is only so much that we can do as far as Trump is concerned. I mean, Trump is going to do what Trump is going to do. So we have to try and ensure that we do what we can to spur consumption, to spur growth, and so on and so forth. We've got to be strategic about the moves that we make. We can't be second guessing what Trump may or may not do because there's just no saying what he's going to do.
So my answer is not to to the policymaker, because my point is that the expectation in the market has to be sort of monitored here, right? We need to do some expectation setting, because India cannot, the government cannot concede too much, because from our previous experience in 2016, even if the next president is a Democrat, it's not going to change, right? Biden continued with the tariffs that Trump imposed during his first term. So if you concede too much ground right now, it is forever.
At least you see, Scott Bessent increased his annual tariff revenue intake to $500 billion a year.
From 300 billion.
So the point is, see,
like tax cuts, tariff revenue is addictive.
So there are two things, right? So I think Surabhi said this at the beginning, right? The horizon for a diplomat is much further away than it is for a
disconnect.
That it is for a trader. Right. So the trader
that's what is going to happen. Not only with
the way I think about it, I think markets will be fine. They'll figure out the way they're intelligent beings.
Will figure out the type.
They'll figure out. It's collective.
Over a long period of time, in Manmohan Singh's words.
They'll be, even in the short term.
Even in the short term, because last look, 1 year market's been flat, right?
Exactly.
Otherwise, just last 3-4 years been phenomenal.
I go back again to the very first episode that we did. I mean, we've been going through wars, we've been going through tariff tantrums, and globally the markets have continued to be resilient, and we've seen that play out. So fine, we might be seeing a bout of underperformance at this point in time, but look, while the headlines have been terrible for 2025, the markets have not reflected that at all, whether it's
Nifty
in the US or in
it's all the SIP money.
Or even India.
It's people watching Surabhi's show and investing every day.
$55 billion the feedback from them is still very, very, very strong when you talk to the mutual fund.
Strong, right? I mean, even the last data was strong.
It was phenomenal. Thanks to all the NFOs, they're still finding ways of selling the equity story.
You know who's taking away your SIP money this month? Lollapalooza.
No, I'm not.
10 minutes,
I can't afford 40,000 rupees on a ticket. No, Sriram, that's only for you. But that brings me back to the point that absolutely we're optimistic creatures by nature, and no one can put India down, etc., etc. But I think a little bit of caution perhaps is also warranted.
Expectation setting.
Because it's not played out as easy as was anticipated on the 2nd of April.
Market is not done well now. That's why markets are flat.
Thankfully, the flows are there. We are all based on flows, and thankfully, those at least the mutual fund and other local flows.
See, and
I have been very, very resilient.
To answer the other side of the question, which is what do we communicate to Trump and his team, right? I think the important point is they're missing the woods for the trees. In trying to squeeze, like the last 2 weeks, 3 weeks, the entire focus has been on India. And they are only digging the hole deeper and deeper every day with one statement after another, right?
Yeah.
So now you have cornered yourself into focusing only on India, right? In the meantime, if you see the data for the earnings revisions for the last 3 months, China is the only country, and by a mile, where there are earnings upgrades, 3.7%, whereas every other country, every other emerging economy, even developed economies, the earnings estimates have been cut down, right? So what Trump is doing is essentially strengthening China at the expense of other countries that are potential allies. I think that story needs to be communicated to him more than, because he doesn't understand sovereignty. He doesn't understand, like those are high concepts for him. So.
And also in terms of negotiation.
I don't know whether they're I don't know whether they're high concepts or not, but it's just not a priority, as simple as that at this point in time. But I think what's also, going back to the statements coming in from Navarro, questioning this re-establishment of ties with China, saying, is that really what you want to do? Talking about Russia and using words like, we're cozying up to them and so on and so forth. I think it's going to be important what happens at that SCO summit. The chemistry between Prime Minister Modi, President Xi, and of course Putin, and what the US takes away from that meeting is also going to be important. Will they double down, on the rhetoric and action against India, or in fact, will this get them to pause and say, look, let's not send India into that camp? I think that's going to be an important one to watch as well. But totally out of time, guys. Surbhi, you wanted to make a final word?
No, I mean, Shireen, I was actually tossing it back to you, because if you look at it, you don't know how this logjam will break. Because it seems unlikely right now that we can give back on agriculture, on dairy, and some of these things. And it seems that Mr. Trump wants it all. He wants acknowledgement for preventing a nuclear war. That's what he said.
The point is, will the 50 go if we say no to Russian oil, or will the 50 go only if we agree to saying no to Russian oil as well as signing the deal in the manner in which they want us to sign it? And I think that's really the important question at this point in time. And the Indian side has said, we will not do a deal till the tariff goes. So, we are at an impasse. What is going to break the impasse is the big question at this point in time. But guys, out of time. Surbhi, Prashant, Ramesh, Sriram, thanks very much for joining us. This is the Editor's Playbook. Send us your questions, comments, suggestions. We always like to hear from you. We'll see you again shortly. From all of us here for now, goodbye. Thanks for watching.
Even after spending billions of dollars, we are unable to solve the cybersecurity problem. And one of the reasons for that was that we were always using yesterday's technology to solve today's problem.
So how long did it take to build the computer?
For quantum computer, we took around 1.5 years. The way it was so exciting was when the fridge came. Fridge was from glucose and we did fabricate outside. People were on the truck from the airport, Bangalore airport to office, and we were all waiting in the basement for this to arrive. And that moment, it was unbelievable. Okay, finally we have this here, because we were waiting for 3 years. And the bigger moment will be next few years when we fabricate it here.
And that moment is a couple of years down the line?
No, next year.
Next year.
As long as my data is encrypted using quantum keys, it is unbreakable. Even quantum computer, most powerful quantum computer,
he can't break into you.
Till the time the people don't encrypt it, he can break it. We built India world's first end-to-end SaaS quantum security SaaS platform. I went into US and presented this to few investors there, and they were little not convinced. But after some time, they said, we haven't heard this story anywhere. So that was the moment for me that India has arrived.
The US is far ahead. China is significantly ahead, especially as far as quantum, etc. is concerned. Where does India find itself?
There was an inventor of Wi-Fi. They did all the research. That's Bell Labs. And who became a leader in Wi-Fi is Broadcom. So similarly, it will not be that people who start first, they'll be leaders. IT era is over. Deep tech is where the next generation really has to focus.
You have to build products. India has to move from services.
What are those ingredients that will ensure that we make that transition?
When you're in services, and I spent some time in the service industry, you try to solve somebody else's problem. When you say product mindset is all about looking at the problem.
For the country like us, where we have largest population, I think the services will be one of the sectors. We can't eliminate that. And then the product will be the sector that creates the wealth of the nation. So these two should continue to coexist.
India is accelerating its push in the global quantum race, from building the nation's first superconducting quantum computer to securing critical digital infrastructure with quantum-safe encryption. At the forefront of the deep tech revolution are two Bengaluru-based startups. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Leading the charge in building India's quantum future are QPi AI with its full-stack quantum AI platforms and the country's most powerful 25-qubit system, and QNew Labs with its indigenous quantum communications technology safeguarding defense, government and enterprise networks. Today, we meet the men shaping India's national quantum mission roadmap, from taking quantum computing from lab to the market to ensuring that in the age of AI and quantum, India's data remains not just encrypted but unbreakable. I have with me today Nagendra Nagaraj, the founder and CEO of QPi AI, and Sunil Gupta, the co-founder and CEO of QNew Labs. Gentlemen, many thanks for joining us. To start with, my mind overnight has been on superpositions and quantum cryptography and quantum supremacy, but I want to break this down for our viewers so we really understand what we're talking about. You don't just wake up one morning and say, I want to disrupt quantum computing. I'll start by asking you, Nagendra, how did this come about? I mean, you were working with NVIDIA. You could have continued to do that. What made you want to bet on quantum computing and bet on it in India specifically?
Yes. One of the things I observed early part of my life is, of course, I was very interested in quantum physics. At NVIDIA, there was DeepMind, which was